the major addition of open interest was seen in 23,000. So it looks like that Nifty would want to protect the level of 23,000, but the major buying in the Nifty can return only when it crosses 23,500. That's the reason support 22,930 and resistance is 23,500. Two stocks remain in the band, as some of the stocks that have been saying fresh shorts, those are PV, Fintech, Dixon and all the gas companies.
Thank you so much for that, Sudarshan. But on that note, we're going to slip into a very short break and we'll get to the updates in the world of AI after the break. So stay tuned. Welcome back to Power Breakfast on CNBC TV 18. Now let's move on, and in a surprising turn of events, HDFC Bank's part-time chairman Atanu Chakrabarti resigned from his role yesterday, citing ethical concerns. HDFC Bank CEO Shashidhar Jagdishan spoke to CNBC TV 18. He said that there were some disagreements with Chakrabarti, but the resignation came in as a huge surprise. Listen in.
We had no such indication. My surprise is akin to what the other board members also experienced yesterday when this came as a huge surprise to all of us. So, and actually, most of the board, all the board members, did ask him to specify if at all there are any concerns. He did say that he has none to share with. So we did sort of persuade if he could sort of remove some of the contentious lines. But I guess he felt that was his calling and it's something that is innocuous. So he wanted to keep that as it is. The term is getting over only in October. And I guess probably, as the chairman was mentioning this morning, the process will commence shortly. The members of the board must know that I'm happy to be a candidate for the same. May 21 and October 23, I think two restructurings I have done. I think it's time for another one. It ensures that the leadership team is always enriched and enhanced, and it sort of brings in a lot of energy at the management level. And this is something that obviously I shall be discussing with some of the key members of my leadership team and also the members of the board before I can announce it.
Okay, now let's move on and get to the latest update from the world of tech. And in our new offering, AI Pulse, we have Rachna joining in with us to take us through all of that. Good morning, Rachna.
Well, today's theme in artificial intelligence is contracts and clashes. And I say this after the US Defense Department has moved to cut ties with Anthropic, citing national security risk or supply chain risk, as they called it. Now there is an internal resistance within the Pentagon because some teams now say that the models are stronger than alternatives, which is Anthropic's models. And key systems like Palantir's Maven, which has been key in the whole US-Israel-Iran conflict, are already built on them, which is Anthropic's model. So All of this is making the separation now even more difficult. At the same time, the scale of AI infrastructure is expanding rapidly. NVIDIA will supply Amazon Web Services with 1 million GPUs by 2027, along with networking systems. This is one of the largest AI infrastructure commitments so far and reflects how aggressively hyperscalers are building capacity. But there's a constraint too. Micron says it can currently meet only about 50 to 65% of the demand for both high bandwidth memory chips and the other chips, which are critical for artificial intelligence workloads. And despite a sharp rise in revenue and increased spending, as we reported yesterday, the company now expects tight supply conditions to continue into 2027. On the product side, platforms are starting to consolidate. OpenAI is combining its browser, ChatGPT and Codex into a single desktop platform after criticism that its ecosystem had become too fragmented. So there will be like a super app. CEO Fidji Simo says that when products begin to work, the focus shifts to doubling down and removing distractions, and that's what the focus is now for OpenAI. That pressure is also showing up in the design space. Google has launched Stitch, an AI design agent that can generate interfaces from text, build prototypes, and respond via voice. And these capabilities directly overlap with Figma's core offering. And so the stock is now down about 35% this year. Inside the big tech, operational shifts are also underway. Meta is rolling out AI systems to take over large parts of content moderation. Early data shows that higher detection rates, lower errors, and thousands of scam attempts flagged each day that human teams had missed. With people still involved in high-impact decisions, there is a push to take AI deeper to the industrial economy as well. Jeff Bezos is in talks to raise a $100 billion fund to acquire manufacturing companies and transform them using artificial intelligence. He's targeting sectors like chip making, defense, and aerospace. At the same time, risks around the AI supply chain are becoming more and more visible. A Supermicro board member has been charged in an alleged scheme to smuggle AI servers to China using fake documentation and shell setups, adding a national security dimension to the company's existing scrutiny. And finally, even AI-driven restructuring is not always precise. Block, which had cut nearly 40% of its workforce, has now quietly rehired a small number of employees, some due to errors and others after internal pushback. With no broader reversal of its strategy, right now they've been rehiring, but it's all a very quiet move. So that's all we're picking up from the world of artificial intelligence.
Okay. Thank you so much for that, Rachna. And in some more news updates that have come in this morning, the Supreme Court has dismissed a petition seeking a probe into wildlife import by Vantara, an animal rescue and rehabilitation facility managed by the Reliance Group. The Supreme Court bench noted that the final report of the SIT has been accepted by the court and categorically records that no violation of any domestic or international law was found. The court further observed that once imports have been made with valid permission, they cannot later be treated as illegal merely because objections were raised subsequently. But that's all the time we have on this edition of Power Breakfast. Thank you so much for tuning in. Up next, your Basar Manikar.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. Hello and welcome to Bazaar Morning Call. We are coming to you live from CNBC TV 18 Motilal Oswal studio. I am Reema. With me is Nigel here in the Mumbai studio, and Prashant today joins in from the Noida studio. Hi guys, good morning. I wasn't there yesterday for closing bell, and what happened, right? There was such a brutal sell-off. Benchmark indices plunged 3%. 13 lakh crore got erased from the market capitalization. That said, this morning looks a lot better. Crude prices have eased back. So I guess we can attempt a bit of a recovery today.
Reema, morning, Nigel, morning. And I can tell you the weather here is nippy, it's cold, it's rainy. And I was wondering, last time I was here, it was raining as well. So, I got all summer clothes, and it's cool and chilly here in Delhi. But anyway, I'm here for a day and back in Mumbai tomorrow. But you're absolutely right, Reema. I think... disaster, right? And 700-800 points lower by the end of it yesterday. So let's just quickly take our viewers through a couple of things. Same time yesterday, we were, and we put out the trade setup. We said that maybe the uptrend is over. That is what I said, which is the high was 23,830. We hit 23,830, but could not close above it. News flow was bad. It looked like a quick 900-point rally, and then it was over. I didn't think that we'd get a 700-800 point sell-off from yesterday. And I think that is what we got. The situation this morning is a little better, as you say, right? So prices, imagine waking up this morning to $119 in oil. It would have been bad. It's not. We are $106, $105, $106 odd. And again, something we had highlighted yesterday, which is every time the market, not every time, but it's the second time now, but it is, I was just using an example from the last time oil hit 120, which is on the 9th of March, which is 2 Mondays back. Comments start to come in, which is comments which generally point in the direction of de-escalation. So oil was at 119 last evening, and statement started. This time, it was Israeli Prime Minister Benjamin Netanyahu essentially saying that, they've taken out Iran's capability to enrich uranium, and there is no possibility to produce missiles anymore. Now, the market latched onto it, and it basically is hoping that this means that they've met their objectives, or at least, bulk of the objectives have been met, and this means that the conflict will wind down quicker. There was also another statement. This is from NATO Secretary General Mark Rutte, who essentially said that NATO members are jointly discussing the best approach to restore the Strait of Hormuz route. Now, remember, most countries have said no to President Trump's appeal to help with the Strait. But this came in from NATO with regards to the Strait, which is the chokehold as far as oil is concerned. And I think that is the reason why. The big cue for markets is the $119 to $105, $106 move that we've seen. I think this is what is behind it. Now, U.S. equities were down 1%. They saw almost a near V-shaped recovery, and we ended about 0.25% lower. S&P, by the way, still down below the 200-day moving average. It's the lowest level since late November. Gold and silver, right? It was true yesterday morning. It's true this morning as well. In a risk-offish environment, gold and silver, precious metals do well. But that's not the case. Actually, gold prices hit 4,500 briefly intraday, and then they came back to about just under 4,700, as you can see on your screen. Silver, of course, is the other story. Now, as we track de-escalation, escalation, etc., remember, some damage has already been done. And that damage has to be assessed, estimated. And we got one estimate yesterday. Remember, we were talking about how the world's largest LNG export hub in Qatar was hit by Iranian missiles and in retaliation to them being struck, their gas fields being struck. So Qatar Energy put out a statement yesterday, and this is what they said. Roughly 17% of Qatar's total exports basically have been knocked out. And then they said they will be compelled to declare force majeure on long-term LNG contracts for up to 5 years. So, and there's a lot more stuff in that statement there about the cost of repair, etc., the cost, the lost revenue. And they also talk about not just LNG, right, but LPG and many other products which are going to be in short supply because of what has already happened. So as we look at de-escalation, some damage has already been done. And I think as time goes by, these things take time because information, I mean, this is one statement, but there's been many other hits as well. So I think all this will play out as we go forward. I'll just tie in and sort of close with the levels here. We yesterday could not get past the swing high of 23,830, the day before yesterday, that is. And yesterday, of course, was a complete washout. But we also, there's a swing low, right? The recent low is 22,955. So two ways to look at this. If this market's got to go even lower, it's got to make lower low. It's got to trade under 22,955 consistently. If it does not, I mean, I would imagine that we kind of, begin one more journey slightly upwards, a little bit of bounce there, maybe not all the way to 23,830, but generally in that particular direction. So we'll see how this one goes. GIFT Nifty will give you a quick sense of how we're likely to start, and then we'll sort of pick it up from there. 178, 180 odd points higher on the GIFT Nifty, so back around 23,200. But that range, 22,950 to about 23,830, I mean, it's about 1,000 points, and that's where we find ourselves at. Well, futures and options and the data and the positioning, Nigel, take it away.
Well, that's right, Prashant. The GIFT Nifty suggesting a big gap up. I'll tell you what, we had a flattish opening. It would have been easier to analyze today's day. However, the hope is after the kind of sell-off that we saw yesterday, we'll see some kind of a bounce back in today's trading session. And hopefully, maybe in fact we go home with as much gains that we start off with. Because intraday, there'll be some volatility, there'll be an intraday dip, and hopefully that gets bought into and holds on to. And the hope is coming from the fact that Mr. Netanyahu said that the war against Iran could end a lot faster than people think. So that's one positive. Another positive is the dollar index as well as Brent crude prices. They're softer in comparison to where we left off yesterday. So dollar index has cooled off. Brent crude prices as well has cooled off, though at around $105 per barrel. It's much higher than our comfort level. So you need to keep that in mind. However, we are better off on both these two parameters from where we left off yesterday. The problem is the FI selling. Yesterday, it outweighed the DI buying, and the institutional net sell number was close to 3,700 crores. I'll tell you what, that's the highest we have seen the last couple of months. Which number? This number, the 3,700 crores or thereabouts. Because all of this month, yes, the FIs were selling, but the DIs were able to combat that. Yes, there was a bank holiday as well, and maybe domestic participation was relatively low, and that's why we had such a large number. So you don't want this number, the net institutional number, to be a few thousand crores or thereabouts. What about the FI positioning in the F&O market? Well, it's fairly cautious. In yesterday's trade, they added some short positioning on index futures. The shorts continue to remain at around 86% or thereabouts. On stock futures as well, they added some shorts. While on the option side, they went ahead and they wrote some calls aggressively. So they added shorts on stock futures, and also they wrote calls in yesterday's trading session. The PCR, well, that's holding at around 0.91 or thereabouts, and there was action on both call as well as put side. And we had to pull up two strikes, 23,300 call, 23,000 put. Both of them were fairly active in yesterday's trading session. And just looking at these strikes and looking at the premium out there, it brings us to the levels. So since you're seeing some kind of action at around the 23,300 call, with the premium ballpark around 150 rupees or thereabouts, that's the first resistance mark that you're looking at. Going by the options data, since there was writing being seen at around the 23,000 put, well, this level is important. You don't want this 22,700 mark to get broken on the downside. And there is optimism, at least that Liberation Day low of around 21,700, which was in April 2025. That's going to get protected. That's an extremely strong support. And the hope is that we don't have to visit this mark. So first level of support there. And then, in fact, maybe it opens up that passage to lower levels. The sector to track today and could outperform is the IT sector. Remember, overnight you had Accenture that have gone ahead and upgraded the lower end of their organic growth guidance for FY26. The rupee as well should show some weakness to kickstart trade. So I think the tech index, it's actually been a relative outperformer in this month so far. We'll keep an eye out on that one. That will have to hold one end up. And the onus on Reliance Industries, that's moved up. The Nifty Bank has moved into a bit of a tizzy. So Reliance Industries, that could be the stock to track. It's very close to its 20 DMA, which comes in at around that 1400 odd mark. And then you have the 200 DMA at around 1450. So I'll keep an eye out on this one. Hopefully, we get into this weekend with some optimism and some green.
Thank you very much for that. Accenture share price was up over 4%. After reporting their numbers. But let's get to the equity calls then. It's Lawrence Belanco of CLSA who says that technical conditions across global markets are deteriorating. with the weight of evidence increasingly favoring further downside and the risk of a near-term flush-out event rising. He says both the S&P 500 and the Nasdaq E-mini futures are threatening pivotal support at their respective 200-day moving average and the November 2025 lows. A decisive break below this zone would confirm a 5-month topping out pattern in both indices, adding to the pressure. The US 2-year yield has confirmed a base breakout, driving flattening of the US yield curve. In commodities, he says soft commodities are breaking out, while copper and gold have further slipped below their 50-day moving average, signaling a shift towards corrective consolidation. All right, moving on now. Markets across the globe are attempting a comeback. Even the GIFT Nifty, the implied open, is up 170 odd points. And the reason for that is comments coming in from Israel's Prime Minister, who suggested that the conflict may not drag on much longer. It's helping calm nerves. So just listen in to some comments that we got from Benjamin Netanyahu. He also went on to say that Israel acted alone in regards to the attack on Iranian gas field. Listen in.
I'll say two things. Fact number one, Israel acted alone against the Slawiya gas compound. Fact number two, President Trump asked us to hold off on future attacks, and we're holding out. I want to close these opening remarks with one other fake news, and that is that Israel somehow dragged the U.S. into a conflict with Iran. Does anyone really think that someone can tell President Trump what to do? Come on.
We are acting now not only to destroy the ballistic missiles and the remaining nuclear programs, very little remains, but also to destroy the industries that enabled the production of these programs. And already now, after 20 days, I can tell you, Iran today has no ability to enrich uranium, and it has no ability to produce ballistic missiles. We are continuing to dismantle these capabilities. We will crush them completely, down to dust.
I think that what has to be done is to have alternative routes. Instead of going through the choke points of the Hormuz Straits and the Bab el-Mandeb Straits, in order to have the flow of oil, just have oil pipelines, gas pipelines, going west through the Arabian Peninsula, right up to Israel, right up to our Mediterranean ports, and you've just done away with the choke points for forever. That is definitely possible. So I see that as a real change that will follow this this war. But I also see this war ending a lot faster than people think.
Well, Claudio Galimberti is Chief Economist and Global Director of Market Analysis at Rystad Energy. Claudio, great to have you with us here on the program. Thanks very much for joining us. Now, so 119 back to 105, 106. Is this a temporary peace in oil markets? And will the peace hold, Claudio?
Thank you for inviting me. This is a $64,000 question they used to say here in the States. We really don't know. This is still the fog of war. But of course, what we heard from the president of Israel is that if we are to believe his words, then if we are close to the end of this conflict, then yes, then we can probably be happy with this outcome, and prices will gradually come down. But let's bear in mind one very important thing: there are no alternatives right now to the Strait of Hormuz or the Gulf of Aden. So these are two routes that you need to go through. There's only some partial ways to bypass them, and that's the reason why the market has been so dislocated for the past 3 weeks. So there is still a lot of work that needs to be done, even if the war was to end tomorrow.
Claudio, that point is taken, right? The war, it depends on how long the war drags on, for how long the Strait of Hormuz is shut. But the other part is the damage that's already taken place to some infrastructure.
Right.
Now, the Qatar Energy CEO told Reuters yesterday that it will take 3 to 5 years to repair the damaged facilities. So even if the hostilities end today or end tomorrow, what is your assessment for the loss in gas or a loss in terms of, the overall LNG, LPG, because the facilities have been damaged and it takes time to get them back on stream in full capacity.
Correct. That's absolutely correct. So there has been, first of all, a lot of production shut in already, right? When it comes to oil, 8.5, 8.6 million barrels per day have shut in. To bring them back is going to take weeks. In some cases, it's going to take months. But most of the oil and gas facility, with the big exception for Ras Laffan in Qatar, have not been damaged. Therefore, they will be brought back online in a matter of weeks. So it very much depends for how long they're going to be shut in. So if they are shut in for 2 or 3 months, it's probably going to take 2 to 3 months to bring them back to the pre-war level. When it comes to LNG, Qatar, 17% of their capacity has been bombed. Which means that we are talking about something like 12 million tons that are not hitting the market in the next 3 to 5 years. So the LNG market, which was supposed to be in oversupply starting from next year, is probably going to be in oversupply. It's going to be in a deficit, at least in the short to medium term. So this is a very important structural shift. Let's also not forget one important thing. The port of Yanbu in the Red Sea saw a huge loadings for the past 2 weeks because Saudi Arabia was redirecting its productions on the east to west pipeline, which ends at the port of Yanbu. We didn't see much activity since yesterday, and the reason is that Iran had threatened to retaliate against of course, the bombing of South Pars. So we are still in the very early phases. If we are going to see a normalization and a dwindling down of all the military activity, that's obviously a very good news. But if that is the case, we're still in the very, very early phases.
All right. Hi, Claudio. Good to hear your thoughts. Claudio, our Indian audience would like to know what kind of levels are you working with the case analysis on Brent crude prices. Could you give us a broad range you're looking at? The hope is we don't get past the recent peak of around $120 per barrel mark. What's your take?
So I'm afraid that given the damage we have already seen and given the production shut-ins, we will probably see Brent hovering around 110, 120, even if the war was to end today. And that would be for the next couple of months, because logistically it's going to be very complicated to bring all the flows back to normal. So, and the market is already, specifically in Asia, India is one of the cases. We have already seen a lot of production curtailment. So refining runs have been decreased dramatically, even 3 to 4 million barrels per day, starting with petrochemical. So in this situation, for the next 2 to 3 months, we're going to see high prices. After that, it very much depends on the state of the Strait of Hormuz and all the production. Then that pretty much depends on its flows. But I would say, in order to see the same level of Brent that we saw before the war, therefore between 60 to 70, we probably need to wait until Q4.
All right, got that, Claudio. So even if the war comes to an end, but the impact could last at least a few months, and we should be getting used to elevated crude oil prices. Quickly, before we let you go, a word on aluminium. Overnight that was down close to around 8%. There could be some liquidation of speculative positions. And also we had seen a big run. All of a sudden, from supply constraints, people are suddenly talking about demand destruction. What do you make of the correction we saw in base metal prices? And if you have a broad range on that one?
Well, so the demand destruction is something that happened actually faster than people expected, and the reason is that we are in a case that hasn't happened for so many decades of rationing. So it's really the rationing that's happening in this case, which means that the correction on demand can actually be quite drastic and quite quick. If that is the case, then we may not be in an enormous deficit, which is caused by the 8 million barrels a day that I mentioned earlier. And that's the reason why the volatility in the market is so high, because it's very difficult right now to understand the fundamental. It's very difficult to pinpoint exactly where demand is and will be in the next 3 to 4 weeks, or let alone months, and the same with supply. The OVX, the implied volatility, is still at extremely high level. Very difficult to price right now, very difficult to assign a price. But if we are correct in our assumption, then you would expect to see this level for the next couple of months.
Thank you, Claudio. Thank you very much for joining in. I think the key takeaway is that even if the war ends today, Brent crude prices perhaps will hover around $110, $120 per barrel. Let's tell our viewers then the interactions that we've lined up on the show today. So first up, 8:35, JM Financial's Ajit Kumar will put the spotlight on HDFC banks and the route that we had in HDFC Bank in particular. 9 a.m., Jayesh Mehta of DSP Finance will discuss the recent trends in Forex. 9:20, Trideep Bhattacharya of Edelweiss AMC will be the market master for the day. 9:35, we will discuss the impact of gas supply disruption on the forging space. We have the management of Ramakrishna Forging and ML Forging joining us. Following that, the management of MedPlus will be chatting with us at 9:45. We'll get talking about the FY27 outlook. Towards the end of the show, we'll bring you a discussion around the second-order impact of the West Asia war on the realty space. So stay tuned for that discussion.
Time to slip into a quick break. We've got a lot of stock-specific action track for you. We'll get to that in just a bit in our special Top 10 segment. But let me run you through the list. The ones that will be reacting favorably to news flow will be Samadana Motherson, JSW Cement, Electro Steel Casting, and IG stocks. On the flip side, we'll have Vedanta that could be under some pressure, Hindustan Zinc, Nalco, Muthoot Finance, Manappuram, as well as CSB Bank. They could be under pressure because of the correction we've seen in industrial and precious metals. Take that break, come back, we get into further detail on all of these names. Stay tuned.
Welcome back. We got about 30 minutes to go for a little more to go for the pre-open session to kick off. Let's dive into the stocks that you sort of need to keep on your radar as we open up. And our research team is joining in with exactly that. We're going to start with metals first. Vedanta, Hindustan Zinc, Nalco. Nigel, take it away.
Well, that's right. Talking about diving into stocks, there was a bit of a nosedive overnight in terms of metal prices. Silver was down close to around 6%, hitting the lowest we've seen the last 1 month or so. Aluminium as well was down close to around 8%. That's the sharpest drop I've seen in many, many years. The factors at play, well, stockpiles in China, that's primarily aluminium, shot up about that 1.3 million ton odd mark. Now, that's the highest we've seen since 2020. So till now, everyone was focused that supply will be going out of the system. However, now the fear is regarding the economic impact of the war in Iran and what kind of demand destruction can we see. So the global demand could be impacted, and now it seems, this focus shifted from supply disruption to demand destruction. The Fed chair as well signaled fewer rate cuts. That's what led to some kind of strength in the dollar index, though it's cooled off. And also there was some speculative liquidation of positions. Some of those long positions got liquidated. So put all that together, we did see overnight that aluminium as well as silver in particular were under pressure. So those stocks that benefited when those prices moved up, they could come in for some profit taking. Hopping across to Gaurav though, the surprising one was gold prices. Well, that one in fact did pull back a little bit. Gaurav, your finances would be in focus today. Run us through that.
Well, yes, if you, as you said, metals are under pressure, and if you look at precious metals, they are also under pressure. If you look at yesterday's move, yesterday we saw gold declining almost by 5%. In fact, in the last 1 month, we have seen gold declining almost by 11%. And if you compare it with its all-time high level, it is down almost by 13%. Now, why this is important for gold financiers is that look at Muthoot Finance, Manappuram Finance and CSB. All of these companies have their gold portfolio more than 50% of the portfolio. In fact, Muthoot Finance has 85% of its loan book in gold loans and Manappuram has around 74%. Now, why this can be a concern is that if you look at the tonnage growth, for the last few quarters, we have seen these players actually growing their AUM more than industry and at a very fast pace. But if you look at the tonnage growth, at least for the third quarter, we saw Muthoot Finance actually reported negative increase, actually a decline in the tonnage growth. Manappuram, they reported around 3% growth, while CSB reported flat in terms of tonnages for sequential basis in terms of gold. And at the same time, even if you look at the LTV ratio, all of these companies are maintaining their LTV ratio anywhere around 57 to 65%. Although the regulatory guidance is around 75%, but given that there is a decline in the price of gold, LTV ratio is also likely to go up. Second is that there are concerns around tonnage growth, which can actually cause some harm to these stocks and can act as a headwind. Now, there will be stock-specific tailwinds as well, but for now, gold prices can actually put some pressure on these gold financiers specifically.
Thank you very much for that. I'll watch for the IT stocks because Accenture came out with their Q2 FY26 numbers, and post that, Accenture's share price gained about 4.3%. Now, Q2 numbers were ahead of estimates. Top line growth, $18 billion. The company saw record new bookings of $22.1 billion, a gain of 6% year on year. In terms of the FY26 guidance, in constant currency, the earlier guidance was 3 to 6%. It now stands at 4 to 6%. But this, excludes a 1% hit to the US federal business, which is why you will see some reports talking about, a 1% lower kind of a guidance, a 3 to 5%. On outlook, particularly on AI, the company says that AI is helping the company win market share and create new growth opportunities. But the brokerage verdict on the impact on Indian IT is mixed. Nuvama says numbers are a minor incremental positive for Indian IT. Motilal Oswal says it's a neutral read-through. They say that the client budgets for 2026 are likely to remain unchanged. HSBC say the results offer limited support to revive the broader IT sentiment, though the 4 to 5% appreciation in the rupee supports earnings and valuations today are close to trough levels. So steady set of numbers from Accenture, more positive than negative, but the stocks have gotten battered out of shape. And if there is a rebound that takes place in the market, I suspect IT will be resilient. So got to go with grain for that. But moving on now to Riyash, who's joining in with some other stocks that are in the news today.
Well, good morning. Let's start off with Samvardhana Motherson first. They have inked a $10 million JV with Hellman Worldwide Logistics, which is a leading German third-party and fourth-party logistics player. Now, the JV will be operational in Dubai to offer supply chain solutions to its clients, and this will be incorporated in a ratio of 51 to 49, with 51% being with Samvardhana Motherson. Apart from this, JSW Cement will also be in focus today. They have commissioned a greenfield integrated cement plant in Rajasthan. They have a capacity of 2.5 MTPA for the cement grinding unit of this facility and 3.3 MTPA for the clinkerization unit, and additionally 1 MTPA of cement grinding unit is under construction at the site at this moment. Keep an eye on electrosteel castings today as well. The promoter entity has bought roughly 3.3% stake in the company for 144 crore rupees via an open market purchase on the 18th of March. So positive news flow for all of these stocks expected to open in the green today.
All right, thanks very much for that. That's Ria with some stocks with news flow. Well, let's just go back to commodities, right? And there's a lot happening. Nigel talked to us about metals, but there's oil, and Manisha is joining in with what's top of mind for her. Manisha, morning.
Morning, and thank you for that, Prashant. Well, I'll start with the crude oil prices. We have seen $120 in the overnight markets yet again in a matter of 1 month. It has now declined to 105, but when you look at the Middle East oil premiums, they are trading at a record, and that does impact Indian oil basket as well. Well, a couple of statements, one from U.S. suggesting that there's going to be no ground troop and that the U.S. is looking to remove sanctions on Iran oil is what has led to a bit of an easing into the market. And then we've been talking about Israel talking about refraining attacks on Iran energy facilities. While the crude oil prices seem to be stabilizing in the Asian markets right now, it is the coal prices that you should look at. That is trading at November 2024 highs. This is after Indonesia says that they will prioritize their domestic markets. Remember, Indonesia is the largest exporter of coal, which is power generation coal, and they account for 50% of global supplies as well. A quick one on the metals as well. Aluminum is declined quite sharply. It's trading at a 3-month lows now. Zinc at a 2-month lows. You have copper prices trading at a 3-month lows as well. It has to do with the dollar index strength, weak Chinese demand, hiking inventories, inflation concerns, all of that bothering that space. And so is the case with silver as well. 10% of decline in the overnight markets. Well, for silver, we are off by 35% from its record highs that we saw in the month of January.
Thank you. Manisha, that's the big story, the cool-off that we've seen in crude prices and many other commodities. We will slip into a break. On the other side, JM Financial's Ajit Kumar will be joining in to put the spotlight on banks. We'll also connect with Siddharth Khemka of Motilal Oswal Financial Services for some fundamental stock talk.
Welcome back. You're tuned into Bazaar Morning Call. You're on CNBC TV 18. Well, it's going to be an interesting trading session and hopefully a good one at that. But let's get some analysis going. Sid Kemka of Motilal Oswal Financial Services joins us on the show. Hi, Sid. Good morning. Good to see you in. Well, the big story overnight is metals are getting a little bit nervous after the kind of run that we have seen. Case in point being, aluminium that has seen a very, very sharp run, or even silver. The ones that went up faster are coming down faster now. What's your view on these stocks? I'll tell you why I asked you this. Because even after the correction, both on silver as well as aluminium, no one on the street is factoring in more than $75 per ounce for silver, or even aluminium at more than $3,100 per ton. So what's your take? If the stocks dip, would you look to get in, or do you think things are too volatile?
Good morning. I'm glad to be on the show. I think there has been a sharp rally, and because of the geopolitical concerns and the overall pressure in the market, there is some profit booking that is happening. What you said rightly is that if you look at the earnings estimates as well as the earnings, not all companies would have businesses in the spots, and as and when we progress in the quarters, I think the overall net realizations would only were to improve. So our view on the overall metal pack continues to remain positive. We believe that there is going to be a huge demand supply mismatch over the next few years, driven by the surge in the AI usage, power demand, EVs, which would require a lot of demand for base industrial metals like copper, silver, zinc, aluminium, and hence we believe that there's a multi-year structural story in that. So any correction because of the current markets, I think that would be a big positive, big opportunity for investors to get into names such like you have Nalco on the domestic aluminium side, Hindalco again on the aluminium side, Hindustan Copper. The best pick, I think, would be Vedanta, which is a conglomerate of multiple commodities. You can play zinc, copper, silver, all through Vedanta, and the restructuring that the company is doing, I think that will only unlock value. The cash flows that they're generating, and we have seen heavy debt deleveraging that is happening both at the parentage level, which kind of removes the overhang on the operating company per se. So I think some of these stocks which would figure out predominantly on our preferred list, Vedanta, Nalco, and some of the domestic ferrous companies like JSW Steel and Tata Steel.
Siddharth, hi, morning, Rima here. There's an article in the paper that EQT Partners and ITC Infotech are eyeing Ashok Soota, who owns 44% stake in Happiest Minds. So they're eyeing a part of the promoter's stake. Now, I know we've asked the management, Mr. Ashok Soota himself in the conference call in January again emphatically clarified that he plans to stay on at the helm and make sure that he sees this whole AI transformation play out at the company. But the fact is that he is 80 plus. And every now and then these rumors come up about Ashok Soota's stake being on the block. What are your thoughts?
Hi, Rima. Good morning. So first of all, we don't have coverage on Happiest Minds, so we don't track it very closely. But if you look at some of these tier 2, tier 3 mid-sized IT names, the succession planning has been a key issue. A lot of PE investors have taken over of some of the companies, and I think that's something that could happen going forward. I think, as you said, if the Ashok Soota continues to be at the helm for some more time to see the transition, that will only add to the positive sentiments for the company for the near term. But I think that's overall change in ownership. That would be the long-term positive whenever the new promoter comes in, because that will give the clear visibility to the market in terms of the long-term succession.
Got that. Sid, hi, morning. Good to see you. HDFC Bank was the big story when we started out yesterday, right? Started with in the pre-open 10% lower. By close, I think was down about 4%. And it became increasingly clear as the day went on with that analyst call. Then, of course, we had the opportunity to speak with Mr. Jagdishan. My colleague Ritu conducted that interview. We'll play out snippets of it. it kind of became clear that this was basically about disagreements, personnel, of the personnel kind. People perhaps, agreeing to disagree, and I mean, nothing to do with the core business per se. How would you rate this one now, Sid, HDFC Bank?
Yeah, Prashant. I think if you look at a lot of developments yesterday from morning, when we heard about the abrupt resignation from the chairman and the issues he raised, and then I think the bank did well quickly conducting a con call. I think appointment of KT Mistry for the interim, that assuages a lot of concern. And the clarification that there is no governance, operational or regulatory issues. Even I think RBI has come back and said that the bank's governance record has been pretty good and there are no material concerns as of date. So I think that definitely gives some credence. We believe that the development that has happened yesterday, that definitely dampened investor sentiments and comes at a time when the market is already grappling with a lot of macro uncertainty. However, as I already said, Mr. Mistry's appointment as an interim chairman, the RBI's endorsement of the bank's corporate governance, that definitely gives some credence and some support in the ongoing concern. Going forward, what we believe is the improvement in the core operating performance. That will be critical to the stock's performance, and the interim leadership appointment to provide comfort. That could also lead to some comfort. At the interim, we continue to have a positive view on the stock. We have a target price of about almost 1,000 plus. So I would say that given that there's no operational or business impact as of now, and the CEO continues to be there, Jagdishan, and the core operating business is seeing improvement from the mergers, I think slowly, gradually, the stock should do well.
Whole financier?
Got that. Shashi Jagdishan's interview yesterday with Ritu, of course, is an important one. He clarified a fair bit of things. He said that there were some disagreements with the chairman, the ex-chairman, Atanu Chakrabarti, but the resignation came as a huge surprise. He's happy to be a candidate, he said, for the CEO roles once again as his tenure expires in October this year. Listen in.
We had no such indication. My surprise is akin to what the other board members also experienced yesterday when this came as a huge surprise to all of us. So, and actually, most of all the board members did ask him to specify if at all there are any concerns. He did say that he has none to share with. So we did sort of persuade if he could sort of remove some of the contentious lines. But I guess he felt that was his calling and it's something that is innocuous, so he wanted to keep that as it is. The term is getting over only in October, and I guess probably as the chairman was mentioning this morning, the process will commence shortly. The members of the board must know that I'm happy to be a candidate for the same. May 21 and October 23, I think 2 restructurings I have done. I think it's time for another one. It ensures that the leadership team is always enriched and enhanced, and it sort of brings in a lot of energy at the management level. And this is something that obviously I shall be discussing with some of the key members of my leadership team and also the members of the board before I can announce it.
Okay, and there's more, by the way. You can go online and check out the whole interview, the full interview with Mr. Jagdishan, which happened yesterday evening. Ajit Kumar is BFSI head at JM Financial Institutional Securities. He's with us. Ajit, good morning. Good to have you with us here. Thanks for joining in. Prashant this side. Having heard, and everything has kind of sort of become a little more clearer, right, over the last 24 hours from the first time the story broke. In your interaction with clients, etc., there's still worries, or that message has gone through that, as Mr. Jagdishan said, this perhaps was disagreements and with regard, and as always happened, just that this happened at the top bank in the private bank in the country, or do you think the street perhaps is a little worried?
Yeah. No, good morning, everyone. Thanks for having me. No, you are so absolutely right. There are a few clients, especially on the FII side, who still have some amount of discomfort with what transpired in the last 24 hours. Our senses, especially on HDFC Bank near-term price performance, may remain under pressure as investors would like to have more comfort in management and board after this episode. And even MD and CEO's tenure is up for renewal in October 26. Some bit of uncertainty over there may also put pressure on stock price performance. We have been cautious on HDFC Bank since last few months, though our concerns have been purely on the basis of fundamentals like elevated CD ratio, lower growth compared to sector, and margin pressure. But currently, on the valuation side, it is trading at an attractive valuation of 1.5 times FY28 adjusted book value per share, which is 1.25 standard deviation below historical mean. While the valuations remain attractive for HDFC Bank, and given the quality franchisee, I believe sooner or later investors will come back. But in the near term, this fiasco will basically implies that a range-bound stock price outcome in the near future.
Got that. What about the entire PSU versus private sector banks? Now, PSUs have done very well, but do you think can they continue to outperform private sector banks, or it's time now to look at the entire basket? There's HDFC Bank, but there's also ICICI, Kotak, Axis.
Yeah. No, so in lending financials, which includes private banks, PSUs, and NBFCs, we find deep value in large private sector banks after the recent correction, as valuation has become quite attractive. Most of the large private banks are trading at 40 to 50% discount to their respective historical mean. On the positive side, your latest system credit growth in February 26 has been approximately 15% YOY, which is highest since July 24, which along with NIMs bottoming out and benign asset quality trends means earnings growth should pick up for private banks in FY27. We prefer private banks over PSU banks at this particular point of time, as we believe that PSU banks will find it hard to maintain their 1% ROA as yield goes up and non-core income tapers off. For PSU banks specifically, the positive is their liquidity situation is better due to low CD ratio and high LCR, which can help them in sustaining margin in next 1 to 2 quarters. But after that, it is going to be very difficult. Their non-core income, which includes your treasury income, recoveries, etc., form 35 to 40% of their PBT, or 35 to 40 basis point of average asset on aggregate basis. So as this non-core income streams taper off, it will be very difficult to be aggressive in terms of pricing and gaining market share. So this market share gain which has been done by PSUs over private, maybe it can continue for 1 or 2 quarters more. But my sense is after 2 quarters down the line, this will stabilize. So they will find it difficult to maintain 1% ROA while giving high teen loan growth both in FY27. That is our assessment of the situation, and that's why we believe that large private sector banks are the one where deep value is there over PSU banks, and NBFCs comes at the last.
What's your pecking order in the large private sector banks?
So we continue to like ICICI Bank. ICICI Bank continues to be our top pick in the entire sector, including private PSUs and NBFCs. From all the angles, the earnings risk to ICICI Bank is quite lower. There is no leadership issues as such because the MD and CEO has got the renewal just recently. And even the third-party product guideline, which came out, from the RBI, few months back, in that guideline as well, ICICI Bank is relatively less impacted because they have lower dependence on, this fee income which is coming from the third party. So from all the angles, ICICI Bank looks, much better shape, and even the valuations are quite attractive.
That's your top bet. But just closing this conversation from where we started, HDFC Bank. You said there are a few clients on FI side who have some concerns on HDFC Bank. Can you elaborate a little bit more on them? At what point will those FIIs who have concerns turn constructive on HDFC Bank?
Yeah. So even before to what transpired in last 24 hours, HDFC Bank, if you see, there has been a little bit of struggle in terms of the performance in the last couple of years because of this merger. After the merger, your CD ratio went up to 98, 99%, which basically meant that you either have to sacrifice on the loan growth side or you will have to sacrifice on the margin side. So in terms of number, there were a little bit of worries, and that is why you would have seen, HDFC Bank, underperforming massively in last, let's say, couple of years. So anyway, FIIs were kind of little bit, not happy with the, numbers. And what transpired in the last 24 hours is completely unfortunate. Ideally speaking, this should not have happened. I think most of the concerns are what happened behind the doors, which we are not privy to. What prompted Mr. Atanu Chakravarti to resign? What are the concerns that he was having? So those are the things which the clients wants to know. Those are the things on which they want more clarity.
Okay. All right. Thanks a lot, Ajit, for joining in and giving us your view on the sector. Wishing you a good day ahead, and we look forward to chatting up with you rather soon. So as you said, at current reckoning, post the recent correction, prefers private in comparison to the PSU banks. So the PSU banks have outperformed. For them to, maintain that 1% ROA will be a little bit challenging. Well, time to slip in a short break. You come back, we'll focus on some volume buzzers. We'll also connect with our technical experts. Stay tuned. Welcome back. Yesterday was a slam dunk day, but today hope is that we see some kind of a bounce back. But let's focus on yesterday's trade first. There were some big volume buzzers in trade. Some of them saw delivery as well. Harmas joins us as always to break it down for us. Harmas?
Good morning, Nigel, and of course can't not talk about HDFC Bank as the stock in the spotlight all through yesterday, and of course the most traded stock on the market yesterday by a distance, the biggest single day drop since June of 2024. The volumes were the highest since November of that year itself, and over 17 crore shares were traded yesterday. 3.4 crore is the average volume, and despite these high volumes, 58% of those shares were marked for delivery, and almost 10 crore shares were there for delivery compared to a 20-day average of just around 2 crore shares. And the trading volumes yesterday were close to around 14,000 crore rupees, and that is almost 6x of the second most traded stock on the Nifty 500 yesterday, which was Adani Total Gas. And despite so much of heightened activity, the HDFC Bank was not the biggest loser on the Nifty. It was Shriram Finance, and Shriram Finance also saw its biggest single day fall since June of 2024. The volumes on Thursday were triple that of Wednesday. Almost 1.2 crore shares were traded yesterday. The 20-day average of around 60 62 lakh shares, and there has been a pickup in trading activity in Shriram Finance in the month of March. The average volumes in March have been close to 85 lakh shares. Compare that to February, where it was only 50 lakh shares, and in January, where it was only 60 lakh shares. So there has been an increase in trading activity in Shriram Finance. The volumes yesterday were the third highest in the month of March. 60% of those shares were marked for delivery, which is around 70 lakh shares compared to a 20-day average of around 34 lakh shares. And the stock, after making a peak after this MUFG deal, is now down around 15% from those levels. And the other one that continued to be in the spotlight yesterday was HPCL. The stock also saw its biggest single day fall since October of 2024, has declined almost 15% this week so far. The volumes on Thursday were the highest since May of last year. 2.5 crore shares were traded yesterday, the 20-day average of close to 80 lakh shares, and more than 1 crore shares were marked for delivery only the second time in this year, and more than 1.1 crore shares were marked for delivery, 20-day average of around 40 lakh shares. And the stock in the month of March itself is down around 26%, has slumped to a 52-week low.
Okay, thank you very much. For that, we will slip into a very short break. We'll come back and get the pre-opening rates. We'll also be joined by Jayesh Mehta of DSP Finance to discuss the recent trends in Forex.
Welcome back. In a few minutes, we'll be getting the pre-opened rates, and we're hoping for a better session. But let's get a couple of individual stock queries out of the way before we let Sid go. Sid, tell us about the EMS companies. You know, some of them, like say a PG Electroplast, they announced a part shutdown. But some of them are also working on alternatives. It could come at a higher cost, but it at least helped them restart the plants. Any view on these EMS companies? You know, they were the toast. People really loved these stocks 2 years ago. And then they got smashed out of shape. What's your take?
Yeah, I think, Nigel, I think there are multiple factors that came in play, and to top it all, the fuel availability that is kind of playing the spoil sport for the EMS companies in the recent past. I think the slowdown in growth, that has been a big factor for some of these companies like Keynes, Dixon and PG Electroplast, but some of the other ones have been reporting strong growth, particularly if you look at a Sirma, SGS or an Amber. And we believe that the current correction is a good opportunity for people looking into these quality names more from a long-term perspective, where the growth continues to remain strong and valuations have come down. And I think the temporary disruption can only give us an opportunity to add to some of these structural themes. Say, for example, Sirma, we've seen that is benefiting from a structural shift in business mix towards high margin segments such as automotive, industrial, railways, alongside the rising exports contribution. The company has been focusing on the higher complex manufacturing, which is improving its margins as well as overall growth. So looking at the strong order book, higher export mix, plus entry into the PCB manufacturing, we are expecting a revenue CAGR of almost 30%, net profit CAGR of almost 45%, and even at current valuations, if you look at it's trading at about roughly 30 times on FY27 basis for an earnings growth of about 45% plus. We believe that's a good stock to look at in the current market with a target price of 1,000 that we have from a one-year perspective on Sirma.
Okay, thank you very much for that, for joining in. Let's talk about the market technicals. It's been such a volatile week for the market. So Monday to Wednesday, we had a very sharp rebound of more than 600 points. Okay, before that, by the way, the rupee has opened at a new record low of 92.89 against the dollar. Remember, yesterday, the currency markets were shut on account of Gudi Padwa. So we're comparing it to Wednesday's closing level. And the rupee has opened out weaker this morning, down 29 paise, and it's a fresh record low. And very quickly, we're inching towards the 93 mark. 92.92 against the dollar rupee rate. That is the opening rate, and it is a fresh record. Let's see whether the RBI comes in and tries to protect the level, or just eases out some sort of the volatility. In moments from now, we will also chat with Jayesh Mehta. He is a prominent voice on everything to do with currency, macros, RBI interventions. So we'll try and understand with him what the way forward for the rupee is and what's happening in the dealing rooms. But for now, let's talk about the market technicals. As I was saying, it's been a volatile week. So Monday to Wednesday, markets were rallying. They rebounded nearly 626 points. And all that got undone yesterday when the markets declined 775 points. This morning, we've got the pre-open rate, and that is a measured positive start. So up nearly 50, 60, 70 points, settling in. So a little bit of a positive buy. Shrikant Chauhan of Kotak Securities, Sudeep Shah of SBI Securities are now joining in on the show. Thank you very much for joining in. Shrikant, starting with you. Yesterday, the Nifty made a new low of 22,930. Are you getting a sense there is a double bottom in place and therefore the bias is positive if that level holds?
Good morning, Rima. Good morning, everyone. So for Nifty, our view is that it is going to remain under pressure. The way there was sell-off in yesterday's trading session, it is very clear that we can expect further more weakness. And yesterday's, yes, because of the expiry, we saw some recovery towards the end. But this is not the final bottom that we are expecting. In fact, further more weakness in the near term. And on the higher side, in case if there is any pullback, then close to 23,300, 23,400 sort of levels, we are expecting one more round of maybe liquidation of long positions. So broadly, we are of the view that market is going to remain in a broader range of 23,500 and in the worst case scenario, 22,500 on the downside. The major support for the Nifty is between the range of 22,700 and 22,500. So in case if we see the market is dropping to those levels, there certainly we should look for taking some long bets. But at these levels, we need to be careful. And in fact, we should look for reducing some long positions.
Okay, all right. Sounding a little bit cautious. Shrikant, got that. Sudeep, let's get your view into it. The optimist will say that hopefully the comments coming in from Israel as well as the United States overnight will be heartening to some extent, and hopefully there is some de-escalation. That's the hope, but we've been riding on that hope for a couple of weeks. Yesterday was a brutal trading session. What are the chances we defend the recent lows, and would you look to play a pullback?
Good morning, Nigel. Nigel, I feel it will be too early to call this as a stable pullback or expecting a pullback right now, because these war situations, as well as the way comments have been coming from Israel and US, they are not. It's just too volatile, and a lot of things are happening too fast on both sides. So rather than relying on just the comments, I guess the next 2-3 days, how the actual scenario pans out is very important. And going into the weekend, that would be more important, because whatever has happened in the last 2-3 months has intensified on the weekends, causing a gap down opening or extreme gap opening on Mondays. So my sense is that it will be better to go light. 23,300, 23,350 will be that stiff resistance, and I agree with Shrikant that yes, that zone will be a very important resistance, and unless and until that is crossed and indices give a close above that, aggressive long positions or those kind of long bets should be avoided as of now. 22,700, 22,750 for me is an important support. And indices, I feel for the day could be choppy, could be volatile, and could trade between this 22,750, 22,800 and 23,250 mark.
Okay, got it. I mean, I think 100 points higher, right, is where we are finally settling in at the end of the pre-open. Not the end. I mean, I think 2 minutes more to go for the pre-open to end. But Shrikant, let's get your stocks out of the way. What would you want to trade?
Good morning, Prashant. I think, see, the way FIs are selling into the market, bank stocks are going to remain under pressure. That's the view. And Bank Nifty is also quoting at its crucial support level of 53,500, 600, above which the Bank Nifty has spent almost 8-9 months. So below this, we can expect some more weakness in those banks where there is like established weakness, like IndusInd Bank, IDFC First. There we are expecting further more weakness. So from here, IDFC First Bank can fall to the levels of maybe 60 or 57 in the near term. For IndusInd Bank, there also we have view that the stock can fall to the levels of 770, 775 in the near term. And the way now there are like some statements and the way crude has fallen from its high, we can expect some pullback in auto companies. In that, TVS Motor looks good. There we are expecting further more activity, and the stock can move towards the levels of 3800, 3850 in the near term. So Mahindra & Mahindra as well as TVS Motor should be on the watch list if there is any pullback in the market.
Sudeep, what about you? What are your stocks?
Good morning, Prashant. Prashant, the one buy and one sell. So the stock which is in buy is TD Power System, a power sector stock. So here what we are seeing is the short to medium term trend is quite positive on the weekly charts. Also, it is showing a decent bottom formation post that correction from higher levels. So what we feel is here the stock can be bought with a stop loss of 815 for a target of 865, 875. There's a one sell here, which is Godrej Properties. So we've seen real estate stocks getting hit, and the severe selling pressure has been witnessed in the last few weeks. So yesterday the stock has broken its important support zone, and around 1565, where the pre-open is showing at 1565, as well as highs closer to 1580, this can be sold. The stop loss would be 1600. The targets on the downside would be 1520 and 1500.
Thanks very much, Sudeep and Shrikant, for that. Appreciate it. Well, I think the other big market, of course, which was shut yesterday here onshore was the rupee. And this morning, of course, the dollar rupee is starting closer to 93. Jayesh Mehta is Vice Chairman and CEO at DSP Finance, someone who spent a lifetime in treasury markets and tracking bonds, the entire forex ecosystem. Jayesh bhai, good morning. Good to have you with us here. So, there are two things, right? One is just the dollar demand from the BOP situation, and the add to it your pet peeve, which is for some time been this large FII selling, which has kind of come through. The RBI intervening and kind of sort of, which means that the depreciation is happening, but it's happening very, very slowly. So very little dollar coming in from exporters, etc. in such a situation, right? Because inevitably, maybe the thinking is this goes higher. What's your sense, Jayeshbhai, to start this off?
No, very true. That exporters, as you said, like they are very, 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 not at all keen to sell any of that. So they typically kind of sell it in the spot. So that's only when they need to actually convert. Otherwise, they are not really keen seller. And that's even before this whole thing happened and the oil crude went up beyond 100, right? We had dollar depreciation continuously happening because of the flows out. And this itself is also creating more pressure. And now, if you look at, okay, we may have top line $700 billion reserves and all that, but your liquid reserves is maybe 450, 400, 500, whatever that number is, plus your forward, less your forwards. So to that extent, you can't really go aggressive because you never know, right? Like yesterday, we saw crude going up dramatically. If this thing escalate, you need to have that buffer, particularly in this kind of thing. So RBI will intervene, but I don't think RBI will intervene in big way. I think they will do kind of daily limit intervention. So maybe some amount they will do every day, but not majorly that, earlier they could manage a rate. So if it's by the flow, if it is depreciating, it will let it depreciate. In fact, I'm actually positively surprised that we didn't cross 93 today morning, which is actually a good sign. But again, it's all temporary, right? Because we don't know what happens over the weekend, and we are sensitive to food. And of course, nothing. Nobody is pricing gas into this situation at this juncture.
Yeah. Jayeshbhai, if I can, and that's helpful starting comments, if I can request you to just wait for 3-4 minutes. We have the Tata Power management joining us, Jayeshbhai, on the phone line. So we'll just come to you at 9:15, right after market start, which is for 3-4 minutes out. Gujarat government has approved the signing of the power purchase agreement with Tata Power for the Mundra coal power plant. We have Mr. Praveer Sinha, MD and CEO at Tata Power, joining us on the phone line. Mr. Sinha, thank you for taking the call. Thank you for joining us. Prashant this side. Sir, just tell us the contours of this deal. I think markets have been waiting for it for some time. How long? What's the pricing? Tell us.
So good morning, and you're right that we had been in discussion with the Gujarat government for quite some time to finalize the SPPA, and now it has been done thanks to the effort of Gujarat government and GUVNL, and now the approval has come, and based on the SPPA, which is agreed with Gujarat government, we'll be taking with the other 4 procurers, namely Maharashtra, Rajasthan, Punjab and Haryana, and hopefully in next few weeks we should be able to close this. So that's the plan right now, and we do expect that this will help us to operate the plant at full capacity.
Okay, all right. Hi, Mr. Sinha, good morning and good to see you. Before we get further details on this, what was the loss that you recorded because this particular plant couldn't operate at full capacity? 9 months, if you have a number.
Yes. Yeah, so last 9 months we have not been able to operate, and we are still working out the details, which is there, and we'll be able to share with you possibly in few days.
Was around 1,000 crores of loss for the first 9 months?
Yes, somewhere around that. But now, once the plant starts operating, then
it'll reverse.
We'll be able to recover. Yeah.
Got it. Could you tell us what is the rate of the PPA? Is it better, than section level terms? If you could help us out with the rate of the PPA.
It is more or less similar. So the arrangement is that this PPA will have a cost pass-through for coal, which was the biggest concern for us. And that is being taken care in the PPA because coal cost is something which is not under our control, and so that is being taken care. And then some of the other commercial issues have been agreed, and those details are we'll be sharing once the based on the government order the SPPA is signed.
All right, Mr. Sinha, I was coming to the Indonesian coal issue, right? Because that's where all of this started. And we have this example of this sharp oil spike in front of us now, unanticipated, out of the blue. So things happen. So agreements have to account for it. So what does the agreement really now say? You're saying it's accounting for that, but
it's accounting for
what exactly is? Yeah. So it's complete pass-through. I mean, or there is no there is a limit.
No, there is a complete pass-through. There is no limit. There is no capping that has been done on the coal prices, and similar terms that has been agreed with Adani and the other imported coal-based plants in Gujarat, that is the SR. On similar terms, we are finalizing this.
You think this will be the blueprint for your PPAs with other states as well?
This will be exactly similar with other states. We have been in discussion, and there is a general, in principle, agreement that whatever is agreed with Gujarat will become the template with all other states.
Okay, all right. We'll sort of invite you on for a longer conversation, but thank you very much. Gives us a good sense of this PPA right now with the government of Gujarat. Well, I think, thank you once again. 2% higher, by the way, 2.5% higher on Tata Power. So the market, of course, likes what it is seeing and what it is hearing, more importantly, from Praveer Sinha this morning. The markets have opened, by the way. We're up about 0.9% higher. The Nifty Bank is up 1%. And the mid-cap index and the small-cap indices will also come up on your screen. Small-cap index is up about 3/4, and the mid-cap index is up about 1.25%. So actually, it's a pretty good start, all told. 200 points after yesterday's 750-odd point smashdown that we had. 1,850 stocks are higher, 340 stocks are lower. And this is the sort of market breadth, right to the word go, right out of the gates. We have 4 stocks, 3 stocks lower, everything else in the green. And is it the Accenture guidance which is playing up with some of these IT names, or just some sort of buying at lower levels? We'll get to stocks in just a bit, but you got some IT names on the upside. Easy to count what is down. HDFC Bank, interestingly, still lower, not by much though. ONGC and Hindalco are the others. So 250, that's about 1.1% higher on the index to begin this session. Rima.
Well, it is IT right on top, apart from the fact that Accenture's numbers were fairly steady, and the company said that the AI is a net new opportunity for the company, helping them gain market share. The rupee is also weakened, and that helps, and valuations for the Indian IT company are lower than the long-term average multiples, which is why you are seeing support coming through for IT. Tech Mahindra 2.5% up today, top gainer, followed by Infosys 2% higher, HCL Tech 1.9%. Wipro, TCS also in the green with gains of 1.5%. So IT is super strong this morning. Then you've got Tata Steel surging 2.5%. SBI is seeing buying, that's up 2.5%. Reliance Industries has been providing some sort of a support today. Reliance Industries has gained nearly 2%. So far this morning. Eternal has been the big winner this week. Eternal share price is up 1.7% for the day, and for the week it's up 8%. So Eternal seeing a lot of buying. Other than that, auto names too are higher in trade. You've got M&M gaining 1% for the day, and for the week it's rebounded nearly 5% after the bludgeoning that it got last week. As you rightly pointed out, on the way down, only 3 nifty stocks. HDFC Bank continues to get hit. That's lower by 1%. Hindalco, HDFC Life, very flattish, but just a red bias.
Well, that's right. Crude oil prices have cooled off from where we left off yesterday. When we wound up the show on closing bell, it was closer to around $119 per barrel. Now, that's cooled off. When you're seeing such a sharp cool off in terms of crude oil prices, it's good for the markets, but it's particularly good for some of those OMCs that have got absolutely slammed. HPCL, BPCL and IOC, they are some of the top gainers, and they're moving on rather good volumes. The cooling off on crude oil prices is definitely helping them. Keep an eye out on some of these refining stocks as well, MRPL as well as CPCL. Both of them have opened up, and they're moving on rather good volumes as well. So I think we should get some of those stocks up for you on the screen. Silver prices, they did correct overnight. But I think, some of these ETFs, silver ETFs are already factored in this weak news. So that's why you're having actually Tata Silver ETF, Nippon India Silver ETF. Both of them are trading higher in today's trading session. So good going on both those names. And a quick couple of other names. You have Reliance Indus Infra. Volumes normally not very, very high, but that one has spiked up in trade today. And happiest minds, as Rima said, that there is some speculation that a deal could be done with a change of promoters. Let's see whether or not that happens. But for the time being, that stock is well up and about in trade today. Just one quick word with regard to Reliance Industries. The stock is now trading above its 20 DMA. Its 200 DMA is at around 1,450. For the time being, above the 20 DMA, and that big boy is holding one end up and given good support by the tech index that we had pointed out earlier today as well. Prashant.
Okay, well, it's 10:1 in favor of advances, right? So 2,200 stocks are higher and about 220 stocks are lower. So it's clean 10:1 and lots of stuff happening. 23,300 is back on the table and it's a 300-point pop, which is basically come through. So actually, we are going to look at the rupee and markets together in terms of the discussion now. So Jayesh Mehta, of course, has been waiting by, Vice Chairman and CEO, DSP Finance. We got a quick word in from him earlier. Trideep Bhattacharya is CIO Equities at Edelweiss AMC, who's with us as well. Trideep, good morning and welcome to the program here, as always. I just want to sort of complete that point with Jayesh Bhai. Jayesh Bhai, as I think there was a Goldman note yesterday saying that maybe we head to 95 on the dollar-rupee pair. It's important from an equities point of view as well, right? I mean, if there is this continued depreciation, it prevents people from coming in, from deploying. Just your thoughts.
So we have self-inflicted goals, right? So of course, one is unknown, Middle East, nobody knows. So that of course will play out the way it will play out, right? But two things, I've been very vocal about the arbitrage and that, right? And in fact, we are enhancing that by, today there was a news that we will allow net settlements for FPI that will actually get more arbitrage flows, and they have much better algos to be better than making more money and outflow of the flows, right? So that's something one has to look for it. And yesterday we had this HDFC Bank, which was not required, but of course that also does create. And in this scenario, when you have unknown of Middle East, why would somebody sitting 50,000 feet away will take a bold call about India, or why would he care about it, right? So I think while external factor, we don't have much control, though the government is doing a pretty good job with diplomatic relationship. But from a market side, we need to do a little bit more for the market, and that will really help the currency. I don't really believe that is the currency which is not allowing people to come through. I would say currency is actually following the equity market, right? If the equity market outflows continue, it will gradually keep on declining. So that's something we need to stop. We need to look into it in much detail. That's what I feel.
Yeah, absolutely. Trideep, your thoughts? I mean, it's been whipsawing up and down, right? I mean, let's talk about the market now at about 22,300, 2200 now, actually coming off a little bit. Where are you at in terms of how you're thinking about this now?
Well, I must admit we are incrementally constructive on the markets. We think that while, of course, in the near term, the war, the way it is impacting some of the key macro variables like oil, like currency, and the gas supply. But I think historically, if you look at last 50 years data, usually these things tend to find a way into share prices long before they find into earnings. In other words, markets kind of reflect a good bit of this fear already. So we think from a market standpoint, given where valuations are, given where stocks are, incrementally speaking, in 3-6 months' time, I think we would probably be kind of higher from where we are overall. The risk that I would say is in case the war goes nuclear, or if oil stays beyond $100 for 3 to 4 months in a row, then we'll have to take a fresh call. But barring most other circumstances, I think incrementally, this will probably cause a bit of a pause in the earnings upgrade story of India, but not reverse it.
Problem is that earnings upgrade story was just starting, right, Trideep, as they started to hit in that sense. Just one last question, Jayesh Bhai, to you, right? There was a fair bit of chatter on that the RBI's forward book, which is now ballooned to $100 billion. That's the other thing, right? Everyone, if that number is well tracked, it's got to be, I mean, they got to buy the dollars at some point. So that is the other demand which will come. Just very briefly, is there a point to worry?
Not necessarily the whole of it, because some of that they can roll it over. Some of them are in the NDF market. They can let it mature. If the market conditions are good, they don't need to really roll it over. They just pay the difference, and that's it. So that's not the offshore side is not really a dollar outflow. The onshore side, yes, will be an outflow as and when it matures. But if the market's not too negative, maybe they don't need to roll it over. So that's something. But hopefully, before that, we may see some positive. Hopefully, as other panel member also said, yeah, they are constructive and things settle down. If the war kind of cool down, we may see some constructive inflows that can help.
Jayesh Bhai, thank you very much for joining in and sharing your views on the Forex and the macros. Trideep, any views on HDFC Bank? Yesterday down, today still that overhang persists despite all the clarifications, conversations with Shashi Jagdishan. How have you analyzed the situation?
Confusion, more than it's been historically a pedestal of corporate governance. And when these data points come about, one goes back to drawing board to sit and analyze. You have something major changed. My sense is, though, from what I read and hear, it's more difference of opinion rather than anything, any serious corporate governance lapse, so to speak. But it's an evolving situation. We keep an eye on it. Difference of views can always happen, and that could lead to divergent actions. Our starting point with regards to kind of some whenever such announcements on any of the stocks that come in is to we kind of give it a bit of time to analyze and then kind of move forward. This is more a general comment rather than any stock specific. And the point that you made with regards to the bank that you talked about, we'll see it in that same context.
But that particular bank or large private sector banks, are they a part of your portfolio? And when such news comes, do you act till you wait for more data points or you just hold tight?
We as a matter of process, we tend to hold tight till the time we get clarity rather than reacting to news. Because in a very near term, markets have an emotional reaction. So we tend to kind of rely on data points rather than anecdotes and then take a view. But if we do find a corporate governance lapse that comes through, we do take action, even though from the starting point, we might be at a loss. Because I genuinely believe that as minority shareholders, as investors in equity markets, many risks we are paid to take. We are paid to take the business risk, the valuation risk, but we are not paid to take the corporate governance risk. That usually markets don't, get you back on track. So we take a serious view of corporate governance lapses, but we rely on data points rather than anecdotes.
Trideep, but this entire, buy the dip on the war cry is still getting very tricky, right? Even if we get a sooner than expected resolution on this war, it's going to be very difficult. Central banks globally, they're going to be tightening, rather than easing. You could see some strength coming back in the dollar index as well. And Brent crude prices, at elevated levels is going to be inflationary, which will give the RBI as well limited headroom. Even in this sort of a backdrop, you would think that downside to the Indian markets is limited. Or would you rule out a sharp 15-20% correction even from here?
So here is put a framework in front of you, which hopefully for yourself and viewers helps you think, or that's what I think. That I mean, in any value of an asset, there is numerator, which is discounted cash flows, and then there is new denominator, which has the risk premium bit along attached to it. In geopolitical events, while the earnings impact gets staggered and comes over a period of time, the risk premium adjusts far sooner, which is why you see a concentrated correction in 1 or 2 months, which happens right at the outset. And that discounts a major part of the earnings risk that later on follows. And hence, in many ways, by the time we get to the right earnings number, how much is the earnings cut, what will RBI do, you will see that the market has already factored that in and moved on from there. That's where I was trying to say that yes, the earnings impact will be there. I mean, in fact, we were discussing this Qatar oil, the gas impact. It'll take about 3 to 5 years for them to rebuild, which will have its impact on global gas supply. But then there are other places where it can come through. If you think in those terms, the earnings impact will be there, but the risk premium adjustment happens far too quickly. And if you look at data over the last 30, 50 years, every time any geopolitical events happen, the first 1 or 2 months take the majority of the impact, and after that, the markets kind of gradually move out of that, out of the grasp of that geopolitical event. So I was thinking from a market reaction standpoint, earnings will follow. Obviously, there will be cuts in certain pockets of the economy, while others might be relatively more resilient. But net, if you look at India's earnings story, over the last, compared to last 2 years, we were at the beginning of an earnings upgrade story. September quarter, December quarter saw 2 rounds of earnings upgrades. My sense is that it will cause a bit of a pause, depending on how long this war situation lies. But it will not reverse the earnings upgrade story in India. And hence, if one kind of looks at it in a more staggered manner, one will still be, hopefully in 3 to 5 years' time, land up on the right side of the returns.
No, yeah, absolutely. By the way, Trideep, do you have a view on the HDFC Bank situation without commenting on what you'd would do with the stock itself?
Yeah, so I mean, we can't get specifics, but as I said, we take a fairly serious view on corporate governance lapses if we find out based on data that there has been one. I think generally the market emotes in and around the event, which we want to stay away from. And I was saying that, again, specifically, I can't comment on it. Our starting position in some of the large private sector banks is in general underweight. We are relatively more positive on the mid-cap private sector banks in the course of our portfolios. But if we do find a corporate governance lapse over a period of time, we will take action. As of now, we haven't taken action specific to some of these cases.
All right. Trideep, a quick word with regard to the metal companies. The entire focus in the last few months has been supply disruption. Suddenly the street is waking up and smelling the coffee. What about demand destruction? So from supply disruption to demand, destruction is going to be very, very interesting. Though I've been reading a few sales side notes today, and most of them still believe that metals could do well from here on. Which part of the argument are you on?
My sense is what we are doing with our portfolios is orienting our portfolios towards companies that have pricing power, which can navigate through tough, volatile macro conditions. Now, today, it's kind of, till about a couple of months back, it was rising commodity prices. Now they might be falling. Currency is going all over the place. And likewise, demand situation, geography-wise, is also kind of, fairly volatile. Companies that have pricing power, have better moats, are the ones to anchor around, particularly in times like this. I also think that this geopolitical situation, which is right now fairly flared up in the Middle East, is unlikely going to die down completely over the next 1 or 2 years. There will be certain events around the globe which will kind of come through. So the geopolitical situation is going to be fairly volatile. And in these circumstances, companies which have better pricing power, have wide moat enough or diversified business enough to kind of run through those or navigate through such circumstances are the ones to bet on from a returns perspective, rather than being oriented about a particular sector or the other.
Trideep, thank you very much for joining us this Friday. Enjoy your weekend as well. Markets are picking up. We were up 250 points at open, and now we're up more than about 300 points. So the rebound extends itself, 1.3% up on the benchmark indices. Mid-caps moving towards a 2% rally. Moving on now to the next discussion. Naresh Jalan, Managing Director, Ramkrishna Forging, and Vidya Shankar Krishnan, Chairman, Managing Director at MM Forging, are now joining in. Gentlemen, thank you very much for joining in. Mr. Jalan, if I may start with you. There are so many industry reports that flag that forging units are also facing difficulty. ACMA had written a letter to the Ministry of Heavy Industries. This was about 10 days back, flagging of LPG availability concerns for forging unit. So two-part question here. One, natural gas accounts for what share of your total energy bill? And two, if there has been a shortage, have you faced any production halts? Has there been a reduced downtime? Have you reduced your shifts? Any volume impact?
So I think we use very less quantity of natural gases, but whatever natural gases we use right now, I cannot quantify in terms of overall consumption, but we are affected, and I think we are trying to manage in some other way. But I think if to say we are not affected is wrong. But
So, Mr.
overall,
Jalan?
I think we are still scraping through with whatever we are able to get through. I think government has already allocated 20% in terms of commercial gases to industries. And with that, we are somehow managing the flow right.
Okay, so has there been any production halt? Have you reduced your shifts? Has there been a volume impact?
No, I think overall in terms of volume impact, we have not had very big volume impact. I think overall in terms of dispatches to customers, yes, it is affected because of finishing lines getting affected. I think that is the place where we use natural gas. And that is the place where we are getting affected.
Can you elaborate a little bit more on that? The dispatches to customers, because
yes, customers, I think end customers or exports or domestic, they are somewhat affected. But I think we will need to see still 10 days to go for this month to get completed. We are trying to manage in the best possible way. So I think probably we will scrape through by the month end.
Okay, got that. Mr. Jalan, request you to stay with us. Let's go across to Mr. Krishnan. Hi, Mr. Krishnan. Good morning. And good to see you in, sir. Give us your analysis. How is the gas? How much of your production first is based on gas supplies? Has there been any kind of disruption? And do you all have a plan B? Please go ahead.
About 50% of our production, basically processing, is based on gas. And very recently, Forgings have taken measures to step up our gas conversion. Means that it moved away from heavy oils, heavy fuel oil, to furnace oil to gas a little bit. We are pushing on that. Unfortunately or fortunately, the whole thing got delayed. So we are in a position to switch back to furnace oil now.
Oh,
which is the big thing. So much of our processing, as Naresh was saying, we are using gas for heat treatment and basically as a process gas. So that is wherever forging units have shifted away from liquid fuel to gaseous fuels, PNG or LPG, those units are likely to be affected.
All right. So
in our case, about 50% is at stake, but we are able to get supplies of gas, and we are also reconfiguring our furnaces to handle more of LPG. So we will, if at all we get affected, we may see something like about 5% being affected overall. But that too, I think, is more on a calculated basis. When it comes to actuals, we'll be able to squeeze that out also.
So, Mr. Krishnan, as of now, have you pulled back on production, or your inventories and your alternative resources are good enough?
No pullback in production as of now.
As of now, you're at optimum levels.
The situation continues and gas availability is dire. We can be very sure that the wheels of industry in India will come to a slowdown at least.
All right. Hopefully it doesn't come to that. But what is the breathing time that you have? A couple of weeks, 2 weeks, 1 week, a month? What is it?
We are reconfiguring things. By end of this month, early April, we'll be ready for.
Okay. And you briefly mentioned you were moving from liquid oil to gas, and now you're looking at moving back to the earlier source of fuel. What is the cost difference between the two? Because this switch will incur some costs. Is it a larger number, or is it easy to switch past and then push it through to your customers?
See, the cost of these two fuels net to net right now and a little bit before was the same. But what happens is the pollution and operating norms, as well as the cleanliness of the plant, everything is better with gas. With furnace oil, everything goes for a toss. So that will be the drawback when going backward to liquid fuels. And you can't change the furnaces overnight. You need 5 days to 15 days of downtime, provided you have all the change parts available. And it's not something that you can just flip a switch It takes time to change from one fuel type to another, and this can't be done overnight, as I said. So while we have gone ahead with gas for one or two furnaces, we are reverting back to liquid fuels.
Mr. Krishnan, good morning, and Mr. Jalan, good morning. Prashant here. Mr. Krishnan, you said you are moving to LPG, or did I not hear you correctly? You're now moving to LPG.
From furnace oil to LPG, PNG, to PNG largely, but we're now going back to furnace oil.
I see. Okay, that clarifies it.
Unfortunately,
and the other thing you said that you will
oil supply as a country seems to be more secure, with Russia likely to chip in for India, and also India finding other sources like in US or Venezuela. So oil is likely to be less of an issue than gas. Gas is more coming in from the Middle East, and the Straits of Hormuz are likely to affect our gas supplies.
Yeah. Now, Mr. Krishnan, and that what you said by that breathing space question, you said you'd be able to tell us by 1st of April, or, I mean, you think another 10 days is essentially where, I mean, if this continues like this for another 10 days, then, as you described it, the wheels of the industry perhaps slow down. So that timeline is next 10 days?
We will be able to change over to liquid fuels in the next 10 to 15 days. Now, there may not be, others may not be so lucky, and their furnaces may be hardwired, processes may be hardwired to gas. For example, many critical processes like paint booths, paint shops in most OEs are all run on some kind of gas or the other. So while they can try to switch over from one gas to another, gas availability could be a major risk to industry as a whole. Because one thing is that gas is also a domestic fuel. And when it comes to a toss-up between industry or domestic, from a national point of view, I think you know which wins.
Yeah. Now, Mr. Jalan, if I can come to you, is same question to you. I mean, your business or your from your vantage point, how, because it's not just one, it's as they say, right? I mean, it's the weakest link which kind of breaks the chain. As Mr. Krishnan said, everyone may not be able to make the switch. So it's kind of interdependency, second order effects, etc. Is that showing up already, or will that show up if the situation persists like this?
Prashant, I think we are not looking for any knee-jerk reaction right now. I think we believe that overall the entire globe is going to get affected if this war continues. And switching over to furnace oil or switching over to alternate fuel, liquid fuel, I think is not an option for us. And I think we would like to stick to it, because I think with the pollution norms and other things also side by side running, I think it is very difficult to switch on and switch off on a regular basis. So we would like to continue with gas. And I think more than us, our OEMs, I think if the gas really becomes an issue and industries start closing down, I make parts, but my OEMs, because of their dependence on gas, which is their paint shop and other things which cannot run on alternate fuel, will shut down. So obviously, if my OEMs do not make vehicles, my parts do not go in. So I would like to stick with whatever we are doing right now. And I think government is also equally concerned and working aggressively to minimize the damage which is there. And I think within short period of time, we will see the things coming back. I think we are not panicking, or we are not doing any abrupt measures just for a few weeks to get over it, because I think it will take a large amount of capex to switch over to liquid fuel, as well as it is again will be a big pain point moving back to gases whenever the situation fully normalizes. And pollution is one of the biggest norms. ESG, I think, and as well as people who are exporting to Europe and North America will have to follow CBAM. I think with the current situation, I think this CBAM issue is not getting resolved. So we will need to stick to that.
Now, just one question to both of you. I mean, as things stand right now, right? Let's assume, say, one more week, which will be 4 weeks in, and so a month-long war, and it comes to an end. some damage has already been done. Like, for example, we heard from Qatar Energy saying that 17% of their export volumes have been disrupted. And so, one is resuming supplies, the other is damage already done. For both of you, and Mr. Krishnan, if you want to go first, assuming this is like a month-long thing, will there be any implication for numbers, and to what degree?
As what Naresh has been saying, we are likely to pull ahead, chug along, forge ahead, but the rest of the industry may not be so lucky. There are more critical processes or fine processes within the manufacturing sector that will require inputs from gas. And gas availability, if it is not resolved, would result in an overall demand, not demand, but overall end customer not producing enough. Because they are an aggregator. Ultimately, all OEs are huge aggregators of various kinds of products.
So my question is, accounting for all, nobody is producing in a vacuum, right? It's all interdependent, as Mr. Jaran also outlined, as you were also saying. So taking all that into account, interdependency and end production cards or whatever, you think a month-long war, will your business, will it show up in your business in terms of numbers, volumes, sales, or the bottom line?
We don't see this in the short term. Long-term impacts are yet to be resolved. But I also believe a lot in resiliency. The whole system will reconfigure itself. India will find newer sources of gas to run. And somewhere, I don't know, the industrial consumption in India is hardly 10% or 3% of overall gas consumption. I don't know if 3 is a reliable number. But if numbers are as low, government will also make alternate arrangements. And see, government is also very clear that industry has to power the economy. So they will go all out to ensure that we have the adequate fuels. And within gas also, there are options. Within liquid fuels and gaseous fuels, there are options available for industry. Yes, they have cost implications. But given all this, I think resiliency will prevail.
Mr. Jalan, a quick question then on, other than, of course, the LPG shortage, etc., that the industry is grappling with, costs have also gone up. Can you give an indication of the overall cost inflation that you have seen in Q4?
No, I think right now in Q4, basically, if we say, I think first 2 months of January and February, we did not face any cost inflation. But yes, in the month of March, I think we are facing inflation due to this war, only mainly in gas related gas and fuel. So I think that's not going to damage or anything for this quarter. But overall, next year we will need to see how the crude and overall gas environment settles. I think for me, I am very optimistic that I don't think that this war is going to continue forever. And within a week or 10 days, if this settles down, everything I think will take 2 to 3 months, but we'll come back to the natural way of working. We will be able to maintain our FY27 guidance, whatever we have been able to make.
Mr. Krishnan, can you help us? What has been the cost inflation for you in Q4 versus 3 months ago?
Jan, Feb, nothing. But overall general trend has been wage costs are going up right across the country. And that's not related to this war or anything. Over a period of years, wages are have gone up and are likely to go up, particularly in an intensive sector like ours. So we see labor costs as a concern over a period of time. Not in Jan, Feb, but this a secular trend. From March onwards, we see a huge increase in particularly second half of March in fuel costs. LPG costs have gone up like 2.5 times. Furnace oil is going up, already gone up by about 30-40% and is expected to slide to around 80% or so of increase, 80% increase to prior prices. So all these things are going to make an inflationary impact. We also see a huge trend, which is in the price of carbides. This comes as a kind of a blow from the side. Price of carbides and those inputs have gone up considerably. and they've shot up in the last few weeks. So that also has an inflationary impact on wherever metal is being cut. Carbides are used in metal cutting industry, in the tooling industry. So wherever we are machining, those inputs have gone up. And well, we are working with customers and requesting them to consider compensating us for the increases.
All right, Mr. Krishnan, 1,800 crores, 1 lakh tons, and 17-18% margins is still on course for FY27.
Yes, Nigel.
You think so? All right, great. Appreciate you all joining in, gentlemen. Wishing you all the best, and for the good of everyone and for good of your industry as well. Hopefully, we do see some kind of resolution and de-escalation to this ongoing war in the Middle East. For the time being, we slip into a short break. On the other side, the management of MedPlus is waiting for us. They'll talk about the impact of the West Asia war on business and the outlook ahead.
Okay, well, the dollar rupee is now hit the 93 mark. That's the flash at the bottom of the screen. It's the first time ever. It's a big move and almost a 0.5% move on the dollar higher against the rupee. So, sharp surge, which has been coming through. As I was saying earlier, yesterday the forex markets were shut, but in the NDF market, offshore market, the rupee had hit, the dollar rupee had hit 93.2, 93.3, so it was a pretty large move, and the onshore rate, of course, is also now moving up. So absolutely relentless demand for dollars, and the problem is that because the depreciation is slow, it's not like one shot, and the expectation is that this will sort of continue to creep. So if you're an exporter who's sitting on dollars and you don't want to sell and convert unless you absolutely necessarily want to, because you're expecting that this is essentially going to keep going and you'd find better rates. So in that kind of a situation, the only supplier of dollars is the Reserve Bank of India at this point, and supplying of dollars they have been doing. Actually, the scale of intervention, the scale of supply has been pretty large over the last 10-15 days or so. Both, I think, in the spot market, but also in the forward market. And I was talking to Jayesh Mehta earlier. The forward book for the Reserve Bank now, by some estimates, around $100 billion US. So, it's like a vicious cycle, but that's where we are at this point. So 93.1, to keep an eye out on this one. We were at about 93 plus something, right? So 93.12 now. So it is continuing to move in front of our eyes as we speak. So we'll keep the rate on at the bottom of the screen. Now, the other big story, we'll come back to the currency space in just a bit. India's obesity and diabetes drug market is on the verge of taking off. Semaglutide, the molecule behind Ozempic and Wegovy, will go off patent this Saturday, paving the way for low-cost generic drugs to enter the market. Ekta Batra is here to tell us how this could reshape, India's diabetes and weight loss markets. Ekta, tell us.
India's weight loss and diabetes drug market is on the cusp of a major shake-up. While the market is currently dominated by Mounjaro from Eli Lilly, which has generated close to 900 crores in terms of sales within a year of launch, semaglutide, which is the molecule behind Ozempic and Wegovy, is going off patent in India on the 21st of March, likely triggering a wave of lower-cost generics. Now, the real inflection point is this. Mounjaro's patent runs well into the mid-2030s, but semaglutide is going off patent now, making it the first widely accessible weight loss drug in India. That gives it around a 10-year runway as a more affordable alternative before the next wave of patented drugs enter. This is already triggering a rush to tap into India's 100 million diabetics, the large, thin, fat population, and with 25 out of 100 people being either overweight or obese in the country. But this accessibility will come with a sharp pricing reset. From current monthly costs of around 8,800 to 16,400 rupees, prices could fall 50 to 70%, with estimates of 400 to 500 rupees per weekly shot within a year. According to Nomura, 400 rupees a week could be the tipping point, unlocking an addressable diabetes market of nearly 2 lakh crore, comparable to India's entire pharma market size. The semaglutide opportunity itself could scale to 9 to 10,000 crores, including obesity and lifestyle use. Companies are already positioning themselves aggressively. For example, Zydus has partnered with Lupin, with 5 brands planned between them. Eris has tied up with Natco, and even innovators are expanding access ahead of competition. Novo Nordisk, for example, has partnered with Emcure and Abbott, while Eli Lilly has tied up with Cipla to widen Mounjaro's reach. Lastly, a few points to watch. Analysts expect the top 3 to 4 players to capture the bulk of the opportunity, while premium patients may continue with innovator drugs. Markets could expand beyond Maharashtra and Delhi, but companies may face high volumes with tighter margins. What will be closely watched is quality, given the complexity of the drug and fear of side effects. And if newer therapies, then sentiment. For now, the key question remains, can semaglutide truly go mass market in India, and in doing so, reshape the Indian diabetes and weight loss market?
Thank you very much for that. That is a big opportunity and investment play as well. Markets are tracking this very closely. Gangadhar Madhukar Reddy, MD and CEO at MedPlus Health Services, is now joining in. And some of the discussion points, one, of course, the impact of the war in West Asia, 2, private label sales, same-store sales guidance, and 3, the GLP-1 rollout. Thank you very much, sir, for joining in. But beginning with the Iran situation, has there been any supply disruption for you which has impacted? And secondly, I believe packaging costs have shot up. How much, and how much of it is a risk for you?
Yeah, the immediate impact of the war for us has been only one. A supplier who actually gave us toothpaste, our private label toothpaste, basically invoked the force majeure and said that given the fact that they don't have enough gas, don't have enough LNG, they'll not be able to supply us. So that's a small hit that can be made up in several different ways. But it is possible that given the fact that now gas fields in the Middle East are being hit, and it'll take a while for them to actually come back on board, this may go on for a while. So some of the private label products we may not be able to actually supply. But these are largely in the FMCG and the general goods area. And these are only a small portion of the overall thing. So I'm not too worried about that part. On the packaging side, given that for the general goods, typically 50% of the cost of the product is packaging for any hair care, skincare product and all that. We will see a slight increase, most likely for the private label will probably absorb the cost. But I'm pretty sure the brands will also absorb it for a while. But that will mean slightly lesser profits on the private label thing for a little while. We also have seen a small increase in the fit-out cost in our stores. Typically, we spend around 10,000 rupees per month per store when we set up all the plastic boxes and all. We just saw the price double. It's just that, someone is being very opportunistic out there and selling a product at a much higher cost. I don't think it warrants it, but we are in no position to wait for it. It's a small enough cost. So, we will see some of those small increases, which we will, take in the capex side for some of our stores.
As things stand today, will you be able to quantify the pressure on margins since you are absorbing the cost?
I wouldn't say it is very significant, mainly because of this. MedPlus has always been a huge discounter. Our general goods, where we see the price going up slightly, we used to discount by 40-50% of the market price. We may end up actually increasing the price by 5% or so in some cases, or absorbing some of it in some sensitive areas. But otherwise, I really don't see a significant, I would say, decrease.
And other than toothpaste, which are the other private label products of yours where you've seen an impact because the vendor is not able to supply the product? And how many such products are there, and what percentage of your overall private label sales would you say is impacted?
Very small portion, I would say. This is the only guy who came off the blocks immediately after the thing got hit. Maybe some of the suppliers will also come back with, some supply constraints and all, but I don't expect it to be very high. It may mean that we'll end up paying slightly more if they switch from one type of fuel to other type of fuel, maybe electrical side and all, if they can. Maybe the cost will go up slightly, but I'm not. Luckily for us, we are not in an industry where this will really hit us. I'm pretty sure this will hit other areas of the Indian industry, but not us, I think.
Got that. On semaglutide, you plan to stock multiple brands and even launch your own private label. How meaningful can this category become in terms of sales?
I am super hopeful that this could become really big for the overall pharma industry. I'm not sure how much of that will translate into sales immediately at our counter, because all these drugs are dispensed as injections. And typically, patients end up wanting to get the doctor to dispense it or, administer it usually. So the first time, second time buy may usually be in the clinic or the hospital itself. But as people get used to it, and given that this is a high ticket price and we give a pretty significant discount, I think once they start buying in the neighborhood, we'll probably start seeing some of those sales. So that's for us. And once we do the private label, obviously we will be the price leader in that whole thing, whenever we launch it. So there also I see a lot of positives for us. On the other hand, the drug itself, I think, will be pretty big, given the fact that it has so many different uses actually. But the primary use being obesity and the secondary being diabetes. I think taken in small doses, this is fantastic for all diabetic patients. Given the fact that this has now come off patent, it's going to reduce in price significantly. Even if it is at around 2,000 rupees per monthly, per month kind of bill, I think a lot of people will be able to afford it. The average ticket size for a diabetic customer in our store is roughly around, they of course buy all the other drugs also. It's not just the diabetes drug. The average ticket size is around 1,800 to 2,000. So it will mean double. So that way it looks high. But the thing is, it is not really a significant portion for a lot of the people. All said and done, a lot of people now can afford the 24,000 rupees per year. So given the fact that it is super beneficial, and it is not super expensive, given that it has now become generic, I think we will see an explosion. But it will take time for two reasons. A, there are small side effects out there. Nothing major. People have to just get used to it. And two, and B, in the way it is administered. It's an injection, so people will take a little while, because the insulin users are probably more comfortable taking this initially. But the other guys who are only using oral tablets may take a little while to adapt to this and start using it regularly.
But you said, right, even for you, the sales of this from other brands that you stock, it will take some time. So perhaps the revenue opportunity is not FY27? It will be FY20. Do you have any timeline in mind? And when do you think you will launch your own private label on this?
We will launch it in the next 2 months max. We're just waiting for a couple of things to happen out there. That's all. But the drug is available for everyone. We can meet the MOQ of any of these drugs. I don't think there's a problem at all. So we will launch it next couple of months, I think. When will the sales start shifting to our thing? It probably will take 1 quarter. It is a pretty, while people will have this notion of the administering issue. It is a pretty easy drug to inject. So it will not take more than one or twice, 2 times of use for people to get used to it and start doing it themselves. Once they start doing it, then they will buy it in the neighborhood. They will not go all the way back to the hospital or clinic where they initially got the prescription.
So have you worked out the numbers? You said your own private label for this weight loss drug should be out in the next 2 months. What is the kind of investment you've put in? What will be the initial production numbers? What are the sales that you're expecting?
Difficult to say. We will see how things are moving before we give any guidance or any numbers out there. I am positive it'll actually be a big thing, but I'm not sure how quickly it will take on. That's all.
Okay. In terms of investment, in terms of your own investment that you're committing?
No, not significant. Not significant. Yeah, I mean, even if you buy 1 lakh doses, it's not going to be more than, let's say, 12 crores or something like that, right? 20 crores max.
Right.
Max.
Got that. And just one final question then. How has the quarter been? Are you on track with your store expansion? What is the guidance for FY27 and the same store sales growth for Q4 and next year?
Everything on trend. There's no surprise. We continue to grow. We continue to put in more stores. We will, be on target for whatever we promised as the store expansion, and most likely on the top line as well as the EBITDA and all. Nothing surprising and nothing out of the ordinary.
Okay, thank you very much, sir, for joining in. That's the word coming in from MedPlus. But let's address the rupee in this slide. We opened up lower at record lows, but since then we've swiftly fallen some more and now crossed the 93 mark. Naveen Mathur of Anand Rathi Shares and Stockbrokers is now joining in. Naveen, thank you very much for joining in. Can you tell us, in terms of the dealing rooms, what's happening in the first 45 minutes since it's open, 1 hour since it's open?
Yeah, thank you very much for having me on the show, and good morning to all of you. Yes, you're right that the rupee opened lower today from the previous close. Yesterday was a holiday. So we have seen the rupee closure on Wednesday at around 92.64. And currently it opened at around, as the market opened, it opened at around 93.185, which is the lowest for the rupee against the dollar. Currently, it is around 93.1415. So predominantly, the dollar index has gaining strength. There are questions about the geopolitics, the state of the conflict in the Middle East, and therefore, with inflationary pressures building up, so people are moving, the foreign funds are moving out of India as the risky investment. So means that is what is, I would say, giving pressure on the rupee. The RBI is intervening through dollar sales. The forex reserves for RBI as of March 6th stands at around $716 billion, which is, means I would say, declined from the all-time highs at around $728 billion, which was in the end of February, just before the start of the war. So RBI is intervening, but I would say the strength in the dollar is putting pressure on rupee.
Okay, got that. Also, in terms of the RBI forex reserves, the RBI net short dollar position, can you give us an update on that and what that signals?
I think the RBI has stated, means it's part of the media news, that they would buy 1 trillion Indian rupees, approximately $11 billion of bonds from the open market this month, which is to be adding into the screen-based purchases carried out in the recent weeks. So this move particularly aims to address the severe liquidity constraint while curbing the rising bond yield. So I would say the RBI wants the rupee to float, but they don't want the volatility. So they are intervening. They are not intervening with full force to hold the rupee against the dollar.
All right, Naveen, thanks a lot for joining in and giving us that quick update. For the time being, the rupee weakness continues, holding at around 93.15 watt. We'll slip into a short break. You come back, we'll focus on markets. We'll also get in Saul Mehta of Mirai Asset, Sher Khan, who joins us for a technical check. Welcome back. We continue to hold on to gains as we speak. In Reliance Industries, actually, that big boy, it's up only around 2% or thereabouts, 2.4%. But that's the biggest contributor on the upside today. And as I mentioned earlier today as well, that could be the stock that the bulls turn to. It was very close to the 20-day MA. Its 200-day MA is at around 1,445 or thereabouts. So you'll want to get closer to then because that by itself is like an, like an index. Let's welcome Saumil Mehta, Head of Retail Research at Mirae Asset Sharekhan, who joins us. Hi, Saumil. Good to see you in. Your view on the Nifty, since you've got a bit of a bounce, what do you think? Take money off the table or this market is good for more? Point number one. And also give us your view on Reliance Industries. It's crossed the 20-day MA and it's been in this vicinity for a while. Your take?
Good morning. Good morning to everyone. Let's start with the markets first. Markets, I was expecting a bounce on the upside till 24,000. However, unfortunately, yesterday we've slipped down again till the previous swing lows of 23,000. Now we've bounced back again from those levels because 23,000 is a very crucial level, psychological mark, and I'll be expecting this bounce again to move up till 23,500 or 23,600, the previous swing highs. Now this is just a bounce. Overall, the trend still remains negative, and I'll be expecting this negative trend to continue till 22,700, 22,500 levels, which is the next, which is the 78% retracement of the entire rally which we saw in the last one and a half year. So those are the levels. I'll be expecting a bounce till 23,600, 23,700. So bounce is definitely expected. Now about Reliance. Reliance, I'm expecting the Reliance to move up, inch up. It is trading about 20 daily moving average. It has started making higher tops, higher bottom. It has not fallen very sharply in the last, couple of weeks. And it is holding on to 1,300, 1,350 levels, which is a great sign for the markets as well. Now, 1433 is a crucial level to watch out for because it is a 200 daily exponential moving average for Reliance. I'll be expecting this level to break on the upside for a target of 1480, 1490 levels, which is the previous swing high. That will also be a breakout level for medium-term outlook. So we'll wait for a medium-term outlook for a big call. But right now, positive on Reliance, expected a bounce in the market as well. So both positive in the short term.
Got it. You want to give us your view on other stocks as well?
I have two stocks in my radar to buy. PFC is one of them. Tata Power looks great as well, but PFC would be my pick. PFC has broken out of a flag pattern on the upside. Yesterday, it retested the averages, but again, today, it has a good move. So stop loss should be 409, and my target is 470 in the medium-term outlook. The second call is on delivery. Delivery today has, made a high top, started making high tops, high bottom, trading about 200 daily moving average. Great setup for a short-term trade. My target would be 450 and my stop loss would be 410.
Okay, thank you very much for that. On the other side, we'll bring you a discussion around the second order impact of the West Asia war on the real estate space. Stay tuned for that discussion.
Welcome back. I mean, markets, of course, holding not at the day's high. They've come off actually as the rupee has moved up, right? Not the rupee, the dollar rupee cross. The pair has moved up to about 93.23. And you've got a bit of a drift off which has come through for the Nifty Bank specifically, I think. That's a big move, right? I mean, we started at about 92.90 this morning, and that's a 60 paise move coming in. Early on, this is still what, an hour or odd. As far as market open is concerned, a little over an hour or so. The implications, of course, of this war in Iran is showing up largely through the energy channel. And there, as we've been, of course, talking to companies across the board, real estate is next in focus. We have Niranjan Hiranandani, founder and chairman at the Hiranandani Group, and Ashutosh Lemai, Joint Managing Director, Advisory and Valuations at Anarok, who are with us. Gentlemen, great to have both of you here, Ashutosh and Mr. Hiranandani. Appreciate your time here. Sir, Mr. Hiranandani, if I can start by asking you, Sir Prashant, this side, the most obvious sort of talked about, discussed impact for now is the most direct channel in that sense is what's happening with the ceramic tile hub, which is Morbi, and feedback is that it's basically just completely wound down operations there. Most units have shut down. Could you talk to us about the impact of that on your business, sir?
Of course, it will have an impact. I mean, there is no industry in the country where it will not have an impact. And the concern is not the short-term impact, but the long-term impact. Short-term, I think the country would be able to manage it. Real estate would be able to manage it. And there's not a real issue on it. We anticipate that if there's a short-term war for another 30 days, I think we can still manage to turn around real estate in a positive manner. But yes, if this war continues beyond another 30 days, then I think the challenge is not only for real estate, but across the country in every aspect of business and industry connected with real estate or not connected with real estate. So we do see that happen. But I don't see a negative in terms of if this is a short-term war. But you tell me, is it going to be a short-term war or a long-term war?
We're in the third week, sir. Next week, it'll be four weeks in, right? Yes. So hopefully, I think we can all just hope this is 4 weeks and it's done.
So I think India will be able to recoup its situation if it is a short-term war. Yeah. Because the internal demand in the real estate sector is very high. And the reverse is happening, that those people who were very comfortable of investing in the Middle East, which is hundreds of billions of dollars have been invested.
I'm just going to come to you. I'm just going to come to you. Yeah, that's my next question. But just to complete the tile point, let's just close the loop there. If this is a 1 month odd, right? I mean, this winds down at the end of the next week. You said little impact if it's short term.
See, so I'll tell you why.
Developers would have some amount of tile inventory?
But no, it's not a question of that. The question is that many of these factories do close down once a year for their revamping and other things. So it is only question that now the shutdown would take place all collectively. Usually they would do one by one. These factories would shut down for 10, 15 days for whatever they need to redo the factories, do it and all that. So one by one they would do. And so there was no implication into the marketplace. Today, because it has happened suddenly, and the fact is that there is so much ongoing demand which is not fulfilled, it is there. So a 30-day war is not an issue which will do any problem for the industry in the long run, either the tile ceramic production or real estate as a whole. But yes, of course, the people whose tile manufacturing is on the line and they are waiting for these products to be actually delivered, that is a challenge that is there, and it is bound to have some challenge in the short run.
Got that. Any other, apart from tiles, I mean, I'm just going a little minute here. Any other way this impacts? Any other channel?
Hugely. We only buy 260 different items in the marketplace. You're talking about cement, we're talking about steel, we're talking about paints, we are talking about hundreds of items which are there on a daily basis that is there. So obviously, all the items are, you're focusing on one ceramic tile because it is focused and concentrated in a certain location. So it disturbs the industry as a whole because it's at one location. But try and understand the same implication handles relating to all the others. We use gas for so many industries which are there. We also use oil, which becomes the base for paints, for every other item that you do for purposes in the construction industry. Every item is affected. So don't look at it only as ceramics just because it's been flagged off by the press.
No, I completely agree. Only thing is that the oil, as someone earlier pointed out, I mean, oil doesn't look like it's been disrupted, right? We're getting oil. The problem is gas. And that's where I was coming from. And so that's the focus. That's the reason for the focus on tiles in that sense. But yes, I mean, costs for most things will go up, as you said. You said what, 260, Mr. Hiranandani? 260 items you buy from the market, right?
260 industries directly will be affected by real estate. So in a way, the impact, out of which gas may be there for about 20 or 30 industries, gas would be definitely an important factor for them also. And it's across the board. So it will be affected, of course. And most of them will try to do a shutdown at this point of time because they normally do an annual shutdown for the purposes of renovation, repairs, upgradation, and all the other problems. So I guess that's the kind of sabbatical we will have to take in terms of production of supplies.
Yeah. Ashutosh, let me bring you in as well. Just first thoughts, top down. How do you see this? You heard Mr. Hiranandani, short term should be able to tide over. Your perspective?
Yes, I do agree with Mr. Hiranandani. Short-term impact, I think we are capable to withstand that. About 30 to 45 days is something that we can do with. All good developers and industry as a whole, they do have certain contingencies which are inbuilt into the business plan. So up to a limit, the contingencies can take care. If the war and the unrest get stretched beyond that, then the pressure starts feeling. So far, most industries are able to absorb the impact and are not passing it on to the consumers by and large. But there will be a limit of their absorption and holding power. If it continues beyond 45, 60 days, then they will have no choice but to pass on those burdens. And then the real impact will be felt. So short term, it's fine. Long term, the war better end soon so that we don't have to deal with the long term impacts.
Mr. Hiranandani, you started speaking, I interrupted you there, that real estate, right? People who are buying property all over the Middle East, Dubai and things like that. Now, there's suddenly question mark over basic security, etc., right? It's exposed certain things which perhaps were always there but were overlooked because this has not happened before. So you think people will turn their attention to, I mean, that cohort which is going there will either stay or will buy real estate here? Is that a proposition?
It's not a proposition, it's a reality. Any person in his good sense is going to look at investment into India rather than in the Middle East in the near future. So I don't see that that is a reality which is going to happen. And you will see an improvement in terms of investments from the Middle East, from the rest of the world coming to India rather than in the Middle East. So that is going to happen. And I do believe that Dubai received billions of dollars every year for the purposes of real estate investment. That will turn back to India is what my belief is. And I think the demand, in fact, at the higher end, at the top end of the market is certainly going to grow. The middle end will also grow. But all in all, I do feel that the situation will be the reverse. So you will get much, much more investment coming into real estate in India rather than in the Middle East in the next 1 year to 2 years.
And we'll track that shift, we'll track the flows. in terms of that change, relatively speaking, that you were alluding to, Mr. Hiranandani. Thank you very much for joining us, and let's just hope, as you said, you asked me when do I think this will end. May hopefully next another week, hopefully this weekend, if it was up to me. Thank you very much for joining us. Ashutosh, thank you very much for being part of the program as well. Appreciate it. I think we are going to just take a quick break here. 250 odd points on the Nifty, 23,250 is a wrap on Bazaar. More coming up on the other side.
The market recovers some ground post the steep sell-off that we saw yesterday. Sensex and Nifty gained close to under 1% each, led by PSU Bank's metal and technology stocks. The mid-caps gain in line.
The rupee slips to a fresh low, breaches 93 against the dollar as the war in West Asia continues. A stronger dollar and surging crude oil prices weigh on sentiment.
IT stocks are among the top gainers today after Accenture posts a steady set of numbers beating street estimates. The company also raises the lower end of their FY26 guidance. Sees a 4 to around 6% constant currency growth versus 3 to around 6% earlier.
Shares of gold financing companies like Manappuram Finance and Muthoot Finance fall in trade after gold prices see a sharp decline in the global markets overnight. Hello and welcome to Chartbusters, live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me is Nigel D'Souza. Well, it's turning out to be a session where we are seeing some amount of a pullback come through for the markets, but whether or not it sustains is something that the markets will watch quite closely. So for today, however, the markets are rejoicing. We have the Nifty, which is up around 200 plus points, 269 odd points to be precise. We have the mid-cap index, which is leading from the front, up around 1.4% currently for the mid-cap index, and we have the advanced decline ratio, which has been strong from the get-go, so that continues at around 3:1 is where the ratio stands when it comes to the advances and the declines. Hi, Nigel.
Well, hi, good to see some green on the screen then, getting into that weekend. But let's get into a couple of stocks then that have been buzzing around of late. One such stock is NPST. That's a stock on our radar. The company has secured a mandate from a large cooperative bank to deploy its UPI interface. We have with us Mr. Deepak Chand Thakur, the CEO and the co-founder of NPST, who joins us on the show. Hi, sir. Thanks a lot for joining in. Well, just want to highlight to our viewers what we're going to be probing, sir, about. One is their revenue momentum to sustain in the coming year, the growth opportunities, the margin impact, and the current market share, and how do they see things evolve from here on. Oh, well, sir, welcome to the show, Mr. Thakur. Give us a brief idea in terms of numbers. You have doubled your revenue and PAT over a year. The scale of your business, though, is still very, very small if I compare it with other larger fintechs. Give us a sense about what kind of performance are you looking to sustain from here on, and if you could break up your revenue, into the various verticals. I think you have 3 of them. Please go ahead.
Yeah, hi. Thanks for inviting me. There's a lot that we have done last year. We are technology partner to bank. For sure, that is our forte, wherein we not only work on the existing paytech requirement for industry, but we also try to work on the innovation as expected by the regulator and the government when it comes to the payment segment. And that is where we are not only working in the domestic market now. For the next year, for sure, we are panning towards the global markets. We have grown double, like you rightly said, but at the same time, for the coming year, we have a target to scale at around 70 to 80% at least. That is where we are working on a budget for the coming year, closing down on the funnels. However, our major revenue has been from technology partner role to banks and the payment industry. But at the same time, we have also brought in a lot of payment solutions for merchants and users, which are actually revenue generating stream for the banks and the aggregators. So we currently have about 80-90% revenue coming in from the technology role that we play, and the rest coming from paytech. The bigger triggers that we see in the coming year is, of course, RegTech. We are the first mover in the segment, trying to work around the AI-based model for fraud prevention, and that is what the industry is desperately looking at. We have been working on this for last 3 years, and we launched it this coming year. We will be looking at several banks and fintech using this solution. So that's the third.
So RegTech, sir, if you had to give us a number, how big can it become as a proportion of your business? RegTech, since you briefly mentioned upon that, and how do you see the segmental breakup for your revenues? Just if you could give us a percentage-wise.
So RegTech for sure is the early stage right now. So coming year, it will be nothing less than 10 to 20% odd. However, going forward, it has a capability to be at least around 30 to 40% of the overall revenue, considering its requirement not just in domestic but also the global market.
Okay.
So at the same time, if I split the entire revenue, TSP, the payment platform, and the RegTech, it should be somewhere around 60 to 65, 70 odd for the first one, at least around 25, 30 odd for the second one, and 10, 20 odd for the last one for 27. And then it will scale in the coming years.
Okay, so for RegTech in particular, Mr. Thakur, what is the kind of competition that you're seeing at this point in time? How many other companies such as yours are providing the same service? And hence, what are the margins that you could possibly be working on when it comes to this segment?
When it comes to the first vertical, I believe overall 8 to 10 companies cover about 90-95% of the market share. And when it comes to RegTech, this is the first space altogether for everyone to enter with the AI-based model. I believe it's completely open right now. Not everyone has that forte. And when it comes to payment platform, it's again nothing less than again about 10 to 20 odd companies targeting this space.
Okay. All right.
And I would like to add the global space as well, because that is where it is a greenfield opportunity for Indian companies. We are currently in discussion with nothing less than 10 odd countries, wherein we are presenting them how we have evolved over last decade in India. And they really want to replicate the UPI story and the overall growth story of India when it comes to digital payments. And that has been a great opportunity for NPSP.
Okay, since you are talking about that, there was some recent news with regards to your company winning a UPI switch mandate from Cooperative Bank. Just tell us about how big that particular order is. What does it mean for the company on a larger scale? How much do you think you can generate in terms of revenues? When does it start reflecting on your P&L?
So we have been predominantly large and mid-size bank vendor. It was critical for us to scale towards mid and small size banks as well. And that is why we launched Bank in a Box last year. What we essentially want to do is, while we have 20, 25 plus banks right now, it is only through Bank in a Box, which is a SaaS-based hosted on-cloud model, wherein every single product that we have is hosted on our environment. And they can take it on a subscription-based model, which is per transaction SaaS-based revenue. Now, that is a real big opportunity for us. While the large banks would be anywhere around 30, 40, 50 odd, the small size banks would be another about 1,800 plus. We intend to add nothing less than about 100, 150 banks in next 18 months. And looking at that target, this particular order is the first entry in this segment when it comes to bringing subscription-based, SaaS-based revenue over the product that we have built for the large banks. Okay. We believe that of the 65% revenue that we see in TSP, over 2 years period of time, SaaS-based revenue will be almost about 50% of our overall P&L. For this particular order, we see that the P&L will start seeing numbers at least by Q2, Q3 onwards in the coming year.
Very quickly, 3 numbers. What's the top line in the next 2 years, margins and profitability?
Like I said, 70-80% from here. We intend to close this year nothing less than 200 plus for sure. I have already given the number earlier as well. Nothing less than 30-35% growth. What we see in the quarter, and then next year 70-80% consistent growth for the next 2 years from here onwards. When it comes to margin, we are somewhere around 30-35% odd. We intend to retain the same.
Sure.
So that wherever we intend to invest, while we have raised funds from Tata as well.
All right.
We have a good cash to look at the inorganic.
Mr. Thakur, we got to leave it on that note. Yeah. Thanks very much for joining in and speaking with us. So that is Network People Service Technology, or NPST, talking to us about their targets. Well, just look at the stock. It's up around 8.5% and what is a lively market? We'll take a short break, but we'll be speaking to the management of CMPDI on their IPO opening next. Stay tuned.
Welcome back. You're tuned into Chartbusters here on CNBC TV 18. Well, the IPO for Central Mine Planning and Design Institute has opened today. Let's go across to the CMD, Mr. Chaudhary Shivraj Singh, for his view and the outlook on the company. Hi, Mr. Singh. Good morning. All the best to you as well as the team with regard to this IPO. Since it's an entire OFS, we like to understand a few details with regard to business. I've been noticing your numbers, and I think you're de-risking yourself from Coal India a little bit. So as a percentage of the mix, what will Coal India contribute? That's point number one. And since we're talking about revenue contribution, I think exploration is the highest right now, as a percentage of your business, maybe 40-45% or thereabouts, but margins are relatively lower. So if you could break it up for us, how do you see the revenue evolve from year on in terms of a contribution? Please go ahead.
So thank you. First of all, to answer your first question, we had about 67% from Coal India last year and 33% from the government, public sector, as well as private sector companies. Looking forward, we will be maintaining 33%, 35% of revenue outside Coal India for some time, and then increasing our outreach to mineral and other sectors as well. If you see the in mineral sector, coal is the largest volume, and in Coal India has the largest volume, and Coal India is our anchor customer. So most of the volume is from Coal India, and that is why revenue from Coal India is at this level. And as there is a lot of opportunity for coal to grow now in the current situation, and Coal India is diversifying into critical minerals and REs, and as well as renewable energy gasification. So we are also going with them into diversification of Coal India, as well as we are taking our own diversification initiatives as well. So the revenue position will be similar. As far as our exploration vertical is concerned, of course, the largest volume is from exploration, and there is a lot of push from government for increasing exploration in coal as well as mineral sector. In coal, if you see the coking coal and high-grade non-coking coal are required for steel sector as well as for the import substitution. So a lot of exploration opportunities there. As in fact, the NMT funding has been increased by 50% by the government.
Sure. Mr.
Singh? Yes.
Just wanted to get a little more color with regards to the revenue from Coal India. You have been reducing it strategically. It was at over 80% maybe 2 fiscals ago. It's now at around 66, 67%. What is the target that you would like to eventually have or get to when it comes to revenue from Coal India and revenue from non-Coal India entities?
So that is why I was telling that Coal India is also diversifying outside coal.
Correct.
So that part being with us, similar kind of we can expect from revenue from Coal India. As we are diversifying on our own into minerals, critical minerals, and REs, as well as the renewable energy sector and non-mineral activities also. So a major chunk will be coming from these diversified activities. But as we will be with Coal India on their diversification initiatives, so overall, I think this will be a similar picture for next few years.
Okay, all right, got it. Interestingly, your overseas revenue is quite little at this point in time, but you want to increase it over the next 5 years to around 10% from the current 3 or 4% that it's at. Tell us, what kind of initiatives are you looking at to do that, and are the margins better abroad?
We have done works in mineral-rich African countries. We did one under G2G for Tanzania, then on our own, 2 works at Mozambique. 1 work we are again getting from Mozambique this month. So we have validated our rates outside India as well, and we have good margins there as well. Again, Coal India is also going outside for critical minerals. We are going with them. So that is again an opportunity with Coal India, as well as we are looking for more opportunities, especially in exploration and downstream services.
So rare earth exploration is what I'm guessing you're talking about.
Yes, so exploration opportunities within India and mineral sector are improving with the opening up of rare earths as well as critical minerals. And outside as well, there are exploration opportunities in minerals as well as critical minerals.
When as you mentioned, Coal India is the anchor, it's always a little bit sketchy from an investor perspective with regard to receivable days. But I'm noticing that you all have done some work on that front as well. Receivable days actually have come down. Could you tell us how do you see this number evolve and where should it stabilize at? If I got the number correct, it's come down to sub 100 days.
Yes, it's coming down. In fact, very recently, Coal India has taken a decision to give upfront 75% on every bill and then balance 25% after the verifications. So this will further reduce, and we will bring it down to 90 days.
Okay. All right, Mr. Singh. We're going to leave it on that note. Thanks very much for joining in and speaking with us. So that is CMPDI talking about their new IPO, which is hitting the markets. We'll take a short break, but get you a lot more in terms of the markets as well as stocks. Stay tuned. Welcome back. Well, for the Nifty, we have the Nifty up around over 300 odd points at this point in time, but it's really the broader markets which are making a dash for the green today. So up around 1.6% currently for the mid-cap index, which is building on gains at this point in time. But let's shift focus to our special segment where we will get you a few ideas for profit from Money Control Pro. Bharat Gyani of moneycontrol.com joins in to talk about a stock that he's tracking closely. Bharat, over to you.
Today's ideas would be Sammy Hotels Limited. The ongoing US-Iran crisis would have a limited impact, as Sammy has lower dependence on foreign tourist arrival, which forms about 15% of the room nights sold. Also, LPG shortage owing to the ongoing crisis would have a limited impact, as Sammy's contribution of food from the overall revenues is relatively lower at about 15%. The domestic demand momentum remains strong. Also, the key markets in which SAMI operates, that is Delhi NCR, Hyderabad, Bangalore, and Pune, would see limited supply addition. Hence, we expect the pricing growth to sustain. Additionally, the company has added about 220 keys, as well as renovated about 130 keys in the 9-month FY26 period, which would be an additional growth driver. SAMI's debt has significantly reduced post the GIC deal, making the balance sheet strong. At the current market price, the stock is trading at an EV by EBITDA of 10 times FY27 projections. Important point to note is SAMI is currently trading at approximately 10% discount to the replacement cost, which makes it an attractive bet in the current scenario. Thank you.
Thanks a lot for that, Bharat. We'll keep an eye out on that particular name with regard to the business and the discount that it trades at as well. But on that note, we'll wrap up on this edition of Chartbusters. That's it from Ekta, myself, and the entire team. You stay tuned. Trading Hour comes up next.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Patakia. There is some bit of relief on the screen, and to share that relief with me is Ritu Singh from the Bangalore studios. You can call it some relief. It's not necessarily a rally per se because of the 800-point drubbing that we took yesterday, but still holding on to the highs of the day, even though oil prices have recovered from their early morning lows, but still continue to remain around that $105 to $110 mark. Ritu, morning.
Good morning, Hormaz. Yes, what a relief it's been after the kind of losses traders would have gone home with in yesterday's session. That fall wouldn't have been taken well, but yesterday we're up almost 300 points on the Nifty, adding to about 626 points that we had gained in the first three sessions, and then of course lost more than 700 yesterday. So yes, a bit of an up move today. If you look at the market breadth as well, it is in favor of advances, about 4.3. More than 4 stocks are advancing for every 1 stock that is declining on the National Stock Exchange. You have the Bank Nifty also that has recovered almost 640 points up in trade today. Yesterday, of course, you had the HDFC Bank news that was dragging this particular index down and the markets lower. But today there is recovery. Even in the broader markets, the mid-cap index is now up about 1.6%. The small-cap index almost 0.7%. So broad-based recovery is what we're seeing. That's where we're currently at. But in terms of specific movers and shakers and, the names to keep an eye out on, in the trading day today, let's go back across to Hormaz, who's walked over to the wall to take us through his list.
23,151 is the level the Nifty needs to close above to register a weekly gain. Now, as of the first 100 minutes of the trading session, it is pretty possible that it is a likelihood that it might happen. So, as of now, we are positive for the week. Despite the drubbing that we took yesterday, and that is courtesy the Nifty Bank. 600 points higher, the index had seen a bit of a dip from lower levels, so it's still off around 200, 250 points from the highs of the session, still holding on to gains of around 650 points. But the bigger contributor to the Nifty today is Reliance Industries. 3% higher now on the stock. It has moved above its 50-day moving average. So that is another positive that is coming in for the index heavyweight. And this is despite the headwinds that are seen in HDFC Bank. But the other major trigger is the currency. The currency was shut yesterday. The trading resumed earlier this morning. And after making a record low of close to 93.30, the currency is seen a slight bit of a cool off. It's back at 93.20. Now, take a look at the specific movers in today's session. There have been sectors that have done well. It is courtesy of this rupee depreciation that the IT stocks are doing well. Accenture also came out with its results in yesterday's session. Oracle Financial, Tech Mahindra, HCL Tech, actually large cap IT, mid cap IT, all of them are doing well because the depreciation in the rupee is a positive for their margins. So IT is a sector that has done well today. On the flip side, what has not done well, or what was supposed to not do well because of the stronger dollar, were the metal names. And these metal names, before we get to that, look at the sugar stocks. Sugar stocks have seen sharp up move in today's session as well, 5 to 6% higher on Dhampur, Sri Renuka, most of these names doing well, and this was despite the cool off in the crude oil prices. Now let's take a look at the metal names and look at GMDC. That's up 10% in today's session. The dollar has cooled off slightly in today's session. Tata Steel, after a positive brokerage note that came in earlier in the day, and despite the sell-off in silver, Hindustan Zinc is up 3 and Vedanta 2, trading with gains of around 2.5%. Now take a look at the other newsmakers. HDFC Bank continues to be under pressure, down 5.5% yesterday. That's another 2% shaved off in today's session. Metropolis is trading ex corporate action today, so 2.5% lower. Petronet, the price target today was cut by Nomura, maintained its buy rating, but still down around 3.5%. And MCX, we'll talk more about why MCX is under pressure later on during the day, 2.5% lower in today's session as well. So currently the market's doing fairly okay for itself. There are sectors that are doing well, but HDFC Bank continues to remain the pain point. But the big talking point though, Ritu, is the currency.
Absolutely, Hormaz, and that is our big story today. The Indian rupee under sharp pressure, breaching that 93 to the dollar mark for the very first time. Now, in trade this morning, the currency has weakened by more than 0.6%, and it has marked a fresh record low of 93. So, what's really driving this fall? At the very core, it is the very same things we've been telling you about for a while. The perfect storm of global and domestic factors that have been in play. Rising oil prices are pushing up dollar demand for importers. Foreign fund outflows also continue. That is adding to the pressure. Add to that, you also have a stronger US dollar globally, and the pressure on the rupee has only intensified. In fact, since the start of this Iran conflict, the rupee has now fallen by more than 2.4%, and it is now down to 3.6% so far in 2026. But, what is really striking is the speed of the fall with which the rupee has been going down. We've looked at how many days it took for every 5 rupees per dollar fall, to really put in context as to how fast this has taken place. But, nearly 5 years for the rupee to move from 65 to 70. More recently, almost 1 year. It's on your screen right now from 85 to 90. But if you look at the current move, just 107 days for the slide from the 3rd of December when the rupee hit 90 rupees to 93 rupees in trade today. And that tells you the depreciation is accelerating very sharply. Now, of course, the Reserve Bank of India has been actively intervening. We understand it has already sold more than $15 billion just in the month of March to defend the currency. And if you look at its forward book or the net short dollar position, that is already now close to $100 billion, which is up quite sharply from $68 billion in January. And, typically your forward book rises when RBI is actively managing depreciation pressure. What this means is RBI is supporting the rupee now, but some of that pressure, of course, is being pushed into the future because this is in the forward market. Now, a large part of RBI's recent activity has also moved to the onshore or rather offshore market with a focus on the NDFs. These are dollar settled contracts, unlike onshore trades, which involve the local currency. So that lets RBI manage the rupee movement without immediately using up the forex reserves. Forex reserves also, by the way, have fallen very sharply in the last week. We'll get the latest data later today. There is also a very seasonal angle that is at play here. Typically, you have RBI intervention that picks up towards the end of the financial year when corporates are also settling their books. And March has often been seen as relatively stable closing levels historically. But this time, again, you can see those numbers on your screen. The pressure is much, much stronger. But, also keep in mind, if you zoom out and look at the picture, it is not just India. Most Asian currencies have weakened since the Iran conflict began. The Thai baht, the Philippine peso, the Korean won, they're all seeing sharper declines. But that said, rupee is still among one of the more pressured Asian currencies in trade today.
Indeed, and there is some bit of cool off that you're seeing from the highs, though. It's 93.19 now is where the currency still is, but significant depreciation nonetheless. And by the way, in some of the movers other than that, the one that I just highlighted, Acme Solar is one of them. The stock was up 8% in yesterday's session. It has cooled off slightly now, seeing some profit booking today. What is also seeing some profit booking today is BSE. That's down 2% as well as we speak. And while most of the metal stocks are doing well, the only one metal name that has not done well today is Nalco, and that is the stock that has seen some pressure in today's trading session. So that is where the situation for the market currently is. But we'll take a short break on this note. On the other side, we'll get you more on the markets. Stay tuned.
CNBC TV 18 and India Bonds present Bond Street.
Welcome to Bond Street. Joining us today on Bond Street is Suyash Chaudhary. He's head fixed income Bandhan AMC. Suyash, hi, thank you so much for your time. Suyash, would be interesting to know also if the India Global Index inclusion genuinely changed the bond markets or the debt market therein, or is the impact is still very, very modest?
So far, I would say the impact is quite modest. I mean, the flows that we are seeing so far, courtesy the bond index inclusion a couple of years back, versus the size of annual gross borrowing, it's still a work in progress. We do hope that over the next 5 odd years, FPI participation in the Indian bond market will progressively rise, although we are in the midst of a bit of an interruption to that for the time being. But yeah, I mean, if you were to see 5 years from now, probably you'll have better FPI participation than what exists today. If you see the dynamic of the last 1 odd year, like I said, a major buyer of government bonds in the last 1 year has actually been the Reserve Bank of India, which they have done for a very legitimate reason, which is that because of their currency interventions, because of their need to smoothen the volatility in the rupee-dollar rate, they have had to sell a lot of dollars, and that has absorbed rupee liquidity from the system. And in order to compensate for that, they have had to actually buy bonds to replenish that liquidity. But around 75% of net government bond issuances over the last 13-14 months, in effect, have been absorbed by the Reserve Bank of India. And therefore, as they step back, we expect a bit more commercial demand and supply to take hold. And therefore, we will have to adjust to a level where it becomes more interesting for even global participation to rise progressively. This is, of course, after the volatile period that we are witnessing today versus the price, as one hoped for in the days ahead.
So should you say that the OBPPs and the time, since they have started coming into the market, they are expanding access to bonds. Do you see that changing now, or do you think investors are still a lot into traditional debt funds or FDs for that matter?
So, the bond trading platforms are an interesting addition to the India bond market insofar that over a period of time, they will enable more utilization of this market. As we are seeing in the equities market, retail participation actually has played a very large role in smoothing volatility in that market and deepening that market, etc. And one hopes that over a longer period of time, the same thing starts to happen for the Indian bond market as well. However, most of the direct bond participation so far in the market is largely institutional, which is through banks and insurance companies and mutual funds and so forth. Retail participation tends to be indirect because whatever deposits you put, a percentage of that bank end up buying as SLR. If you subscribe to an insurance policy, the insurance company will also buy government bonds to some extent against that, or for that matter, corporate bonds against that. So, the participation of retail savings so far has been more indirect into the bond market. To some extent, both via the mutual fund route as well as through the bond platform route, one is seeing the slow rise of retail in the bond market. So, assessing what your needs for investment.
So, if you look at 5 years out, and what do you think will shape India's debt market more? Is it going to be rates, flows, retail participation, or these platforms like OBPPs will also have a big role to play?
So actually, I look forward to all of these progressing in the next 5 years. Like I said, there is a process of deepening the Indian bond market as well, which is well and truly underway. So FPIs or foreign investors will play a part, which will diversify part of the demand for India bonds. The continued retailization, both via mutual funds as well as bond platform routes, will play a part, as well as the normal institutional commercial demand for bonds through the pension funds, the mutual funds, and the banks will play a role. We do think this will enhance liquidity in the bond market over a period of time, not just for sovereign, but for potentially corporate bonds as well. And that in the journey of evolution of any financial system, the bond market has to play a very large role because a large part of the financing needs of any balance sheet is met via the bond market. So, we do think that this need will have to be met by a progressive expansion of India's bond market as well. And a lot of what is happening today is basically building the blocks for this to happen over the next 5-10 years.
Suresh, let me wind down this conversation with one final question. So what would you say is the place of debt or bonds in a portfolio? And with the kind of scenario that you're in, how much of one should include that? And then you, from the place that you're sitting, how would 2026 pan out for you, given the fact that there's geopolitics and trade tariffs and a rate cut cycle which is not going in the direction that markets anticipated?
Having a reasonable bond allocation to your overall asset allocation gives you some bit of counter cyclicality, which means that if you only have pro-cyclical assets in your asset allocation table, which is, let's say, equities, credit, commodities, and so forth, then when invariably you get hit with an adverse economic or financial market cycle, you potentially have nowhere that smoothens your return over a period of time. So we think fixed income or quality bonds play that very important role, even though the expected return profile there may be nowhere close to, some of the growth assets that you hold in your asset allocation table. And we do think that's a very important aspect to consider when one builds an asset allocation table. So, irrespective near-term volatility, and like we discussed earlier, there are enough opportunities in the bond market, especially in front-end corporate bonds, provided one has, like I said, some appetite for volatility. We will potentially enter a rate hike cycle if, the situation that is unfolding today actually leads to some bit of rise in inflation, etc. But if one has a sufficiently long investment horizon and one is controlling the total risk that one is taking, and one has some appetite for volatility in the near term, this is as good a time as any to build bond allocations into one's portfolio. In fact, I would say, if the global macro environment is getting more uncertain, then the need to have this counter-cyclical allocation, which is bond allocation, is probably something that needs to be addressed sooner rather than later.
CNBC TV 18 and India Bonds present Bond Street.
Welcome back. Now, the ongoing disruption around the Strait of Hormuz amid the West Asia war is beginning to impact real estate as well. Developers are facing delays of 10 to 20 days for shipments of construction materials as vessels are being rerouted via longer routes, and also investments have slowed down. Sumit Kumar, real estate research analyst at JM Financial Institutional Securities, is with us now, to give us an overview of the sector. Sumit, thank you so much for joining us here on CNBC TV 18. NRIs account for 10 to 15% of real estate investments. If you're beginning to see delays, cancellations, deferred bookings on account of what's going on in West Asia, to begin with, which developers are most vulnerable with the weakest balance sheets heading into this? And at a time when you have steel that's up 20%, shipping cost is up, tile, ceramics, all of that is squeezed. How much will it add to a developer's per square foot cost? Is there a calculation you've done?
Okay. Good morning, and thank you for having me on the show. So, to answer your first question, I think the segment that gets impacted by the geopolitical disruptions that we've seen recently is the luxury and the uber luxury segment, which have a significant proportion of NRI buyers. So, any developer with a significant presence in luxury. Wouldn't like to name particularly, but I think luxury as a segment will get impacted to the extent that a lot of the inquiries and the sales or the pre-sales happen through the NRI channel. So I think that should get impacted, but it will not be a structural issue. I think it's more sort of a short-term phenomena, and it probably recovers as this situation sort of comes to a halt. So don't see that as a structural issue. Probably in the Middle East, in cities like Dubai, because there are certain Indian developers who were looking to venture out. That probably should be maybe postponed or it gets delayed. There is an element that a geopolitical risk premium gets added, and you see valuations correcting at least for the short to medium term in Dubai. From a pre-sales perspective, for the Indian developers, don't see much of an impact. Obviously, it will play on the sentiments, but not really a structural issue. And my guess is that the NRI channel contributes about 20% of pre-sales to the listed universe. So that's about it, and should have a limited impact and a short-term impact if there is any.
But Sumit, you mentioned that this may be a short-term impact. Yes, but does that also mean that the main component here, of course, gas is becoming a big concern here right now because of the statements that Qatar Energy has put out as well yesterday. Do you not believe that if this goes on for a prolonged period of time, that will have an impact on the ongoing projects, and of course, based on whatever is happening in the global economy, do you believe that this would also end up having a transient impact on the sector as a whole?
Yeah, you're correct. To a certain extent, look, construction costs contribute about 35% of the total cost. The rest would be land, which is, quite expensive, as well as, other approval related costs. So land is almost 33 to 50%. If you see Mumbai, it's about 50% contribution. In other cities, it's about one third. And then the one third is basically the construction cost, where you have all the raw materials that go into construction, steel, concrete, the other equipments related to MEP, all of that. So if there is concerns around supply chain disruptions and the inflation linked to it, I think to the extent of construction costs contributing about one third, I think there would be a 2 to 3 percentage points impact, but that depends again on how long this war prolongs, what sort of supply chain disruptions we see. Of course, you've heard news around tile production, etc. All of that getting impacted. But again, from a overall pie or overall exposure in terms of construction cost, and then in particular looking at individual items, I think there is a single-digit exposure or risk there. But what I'm more worried about is the interest rates going up, and real estate is a rate sensitive or an interest rate sensitive sector. So any inflation will lead to sort of the interest rate cycle maybe turning around, and we may see some rate hikes. And that has a double impact in a way that, your cost of interest and your cost of borrowing goes up, as well as the cap rate or the valuation basis also moves in tandem with the benchmark rates. So your valuation goes down, your interest costs also go up, your cost of borrowing goes up, and that hits the bottom line. And that's what we've seen, in terms of sentiments that has hit, the valuations of the real estate stocks in particular, and that actually explains the weakness that we've seen in the last week or so, or maybe in 2 weeks.
All right,
To answer
Sumit,
the question, I think
unfortunately, we've run out of time. A lot more to ask you, but we'll have to bid you goodbye. Thanks very much for joining us here today on the show. With that, we'll slip into a break, but when we return, we'll get you more on the markets and specifically market technicals when we return with Ajit Mishra from Religare Broking and also his top trading bets.
Welcome back. There was a brief period just a few minutes back when the Nifty had managed to test levels of 23,350 and now it has a slight cool off from there. So we are back at those levels at which we had started the show at, back at 23,300. There's still a 300 point up move on the index that we see. HDFC Bank though has extended its losses. It's now down 2% as we speak. So another week of losses for HDFC Bank. It's turning out to be the fourth straight weekly loss for HDFC Bank. It's turning out to be a 52-week low for the stock today as well. Ajit Mishra from Relier Broking is now joining in for a quick chart check. Ajit, good morning. Now that you've seen this bounce, do you use this to trim your long positions again because you expect a retest of the lower levels that you saw yesterday? Or do you carry your longs into the weekend if you are brave enough and then see how things turn out on Monday?
Good morning, Homaz. So, Homaz, I would rather trim my position considering that there is parameters still intact. Means if you see the India VIX is still around 22 mark, crude definitely has cooled off substantially after testing $119 mark yesterday, and still we are at around 106, 107. So in case if there will be any further developments over the weekend, possibility of crude again inching higher towards 110, 112 is still high. So keeping that in mind, I feel that rather positioning yourself on the negative side or taking no position is a good trade, especially in the index. And in case if you want to hedge your position, then look for option strategies, means a bear spread, for the overnight carry and for the overnight carry for the weekend position.
All right, Ajit, any specific names you'd like to highlight for us? Your top trading bets in the current market?
Yeah, so pharma, I believe that largely is likely to hold, and some of the names they are already doing well. So Oro Pharma, after this marginal retracement with hardly any volumes post the consolidation range breakout, gives us the opportunity to accumulate fresh with immediate target of 1345 with stop at 1230. At the same time, since the market tone is negative, one should look for shorting candidates also. So PG Electroplast is where we see fresh breakdown, followed by a marginal consolidation. So it's again like a shorting pivot formation, which is going on the daily chart. So possibly around 468 is something that the stock might test in the near future. So one can go short here with 523 as a stop loss.
All right, Ajit, we leave it at that. Thanks very much for joining in with those views. Let's go across to Sudarshan, who is standing by to get us the latest trends from the F&O space. Sudarshan, what are the cues telling you?
So you can see your major indices are moving higher and up, almost more than Nifty is up more than 300 points, and similar kind of move is being seen even in the broader markets. In the last few minutes, we have seen a big up move coming in for Nifty Midcap Index and as well as Nifty Bank. Nifty Bank is now being majorly supported by ICICI Bank on the upside, but the gains are in the check because there's a sharp fall coming in the HDFC Bank for another day. Now, you have to keep a track on two, three things. First, PSU put call ratio, which has moved higher. It's above 1 versus yesterday's level of 0.9. Second, crude is off highs. It's at 106, but still much of the level of 100. And third is volatility index, that is India VIX. It's still above the level of 20. So these three indicators you have to keep tracking. Has the level come for someone to enter and see the upside in the market? We can't say so, because till the Nifty is holding around the levels of 23,300, it has to go to the level of 23,500 to see any further upside. Now coming to the options data on the put side, 23,200, 23,300 and 23,000. These three put options have seen maximum open interest addition, but premium for all these three put options has seen a fall. There is a big fight going on for 23,300 between both bear and the bull. So 23,300 has become very important level. Once it crosses, then only we can see further upside. Nifty level, so support, first support 23,300. If we breach that, next support comes around 22,930. That's yesterday's intraday low. Resistance 23,500. If we cross that, next resistance comes around 23,800. Some of the stocks that have been seeing fresh longs or fresh shorts on the long side. Coal India is seeing fresh longs, and also amongst banks, ICICI Bank is seeing the fresh long, amongst fresh shorts, LTI Mindtree and Petronet LNG.
Sudarshan, thanks very much for bringing us that. Now moving on, in a surprising turn of events, HDFC Bank's part-time chairman Atanu Chakravarti resigned from his role. We had that news yesterday, adding pressure to the stock. He cited ethical concerns. We also spoke with HDFC Bank CEO Sashidhar Jagdishan yesterday, and he said, yes, there were some disagreements with Atanu Chakravarti, but the resignation itself came as a huge surprise. Take a look at snippets of that conversation.
We had no such indication. My surprise is akin to what the other board members also experienced yesterday when this came as a huge surprise to all of us. So, and actually, most of all the board members did ask him to specify if at all there are any concerns. He did say that he has none to share with. So we did sort of persuade if he could sort of remove some of the contentious lines. But I guess he felt that was his calling and it's something that is innocuous, so he wanted to keep that as it is. I know that these lines did sort of cause a little bit of a stir amongst the minds of the directors, and you can see how the entire investor community has also reacted to this. But I guess the foundation of the company continues to be intact. You've heard the new chairman, interim part-time chairman, Keki, sort of coming out with itself, accepting the position, which itself is a great testimony of the strength and the resilience of the conduct of the institution. Surely in any institution there will be errors and omissions and issues which need to be addressed with a defined timeline. That is not something, so no one can say that there is zero issues, especially when you're running a very extremely large bank. But the icing on the same was the testimony from the regulator this morning as we were going through these various calls, where I saw a statement from the regulator which sort of backed the franchise to the hilt, basis their observations and their inspections over a long period of time.
Mr. Jagdishan, since we understand there was friction between Mr. Chakravarti's style of working and perhaps what was expected out of that non-executive position, just for the benefit of our viewers, if you could elaborate on how your working relationship, how would you describe your working relationship with Mr. Atanu Chakravarti, given that he spent all this time since 2021 working with you?
No, there was no friction. See, in a very good governance model, people have to, and we are a democracy and we are a democratic institution, so people will have to have views. Some of the views we may agree, some of the views we may not agree. That is, so if that cannot be construed as friction.
And Mr. Jagdishan, given that your current tenure is set to end in October, while the board, or at least Mr. K.K. Mistry on the con call said the NRC will recommend your name, have you yourself discussed the matter? Are you willing to stay on as CEO for another full term?
See, there is a process. I respect that process. The NRC will sort of, try and follow that process and recommend to the board, and who will then recommend to the regulator for approvals. If you're asking me whether I would like to be a part of that process as a participant, as one of the candidates, absolutely.
Okay, that was the HDFC Bank CEO talking about, the resignation of the chairman. Let's take a short break on that note. Up next, we'll discuss market fundamentals with Varun Lochab from HDFC Securities.
Welcome back. Still holding on to a 300-point advance, but was leading the pack today on the Nifty are a lot of these metal names. JSW Steel is now up 5%. Tata Steel is up 4.5%. Coal India is up 3.5%. Remember, one of its subsidiaries, CMPDI's IPO, has opened for subscription today. You just heard the management as well a few minutes ago. So metal stocks doing fairly well for themselves today, despite the sell-off that you saw on the commodities overnight. Now, continuing this conversation forward with Varun Lochab from HDFC Securities. Varun, good morning. Thank you for joining in. Since we were on the subject of metals, let's pose that question to you as well. Now, with these concerns surrounding the war, the aluminum inventory is piling up, copper prices selling off. Copper prices selling off is generally an indicator of an economic slowdown, and the sell-off in gold and silver as well. Now, what do you do for a pack like this? The standard question always is whether metals is just a tactical play. You ride the rally out, and once the rally is over, you move out into better opportunities. Does that theory still persist, or do you just see this as a temporary phase for these metal names and they still have a lot more upside to go?
So I think, see, metals are always a tactical play as per us. They are not long-term buy and hold stocks, barring, say, one or two stocks, which would be probably the lowest cost curve producers in their respective industries. But generally, we play tactically. Metals is no longer an overweight for us. It's more like a equal weight. And especially, I think some of the non-ferrous names, we have taken some money off the table. Steel, we still continue to like, and we have Tata Steel and Jindal Steel and Power in our model portfolio. But overall, we are more like equal weight now. And if market corrects further and other sectors correct further, we would be quite happy to go underweight metals, over next 1 to 2 quarters. We believe a large part of the rally in metal stocks has been done already.
So is the large part of the rally also done in a lot of these private banks? Because private banks haven't done much, to be fair. The PSU banks are the ones that have outperformed. But the issues that have come in for a lot of these private banks, you saw one issue last year. You've seen one earlier this year. We are seeing one play out right now for the largest private lender. What do you do in circumstances like these? Is this also a case for PSU banks because they also carry valuation comfort with them?
Yeah, I think, again, PSU banks, middle of last year were very attractive. In fact, we came out with a big sector report and, with a lot of positive ratings, and we did add a couple of stocks in our model portfolio. SBI was always there, but, Indian Bank, Bank of Maharashtra, these were some of the other topics which we had. Frankly, again, if you look at, there is a limit to which their valuation can go, and they would be trading at a discount to private banks given the sustainable ROAs that they are capable of. So in that context, we believe now the trade between PSU and private is not that attractive, that you have to just go and blindly buy PSU over private, which was the case probably 6-9 months back. Now, the good part is private sector bank valuations have corrected after this fall of last couple of months. And while we still continue to be overweight PSU banks in that sense because they have a very small weight in the overall banking index, but I think one can selectively look for private banks as well. Valuation for some of the private banks have also become attractive now. So overall financials we are happy owning, but we had taken some money off the table 1-2 months back, given how well the sector had done. But I think right now there is no big preference for PSUs over private at this moment.
Varun, I wonder if I could push you to comment on particularly HDFC Bank, since that's been in the news. When you say you've taken money off the table, in any change in position as far as HDFC Bank is concerned, and while you're saying there's no big case for shifting to PSUs right now, a marquee stock like HDFC Bank, hardly any returns for investors though.
I won't be able to comment because we don't cover it. Plus, even in our model portfolio, we don't take any active bet on that one, given it's our parent company.
Okay, then I'll move on from financials. Varun, the EMS space, some of these stocks, if you look at them, they were very much the flavor of the season, but they have come off significantly from their highs, as much as 30% maybe for Dixon Tech, Keynes, some of these names. Overall, on the EMS space, are you constructive?
Yeah, I think the problem with some of these themes, be it renewables, be it EMS, is that they have been, well discovered, and the themes were playing for last 1 to 2 years, and valuations has been a big concern in a lot of the mid cap, thematic sectors, and EMS was one of them. Thankfully, with this correction, valuations have become less heady. We only continue to own one stock, Sirma SGS, in our model portfolio in this space. Dixon, we have a negative rating. Second stock, which we like to an extent, is Amber after Sirma. But that's it. Dixon and Keynes, we have avoided. And overall, we believe still they are not in a very attractive zone, from a valuation and growth sort of a perspective. So it's very stock specific. Certain stocks, if they are going to deliver, growth the way Sirma has been doing over last, 3 to 4 quarters, then there is still some room. But again, valuations even out there are not cheap now. So one has to be very, very careful in this space, because we are paying a lot for growth. If growth falters, given whatever, is happening around the world or domestically, then the risks are more to the downside than to the upside in some of these thematic sectors still.
Rather, risk to the downside also applicable for oil marketing companies, because they have been smashed in this US-Iran war. All of them, HP, BP, IOC, all of them are down 25-26% already this month. With the earnings risk that they face, is an attractive dividend yield a good enough prospect for someone to hold on to these names, or do you await the situation to die down and then have better entry points?
No, I think oil marketing, one can look to kind of add them in this fall. I'll not be overly worried on this. Obviously, 1 or 2 quarters, their earnings will get impacted. That's a known thing. But I think stocks have priced that in now after this sharp 20-25% fall. And valuations on a normalized basis, if we assume that crude will not sustainably remain above 100 for rest of FY27, then we expect in second half, their margins and marketing margins should normalize. In that case, I think oil marketing companies are looking okay to us. They are not like, we don't have huge sort of overweight on this space, but we don't mind, adding some at today's prices, frankly, if you were to ask me.
All right, Varun, pleasure having you today. Thank you so much for sparing time and joining us with your views and insights on sectors and specific stocks as well. Take a short break. Back with more on the markets on the other side.
Welcome back. It's time to get you a check of the macro signal that we're tracking for today. Now, at a time when markets are debating whether India's consumption cycle is peaking, it is worth stepping back and looking at what the credit data is signaling, because the latest credit data shows how households are choosing to borrow is starting to change. Now, in the last 15 years, retail lending has clearly outpaced the broader system credit growth. So the non-food credit growth, that has been about 12.7%, but retail loans have expanded much faster at 16.7%. And as a result, retail share in total credit has jumped from 19% in FY10 to nearly 33% in FY25, which means 1 in every 3 loans given out by banks today is retail. And this outperformance is not really new. It's been building for nearly a decade, because between FY10 and FY15, there was virtually no gap. But from FY15 onwards, personal loans started pulling ahead, growing 7 percentage points faster than the system credit at one point. Now, even in the last 5 years, that gap remains quite strong at about 5 percentage points. But now, here's where the story starts to get interesting. The mix is changing quite drastically. Unsecured personal loans are slowing down, obviously after RBI's measures on higher risk weights, etc. Credit card growth has nearly stalled, and consumer durable loans are actually contracting. But on the flip side, you have the faster growing segments, gold loans, which is up nearly 129%. Vehicle and education loans also seeing steady growth. In fact, gold loans are in a league of their own. They've grown at more than 30% compounded rate in recent years and surged around 125% in FY25 alone. And it is now currently the fastest growing segment in retail credit by far. Now, structurally, housing continues to dominate the retail pie at about 50%. They have larger ticket sizes too. Vehicle loans are stable, but unsecured personal loans have seen a sharp rise over the years, from 18% to nearly 26% of all retail credit. And that build-up, however, is starting to moderate. Now, importantly, asset quality for retail is also holding up. Retail NPAs remain quite low at about 1.1%, with even credit cards and home loans below 1%. So there's no immediate stress signal on that front. And overall credit growth is still strong. Non-food credit growth, the latest data shows, is well over 14%. Retail at more than 15%, still ahead of industry. So the headline growth story is intact, but the macro signal is this. Now, while India's retail credit boom is not slowing down, it is shifting, from unsecured consumption-led lending to more secured collateral-backed borrowing, and that is led by gold loans, which suggests some caution also creeping in at the margin for households, especially in light of very recently what we're seeing with gold prices seeing a bit of a correction, and that could reduce the loan-to-value ratio for lenders, potentially trigger some margin calls for borrowers, and that is the one macro signal that the market needs to watch out for. On that note, it's back to you in the studio, Hormaz.
Well, shifting is the trend, is what you highlighted, Ritu. Thank you for highlighting that. By the way, what has also shifted is a slight bit of momentum from the markets, 23, 300, 350 odd. We've shaved off around 120 points from the highs of the day. So a little bit of slowdown as we go into the second half of the trading session. But Ritu and I take your leave on this edition of Trading Hour. Halftime report on the other side.
Stocks perk up following Netanyahu's comment on the Iran war ending soon and Scott Bessent's statement on rolling back some sanctions on Iranian oil. The Sensex and the Nifty is off the day's high, but utilities, metals and consumer durables remain the prominent gainers.
Gujarat approves a power purchase agreement with Tata Power's Mundra unit and a big boost for the company as the state will off-take half its output. The company expects similar pacts with other states soon. The stock charges up.
Rupee slides to a 93 to a dollar on rising demand for the greenback as oil prices spike and foreign funds continue their selling spear. RBI's net short position swelling to near $100 billion from $68 billion in January also sparks concern.
The HDFC Bank CEO tells CNBC TV 18 his relationship with the former part-time chair Atanu Chakrabarti was cordial, though they did disagree occasionally. He also expressed keenness on being considered for a new term as CEO, while his conscience was clear on the Leelavati issue. Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra. With me is Vinny Motiwala. Well, it's turning out to be a day where we are seeing some amount of respite for the markets, but the key question is whether or not it continues. So currently we have the Nifty, which is up around 230 odd points. It's off today's high. We have the mid-cap index, which is also shaved off what it had gained earlier. So currently higher by around 640 odd points, up around 1.1%. Remember, at one point in time, it was up around 1.4%. The Bank Nifty also higher by around 0.8%. Overall, the texture of the market looks good because we have the advanced decline ratio, which is on the advancing side. So currently at around 2,900 stocks advancing to around 1,250 stocks declining at this point in time on the Bombay Stock Exchange. So let's see whether this sustains. As of now, it seems as though we're going to end the week on a positive note.
Okay, good end to the week, right, Ekta? We did see some green, then red, and again a green. So not a bad way to end the week. Hope this sustains. 23,230, like Ekta mentioned as well. That's the level. All the sectors today are trading in the green. Leading the charts is PSU Banks. We have metals, energy, all of them buzzing away in trade. But we have a very exciting lineup for you all on the show as well. So we'll be putting the spotlight on power stocks in our What's Trending segment on the Central Electricity Authority's 10-year power plan. Then we'll also be speaking with Sunil Chodia, who is on the second order impact of MSME sector. Moving on, we'll also later on focus on Durandar's 2's release that is there and the key tailwinds that actually come in for media stocks. And in a special segment on Commodities Corner, Manisha Gupta will also be speaking on commodities fronts with a special guest, so do stay tuned in for that conversation.
Okay, all right. That's a power pack line up in the next 60 odd minutes. But time now for our What's Trending segment. The maiden edition of India's biggest electricity summit, Bharat Electricity Summit 2026, saw a key announcement. The Central Electricity Authority has come out with a 10-year plan for the power sector in India, where the composition of India's power sector capacity is set to change. We have Vivek, who's joining in to break down the details and the key beneficiaries on our What's Trending segment. Vivek, over to you.
Well, thank you so much for that, especially when you're looking at the power segment. Remember, this is on the sidelines of the Bharat Electricity Summit, where our colleague Manisha Gupta too has been interviewing various stakeholders as far as the entire power sector, as power, entire energy ministry is concerned. Now, last evening on the PIB website, as well as the Central Electricity Authority's website, you did see details emerging as far as India's 10-year power capacity addition plan is concerned. Now, to give some context to our viewers, remember, the current capacity of India's power sector is close to 521 gigawatts. So in the next 10 years, it's expected to more than double. And by 2036, we are expected to reach close to 1,121 gigawatts of total power capacity. Now, in terms of which are the sectors or which segments of power is expected to see maximum capacity addition. Remember, coal is expected to jump up to almost 315 gigawatt from the current 235 gigawatt, but the pace of addition for coal growth and thermal power is expected to be slower, given the fact that India at various summits, especially at COP26, has always said that they will be reducing the speed at which thermal power is increased and will be increasing other sources, namely the renewable energy source. Now, coming to the solar space, the one that we will focus on the most, remember, currently India has close to 156 gigawatt of solar power capacity. By 2036, it is expected to jump up significantly to over 509 gigawatt. And wind too is expected to triple from 55 to 155 gigawatt. Now, in terms of the stock market impact, and especially for investors, which are the stocks you will be focusing on? Well, we've culled out a list and spoken to various analysts. First on the list, of course, has to be the kind of capex that the transmission sector is expected to garner. Power Grid will be the key beneficiary there. 1.7 lakh kilometer of new transmission line at an estimated capex of 7.93 incremental lakh crore is what you will see. Remember, that is something that will benefit also HVDC players like G1 T&D, Siemens Energy. The entire value chain there will definitely benefit. Now, on the other hand, a slightly muted read-through, especially when you're looking at BHEL, given the fact that a whole host of analysts have been talking about the terminal value for coal power plants in India, and only 16.4 gigawatt of incremental ordering from PSU space is expected in the next 10 years.
Okay. Vivek, thank you so much for that. A whole host of names that come in from the cap goods, power, transmission side. So you should keep an eye out on those names. But Tata Power, there's some positive news flow coming in here for them as well, Vivek. And the stock is also trading with some bit of a gain here today.
Well, it's been a decade-long struggle that Tata Power has had, especially when it comes to the Mundra power facility. Mundra, remember, is a UMPP, an ultra-mega power plant. Now, the key worry here was the fact that the company, which was importing coal from Indonesia to fire their thermal plants, actually faced an issue given the fact that the Indonesian government had declared a force majeure and had started taxing the coal exports out of the country. On the back of that, it became unviable for Tata Power to run the facilities at Mundra. So over the last decade, the company has been speaking to various state governments. Remember, the company supplies power to 5 state governments from this particular facility itself. And the plants were shut on multiple occasions, given the fact that they were unable to make even a cost plus, or they were unable to even recover the losses. To give some perspective, in FY26 alone, where Section 11 was not active, the company and the management corroborated this particular fact with us, that the company suffered a loss of close to 1,000 crore just because this particular plant wasn't up and running. Today morning, like you mentioned, the Gujarat government has gone ahead and signed a supplementary PPA with Tata Power. The company said that the terms and conditions for this particular PPA are in line to slightly better than the Section 11. And on the back of that, they expect all of the losses to now get arrested. It's a significant development for Tata Power, and analysts on the street have immediately started upgrading their EPS targets.
Okay, all right. Thanks very much for that, Vivek. So Tata Power up around 2.3%. In fact, let's extend our What's Trending segment and listen in to Praveer Sinha, who's the MD and CEO of Tata Power, on the signing of this PPA.
Now the approval has come, and based on the SPPA, which is agreed with Gujarat government, we'll be taking with the other 4 procurers, namely Maharashtra, Rajasthan, Punjab and Haryana, and hopefully in next few weeks we should be able to close this. So last 9 months we have not been able to operate, and we are still working out the details which is there. Yeah, somewhere around that.
That's the word coming in from the MD and CEO of Tata Power. But markets move in cycles, and for 26 years, we've been tracking them closely, because in volatile times, what investors really need is insight, not just information, and above all, perspective, not panic. Now, if you have any questions about your investments, we are here to get them answered with the guidance from experienced market experts and understand today's fast-changing market environment. So join our special market editors on your stocks as well as MF Corner every day at 2 p.m. on CNBC TV 18 and stay one step ahead of the market. On that note, we're going to step into a very short break. Thanks for staying tuned into Halftime Report on CNBC TV 18. As of now, Nifty obviously has come off from the day's highest point, but still managing to hold on to the gain. Look at it. Since 11:30, we're seeing a bit of a decline. So that's where it's come, 23,200 levels. Before that, it was about 23,300 levels. So obviously, off the day's highest point, a bit of a downward trend that's shaping up for the markets. We'll watch out for that. IT continues to do well. Broader end of the market, the mid cap, also managing to hold on to gains in the trading session. But considerably, all of them are a bit off the day's highest point. So just hope that this positive side that we're seeing, 1+% gain, is something that maybe continues for the market. A lot of moves that have come in, especially in the last 15, 20 odd minutes. Also, if you look at it, look at GMDC. That's the stock that's seeing a sharper cut coming in, especially in the last 20 minutes. Keep an eye out on that one as well. GMTC from the day's highest point, that's also come off. Look at it, in the last few minutes, that spike down has come in. MCX also has come off from the move as well. So MCX also in the last odd minutes, 15, 20 odd minutes, is down almost 1% as well. But yes, let's move on. And India's obesity as well as diabetes drug market is on the verge of taking off. Semaglutide, the molecule behind Ozempic and Wegovy, will go off patent this Saturday, paving the way for low-cost generic drugs to enter the market. Ekta has analyzed all this data. How could this reshape India's diabetes as well as weight loss market? Let's go across.
India's weight loss and diabetes drug market is on the cusp of a major shake-up. While the market is currently dominated by Mounjaro from Eli Lilly, which has generated close to 900 crores in terms of sales within a year of launch, semaglutide, which is the molecule behind Ozempic and Wegovy, is going off patent in India on the 21st of March, likely triggering a wave of lower-cost generics. Now, the real inflection point is this. Mounjaro's patent runs well into the mid-2030s, but semaglutide is going off patent now, making it the first widely accessible weight loss drug in India. That gives it around a 10-year runway as a more affordable alternative before the next wave of patented drugs enter. This is already triggering a rush to tap into India's 100 million diabetics, the large, thin, fat population, and with 25 out of 100 people being either overweight or obese in the country. But this accessibility will come with a sharp pricing reset. From current monthly costs of around 8,800 to 16,400 rupees, prices could fall 50 to 70%, with estimates of 400 to 500 rupees per weekly shot within a year. According to Nomura, 400 rupees a week could be the tipping point, unlocking an addressable diabetes market of nearly 2 lakh crore, comparable to India's entire pharma market size. The semaglutide opportunity itself could scale to 9 to 10,000 crores, including obesity and lifestyle use. Companies are already positioning themselves aggressively. For example, Zydus has partnered with Lupin, with 5 brands planned between them. Eris has tied up with Natco, and even innovators are expanding access ahead of competition. Novo Nordisk, for example, has partnered with Emcure and Abbott, while Eli Lilly has tied up with Cipla to widen Mounjaro's reach. Lastly, a few points to watch. Analysts expect the top 3 to 4 players to capture the bulk of the opportunity, while premium patients may continue with innovator drugs. Markets could expand beyond Maharashtra and Delhi, but companies may face high volumes with tighter margins. What will be closely watched is quality, given the complexity of the drug and fear of side effects. And if newer therapies, then sentiment. For now, the key question remains, can semaglutide truly go mass market in India, and in doing so, reshape the Indian diabetes and weight loss market?
Okay. Thanks so much for that, Ekta. But, the war in West Asia, that has resulted in energy costs that are spiking, LPG shortages that have come in, disruptions in logistics are also there. Now, to talk to us more about the impact of this, that it has on MSMEs, what does it mean for them as well? We have Sunil Shodia, who's a chairman, CII National MSME Council, as well as CMD at Rajratan Global Wires, joining us right now. Hi, sir. Good afternoon. Thank you so much for joining us on the show. You know, this is such an uncertain time. There's so much that's happening every day. Whether, you know, there are attacks that come in on the gas fields, oil fields, disruption on that front. If you could highlight right now in these last few weeks, what's been the impact on the Indian MSMEs? Maybe what is the concern that you're seeing overall right now?
You know, what we see on the TVs is the disruption happening in the war zone in the West Asia for us. But I can say that the impact on industries and manufacturing is equally big in India also. The impact is quite severe and widespread. So MSMEs are affected because of non-availability of energy, high prices of all the inputs, whether it is metal or plastic or energy cost has gone up. And on the top of it, there are logistic issues. You know, the exporters to West Asia are all affected. They are not getting containers, they are not getting ships, and the material is either lying in the factories for ready to dispatch. And this being the month of March, year end for all the companies, okay? All the MSMEs and manufacturing companies have high target of completing their, pending orders. So there's a huge disruption in the supply chain across all the sectors. I will say if somebody says I am not affected, he may be telling a lie. But overall, when we meet our members, when we talk to our members, we have collected information, and almost everyone in the value chain is affected.
Okay. Well, Mr. Chordia, you know, just wanted to get more granular details in terms of how the MSMEs are impacted right now and whether or not they are now shutting down some kind of operations. An example is, you know, the management of MedPlus told us earlier that one of their Gujarat suppliers can't supply toothpaste to them anymore because of the LNG shortages which are taking place. So just wanted to understand from your end, what are the MSMEs telling you? What is the on-ground granular situation when it comes to disruptions such as these?
Yeah, so when we met all the members yesterday, there were information that Morbi, which is a big hub for, tiles and sanitary ware, is totally shut because of non-availability of gas in the Gujarat. So I think Gujarat has severe cut on the supplies of LNG, and government has also, asked them to divert LNG production and other gas production to LPG, which is used for domestic. Okay, and similarly, there was a company making glassware. Okay, they make for pharmaceutical industry as a raw material, as a packing material, and they are having shortage, and they fear that glass industry need 100% supply of gas, otherwise their furnaces get choked, and which is a huge impact on their cost, and which becomes a huge loss for them. So similarly, industries which are related to metal are also affected because of the high price. And automobile industry, one more example, one of the members who is into auto supply, auto ancillary, he says my pen shop will get closed in next 2 days because I don't have the gas to run my pen shop. So in value chain, everyone is using some form or the other form of gas, which is not available today. And there is total uncertainty. We have got notifications from GAL and other suppliers, the oil companies, that it has been cut down to, first it was 80%, now it has cut down to 65%. And some of the processes, some of the industries which are like when they have to run the entire factory, they need full supply. Okay. So the choice is to pay 3 times, 4 times the cost of the additional gas you draw from the source, or you shut down the entire factory.
Right.
So many sectors are affecting, and people are still not clear what to do. This being the month of March, they don't want to stop the production. Otherwise, it will be a big loss to everyone.
Okay. So they don't want to stop the production right now, but these issues are persisting. You're saying some of them, maybe the paint shop you were giving us for the auto ancillary company, right? The example there, that they would have to shut shop in 2 days. Then, what is the support? Maybe you're not talking to the government.
Entire supply chain will get disrupted.
So now, how much time do you think these companies can survive on, or would they have to shut shop if this continues even for a few days? Then they would have to shut shop.
Yeah, so the kind of information we are getting from the war zone are very disturbing. Okay, Qatar was attacked yesterday, and India sources around 40% of its LNG from Qatar. Okay, even gas supplies the LNG to our company, which is a Qatari gas. Okay, so this is going to have a long-lasting effect. Even yesterday, there was a meeting and we discussed that it will take at least 8 weeks to unwind the situation. Whatever we are in a situation, even if war stops tomorrow, it will take at least 2 months' time to normalize the situation. But right now, we don't see war stopping immediately.
Okay, just quickly, is this now resulting in possibly some kind of employment issues where maybe the workers are, seeing some amount of delay in payments? Is that a situation already on the fringe, or is it maybe some time away?
No, it may be, 1 week or 2 weeks away from now. None of the company will start, reducing the workforce. They will first struggle to keep the production on, keep the workers engaged. Okay, but if the shutdowns are longer, then there will be an effect on the employment also, and the first casualty will be the bottom of the pyramid, which is a casual worker. Okay, and then there will be more, job cuts. Industry will have to take up. Yeah.
Okay. All right, Mr.
And
Chordia.
cash flow issues, yes. Because of the sudden non-availability of containers, and India exports around 35 to 40% to West Asia, the Gulf countries, and all the export is stuck either on the port or on the ships, or it is in the godowns of the factories because the containers are not available. We have also heard that some ships have come back from mid-sea. They came back to the port, and now members have to pay the charges, the demurrage and wharfage for the storage of material. So there is a huge cost impact, and there is a cash flow issue. Okay, so we have requested government to, because this is a COVID-like situation, so some relief should be given to MSME for this situation, some relaxation in working capital support, some interest subvention. This kind of support is needed for industry to survive.
All right, Mr. Chordia, we're going to leave it on that note. Thanks very much for joining in and giving us more perspective in terms of what the situation is when it comes to MSMEs and the Iran war at this point in time. States such as Gujarat have seen severe cuts in terms of LNG supplies. That's the word coming in at this point in time. We'll take a short break, but we'll bring you a technical check. Vinay Rajani will join in next. Stay tuned. Welcome back. Well, coming off the day's high for the markets, a good time to get a tech check in. Then we have Vinay Rajani joining in from HDFC Securities to tell us more. Vinay, hi, welcome to the show. Well, the mid caps are giving up their gains. The Nifty is just about higher by around 140 odd points at this point. How do you approach today's trading session, considering the intraday volatility that we've seen, as well as your stock picks?
Yeah, so good morning, good afternoon. So from since morning, we've seen a good strength, but after 11:30, we've seen some profit booking, more than 200 points correction, and Nifty has found resistance near yesterday's high. So 23,345 is a very strong resistance and today's high. And though it has fallen, but some sectors and stocks are still showing strength. So we don't know, we are not sure what is going to happen tomorrow. But yes, for sure, it looks like that it is an intraday correction. So some sectors and stocks can do well from here as well. So risk reward ratio is favorable for the long traders. I think yesterday's low was 22930 in Nifty spot. So that can be kept as a stop loss in long position. And some risk reward is favorable right now because of the intraday correction. So one can expect a recovery after some pullback. So I'm expecting Nifty to find support around 23,100 today, and stop loss should be 22,930. And we can expect some recovery. And as far as stock recommendations are concerned, we are bullish on some mining companies and some power companies. So NLC India is looking good. Navili Lignite, which is trading around 271. Stop loss can be kept at 265. Target should be 284. The second stock would be from the power space. Power Grid is looking good to us for trading. 303 is the entry level. 297 should be the stop loss, and 315 should be the target.
Okay, Vinay, thank you so much for joining in this afternoon. A quick check in terms of the markets is what you gave us and levels. So thanks so much for that. But on that note, let's move on and talk about rupee, because that has slipped to a fresh low, breaching 93 against the dollar as the war in West Asia continues. Ritu is here now to tell us what's happening. Ritu, over to you.
Well, Vinny, not very much new from what we already know has been pressuring the rupee, but today it was a very sharp fall. In fact, so far in trade, the rupee is down almost 0.89%, and it has breached that 93 mark to the dollar for the very first time and has been trading lower since. So, at the core, of course, it is that perfect storm of both global and domestic factors that have been in the play. The rising oil prices, they're pushing up dollar demand for imports, and foreign fund outflows continue. Add to that a stronger US dollar globally. All of that is putting pressure on the rupee. In fact, since the start of the Iran conflict, the rupee has now fallen by more than 2.4%. And so far in 2026, it is down by 3.6%. And this strain is unlikely to ease anytime in the near term because of what's happening in West Asia and the oil price shock. And that has been prompting foreign investors also to pull out more than $8 billion from India so far. And that's the largest monthly outflow, by the way, since January of 2025. Now, what's also a bit striking is the speed of this, the velocity of the rupee fall we've been seeing. So if you look at how many days it took for every 5 rupee per dollar fall, while 90 to 93 is not a one-to-one comparison with that, it is still staggering. So take a look at the graphics on your screen. Almost 5 years is what it took for the rupee to move from 65 to 70 to a dollar. More recently, almost 1 year for the move from 85 to 90, and now just 107 days for the rupee to slide from 90 rupees we saw on the 3rd of December to 93 rupees today. And that tells you depreciation accelerating very sharply. Now, it's not that RBI has been sitting idle. It has been intervening. $15 billion sold in March alone. Its forward book is also ballooned to almost $100 billion. But also keep in mind, India is not the only currency under pressure. The Asian currencies on your screen have also been reeling from what's going on globally.
Okay, all right. Thanks very much for that, Ritu. And, it's important to put it into context that from a one-year perspective, while now the currencies are all depreciating, from a one-year perspective, the rupee has depreciated around 8% odd. So from the start of 2025, the rupee has depreciated around 8% odd as compared to the Thai baht, as well as other currencies such as the Malaysian ringgit, the Brazilian real, the Swiss franc, the euro, the British pound. All of them have appreciated, but the rupee has depreciated around 8% odd in this past couple of months to a year. So that's important to put into context. And remember, from a 6-month to 12-month perspective, economists as well as rupee experts are expecting the rupee to possibly stabilize at around 92 to 93. So they do have an appreciating bias at this point. We'll take a short break, but Manisha Gupta will join in, and she has with her Christophe Ruel of Crystal Energy. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. Now, let's go across to Manisha Gupta, who is joining us and is here to tell us what's happening in the world of commodities. What's on your radar today, Manisha?
Mini, thank you so much for that. Joining us today is Christophe Ruel. She's Global Advisor, Crystal Energy. Christophe, hi, thank you so much for joining in. First of all, your sense with the war getting prolonged, various statements coming in from various governments, country leaders as well. But 20th day really, as the West Asia conflict just about continues, how are you reading as another weekends?
Good morning or good afternoon for you. Thanks for having me. I see, first of all, these attempts which we saw now to attack energy fields, the Pars field, both in Qatar and then before that on the Iranian side, and the attempts afterwards to allocate blame and say it was Israel, it was not Israel, and then the attempts to calm down the markets and everybody by saying we won't do it again. I think the really important thing in this episode, and where I had my eyes on, if you ask, was the capacity of Iran, which it showed, which it signaled, to not only at randomly with salvos attack the neighborhood, but to clearly hit a pre-specified energy target. So after 3 weeks, as you point out, of relentless bombardments, they still have the capacity to target whatever they want to target. And that means they still have the capacity to do this asymmetric warfare, which we have seen for a while now. And if you think, it takes only 1 rocket per month to keep Dubai unsettled. And as long as they can do that, they will, because they have an incentive with the back to the wall, probably, as they have said, not to engage in any ceasefire a la Gaza. So that is the worrisome part, that there's potential and the willingness to ratchet up the conflict and to maintain it brewing including to maintain the Strait of Hormuz closed, has been shown to be probably more developed than most observers would have thought.
Oh, absolutely. Christoph, also, a lot of reports also suggested that if this continues until the end of March, we could be looking at crude oil prices much higher. We've seen 120 being tested twice. How are you reading the prices from here on?
Well, let's talk about crude and then gas. I think the prices have so far been price effect have been relatively speaking moderate. If you compare it, for example, with February 2022, when Russia attacked the Ukraine, price spikes were multiple times higher, both in oil and in gas. So why has it been moderate? For two reasons, I think. One, because it is mostly driven, one, because the market was very well supplied. I mean, we had an excess of oil supply over demand for months before that attack took place. We have extremely high strategic storage being built up in China. We have high strategic storage levels in the G7, in Europe, in the European Union. We have the US now an oil exporter. We have a lot of oil on the water, which is mostly Russian and Iranian sanctioned oil, which now is allowed to come to places like India. And so there is multiple buffers here. The prices have gone up more than driven by a real disruption, driven by the expectations and the fear of the unknown, the fear of even bigger disruptions, the fear of attacks against production facilities, and so on. And you can see this clearly not only in oil markets, but also in gas markets. If we step back and just take a look at the numbers, then the damage which Qatar, has said was caused to the Pars field on its side is about 16%, 17% of production capacity of LNG. And Qatar accounts globally for 20% of LNG production capacity. So the global impact into the LNG market of that attack is only 4%. And that's why you saw prices reacting, but moderately. And that makes the situation a little bit easier to cope with on one side, because we don't have these massive price spikes which people were worried about, and very difficult to estimate for future impacts, because it's all more or less driven by expectations more than by any real disruption. Just take a hypothetical. If the strait were open tomorrow and peace would break out tomorrow, markets would adjust pretty smoothly, and that prospect is not been there, and that's why prices are high.
Christopher, I have one final question, and this is on various prices, really. So we have WTI just about holding 100. We have Brent, which is trading at around 105. But it really is about the Dubai crude, which is trading at 130, and Oman crude, which has seen a high of $150 a barrel as well. So the Middle East crude premium at record numbers therein. How are you reading at various varieties and such different prices currently?
Yeah, the spreads have widened across the board. You have to see oil is not equal to oil. Oil is a little bit with wine, with different qualities and origins. And what has been affected in terms of crude oil more than others, as you said, is of course the local crude oil, which has been shut in. So that is missing in the markets, and therefore commands now a higher price. But even more important, we are, of course, nobody consumes oil directly. Yeah? So we consume refined products, LPG, gasoline, airplane fuels and things like that. And there have also been very different price impacts on refined products, because the Middle East, of course, has also refineries, and they also export through the now blocked Strait of Hormuz. So, for example, airplane fuel has massively increased. Diesel has more increased than gasoline. LPG is a big problem in places like India. And so these differentials are the natural outcome of what has been blocked and which production capacity and refining capacities have been disrupted.
Okay, all right, Manisha, thanks very much for taking us through that conversation. We need to take a short break at this point in time, but we will get you an interesting conversation with Jinesh Joshi of PL Capital to talk about Dhurandhar the Revenge and what this could mean for multiplexes in terms of revenue. Stay tuned. Welcome back. Well, let's focus on the media and entertainment space. All eyes are now on one potential blockbuster that could really flip the script. Enter Dhurandhar The Revenge, a film that's already clocking 40 crores in paid previews and is threatening to crash into the all-time advance booking charts. Jinesh Joshi of PL Capital joins in to break down the numbers for us and what the potential of this movie could be. Jinesh, hi, welcome to the show. If you could just start by telling us, how exactly have you analyzed Dhurandhar The Revenge and what could it mean for the media and entertainment segment?
If I talk about the opening, in paid previews itself, the movie collected about 40 crores. And on the first day of the release, the movie has collected about 100 odd crores. So up until now, we have already seen a collection of about 140 crores. Now, if you look at the previous one, that collected about 840 crores on a pan-India level on a net basis. So I think Dhurandhar 2 will definitely do better than Dhurandhar 1 because what will happen is that blockbuster pricing is into place. Dhurandhar movie, the earlier version, it was a sleeper hit, but this one, there's a lot of anticipation surrounding the movie at this point in time. So the pricing will be better. And I think the opening trends also indicate to be anywhere between 800 to 1,000 crores in terms of overall box office collections. That is we're assuming in a base case scenario.
Jinesh, you said pricing of the tickets also is higher for this one as well, right? So overall now for PVR, what does this mean for their Q4 revenues?
So see, what can happen is that, up until now, the industry-wide collections are anywhere between 1,500 to 1,600 crores. And if we assume that movie does about 1,000 crores and roughly about, say, 75% of the collections accrue in this 15 days, the overall industry-wide collections should settle anywhere between 2,300 to 2,400 crores. And PVR's box office share in industry collections is roughly about 30%, which means that they should be at about 700 to 750 crores in terms of overall net box office revenue, which is 50% of their top line. So I think if these we will see a decent quarter for PVR INOX.
Okay, so just wanted to get back to this particular figure. I'm not sure if you mentioned it, but the first part of the movie, Dhurandhar, netted around 840 crores in the box office. So you're expecting that to possibly be higher this time?
Yes. Oh. Because see, the earlier one, there was very little expectation from the movie, right? But despite that, it collected about 840 crores. And whosoever has seen one, obviously is going to have a look at two as well, which means that 840 crores is the base case number that we believe will definitely be achieved for Dhurandhar 2.
Okay. What is the pipeline besides Dhurandhar in terms of movies? Are you optimistic in terms of what multiplexes could do X of Dhurandhar, the second part?
See, I think if I talk about 1Q, you have a Toxic, which will be released, which will get released in 1Q. Apart from it, there are a couple of Bollywood movies where you have Galwan, which is a Salman Khan movie, and then there are two Akshay Kumar movies as well, plus a Malayalam movie which is about to be released. I think the pipeline also looks decent from a 1Q perspective.
Okay. So even lineup looks exciting even from a Q1 perspective as well. But Dhurandhar surely something that could help support the revenues for PVR at least in Q4 this time. Jinesh, thank you so much for joining us this afternoon on the show, speaking with us in terms of what it means for the media industry as well and for multiplexes. So thanks so much for that. But on that note, we're actually going to slip into a very short break. After the break, we'll come back with more on markets, more on stock-specific action. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is just at 23,200 levels, just around that mark. Yes, come back a bit from the lower side of the day and 23,100 levels. So a bit of a recovery from that, but not at the day's highest point as well. But let's refocus now and talk about the renewable space. And in conversation with my colleague Abhimanyu, who spoke to Vedanta Power's Rajendra Singh on opportunities in the sector and how they are looking to de-emerge as a part of the growth plan. Listen in.
The renewables is the talk of the town, but I think nothing to forget about the coal or thermal power, which is the base load. Actually, thermal is kind of a base on which you can add renewable. Without thermal, you don't see a future of even renewables for grid stability, for reliable round-the-clock power.
Moving ahead, what kind of growth plans are you looking at, not just in terms of overall capacity addition, but also in terms of acquisition of different plants, as well as usage of more gas in your operations like many thermal power plants do? Are you using gas in your operations extensively? And what has been the impact of the current West Asia crisis, which is still unfolding?
So when I tell you about the acquisition plan, so Vedanta's DNA actually is that, taking over the SIC units or the NCLT plants, which has not been successful in the past or either stagnant capacity. And in recent past, we have taken two such plants. One is Meenakshi power plant at Andhra Pradesh, 1000 megawatt capacity, which was not running and was in the NCLT from last 7-8 years. Second, at Athena, Chhattisgarh, we have 1200 megawatt unit which we have acquired from NCLT. Within acquisition of 3 years, we have made these capacities operational. Now, Meenakshi is 100% commissioned, 1000 megawatt capacity is up and running and profitable. We have run it profitable this year. Athena is in a very sweet spot. It's very near to the coal mines, Indian coal mines. And one unit has already been commissioned, 600 megawatt. Another 600 is under project. We are at very good space in terms of bringing this unit up. In next 2 quarters, we'll try to say it's up and running. So this is our strength, looking at the assets which has not been working or is either in the NCLT and, making it transition from non-working assets to a successfully running self-sustainable asset. So that's the strength we carry. And we are looking at demerger. So we have a very clear growth plans, which we will announce soon, maybe in a time to come.
All right. On that note, we need to wrap up on Halftime Report. Business Lunch will take all of the action and all the stocks in focus forward. Stay tuned.
Stocks perk up following Netanyahu's comment on the Iran war ending soon and Scott Bessen's statement on rolling back some sanctions on Iranian oil. The Sensex and the Nifty off the day's high. Utilities, metals and consumer durables remain the prominent gainers. Gujarat approves a power purchase agreement with Tata Power's Mundra unit in a big boost for the company as the state will offtake half its output. The company expects similar pacts with other states soon. The stock charges up. Rupee slides to 93 to $1 on rising demand for the greenback as oil prices spike and foreign funds continued their selling spree. RBI's net short position swelling to near $100 billion from $68 billion in January also sparks concerns. HDFC Bank CEO Shashidhar Jagdishan tells CNBC TV 18 his relationship with former part-time chair Atanu Chakraborty was cordial. Though they did disagree occasionally, he also expressed keenness on being considered for a new term as CEO while his conscience was clear on the Leelavati issue. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan, and with me as always is Harmas Patakia, who is standing by the wall. After yesterday's sell-off, the markets are all in the green. The bulls are fighting back. The Nifty holding well above that 23,200 mark, but off the day's high. But let's go across to Harmas to decode what's happening in the markets today. Harmas?
The last 90 minutes, the one trend that has been prominent is the fact that it has been extremely choppy. We were one way up until 11:30. Then there has been a one way down. At one point, we were down to almost 23,125. Then we saw a 100-point up move, and then this recovery is now getting sold into yet again. We're still at that 23,200 mark. There's still 125 points off the highs of the day. Now, take a look at the Nifty Bank, showing a similar trend. It started off well, then saw a bit of a sell-off, and now it is looking to recover from the lows of the day, and this recovery too is getting sold into. So from a 650 odd point up move or close to 800 to 900 points, the Nifty Bank is now left with only a 350 point gain currently. The one stock that was holding on at the start of the trading session is Reliance Industries, and while the banking stocks and while HDFC Bank underperformed, Reliance Industries was resilient yesterday. It continues to remain resilient today as well. At one point, Reliance was up almost 3.5%, and that is the one stock that has ensured that the Nifty gains have continued to remain paramount. Now, the other one on the flip side, barring Reliance Industries, is HDFC Bank. As while Reliance continues to outperform, HDFC Bank continues to underperform, and it is now set for its fourth straight weekly loss, and it is now set, it has entered bear market territory, although the stock is seeing a slight recovery from the lows of the day, and that is what is contributing to some of the recovery that you see on the Nifty as well. Reliance holding on to gains of around 3%. The other major talking point has been the currency. The currency opened at record lows, then cooled off, and now has hit new record lows again. 93.39 was around 93.50 is where the currency had surged to at one point. Now back at 93.35, but a record low nonetheless for the currency. For now, the Nifty is marginally positive for the week. 23,151 is the level that it needs to close above for a weekly gain. But take a look at the worst performers this week. All of them were big losers yesterday. Shriram Finance is down 5, HDFC Bank down 4.5, Cipla, Wipro, HUL. HUL is in fact at a 52-week low, as is HDFC Bank. So the top underperformers on the index today down anywhere between 4 to 5% for the week. The power stocks are doing well. They've done well all week, and this time whether it be renewable power or be it thermal power or hydropower, all of these stocks are doing well. BHEL, Inox Wind, SJVN, all of them have done well. Metal stocks are the ones that have done well as well today, holding on to gains despite the sell-off in commodities overnight. Although MCX and Nalco is one metal name that continues to remain under pressure, as do the gas names, Petronet and MGL. They too are currently trading weak. The stocks at 52-week highs in a market like this. Tata Power is a news flow driven reaction, and Aether Industries and CCL also at 52-week highs. And one last name, Brainbees Solutions, the top gainer on the mid-cap index today, is an 18% up move, and it has surged after hitting a 52-week low today.
Absolutely. Herma's there with all the things that are happening with the markets, the gainers, the losers, all of it. But as he pointed out, the other big story today is the falling rupee. The currency has slipped to a fresh low, breaching 93 against the dollar as the war in West Asia continues. Ritu Singh is here to decode what's happening with the rupee. Ritu?
Well, the Indian rupee under sharp pressure, breaching that 93 to the dollar mark for the first time ever. So what's really driving the fall that we're seeing at the core of it? It's nothing new. It's the perfect storm of global and domestic factors that have been in play for some time. Rising oil prices are pushing up dollar demand for imports, even as foreign fund outflows continue. Add to that a stronger US dollar globally, and the pressure on the rupee has intensified. In fact, since the start of the Iran conflict, the rupee has fallen by 2.4%, and it is down 3.6% so far in 2026. And that strain is unlikely to ease in the near term as per traders because of the worries over oil price shock, and that has prompted foreign investors to pull out nearly $8 billion from stocks in India so far. In the month of March alone, the largest that we've seen so far since January of last year. Now, the speed of the fall is what is really striking. We've looked at how many days it took for every 5 rupee per dollar fall. So the 90 to 93 rupee fall is not a one-to-one comparison, but even then it is staggering because, it took nearly 5 years for the rupee to move from 65 to 70, more recently around 1 year for 85 to 90, and just 107 days to slide from 90 to 93. And that tells you depreciation is accelerating sharply. Now, RBI, of course, has been actively intervening. It has already sold more than $15 billion just in March to defend the currency. And, its forward book shows you the picture. Its net short dollar position is now close to $100 billion. Now, keep in mind, it is not just India. Most Asian currencies have weakened since the Iran conflict began. So the Thai baht, the Philippine peso, Korean won, all of them are seeing even sharper declines. But that said, rupee is still among the more pressured Asian currencies.
Ritu, thank you for that update there. The currency continues to remain under pressure. Now, the Gujarat government has approved signing of the PPA with Tata Power for the Mundra coal power plant. Praveer Sinha, the MD and CEO of Tata Power, spoke to us earlier in the day. Here's what he had to say.
Now the approval has come, and based on the SPPA, which is agreed with Gujarat government, we'll be taking with the other 4 procurers, namely Maharashtra, Rajasthan, Punjab and Haryana, and hopefully in next few weeks we should be able to close this. So last 9 months we have not been able to operate, and we are still working out the details which is there. Yes, somewhere around that.
HDFC Bank CEO Shashidhar Jagdishan spoke to CNBC TV 18. He said there were some disagreements with Chairman Atanu Chakraborty, but the resignation came as a huge surprise. He is happy to be a candidate for the CEO role once again as his tenure expires in October. Ritu Singh is here with the key highlights of the interview with Jagdishan. Ritu?
Well, several significant takeaways from our conversation with the HDFC Bank CEO Shashidhar Jagdishan. Now, on the resignation itself, he said the management had no indication this was coming, and he said that the bank even tried to persuade Atanu Chakraborty to remove some of those contentious lines from his resignation letter, but the attempt did not succeed. On his own working relationship with him, Shashi Jagdishan pushed back firmly on any narrative of friction, and he said the relationship was cordial. They agreed to disagree on occasions, but that he wouldn't apologize for that. He also addressed the specific theory that the market had been speculating in regards to HDB Financial's sale and then the subsequent IPO, saying it was unfair to call it a point of disagreement as to what happens next. And this is important. Shashi Jagdishan committed to ensuring that any issues that are flagged by committees will be addressed within set timeframes, and he will re-examine decisions that have not been fully agreed upon. On his own future, he is quite unambiguous. He told us he's happy to be considered to continue on as the CEO, and the board is well aware of his willingness. He also confirmed a remediation plan was in place for issues that had surfaced so far. Also spoke about the restructuring, saying they would look at bringing in external flavor if needed. On the specific Leelavati issue, he said his conscience is clear. He also acknowledged the leadership pipeline gaps and said the bank is seized of these upcoming retirements and will look to fill in these positions. On the bank itself, he said they are coming out of a major merger, but the growth glide path remains as committed. Asset quality is pristine. On technology, he said upgrades are going to be unleashed very soon and they will be meaningful for the bank. He sees the bank as very well positioned to ride the growth wave in the medium to long term, and finally told us that this is not the first challenge that the bank has encountered, and yet again, it is going to bounce back with vigor.
We had no such indication. My surprise is akin to what the other board members also experienced yesterday when this came as a huge surprise to all of us. So, and actually, most of all the board members did ask him to specify if at all there are any concerns. He did say that he has none to share with. So we did sort of persuade if he could sort of remove some of the contentious lines. But I guess he felt that was his calling and it's something that is innocuous. So he wanted to keep that as it is. The term is getting over only in October. And I guess probably as the chairman was mentioning this morning, the process will commence shortly. The members of the board must know that I'm happy to be a candidate for the same. May 21 and October 23, I think 2 restructurings I have done. I think it's time for another one. It ensures that the leadership team is always enriched and enhanced, and it sort of brings in a lot of energy at the management level. And this is something that obviously I shall be discussing with some of the key members of my leadership team and also the members of the board before I can announce it.
The story of the week has been HDFC Bank. But take a short break. Just before we do that, markets move in cycles. And for 26 years, we've been tracking them closely. Because in volatile times, what investors really need is insight and not just information. And above all, perspective and not panic. If you have a question about your investments, we are here to help with guidance from experienced market experts who understand today's fast-changing market environment. So join our special market editors on Your Stocks and MF Corner every day at 2 p.m. and stay one step ahead of the market. Welcome back. On to updates from West Asia. Israel and Iran continue to exchange fresh attacks as blasts were heard over Jerusalem earlier this morning, and fresh strikes have also been reported in Iran's capital city of Tehran. Now, Iran's foreign minister warns of zero restraint if Iran is attacked again. He added that Iran only used a fraction of its firepower in attacks on regional energy infrastructure. Meanwhile, Qatar Energy CEO says Iran's attacks on the Ras Laffan gas facility will cut Qatar's LNG export capacity by an estimated 17%, which could disrupt supplies to Europe, Asia and beyond for at least 5 years. And Iranian missile strikes Haifa oil refinery, but no significant damage has been reported there. Meanwhile, US President Donald Trump has said that he told Israel's Prime Minister to not attack Iran's natural gas infrastructure. Israel's Prime Minister also confirmed that Israel had acted alone and would not repeat attacks on Iran's gas field. Take a look at this report.
U.S. President Donald Trump said on Thursday he told Israel not to repeat its attack on Iranian natural gas infrastructure, as tit-for-tat strikes on energy plants sent energy prices spiraling, sharply escalating the U.S.-Israeli war on Iran.
Have you talked to Prime Minister Netanyahu about attacking the oil and gas fields?
Yeah, I did. I told him don't do that, and he won't do that.
Trump's comment came as energy prices jumped on Thursday after Iran responded to an Israeli attack on a major gas field by hitting Qatar's Ras Laffan industrial city, which processes around a fifth of the world's liquefied natural gas. It caused damage that will take years to repair. Trump is politically vulnerable to rising fuel prices among his core voters, and has lashed out at allies who have responded cautiously to his demands that they help secure the Strait of Hormuz, the conduit for around a fifth of the world's oil. Israeli Prime Minister Benjamin Netanyahu said he got the message.
Well, I'll say two things. Fact number one, Israel acted alone against the Slawiya gas compound. Fact number two, President Trump asked us to hold off on future attacks, and we're holding out.
He also said that Israel didn't push the U.S. into attacking Iran.
And I want to close these opening remarks with one other fake news, and that is that Israel somehow dragged the U.S. into a conflict with Iran. Does anyone really think that someone can tell President Trump what to do? Come on.
The U.S. and Israel appear to have different goals in this war, according to Thursday House committee testimony from Director of National Intelligence Tulsi Gabbard.
We can see through the operations that the Israeli government has been focused on disabling the Iranian leadership and taking out several members, obviously beginning with the Ayatollah, the supreme leader, and they continue to focus on that effort. The president has stated that his objectives are to destroy Iran's ballistic missile launching capability, their ballistic missile production capability, and their Navy, the IRGC Navy and mine-laying capability.
The Trump administration is requesting $200 billion of additional funding for the war, a U.S. official confirmed on Thursday, but faces stiff opposition in Congress, which must approve the funds.
And here's what Israel's Prime Minister had to say on Iran's nuclear and missile capabilities. Take a look.
We are acting now not only to destroy the ballistic missiles and the remaining nuclear programs, very little remains, but also to destroy the industries that enable the production of these programs. And already now, after 20 days, I can tell you, Iran today has no ability to enrich uranium, and it has no ability to produce ballistic missiles. We are continuing to dismantle these capabilities. We will crush them completely, down to dust.
Let's now listen in to U.S. Treasury Secretary Scott Bessent, who talks about potential sanctions relief for Iranian oil that is already out at sea.
We may unsanction the Iranian oil that's on the water. It's about 140 million barrels. So depending on how you count it, that's 10 days to 2 weeks of supply that the Iranians had been pushing out. That would have all gone to China. In essence, we will be using the Iranian barrels against the Iranians to keep the price down for the next 10 or 14 days as we continue this campaign.
The European Union proposes to cut taxes on electricity and subsidize prices as a quick way to soften the energy price shock caused by the US-Israeli war on Iran. Ursula von der Leyen, President of the European Commission, says that they want to lower the tax rates and ensure that electricity is taxed less than fossil fuels. Take a look.
At present, the European Union's physical security of supply is secure. However, Europe is not immune to global price spikes, and as the conflict continues, energy prices continue to fluctuate. In some cases, electricity is taxed much more than gas, partially up to 15 times more, and this cannot be. So we will propose to lower tax rates on electricity and to make sure that electricity is taxed less than fossil fuels. Member States can already make use of state aid measures to compensate for the cost increases of the energy source, and we will further flexibilize state aid for this purpose.
Take a short break. More news and updates follow on the other side.
Welcome back. You're still with us on Business Lunch. As per maritime authorities, 4 ships have crossed the Strait of Hormuz in the last 24 hours and 100 in March. As per the BBC, before the war began, the number stood at 138 a day. The alternative to this, chokehold could be Fujairah, the only port on the east coast of UAE situated on the Gulf of Oman, just 70 nautical miles away from Strait of Hormuz. Can CNN News 18's Arunima travel to UAE's oil storage and export hub of Fujairah to get a sense of life 70 nautical miles off the Strait of Hormuz, and is here to give us a ground report on this critical alternative route. Take a look.
Fujairah, one of the most important ports for UAE and the only port on the eastern coast of UAE. Its importance, its significance has been underlined in the last few days. So far, we knew of Fujairah as a bypass to the Strait of Hormuz. For example, if you wanted to take your oil from Fujairah right till Mumbai without getting into Strait of Hormuz, you could have taken it. Now that Strait of Hormuz is being used as a choke point by Iran, its importance is that much more defined. This is about 70 nautical miles off Strait of Hormuz. If you go this way for 70 nautical miles, that is where Strait of Hormuz will be. And, over the last few days, we have seen the UK maritime authorities point out that how about 25 to 30 nautical miles off the coast of Fujairah, Iran has targeted oil tankers. So that is the significance of this place. If the chokehold on Hormuz is not removed, so far the NATO allies of Donald Trump have refused to, join him. UAE for once has said that it is willing to consider if there is any proposal to open up the Strait of Hormuz. But even if that does not open, this place is quite significant. The Abu Dhabi oil pipelines come straight here. The blending of oil also happens for various petroleum products, which are essential to keep the world economy going, its energy needs going. On the coastlines, the rules and regulations here do not allow us to explain exactly where we are or to talk about the infrastructure that is available, that is visible to our naked eye. But on the horizon, you'll see several ships which are either docked or which are in the process of moving ahead. There is, of course, a threat here because of the current situation. But overall, Fujairah, life here in Fujairah seems to be gearing up for the new normal very quickly. Even after Iran's relentless onslaught, UAE has managed to get Fujairah back on its feet very quickly. And that's the message that we also got when we came into this emirate. Gulf of Oman, the warm water of Gulf of Oman, and the people here are warmly greeting everyone who's coming, not betraying any sense of anxiety or fear.
Arunima there from Fujairah. We take a leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. The markets are nearing the highest point of the day again. Mid-cap radar on the other side.
Good afternoon and welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Vivek Iyer, and with me today joining in from Bangalore is Ritu. Well, it's been a very volatile trading session. You're seeing one up day, one down day. Today a bit of a bounce back after the kind of weakness that we've seen in the last two trading sessions. The Nifty, however, is holding up quite well. Good afternoon, Ritu, and what is it that you are picking up, especially in the Bangalore?
Well, Vivek, good afternoon to you as well. It seems like a relief rally, right, after the steepest fall we saw in the markets in the last 2 years coming in yesterday. So a bit of a breather. Let's take a look at some of the key headlines we're tracking for you at this hour. Stocks, of course, perking up after Netanyahu's comment on the Iran war ending soon and Scott Bessent's statement on rolling back some of the sanctions on Iran oil. The Sensex and the Nifty are off the day's highs. Utilities, metals and PSU banks remain the prominent gainers. We also have IT stocks that are among the top gainers today after Accenture posted a steady set of numbers beating street estimates. The company also raised the lower end of the FY26 guidance and sees 4 to 6% constant currency growth versus 3 to 6% earlier. Gujarat has approved a power purchase agreement with Tata Power's Mundra unit in a big boost for the company as the state will offtake half its output. The company expects similar pacts with other states soon. The stock charges up on the back of that. And shares of Natco Pharma trade with gains as the company is set to launch semaglutide in India tomorrow. The company says the drug is approximately 90% cheaper than the price of the innovator brand. And the FTSE quarterly review is set to be implemented today. Analysts estimate this as a $95 to $100 million net inflow event for India.
Well, thank you so much, Ritu, for taking us through the headlines. Well, the first thing that we will be tracking, of course, in the last hour of the trading session, like you mentioned, will be the kind of impact that the Indian markets will see on account of the FTSE Rebal event. It's a net inflow event, like you mentioned, close to $90 million of inflows is what Indian markets will enjoy. It's not a very large event in terms of an impact, but overall, you will see a certain amount of buy flow from passive funds that will come about. Well, the other thing to keep an eye out for, of course, has to be the most of the pharma stocks today have seen quite a bit of a bounce back. A few companies have gone ahead and actually met analysts, especially a name like Laurus Labs. That particular stock is doing quite well. And names like Piramal Pharma, Dr. Reddy, Aurobindo Pharma, most of these names have recovered quite sharply. But moving on to our special segment, Mid-Cap Movers, Gaurav today is standing by the wall to take us through the mid-caps that are moving around the session. Gaurav, over to you.
Yes, if you look at the market, it is actually rallying, and it is actually a relief rally, we could say. And even within the market, we are seeing some stocks which are gaining in trade. We have got companies which are gaining more than 10%. We have got companies like Websol Energy, Brainbee Solution, Inox Green. All of these stocks, if you look at it, the performance is about 10%. Apart from that, let's also not forget about NPST. Now, in the morning only, we had a conversation with the management. They are optimistic about the business. And even if you look at the stock price, it is up almost by 8%. And let's also not forget about Apex Frozen Foods. Now, it's not only up in trade, but we are also seeing strong volumes here. When we look at PSU index, it is one of the top gainers today. In fact, it has gained more than 2.5%. And we've got companies like Bank of Maharashtra, IOB, Bank of India. All of these stocks are up in trade. And we are also seeing healthy volumes here. And this rally is seeing after a very long time. Let's also not forget about the mid-cap index itself. We've got companies like Tata Elxsi, BHEL, GMR Airports, Glenmark Pharma. All of these stocks are up in trade and also helping the index to hold at its green level. On the losing side, let's not forget about Jindal Poly and Swan Defense as well. Both the stocks are locked in its lower circuit. Remember, Swan Defense has been in the lower circuit for the last 3 days. Apart from that, let's also not forget about Petronet LNG. Now, the entire situation and the West Asia war is impacting these stocks, and some pressure is seen in today's performance as well. MCX and BSE, if you look at these exchanges, there also we are seeing some kind of pressure building up today. Both these stocks are down more than 2.5%. From the mid-cap index, we don't have many losers to say, but at the same time, National Aluminium, Phoenix Mills, SBI Cards, these stocks are currently under pressure. Remember, SBI Card is also near its 52-week low level, and ITC Hotel is also something which has been consistently losing in trade, and it is also under pressure today. So all in all, we are seeing some greens on the screen today, but let's see how the market treats these stocks which are actually losing, and if there is any rebound specifically for SBI Cards and ITC Hotels in coming days.
All right, Gaurav, thanks very much for running us through that list. On that note, let's welcome Himen Kapadia, Technical Associate at Dr. DR Choksi FinServ, for a technical check on the markets. Himen, thanks very much for your time here. First three trading sessions of the week down some 626 points. Wednesday, we had that 700 plus point fall. Today, you have a 260 plus point gain so far. In this volatile session, how do you trade, the markets, firstly, near-term levels you're watching out for, and any specific stocks, your trading bets you'd like to call out for us?
Very good afternoon, Ritu. Thank you for having me on the show. It's always a pleasure. Well, frankly speaking, it's better not to trade these markets. But that's on a lighter note. It's like a veritable minefield. You have gap ups and gap downs, mainly gap downs every other day. The VIX is about 22. Crude is on a boil, and the dollar is going berserk. So frankly speaking, everything would suggest that you stay away. Having said that, it's not a double bottom yet. But if you look at the charts, we posted 22,955 last week, and yesterday we went to 22,930. So we almost posted the same low. We've taken support over there. A bounce is underway. I think Vivek also mentioned it's a bounce, it's a recovery in order rally. If you look at the Bank Nifty, same logic. We went to around 53,273, and yesterday we went to 53,336. So we've taken support at the previous lows of last week. Now we are bouncing back. IT has been deeply oversold for quite some time. So we are going to make a further recovery, further upside. It's got bearing on the market in terms of weightage, and more importantly, Reliance. It's shown relative strength, hasn't broken the previous bottoms, so it's bouncing back. So frankly speaking, index heavyweights are tired of declining. They are at strong medium-term supports, oversold, positive divergences, crossover buys. Succinctly put, it's a recovery, and the recovery is going to recover some more.
Okay, Himen, so Reliance clearly leading the gains. A bit of a bounce back is what you're expecting in the IT pack. Himen, have you had a chance to look at some of the pharma stocks? A bit of a bounce we're seeing today, especially some of the larger names like Sun Pharma, Dr. Reddy. Do you have any picks here? And within the pharma pack, do you feel that maybe a near-term bottom is formed and you could see some upside, given the fact that it's one of those sectors not really impacted by all of the geopolitical events?
Very nice observation, Vivek. I think I would agree with exactly what you said. But rather than the Sun Pharma, yes, a bounce is underway, no doubt. There are a couple of, I wouldn't say offbeat stocks, but they are not in the mainline pack. If you look at Ipca Labs, the rounding bottom hasn't done anything for a long time, maybe a year or more, is making all the right noises. We are currently at 1520, fine. It's not closed above 1580 since the weekend at 10th Jan 25. I believe we are setting the stage for a up move from here, so one can keep Ipca on the radar and using similar logic. Aurobindo Pharma is also looking very interesting. Stock is very similar, like you said, relative strength hasn't gone down much, has found a rounding bottom, oscillator the buy, and I'm not saying this even from a shorter term, but medium to longer term charts. 1320 is a level to keep an eye on. A weekly close above this would trigger off an upside. So both are looking good in a very wobbly market, and both of them are looking good for the next quarter or two. So these are the two pharma stocks going with the sector that you mentioned, which look like standing out and are promising to do that. Vivek.
Himen, thank you so much for taking us through that. We appreciate your time on the show. On that note, we have to slip into a short break, but don't go anywhere. When we get back, we'll get you more on the markets and some stock-specific action in just a bit. Welcome back. The market's holding on to their gains. It's up to 250 points as we speak on the frontline index. The market breadth also stays in favor of advances. About 2.5 stocks are advancing for every one stock that is declining. Let's quickly also pull up the rupee chart for you. That has been one of the key stories we've been focusing on today, with the rupee breaching 93 to the dollar mark. Currently, it's trading at 93.37 to the dollar. Remember, it's down by almost 2.5% since the start of the Iran war, and a steeper fall, of course, since the start of the year. Currently down 0.8% in trade. But let's move on. The FTSE quarterly review adjustments are going to be implemented today, and Vivek has been tracking that. Vivek, take us through the details on that front.
Well, absolutely right. So, it's that time of the month where you're actually seeing a lot of passive indices are being forced to go ahead and rejig their portfolio on account of the fact that a month ago, you actually saw the FTSE Index Committee go ahead and rejig their portfolio. So this time around, it's a very minor rejig in terms of the number of stocks being added, especially from an Indian point of view. Now, the index that we track very closely is the FTSE All World Index. There are multiple indices that FTSE actually runs, including the all cap as well as the small and mid cap indices as well. But the one that typically has the largest amount of impact in terms of flows is the FTSE All World Index. In this particular quarter, a recent listing, Knowledge Realty Trust, that particular stock will be entering into the FTSE All World Index. It's almost $29 million worth of inflow. And the other stock, that's migrating to the All World Index is Hindustan Copper, and expect to see flows of a little over $16 million. Now, overall, there will also be multiple weight adjustments that will be seen, and all of these together, now this particular event is a net inflow event in terms of passive flows for the Indian market. So overall, expect close to $95 to $100 million worth of inflows. So that's quite positive. And all of these adjustments will typically take place in the last hour of the session. Back to you, Ritu.
All right, Vivek, so that's about the FTSE adjustments. Let's move on. MCX and BSE are some of the other counters that are in focus in the trading session today. The exchange stocks are going to see big turnovers in trade, and they have seen record turnover, in fact, in March. Sudarshan joins us with more on this. Sudarshan, take it away.
So today, both these stocks, BSE and MCX, are sharply lower, are under pressure since the opening of the trade. But there is a report contrary to it, and the report is from Haitong, a brokerage firm. First, on MCX, it's saying that MCX is currently in a positive volume momentum with a sharp increase in average daily turnover. In Q1, overall options premium turnover has increased more than 50% on a sequential basis. And one segment, that is energy segment, because of the sharp increase we have seen in the crude prices, energy segment ADTO is up 83% sequentially, and it's forming almost 70% of total average daily turnover mix in Q4. So as per Haitong, the turnover for MCX has been increasing sharply over the last few quarters, but in Q4 it has only increased further. Now coming to BSE, its March ADTO, that is average daily turnover, is up 46% month on month versus industry's average of 36%. So it's outperforming the industry, and market share has increased to 31% in the month of March versus 29% that BSE had seen in the month of February. As far as ADTO in Q4 is concerned, it's up like MCX. For BSE also, it's up 51% on a sequential basis, and the 31% market share that it has talked about in the month of March, it's at the record high that company has ever seen.
Thank you so much, Sudarshan. Record high market share when it comes to the exchanges trading for BSE. But one particular stock from the broader end of the markets and the space we track closely is the power space, and that is Tata Power. Today, a decade-long worry that was a bit of an overhang on Tata Power, that got resolved. The company went ahead and signed a supplementary PPA with the state of Gujarat for offtake of power from its Mundra UMPP, that's the ultra mega thermal power plant. The company said that they were in talks with Gujarat for quite a while, and finally the PPA has been signed. The management told us that the PPA is largely in line with the terms and conditions of the Section 11 under which the company was operating. Why is this important for Tata Power? Well, in the 9 months that the this particular plant was non-operational due to both no sign of PPA and also due to no extension of Section 11. You did see the company lose close to 1,000 crores just in the 9 months of FY26. So the reversal of that is something that is seen extremely positively for Tata Power. In fact, we spoke to Praveer Sinha, MD and CEO of Tata Power, on the signing of the PPA. Let's listen to bites of that particular conversation.
Now the approval has come, and based on the SPPA, which is agreed with Gujarat government, we'll be taking with the other 4 procurers, namely Maharashtra, Rajasthan, Punjab and Haryana, and hopefully in next few weeks we should be able to close this. So last 9 months we have not been able to operate, and we are still working out the details, which is there. Yes, somewhere around that.
All right, so that's about Tata Power. We'll slip into a short break on that note, but don't go anywhere. We're back in just a moment with more on the markets.
Welcome back to Midcap Radar. Well, India's obesity and diabetes drug market is on the verge of taking off. Semaglutide, the molecule behind Ozempic and Wegovy, will go off patent this Saturday, paving the way for low-cost generic drugs to enter the market. Ekta analyzes how this could reshape India's diabetes and weight loss market.
India's weight loss and diabetes drug market is on the cusp of a major shake-up. While the market is currently dominated by Mounjaro from Eli Lilly, which has generated close to 900 crores in terms of sales within a year of launch, semaglutide, which is the molecule behind Ozempic and Wegovy, is going off patent in India on the 21st of March, likely triggering a wave of lower-cost generics. Now, the real inflection point is this. Mounjaro's patent runs well into the mid-2030s, but semaglutide is going off patent now, making it the first widely accessible weight loss drug in India. That gives it around a 10-year runway as a more affordable alternative before the next wave of patented drugs enter. This is already triggering a rush to tap into India's 100 million diabetics, the large, thin, fat population, and with 25 out of 100 people being either overweight or obese in the country. But this accessibility will come with a sharp pricing reset. From current monthly costs of around 8,800 to 16,400 rupees, prices could fall 50 to 70%, with estimates of 400 to 500 rupees per weekly shot within a year. According to Nomura, 400 rupees a week could be the tipping point, unlocking an addressable diabetes market of nearly 2 lakh crore, comparable to India's entire pharma market size. The semaglutide opportunity itself could scale to 9 to 10,000 crores, including obesity and lifestyle use. Companies are already positioning themselves aggressively. For example, Zydus has partnered with Lupin, with 5 brands planned between them. Eris has tied up with Natco, and even innovators are expanding access ahead of competition. Novo Nordisk, for example, has partnered with Emcure and Abbott, while Eli Lilly has tied up with Cipla to widen Mounjaro's reach. Lastly, a few points to watch. Analysts expect the top 3 to 4 players to capture the bulk of the opportunity, while premium patients may continue with innovator drugs. Markets could expand beyond Maharashtra and Delhi, but companies may face high volumes with tighter margins. What will be closely watched is quality, given the complexity of the drug and fear of side effects, and if newer therapies, then sentiment. For now, the key question remains, can semaglutide truly go mass market in India, and in doing so, reshape the Indian diabetes and weight loss market?
All right, Ekta, thanks very much for taking us through that interesting conversation there. Here's what Patrick Johnson of Eli Lilly had to say on competition from generics and the pricing in the India market.
No, there is nothing new that we didn't know a couple of years ago. I think we have a good understanding of the time of patent expiries for ours and the competitive portfolio as well. So we are not surprised by any means. In terms of pricing, I think we and many other research-based pharmaceutical companies are taking a very value-based approach to pricing, and we also reflect the GDP per capita in different countries. So the price picture in one market is a reflection of their GDP, and that is the case in India as well. I think we have currently under regulatory review the first oral GLP-1 of Orglipron, and that demonstrates in an oral, in a pill, but without any restrictions in terms of food and water intake. It demonstrates an efficacy and a safety very much along the lines of the injectable GLP-1s, not like tirzepatide, but like the single agonist. I think that's super exciting. And we released data from what we call a triple G. So on top of the GLP-1 and the GIP, you also add the pharmacology of glucagon. And we released the first phase 3 readout back in December last year.
Well, India's diabetes and weight loss market is going to see a seminal shift with the launch of these drugs. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala, and with me is Nigel D'Souza. Nigel, good afternoon. We've had a better afternoon at around 12, but now 23,200. We're holding on to that as of now for the Nifty.
You know, the market's in such a mood, Vinny, that any kind of green will be accepted. You want this market to stop falling, I think, first, and then hope for a bit of a recovery. So till we're not falling, I think I'm pretty okay. You'll still argue that, you know, in comparison to yesterday, we pulled back only a third of what we lost out. But par for the course, I would say.
Why not par for the course? But a week that at least we'll end on the green note is what we'll keep an eye out on. Look at the mid-cap space as well. A quick check in terms of that. Nifty mid-cap is also managing to hold on to good gains. 1% gain for the Nifty mid-cap, small-cap 2 holding on to gains. And advance decline ratio today obviously is in the favor of advances versus decline. So no complaining there as well. Everyone's portfolios will be happy as well today, at least in the trading session. There's no merger of a line coming in, so not much of a worry, at least, that we should watch out for.
We're not kissing each other before the weekend. That's good.
Yeah, that's what we wanted at. But yes, that's what it is all about in terms of markets. A lot of uncertainty that has come in the recent times. So we want to get more stock-specific, solve all your stock-specific doubts as well. And today we have joining us right now Nirav Chedda, AVP at Derivatives Technicals at Nirmal Bang Securities, to answer all your queries. And Vikas Khemani will also join in shortly as well. Nirav, good afternoon. Thank you so much for joining us on the show. Firstly, a quick check in terms of the markets, levels that we should watch out for, important ones. Today, we did go around the 23,100, but then bounce back from that. So what is the key level that you're keeping an eye out on?
Yeah. Hi, Vinny and Nigel. Thanks for having me. See, basically, in terms of Nifty, a very important support level is 22,800 odd. There is a small gap still pending in between 23,900 and 23,950 odd. But there are a host of supports in between 22,900 and 22,800 odd levels. I believe good amount of support levels should basically come in from these areas, and Nifty should possibly bounce back today and probably in the next week up to the 23,500 levels, which is a resistance zone. So as of now, I believe if you've bought anything, you should be booking some profits around the 23,500 zone. The overall structure for Nifty is negative. Yes, we will have this bounce coming in, but overall, I expect more selling to come in once Nifty again hits 23,500 odd. So this is a sell on rise kind of a market, and that is how it is going to be.
Got it, Nirav. Thanks a lot for that. Let's get in a couple of queries. Then we'll have Vikas Khemani will be joining us in just a bit. Sanjay Ghosh writes to us from Kolkata. He holds, I think, SBI at a price of around 1,015 rupees. He wants to know the future prospects of its investments. What do you make of it, Nirav? He's still in the money, mildly so. But PSU banks have actually outperformed the private sector banks. What would you advise, to continue to ride SBI or book some profits?
See, Nigel, at this point, I would advise to book some profits as SBI comes towards 1080, 1100 levels. Why? Because this stock has seen a linear rally from 700 odd levels up to 1250 odd within 6 months odd. Now with everything falling, this is the last sector which is showing strength, and there are chances that even in this sector, some selling will come in. Add to that 50-day moving average for SBI has been broken, which was a strong support area while it was moving up, and which is a negative. So I believe now probably the stock can come down towards 950 odd in the next couple of months or so. So it would be better to book some profits as the stock bounces up to 1080, 1100.
Okay, we'll keep an eye out on those levels. Can book some profits, at least, is what's the word coming in from Nirav here. But we also have Vikas Khemani, founder at Carnelian Asset Management and Advisors, now on the show as well. Vikas, good afternoon. Thank you so much for joining us on the show. We were just talking about SBI and the financial pack as a whole, especially when you look at it on a month-to-date basis, since we've seen the start of the war, has been an underperformer versus other sectors. Your thoughts on banks as well as financials?
I think, of course, there is a current, Iran war has created a bit of a situation in the overall economic context. The hypothesis is that if the war continues or prolongs for a very long time and energy supply becomes a challenge, then of course it will have an impact on the economy, and thereby banking is the best or the most levered sector towards economic growth. So I think that's probably one concern. And secondly, whenever you sell, somebody wants to sell a basket of stock, it is largely frontline and the most liquid stocks which takes the beating. So in this context, I think banking shares have taken beating across the board. Now, really depends on, from a medium term to long term perspective, of course, banking is a great sector. Short term, what happens? I don't know. It really depends on the outcome of the war. Structurally speaking, it's one of the, amongst all of the sector, probably not as much impacted sector, because I think Indian economic fundamentals are fairly okay, fairly good. Short term energy crisis can have some problem, but medium term to long term, it's all fine. State Bank, of course, being the largest public sector bank, is one of the well-managed bank and very good bank. Valuations have corrected. So, at least we've been very positive on the entire banking space. We've been increasing our weight, in the sector in this fall.
All right. Hi, Vikas. Good to see you. When, Vikas, markets are getting a little bit jittery, and at a time like these, I like to listen to someone like you, actually, because you have been a big bull. You believe it's a time-wise, price-wise correction. Both those two are actually entry opportunities. But the pessimism that you hear on every weekend or, every dinner or market meeting that you go for, tells you that there is some pessimism in the system. Sometimes when we reach peak pessimism, that's when the market turns around. How far away are we from that?
I will see, if you have to understand that this current whatever event is there, it's a very unprecedented event. It has a lot of implications and depends on how long it goes and how intense it gets. Especially more critical from an energy infrastructure point of view. A large part of damage is done to the energy infrastructure, and fairly insignificant supply goes out. It can create a medium-term problem for the global economy, not only Indian economy. And in that, if that happens, the pessimism is really real. But so it's really a very binary outcome at this point in time. My own take is that everybody knows that you can't, while there are in our war kind of situation, there are overtures being made. There are lots of pulls and pushes happening. There are they're trying to kind of in a way settle in some way, because high energy prices, not good for even U.S. economy. And that's the reason if you see intense effort being made the moment oil crosses $100 from the US side. So my sense is that somewhere it should settle down. Whether it takes 1 week, 2 weeks, 3 weeks, I have no idea. But we've seen these kind of uncertain events in the past as well, whether it was Ukraine war to Brexit to which at that moment looked very big and real and had all the pessimism in our social conversations. But we have all seen that passes away, and then life gets to normal. So my assessment is that this shall too also pass, and maybe 6 months down the line we'll be talking with saying that also happened and that was a great price to buy, just like it happened during the Ukraine war time.
Okay, point taken there, Vikas. We have this next query that's coming in for GSW Energy. Parag Joshi is writing to us from Navi Mumbai. He's holding 60 shares of GSW Energy. Price is 628 rupees. Should they continue to hold or maybe look to add some more as well, given that currently the stock is at around 500 levels? Nirav, what is your view on this one? Is average an option on the charts and technicals?
No, as of now, you should not be averaging. This stock is in consolidation, and a breakout above 550 would give a confirmation for this stock to move up to 650 odd levels. So as of now, the consolidation is going on. You can keep a stop loss of around 465 for your longs. If the stock breaks 465 levels, there is a very good chance this stock can come down towards the 400 level. So you should be exiting if 465 is hit on the downside, and do not average at current levels.
All right. Very quickly, let's go across to Vikas. Vikas, what's your view on the energy space? And I'll tell you what, as you're saying, infrastructure has got hit. And India has that plan of moving from around 525 gigawatt to around 850 gigawatt or thereabouts. Now, with the globe going to a bit of a tizzy and infrastructure getting hit, things are going to get even more interesting out here. I recall having a conversation with the analysts at Bernstein. They were talking about these traditional names, NTPC, power grid, nuclear power. How would you approach this theme? And do you think the energy/power segment deserves a high amount of attention now?
You see, it's not only now, but last, 12 months or so, or little more than that, power sector has been getting attention for the simple reason. I think we all know that structurally we'll need more power, even in the AI and otherwise, to meet our economic growth. And there's a global sort of investment happening or reinvestment happening in the more power generation situation, and including building the infrastructure of the transmission and distribution and all those things. So we are quite positive from a medium term to long term perspective on the entire power space, because we think in some point a lot more investment needs to happen. Think about it, company like BHL has been getting lots of orders, in the thermal power situations, right, where in last 10 years a lot of investment happened in the renewable. So investment is coming back to thermal, coming back to building P&D capacities. So I think all those things are indicating you that there's a lot more investment is happening and needs to happen. So in the entire value chain, there's a lot more opportunity according to us.
Okay, a lot more opportunities that you see coming in the power space as well. Point taken there, Vikas. But on that note, we're going to actually sip into a very short break. We'll come back with more of your stock-related queries, viewers, after the break as well. So stay tuned in.
Welcome back to Your Stocks on CNBC TV 18. That's a good-looking screen. There's green on the screen as we speak, and almost all the indices are trading the green. Wish these markets continue in this sort of momentum, and hopefully for the next week as well, we'll have more green than red, because yesterday the problem was we got a sharp slam dunk in trade. That said, let's get back to our experts who are with us. Nirav as well as Vikas are with us. Let's take a query, actually. We have Vimala Devi, who writes to us from Bengaluru. He holds around 130 shares of Tata Motors at around 208 rupees. Considering the volatility in the market, he also asks whether or not he should hold or sell. Nirav, quickly, if you could give us your view, how is it looking on the charts?
Yeah, I think this is passenger vehicle or commercial vehicles?
I think CV. It's a CV.
CV.
Yeah, CV. Okay. Tata Motors CV at 208 rupees.
Okay. So, see, basically, this stock was having a linear uptrend. It moved up from 300 odd to about 500. Now that uptrend has been broken, it has come below the 50-day moving average as well, which is a negative, but it has got good support around 375 odd levels. I do see the stock coming down towards 375, but that's a good support area. That is where you can probably average and keep a stop loss of around 350 for your longs. A good bounce back up to 480 can come in from there.
Okay, we'll keep an eye out on those levels over there. Because, what's your view coming in on the auto pack as well, right? When you look at those Vahan registration numbers, very good numbers. Even for March, seems like it's going to be a good one there for them in terms of the month. How are you looking at autos? Are you PV, CVs, two-wheelers, three-wheelers? What is more exciting for you there?
In general, positive on the automobile sector, because I think post last in 6-8 months, a lot of demand drivers have been there. Interest rate cut to GST rate cut to lots of demand drivers have been there, and so we've been playing. We've been overweight. We've been holding Tata Motors CV because CV cycle also has been coming up very well. Numbers the last in the recent past, all monthly numbers have been very good, and still we are below pre-COVID levels. So I think there's a long way to go, also linked to the economic cycle. So so we own more EV. Also, we own a Mahindra & Mahindra, which is actually pretty much on the tractor cycle, on the PV, including EVs. So that's one name which we've been owning. So in general, we are positive on the automobile cycle.
Okay. Positive on the automobile cycle over there. Let's move on and talk something about cap good space as well. We have this next query actually come from Mohan Kumar, who's writing to us from Bangalore, holding 525 shares of CG Power. Price is 105 rupees per share. So making a profit on this one. Wants to know if he can continue to hold this for the long term. On the long term, Nirav, how are the charts looking?
Basically, this is a cycle where most of the stocks are making a top and they are coming down. This stock again has a top kind of a formation. I believe this will probably come down up to 525, which is a good support area. But that is again 150 points down the line. So I believe it would be a good idea to book profits here and wait for certain downside, because I'm seeing this is across sectors. Most of the stocks which are up, from a 2-year, 4-year perspective, they are making it their tops, coming down about 15-20% from there, and the selling has just started here. So I believe it would be better to book some profits.
Got it. Vikas, what do you make of positioning with regard to the capital goods space? That one was moving with very, very good momentum. And suddenly, all of a sudden, you have all this news flow that's coming in there. And that sector has taken a hard knock. Good time to go overweight on that space?
Capital goods is actually very widespread sector linked to the energy and energy-related infrastructure. I think, in my opinion, still a long way to go. Still, we'll have investment cycle continuing. And in general, capex has been doing very well. Only challenge in the capital goods sector right now is the valuations. I think kind of valuations, many of them are commanding, probably are ahead of the growth potential. And so we've been we in general like the sector, but one has to be very conscious about what valuations one is paying. And wherever you have seen correction coming through, good fundamentals, good growth, there could be entry points. But in general, I can't say that by and large capital goods you should go overboard. It is more stock specific, company specific, some segment specific, like power sector I mentioned to you. But the capital goods stocks aligned to the Middle East, one has to be now revisited, relooked at it, post whatever situation develops, because many of them have reasonably good exposure out there as well. So, but in general, I'm positive on the capex cycle. In general, I'm positive on the sector.
Since you made that point on the Middle East, a stock like, say, L&T, it's got hit substantially because of the exposure. I think 30-35% of their business comes in from there. Large cap name, EPS estimate expected to compound at 19-20%. Return ratio is very favorable as well. And it's seen a very, very sharp correction. Would you like to stick to some of these large cap names at least, Vikas? Because prospects otherwise are good, well-run business. And if we are towards nearing the latter part of this war, then, some of these stocks have got hit rather hard just in the last 45 days.
Absolutely, and rightfully, I think, markets are making right now an hypothesis that probably post-war, whether the customers would have same plans of aggression or not, investments or not. Is there a cash flow crunch happening in the shorter term? So all those concerns are right now there in those names in the market. Now, it really depends on how the situation pans out. Historically, whenever you've seen, like in I think 2012 or 13 period, when Middle East were going through the economic crisis, these companies had lost a lot of money and there was a lot of stress. So now we will only know in some time whether which side it is turning, and hence I think this caution is warranted, and one should be careful in terms of. And I'm not saying it's negative, but I think one has to wait and watch before I think making a overboard decision just because it has fallen.
Okay, point taken there. Nirav, L&T to you as well. Narendra has this query and wants to know if it's the right time to invest. Is there any level that maybe you're looking at when they can start investing in L&T?
Yeah. So, see, this stock has fallen 25% odd from the top. And generally, whenever such things happen, at least for a large cap stock like L&T, there is a bounce back that comes in. I'm looking for some bounce back at current levels. You can probably average out at this level, keep a stop loss of around 3,300, and this buying can probably come in up to 3550, 3600 zone, which is where he can look to book some profits that he's bought at lower levels.
Okay. Nirav, thank you so much for that. We'll keep an eye out on those levels over there. And Nirav, as well as Vikas, that was the last query. So thank you so much for joining us on the show, helping our viewers understand more in detail about sectors, what are looking nice, what is looking attractive. Given you're seeing a fall, doesn't mean you just have to jump into it. To be cautious as well when you enter it.
All right, Vinny, you summed it up quite well, and thanks to our guest as well. And happy holidays, Vinny. We see you after a week or so. Have a good time in Sri Lanka.
Thank you so much for that, Nigel. But thank you so much to our viewers also for sending us those queries. Please send us your queries as well. We'll keep solving them on Monday, Wednesdays, Fridays on your stocks. So do keep them sending us those queries. Thank you so much for tuning in. Up next, we have Closing Bell to take you to the last hour of trade. So don't go anywhere.
go beyond market headlines to understand the reasons for the day's movers and shakers and get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Taiwan index, which is managing to hold on to gains. A muted day of trade that's come in, at least in the opening, for Hang Seng. Apart from that, Nikkei, that's trading with cuts in the trading session, so keep an eye out on Nikkei as well.
Iran today has no ability to enrich uranium, and it has no ability to produce ballistic missiles.
We can take out the island anytime we want.
The members of the board doesn't know that I'm happy to be a candidate for the same.
We are $106, $105, $106
General in principle agreement that whatever is agreed with Gujarat will become the template with all other states.
Holding on to the highs of the day, even though oil prices have recovered from their early morning lows, but still continue to remain around that $105 to $110 mark.
The perfect storm of global and domestic factors that have been in play. Rising oil prices are pushing up dollar demand for importers. Foreign fund outflows also continue. That is adding to the pressure.
Semaglutide, which is the molecule behind Ozempic and Wegovy, is going off patent in India on the 21st of March, likely triggering a wave of lower-cost generics.
A bit of a bounce back after the kind of weakness that we've seen in the last two trading sessions. The Nifty, however, still holding up quite well.
That was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Rima. And Rima, good to see at least some green. It's not very convincing, but at least we have pulled back closer on a third of what we lost in yesterday's trading session. The problem, though, is the way the rupee has slipped. Now we're getting used to the rupee holding at around 93.5, which is a bit of a worry.
Indeed, the rupee is in an absolute free fall today. Yesterday's closing was about 92.6. And today we're now hitting fresh lows of 93.48. Wednesday's closing. And today now it's 93.48, a fresh record low. But that said, at least in the equity markets, there is a fairly meaningful bounce. We're holding up with a gain of about 170 points. So compared to yesterday's battered close of 23,002, we've added on about 173 odd points. Mid-cap's faring better. The mid-cap index is up 0.8%. So finally, after 3 days of brutal selling, we've got the bulls showing up at the door. Week to date, the Nifty is up 0.2%. Mid-cap's faring better. The mid-cap index is up nearly about half odd percent. PSU Banks, IT doing well. And we'll discuss that in greater detail. But let's tell our viewers what the last hour looks like. Markets see a sharp rebound in today's trade. The Nifty's come off from the high point of the day. 23,350 was the high. The Nifty is currently trading just shy of 23,200. PSU Banks, pharma, metals remain the prominent gainer. The rupee once again has hit a new low today, breaching 93 against the dollar as the war in West Asia continues. Metals are in focus after brokerages share that they're constructive on the Indian steel stocks. Meanwhile, Vodafone Idea is back in the spotlight. The shares are 5% higher after subscriber attrition slows in the month of January 2026. IT stocks also in focus after Accenture posted a steady set of Q2 numbers, beating street expectations. The company also raises the lower end of their guidance by 100 basis points. How should you position yourself in the last hour of trade? Ashish Kyal, a Wave Strategy Advisors, is now joining in on the show. Meaningful, not a roaring bounce compared to the fall that we had yesterday of about 775 points. Compared to that, it's a 180-point gain. But what is the trade that you've taken today and what would you advise?
Hi, afternoon to you and all the viewers. If you look at the overall market, yes, the bounce has been meaningful, but given the fall that with the magnitude of fall we saw in the previous session of more than 800 points, I think 175 is just minuscule bounce back. And Bank Nifty also, which was very high in the morning, has now given away a majority of its gains. Now, that is having said that the rupee depreciation remains a concern. This time, it is because of the dollar index rallying big time and breaking out above that 110 levels, and that's the reason the rupee is under pressure this time. Along with that, we can clearly see there has been a sell-off that we are seeing across the metal space. The gold and the silver are selling off, which everyone was expecting because of the war should be a safe haven. The crude, WTI crude is still hovering around that 98 mark. So there has been a concern globally. So having said that, the strategy on Nifty is going to be simple. Any move towards the level of 23,400 can be used as a selling opportunity again, as market is nervous and moving down in gaps, and we can expect it again moving towards that 22,950 mark. That's the zone, 23,400 to 22,950 on Nifty one should aim for.
Okay, all right. Ashish, hi, good afternoon. Good to see you in. A quick word on two heavyweights. One is Reliance Industries. You know, at the start of the trading session, I had mentioned that since the Nifty Bank has gone into a bit of a tizzy, the other heavyweights will have to stand up and get counted. Now, luckily, that's played out actually because Reliance Industries has conquered the 20-day MA. It appears it's on its way to around the 200-day MA, and that's like an index by itself. So where is this one headed? Point number one. Point number two, what about the Nifty Bank? Where does support come in at? Because when the largest constituent is going to be a little under the weather, it's going to be difficult for that index to get up and going. Please go ahead.
Absolutely, Nigel. If you look at Reliance is up by nearly 2.8% right now, showing a good bounce back. And I think it might be headed towards the level of 1470. So Reliance over short term looks bullish. The support for the stock is around 1376. But as far as the index is going, the problem is the other heavyweight HDFC Bank, which has been a major dragger over past 2 days because of the news flow and the events. But it has been a major dragger. HDFC Bank is down by more than 2%, and that's dragging the index. And that's why we are seeing pressure in Bank Nifty. But overall, Nifty is managing to still sustain there. So Reliance is positive as of now. And if you look at Bank Nifty, it's important to also look at HDFC Bank, what is happening with HDFC Bank. And the support for this stock is going to be around the levels of 760. It is trading around 781. So HDFC Bank is at 781. There is no positive attempt here. I think it's going to go down to 760, and that is going to drag Bank Nifty index lower again. So Bank Nifty can move towards the levels of 52,400, 52,600 levels from here on, and looks like the recent low which was made yesterday is going to be broken. Upside, the gap area of 54,870 is going to be a major hurdle for banking index.
Stocks? Ashish, what are you recommending by way of stocks, and what will the timeline be?
Sure. By the way of stocks, the first recommendation that I'm going to give across is going to be in Chennai Petro. We can see that the energy space is doing better, and we can clearly see the buying is emerging across this segment across this sector as a whole. The stock is up by nearly 5% as of now, but any dip from here can be used as a buying opportunity. On the downside, the stop loss can be maintained at 1,000, and on the upside, we can expect the stock to reach towards the level of 1180, 1190. This can be the time frame for around 2 to 3 days from here on. And the next stock on the buy side is going to be Jindal Steel. We can clearly see that there is a positive traction on the stock as well. It's up by nearly 4.5%. What is interesting to see in Jindal Steel is that in the entire chaotic sell-off that we are seeing since January, the stock is hardly down, and it's now moving back above. So above the prior swing high as well. So the overall undertone is bullish for Jindal Steel. We can expect the target of around 1255 here, and on the downside 1150 can be the stop loss. Again, the horizon can be 1 or 2 days, and you don't know. Market moves very fast these days.
Got it. All right. Thanks a lot for that, Ashish. We'll come back to you. For the time being, let's focus on the big story. That's the falling rupee. The currency has slipped to a fresh low. It's breached the 93 odd mark, holding at around 93.5 odd mark because of the war that's currently breaking out. Ritu joins us to tell us what's happening, giving some timelines and some data points. Ritu, take it away.
Good afternoon, Nigel. What a sharp fall in the rupee that we've seen today, breaching the 93 to the dollar mark, setting new record lows of almost 93.5. What's driving this fall is not very, very new. We've been telling you, at the core, this is a perfect storm of what's happening globally. Also, some of the domestic factors that have been in the play, rising oil prices because of the West Asia conflict, that's pushing up dollar demand for imports, even as the foreign fund outflows, very well, they continue. Add to that a stronger US dollar globally, and the pressure on the rupee is just intensifying. In fact, since the start of this Iran conflict, the rupee has fallen by more more than 2.5%. And the strain on the rupee is also unlikely to ease in the near term because of what's happening with the oil prices. We've already seen $8 billion of outflows as well, from foreign investors just in March. So none of those pressures are really easing. But, what's really striking, Nigel, is the speed of the fall that we've seen in the rupee. If you look at how many days it took for every 5 rupees per dollar fall, the 90 to 93 rupee fall is not a one-to-one comparison, but even then it is staggering that it took almost 5 years for the rupee to move from 65 to 70. It's on your screen, the movement that we've seen more recently, almost 1 year for 85 to 90, and just 107 days for the fall from 90 rupees to 93 now, and that tells you that the depreciation is accelerating very, very sharply. Now, some of the traders we've been speaking to also worry that these lower lows tend to bring in speculators in the market, and then that fall becomes self-reinforcing. Now, RBI, of course, has been actively intervening. In fact, it has already sold more than $15 billion just in March to defend the currency. And if you look at RBI's forward book or the net short dollar position, that is close to $100 billion now, up sharply from January, and shows you how actively they've been managing the currency. But keep in mind, it's not just India. Most Asian currencies have weakened since this Iran war started, many on your screen seeing even sharper declines than the rupee. So, Nigel, Rima, I don't know if you're planning any foreign vacations, but if you are, probably keep a bigger budget aside.
No, I'm coming to Bangalore, so I'll let you know, Ritu, and then we can chill out. You can take me out for dinner and all in rupees. So we'll chill out on that. Thanks for the alert, and thanks for giving that travel advice as well, Ritu. But let's focus a little bit more on the rupee. We have Lakshmi Iyer, Group President Investments and CEO at Bajaj Alternate Investment Management, who joins us. Hi, Lakshmi. Good afternoon, and good to see you. When the rupee, what are you making of this kind of fall? The factors involved, no sign of intervention, at least today, though we had the RBI that was trying to defend a couple of levels. Where are we headed now? At around 93.5 as we speak.
Yeah, I think, it is a combination of, I think, I should call it double whammy or triple whammy, but I think it's the oil, price spike, and obviously the resultant instability which has been happening up until now. I think that's still not showing any signs of settlement, and you requiring, some sort of a catalyst. And, once you see that catalyst easing out or not being in the market for a bit, you see this kind of phase. And yes, I do agree, there could be some speculative element, but it's very difficult to put a number to it. So I think all of this is, clearly playing truant on the currency. And of course, not to mention the fact that FPIs are relentlessly pulling out money, both from fixed income and equities, more so from equities. So I think that's the, I would say, party pooper at this point in time, and then looks like it is going to remain for a bit. It's not showing any time, any signs of reversing the sentiment really soon.
But Lakshmi, why today? It's a 1% appreciation. It's not the rupee has, the crude price has hit a fresh low today. The fresh low was hit, say, yesterday, and even prior to that when we went back to $120. And from there, actually, the level right now is better than what it was. So what prompted such a large, down move in today's trading session? And then if you could tell us what's been the RBI intervention or the action that we've seen from the authorities in today's trade.
No, so it's a combination, I would say. Also what happens is that lot of, whether it's the, exporter fraternity, everyone has certain threshold limit in mind, either whether it's the trader position which unwinds or if it is the exporter who has to, unwind position. I think it's a combination of all of that plays in. And the moment you see one trigger, it's like a cascading, it's like a pack of cards. So you just touch one card, you see the entire pack falling. And is it fair to expect the central bank to intervene at every level? Probably not, because if you look at, and it's also tied in, as I said, to how the impact or the end impact of crude oil has been for the end consumer. I think when you tie all of that in, we have not really seen that kind of an impact being passed on to the end consumer. So I think all of that is combination probably percolating. And, yesterday we saw equity markets, really correct meaningfully and some resolution happening today. So I think it's very difficult to give you a cause and effect relationship precisely, but it's one or many of these factors which are playing at the same time. And let's not forget, it's also the weekend. So I think some bit of squaring off of positions is obviously inevitable.
Lakshmi, what do you expect the RBI to do next? It's going to be in a bit of a hard spot actually, because rate cuts will be very difficult from here on. They need to deploy money to defend the rupee as well. So, any kind of measures that you would be looking forward to from the RBI to stem this fall?
Today, if you look at since the war began, if you look at just the fuel prices across countries, US has already gone up by almost a little under 25%. Diesel is up almost 33%. If you look at China, it's up 10%. Germany is up 15%. India, if you see petrol and diesel prices are flattish because there's no change, right? So what is going to happen is from here on, if the central banker has to come in, it's going to be tricky because if you defend the currency, we are talking about liquidity obviously getting infused, and then you also have a situation where crude oil prices are not in our control. So if you look at the swap curve today, it is actually pricing in a rate hike. Are we calling for a rate hike? Answer is not. But this is a shock, one of its shocks that we have seen, which nobody is really prepared for. So rate cut, definitely not in this kind of a scenario. I think that's totally ruled out. But it is going to be a very tread cautiously kind of a situation. And I think if the central banker has to come in with a measure, it has to be more from a currency assuaging perspective, not really too much from a liquidity perspective.
Brilliant. Thanks a lot for that, Lakshmi. So forget about the rate cuts. Hopefully we don't get a rate hike. That's the analysis that's coming there. Lakshmi, we look forward to chatting up with you in the coming week, and hopefully the rupee sees some kind of stability, or maybe in fact pulls back a little bit. That said, we have Gurmeet Chadha who's joining us to help us out with some stock-specific analysis. Hi, Gurmeet. Good afternoon, and good to see you in Gurmeet. We want to talk to you about a few stocks. So let's start off with the Ferrous companies. So I'll go through a piece and then come across to you for your view on the metal stocks. Well, Ferrous companies, they're actually outperforming today. A couple of brokerages are more optimistic on their prospects. Macquarie says that the recent correction is an opportunity, and they prefer Ferrous stocks, which have corrected by around 7 to around 8% since February 2026. But they say that's more or less in line with the broader markets. Let's run you through 5 big points why they are constructive on Indian steel stocks. They say that since mid-2025, price hikes are up by around 12 to around 13%. That in turn will aid spreads. They say that the spreads for Indian steel companies has recovered from around $260 per ton in December 2025 to around $310 per ton on an average in Q4. And currently they're even higher at around $340 per ton. This will help the EBITDA per ton improve by around 1,500 rupees per ton for this quarter, that's March 2026 quarter. And they're expecting further upside even in June 2026. That's going to be helped by the current steel price trend that we're seeing. Additionally, healthy domestic steel demand and the recent rise in regional steel prices, as well as the moderation in China's steel production, that's what bodes well from a broader perspective as well. JSW Steel, that's their top pick. They believe the company is well positioned with regard to the growth standpoint, also the management's focus on cost. Hence, they have an outperformed rating on JSW Steel, Jindal Steel, as well as Tata Steel. And on a couple of other names like Coal India, as well as on Hindalco, they have actually a neutral rating. HSBC is weighing in as well. They have a buy rating on Tata Steel. They have raised the target price to around 250 rupees. This after the UK, United Kingdom, announced import protection with 50% import tariffs. And they have also, their import quotas have been cut sharply. This, remember, the action from UK follows EU's CBAM as well as India's safeguard duty. So basically what they're saying is Tata's key regions now have multi-year import protection because they have protection in India, in Europe, as well as in UK as well. So they're lifting their earning estimates by around 5 to around 14%, and that's where they've gone ahead and up their target price. Put everything together, Ferrous, they're outperforming the other metal stocks today. Gurmeet, what's your view on the metal space? Extremely tricky. Aluminium was having the time of its life, but then it's coming for some profit taking. And now suddenly you're seeing, Coal India actually outperform. If I pull up a month-to-date chart, Coal India is the place to hide. The expectation is things will bounce back out there. What's your view? Or do you stick to these Ferrous names?
Well, we've been moving, being tactical on Tata Steel and Hindalco in and out. We do know it's not part of the core portfolio. Coal India is one of the beneficiaries because of the shortage we are seeing in the fuel, especially LPG, as the shift happens to non-gas sources. So we're playing it through solar industries, which is where Coal India is one of the largest, client in terms of as they supply explosives, defensive there. Other than that, we have no exposure neither on this. And one stock which I've discussed earlier is is a special situation play called Mukan, which is more into stainless steel, which is for us is a special situation. It's completely undervalued, and a lot of land monetization happening with a large parcel of land being sold in Thane, which has come up as a key data center hub.
Okay, Mukund is a stock that you like. By the way, the private sector banks have now completely flattened out because HDFC Bank continues to drag its feet. After losing 5% yesterday, HDFC Bank has extended the fall by another 2.5% today, and the stock has now entered bear market zone. This would be the fourth weekly drop for the bank this week. This week, of course, it's down nearly 4.5%, but now even the other private sector banks, Axis Bank, Kotak Mahindra Bank, have dipped into the red, and you've got large NBFCs too, declining nearly 1%. We're talking about Bajaj Finance and Shriram Finance. They did well yesterday, but today they're giving up some of those gains. Gurmeet, HDFC Bank, what is the advice?
I'm a little disappointed with the way this event has played out, and also I think the bank should have come out on transparency, very clear on the issues highlighted, both by the part-time chairman who exited as well as the bank. I think it's important to be specific and not make vague statements when it comes to the largest private bank, which is systematically important. And I think he should have probably addressed it. But so there are different stories going around, and any uncertainty which happens in this environment, it creates doubts, and which is not welcome. I've been speaking to some senior bankers. There've been discussions on the MUFG deal being scuttled. First, probably it came to HDB. There are differences in terms of interference with leadership team and getting involved in execution roles. So I think they should come out clean on this rather than, it's okay to say there are no material issues and all that. And I think RBI circular also helped. But I think that in this kind of environment, a bank which is known for its pristine governance, it's important to communicate, more clearly. And I think that is where you see selling pressure intensifying. And I think I would not be surprised if FI weightage continues to go down. It has gone down to 49% from the peak. I think probably will further go down a few hundred basis points.
All right, Gurmeet, what about your view on Eternal? We have some news that's coming in there. Zomato has hiked its food delivery by close to around ₹2.40. So that's close to around, I think, a 19.2% increase. From around 12.5, it's gone to around 14.9. I'm just looking at an Anand Rathi note. They're saying for every ₹1 increase in the platform fees, Zomato's annual EBITDA moves up by around 85 to around 90 crore rupees. That's some kind of a relief that's come in there. Keep in mind, Eternal for this week, I think it's already up close to around 7%. Yeah, last few days it's up close to 7%. But this price increase as well should be pretty good for them. Gurmeet, what's your view on Eternal? Was it darling at 350 rupees? So much of talk about it. It's down to 230 rupees. And this increase should help. Your take?
So we are adding Nigel on dips. Reason being that I think the food delivery is mostly duopoly now. So any hike, as you rightly mentioned, I think the key driver would be the quick commerce. And I have a feeling with the kind of environment we are in, the burn which was going on, especially by competitors, which is Swiggy, Instamart, and Zepto in particular, will come down. Also, there's been some concerns even on Big Basket. In the internal board meetings of Tata of whether you need to burn so much to bring that up. So and then once somebody really gets close to 50%, and I think which Blinkit has done, it's I think 46, 47%. I think you will see probably the leader consolidating market share more and lesser burn going forward, considering the environment we are in. And I think that is positive. And once this maybe the gas issue gets settled, especially the commercial ones. I think the adoption of electric inductions have been really quick, especially on the commercial side. I think the other stress will go. I think Dipender's exit, considering and the environment we just went bad, I think that started weighing on the stock, despite very decent earnings it reported. So I'm pretty constructive on this thing.
The FTSE rebalance is also effective. The FTSE Russell semi-annual rebalance is scheduled for implementation today after market close, and the changes will be effective for trading on Monday, 23rd of March. That also is helping. There would be some adjustments, some buying that comes through in the last 30 minutes. Some stocks like AU Small Finance Bank, Swiggy, Escorts, IOB, Biocon, Whirlpool. These are some stocks where you are expected to see some moves and adjustments. So keep your eye on that. What else, Gurmeet? After last week's 5% loss, which was absolutely brutal, this week at least we've managed to hold on to levels. Are you getting a sense that the market reaction maybe to the war is coming to an end, and maybe the worst is priced in, and from here on, even if we don't rally, maybe we stop falling?
Difficult to say. We still have 50 minutes to go. You don't know how it has been, right? So I think, but a lot of pockets are giving you very good valuations. I think the entire bank Nifty is 12 times, 13 times earnings. Most private banks are below 2 book. So I think that's one pocket. Although all the stress in the economy will eventually creep in bank if this lasts longer. Then you have stocks which have less correlation to the conflict have fallen, which is pharma, telecom, defense. I think the defense index yesterday was down 3.5%. Today also the stocks are pretty weak. And then here you will see a lot of order picking once things started settling down. In fact, my visits to, and people I've spoken to in Nagpur, there is a lot of visits and inquiries already, and you will start getting more exchange notifications over the next some time. So that's another space. So adding something which is less correlated more right now gradually, it's always not easy, even if you have cash. And getting a little contrarian on IT now. I think the Accenture update yesterday, I have a feeling that a bit of negativity is a little overdone and numbers may slightly be better. So maybe, we've gone increase a little bit in HCL Tech, little bit we've added KPIT at the lows, but it's about 4-5% of the portfolio.
Got that. Contra buy coming through on IT, slowly started nibbling in. Gurmeet, great chatting with you. Thank you for joining in. Get into a break. On the other side, Shibani Sarkar Kurian from Kotak Mahindra AMC joins in on the other side. Stay tuned.
Some nervousness creeping into the market. So though we're holding in the green, there are select stocks that have come off the high. Case in point being Grasim, Hindalco, Bajaj Finserv, all of them. In the last 10 minutes, all those three stocks actually have slipped quite a bit actually from holding well in the green. But let's find out what Shubhani Sirkar Kurian, Head of Equity Research and Fund Manager at Kotak Mahindra AMC has to say. Shubhani, how are you feeling about the markets? You know, now it's been a few weeks. Everyone's talking about the war cry, a lot of money. Easier said than done, right? Your portfolio is bleeding actually. And the macro indicators itself have changed. Now you're going to be dealing with elevated crude prices, a weaker rupee as well, and maybe not much support from central banks. What's your view?
Hi, Nigel, and good afternoon. So you're right. Markets have been volatile, and this volatility will likely continue. So there are two things that are important from a market perspective. One, of course, is how soon this conflict ends. And the second thing that we need to also keep in mind is once the conflict ends, what is the period over which things start to normalize, and then what is the new normal? That is something that will have a bearing in terms of macros and earnings as we go forward. But at this point in time, given that the conflict is still ongoing, market volatility is likely to be here. So if you look at just what happened in the Russia-Ukraine crisis and at that point in time, if you look at valuations and where markets bottomed out, Nifty bottomed out at about 17 times on a one-year forward price to earnings multiple. Today, we are at about 18 times. Of course, we'll have to see once things start to stabilize, what is the impact, if at all, on earnings. At this point in time, consensus is still going in with FY27 earnings estimates being better than FY26 and somewhere in the mid-teens. From our perspective, our view on markets has been remain neutral from an asset allocation perspective in terms of equities. The bent continues to be large cap and mid cap over small caps at this point in time. And in terms of portfolio positioning, in terms of sectors, we are still focused on the domestic facing sectors, for example, the banking financial services space, healthcare, specifically hospitals, and some parts of capital goods industrials. These are the segments where we believe that earnings trajectory should still stay quite stable and valuations are in your favor.
We'll come back to you and try and identify these stocks in the hospitals, healthcare, financial space. For now, Hormus is joining in, and he's going to put the spotlight on the top movers in the market today. Hormus.
The markets have come off significantly from the highs, and there was an expectation that you would end the week with some gains. As of now, it doesn't look that way, but there are some stocks that have done extremely well today. Brainbees Solutions is one of them, is the biggest single-day gain on record. Now it's a 20% circuit for the stock. The volumes are the highest since it listed all the way back in August of 2024. Take a look at the volumes today. 6.5 crore shares have been traded so far. The 20-day average is just over 40 lakh shares, and out of those 6.5 crore shares that have been traded, 7.5% of those have been marked for delivery. And considering the trading activity today, it is the third most traded stock on the Nifty 500. But despite this 20% move, the stock is still down 46% from its issue price, which was 465 rupees. The other one that's not doing well today is MCX, and it has not done well this week. It's the third straight day of losses. Now it's set for its worst week in 2 months. The volumes today, though, on this 4.5% fall that you're seeing are the second lowest in this week. So it's not falling on very high volumes. 41 lakh shares have been traded. The 20-day average is almost at par as well, around about 30 lakh shares. 43% of those shares are marked for delivery, and the stock has corrected slightly from its 52-week highs. They're down around 11% from those levels is MCX. And lastly, possibly the stock of the week, Olectra Greentech. It's up in 4 out of the 5 sessions that we have had this week. This is the second instance this week that the stock has seen double-digit gains. It's up 10% right now as well. And for the first time after 6 consecutive weekly losses, the stock is set to report some weekly gains. And it's up almost 27% this week. This is turning out to be the best week that the stock has had since March of 2023, has Olectra Greentech. Around 60 lakh shares have been traded so far on the stock. 20-day average is around 7 lakh shares, and close to 17% of those shares traded have been marked for delivery. And despite this week that the stock has had with gains of close to 30%, the stock is still down 35% from its 52-week highs.
Thank you very much for that. Important news, HPCL has hiked the premium petrol prices by 2 rupees per litre. there is no change in the normal petrol prices. This is what we've learned from our sources regarding HPCL. The stock is up nearly 3.5%, a hike in the premium petrol prices. Shibani, just off the cuff, I know you don't look at individual stocks in that much granular detail, but what would be the contribution of premium petrol prices? Because there is diesel, there are so many other factors. So how material is this for HPCL? Today, of course, the entire basket is doing well because crude prices have eased. But this particular news flow, if you have any early comments?
No, sorry, we can't comment, as you know, on specific stocks. So I will refrain from doing so because of compliance reasons. So we'll not be able to talk about a specific stock and an impact on the same.
Many private sector banks have corrected very sharply, some in the eye of the storm. You're like private sector banks. Is this the time to accumulate?
So our view on private sector banks continues to be positive. As you rightly said, these stocks are now trading at multiples which are significantly below their historic average valuations. There have been concerns on the second order derivative or impact of the current crisis on banks, both in terms of growth and asset quality. However, our belief is that growth continues to remain fairly healthy at this point in time. And also remember that from an asset quality perspective, banks' balance sheets have been cleaned up considerably. Balance sheets are healthy. Many banks carry considerable amount of provisioning coverage on their books. And more importantly, they are all well capitalized. So therefore, if you marry growth as well as return ratio profile with the current valuations at which these banks are trading at, we believe that valuations are fairly attractive. We do expect to see improvement in earnings going forward, primarily because of the pressure on net interest margin abating going into next year. And also credit costs are likely to remain largely stable. And therefore, at this point in time, the whole banking pack looks attractive. But within that, clearly the private sector banking valuations are very well placed.
Private sector banking valuations well placed. Would you say the same about tech? One of the biggest underperformers, quality names. Unfortunately, businesses are evolving. So the street got very, nervous about it. Last few days, they've been seeing some buying, and Accenture going ahead and upping the lower end of the guidance has given some hope. Would you ride that hope, or would you think you don't know which way AI is going to swing? You'd rather stay away?
So, Nigel, our view on tech remains that, in terms of positioning, we are neutral to slightly underweight. That continues. So you're right. There are a couple of factors at play. One, of course, the growth trajectory itself, because the sector, despite of, and keeping the AI argument aside, the sector has seen growth come off. And in the current situation, given the kind of macro volatility and uncertainty, the expectation was that FY27 would be a better growth year from a revenue perspective. However, we'll have to wait and see. Q4, as it is a seasonally weak quarter, and then Q1 and Q2 therefore become very important. Deal flow momentum as of now seems to be holding up, but again, it's a fairly evolving situation. On the AI bit, we think that a lot of the concerns over AI eating up software is possibly overdone. There will be some impact because of pricing and deflationary impact on the overall growth aspect, but AI will also help services generate new areas of business. Our view is that in this sort of an environment, there will be differentiation between companies who are more agile in terms of offering solutions to their clients and therefore winning a larger share of the pie. But the sector itself will possibly see volatility, especially as this transformation takes place. And therefore, from our perspective, we'll wait and watch and see how this evolves.
Okay, the sector itself, the index has taken a bit of a leg up as we speak. The IT index should come up for you on the screen. Thanks, Shibani. Wishing you a good remainder of the evening and have a good weekend as well. Well, let's move on then. I think we have Sudarshan who's standing by to help us out with some brokerage notes that he's bringing for us. Sud?
So I start with Petronet LNG, which is sharply lower at this point, currently down almost 4% in the trade. And the reason is that it might see a dip in its volumes due to the West Asia war. And that's the reason Nomura maintains buy call, but it has cut the target price to 340 rupees from the earlier target price of rupees 370. And it says West Asia crisis may hurt the near-term volumes. And because of that, it has cut FY27 estimated EBITDA by 23% as RAS, LAF and may take months to come back online. Next one is appliances. HSBC has initiated coverage on LG Electronics with a target price of 1,850 rupees per share. It says appliance and electronics industry are forecast to grow at a 12% CAGR through 2029, and product penetration rates are based on three different stages of development. Next one is Lotus Labs. Motilal Oswal maintains buy call with a target price of 1,280 rupees per share, and today the stock is moving higher despite the volatile market. And it says deepening innovator CDMO relationship with capability-led scale-up that will also boost the growth. Second, dedicated capacity build-out enabling high growth adjacencies, and strategic JV with KBK to build European and Asia-Pacific focused formulation scale. And last one is volume-driven ARB growth with stable pricing dynamics that also will boost revenue for the company as far as Lotus Labs is concerned.
Thanks a lot for that, sir. Interesting notes coming in there. Well, let's focus on the markets and a quick F&O check. The Nifty Bank, that's become the bit of a weak spot when the largest bank in there is showing some weakness, and the Nifty Bank is under some pressure, and today as well is doing a relative underperformance. What's making up for its underperformance is the other two pillars. That's Reliance Industries as well as the Nifty IT Index. Both of them actually are rallying in today's trading session, and that's trying to do its bit when the Nifty Bank is under some pressure. A Nifty PCR, that's holding at around 0.96 or thereabouts, and the options data should come up for you on the screen. So though we're up close to around 150 points or thereabouts, still you have the 23,300 call, the premium out there. It's not moved too much actually. It's at around 165 or thereabouts. Even the 23,200 call, the premium out there is around 190 rupees. So there is mixed activity being seen out here, which tells you still the bears believe they can defend that 23,500 odd mark. The 23,100 put. Now, that's giving some hope. The premium has come down to around 220 rupees. Yesterday, it was close to around 300 rupees. There is a sense of writing out there, which is telling you 22,700, 22,800 on the downside. And on the upside, you have this range of around 23,500, which is going to be a bit of a resistance mark. Today, HDFC Bank, it appears there is more unwinding of long positions that we're seeing. Stock is down, open interest is down. So we'll keep an eye out on that. Vodafone, though, that's coming for a bit of a short squeeze, as is the case with BHEL. Both those two, a bit of a short covering bounce are there. Stocks up 4-5% while open interest is lower. But we'll slip into a short break, come back, dealing room check. Nimesh is waiting for us on D-Street Chatter.
Welcome back. Now below 23,100. The high today was 23,350. So markets have come off from the highs. We're still up close to about 0.5%. But in the last 1 hour, some profit booking has set. Perfect time then to get in D Street Chat, and Nimesh joins in with the insight that he's gathered after making many phone calls. Nimesh?
Hi, Rimana. So market off highs, but it's a decent outcome, I would say. The bigger thing is that the broader markets are actually doing well. The breadth is quite strong. And a lot of the mid-cap and small-cap stocks are buzzing in trade. Many of them are up between 15 to 20% as well. So a decent day, I would say, from a broader market standpoint in today's market. The volumes are going to be on the higher side because of the two rebalancing, Bharat 22 as well as the FTSE rebal. So obviously the volumes are going to be higher side. Having said that, the FIs are still better sellers is my sense. And that selling is largely in the banking names, which is the reason why the bank index has actually sharply fallen from the day's high. The sector which are buzzing in trade today are metals and OMCs, and it looks like there's a bit of short covering in both those sectors in today's market. So metals, especially steel, is doing good today, and of course OMCs on the back of falling crude prices. So those two sectors are seeing a bit of short covering rally. But I guess two things. One, the volumes are going to be higher side because of the FTSE rebalancing, but the FIs still continue to be better sellers in the Indian markets.
Let's focus on individual stocks. And Nimesh, what are you picking up?
So, Nigel, a couple of stocks which deserves mention today, Tata Steel as well as DLF. Both are up in trade today, but I understand there's going to be an MOC buying in both these names in today's market. It's essentially market at close buying that happens in the last 30 minutes of trade. So that these are the two names to watch out for. The second name is ABB India. While the stock has been consolidating with a positive bias, last week there was an UBS upgrade as well. They've sharply raised the target price. The city is now anticipating a corporate development as well in ABB India. Potentially, a bit of value unlocking in one of the subsidiary business is the buzz as far as ABB India is concerned. The third name is Sun Pharma. The entire pharma pack has done well today, but Sun Pharma stands out in terms of aggressive buying. I understand at least one leading long-only fund has been an active buyer in Sun Pharma at current levels. And the last is South Indian Bank. I spoke about a couple of MOC buys. South Indian Bank on the other side is going to see a large MOC sell flow at a leading FID. So in the last 30 minutes, might see a bit of reaction in South Indian Bank on the back of that MOC sell flow.
Got it. Okay. All right. Thanks a lot for that, Nimesh. And there's some news at the bottom of the screen. Maharashtra, CMS, another stock that's come up drastically from the top. They have a good amount of cash in the books, and the promoter entity is showing some intent in there. Going ahead and creeping. And I think that 0.45% is for this quarter itself. Last few trading sessions, that's between March 17th and 19th. It's picked up, the promoter entity has picked up close to around 4 lakh shares or thereabouts. So explains why that stock has perked up a little bit. But if you pull up a wider time horizon, you'll see that the stock actually has corrected big time from the top. What's supporting it is the cash in the books and the promoter as well coming in there and showing some faith. Ashish Kral is back with us. Ashish, give us your fresh ideas in terms of buy or sell calls.
See, if you look at right now, the overall trend for market still remains in the range. 22,950 remains a very important support on the downside. Let's see if that is seen on the charts or not. Having said that, on the buy side, I think JB Chemical and Pharmaceuticals, it's showing, it's bucking the trend, moving independent to the overall market, and I think it's going to go towards the level of 2,200 on the upside. The stop loss for the stock can be maintained at 2,080. Despite of the sell-off that we have seen in the broader markets and across the space, this stock is managing to outperform. The next stock on the buy side is going to be Dr. Reddy's Laboratory. We can clearly see the pharma space can act as a cushioning or insulated towards what is happening globally. And we can expect Dr. Reddy to move towards the level of around 1340 to 1350 on the upside. On the downside, 1280 is the stop loss, and one can hold the position for approximately 2 to 3 days.
Thank you very much for that. Vodafone Idea also in focus because yesterday we got the TRAI subscriber data. It was out for the month of January, and in the month of January, we've seen Vodafone Idea lose about 4.11 lakh subscribers. This is in the month of January, and this is the lowest since August of 2025. In December, they had lost about 9.4 lakh subscribers. In November, it had crossed even 10 lakh subscribers. In October, it was 20 lakh subscribers. September was about 7.5 lakh. So I think the street is taking comfort from, the fact that perhaps the market share erosion is taking place, but is the pace coming down? But I think one number will not tell that story because it's still down 4 lakh month.
Got that, Rima. So the erosion is slowing down. That seems what the street has taken heart. And as I said earlier, there's a bit of a short covering bounce being seen on Vodafone as well. Slip in a short break, come back. We'll wind down the markets for you. Final 10 to 15 minutes of trade. Welcome back. Headline index is up 100 points. The Nifty Bank has been the weak spot. That's moved back into the red. So that's the problem pocket. It's down closer around 100 points as we speak. But individual stocks are doing a thing of their own. Gujarat Alkali, just take a look at the intraday chart of that stock. Yesterday, I recall the stock was up on very, very large volumes. Today, it came for profit taking. Last few minutes, Gujarat Alkali is at the day's high. Ola Electric as well, another beaten down name. That stock has spiked up. And I don't know what's going on with Happiest Minds. It appears the street is sniffing something. That one has seen a big, big spike up in the last few minutes. I think that one should come up for you on the screen as well. We're getting some news at the bottom of your screen as well. IOC has hiked industrial fuel price to around 109 rupees from around 87, 88 rupees or thereabouts. We'll have to find out how much is industrial fuel as a percentage of their mix. We'll get some details on that. But in terms of hikes, Shilpa joins us to tell us about the platform fee hike that was flashed earlier in terms of Zomato. Shilpa, take it away.
Well, you're right, Nigel. You know, Zomato has hiked its platform fee to about 14.9 rupees, almost 15. And this is up from about 12.5 rupees that it had earlier. Now, it seems to be matching what Swiggy already has. Now, Swiggy's current platform fee is about 14.99, again, which is almost 15. And Swiggy had hiked this as early as September 2025. Typically, you know, they tend to do this before the festive rush. So they had hiked the prices then. And at that time, Zomato had increased it from 10 to about 12 rupees per order. And now from that, eventually it had increased it to 12.5 and now to almost 15 or rather 14.90. Now remember, platform fee is something that both the platforms had introduced in April 2023. Swiggy was first, Zomato then followed, and it was at about 2 rupees per order. And then it gradually went up from 4 to 5 to 6 to 7 in 2024. And in 2025, we saw slightly steeper hikes. And now both the platforms, Swiggy and Zomato, have settled at around 14.9 or 14.99 rupees. And we've reached out to Zomato for an official comment, but we've not heard back from them. Now, remember, typically, a rise in platform fee we've seen so far historically has never really had an impact on order volumes, but it is very important for both platforms in terms of profitability. And, you know, brokerages have said, for example, Elara has said in the past that each rupee of platform fee increase, Zomato sees about a 22 basis point impact on take rates. Anand Rathi has said about 1 rupee increase in platform fee. For Zomato, the annual EBITDA is estimated to increase about 85 to 90 crore rupees. And like I said, typically there is no impact otherwise on order volumes, and customers typically absorb this. Now, usually this happens before a rush season. Right now, there is no particular reason why there's probably a hike by Zomato. Could be to match what Swiggy is already charging. And Zomato's EBITDA, just for your reference, EBITDA margins in third quarter were about 1.5%. So right now, both the platforms will be charging for the food delivery about 14.9 rupees. Back to you.
Got it. Thanks a lot for that, Shilpa, for giving us that quick update on that one. Anand Tandem, market expert, joins us on the show. Anand, how are you feeling about the market? I recall for many, many months you were cautious, and that's played out actually. Markets have either gone nowhere, time-wise correction is what we saw, and off late the price-wise correction. Feeling better? If yes, what will you buy?
I think, the reality is not about what will happen in the Indian market, but what's happening globally, because at the end of the day, that whether or not the numbers that we were working on in terms of the GDP and the earnings estimate for the next few years will still hold. And frankly, we have no means of knowing how long this the war and so on will last and what will be the eventual impact. So yes, some of the companies have corrected, but the question is whether the correction is reflecting an older reality or is it reflecting something which is happening today or is likely to happen in the next few months. So I would still think that while if there is some compelling cases that you may have identified as individual stocks to buy, I would still suggest that one would be very careful and slow in terms of fresh investments. There is no need to hurry. I don't think this war is going to go away anytime soon. And therefore, we will have adequate opportunity to be investing again. The market definitely has corrected, but I think, it's still not factoring in the current reality.
Any quick thoughts on Natco? Now, Natco is going to become the first company in India to offer semaglutide in the vial dosage form. And very affordable. I was just seeing Ekta's note, 70% cheaper than the pen device and 90% cheaper than the innovator brand. So they've got that early mover advantage. Stock is up 4% today, and the opportunity is there. But with so many companies in the fray to enter this market, the generic market, what kind of margins are they likely to enjoy?
I think if you recall, I had mentioned a few weeks back that pharma, especially those which are looking at this space, would be likely beneficiaries. So it is certainly a company that you like, except that, despite the launch, you will still go through a kind of degrowth because of the fact that some of their earlier molecules are going off and therefore will be earning less than what they had been earning in the current year. So for the next 2 years, the earnings from NATCO are not going to be increasing, at least as per current estimates. And that will mean that, again, while semaglutide can be something which will be a big winner, you have to have the patience to see through what may be a kind of flattish move. That said, it is cheap. There is no question that even if you assume that the current molecules which are going off don't produce much, you are still looking at a company which is in the teens in terms of the PE. And that in the context of the current market still makes it cheap. Also, their product profile, they've taken a few large bets and some of that may start paying off in the next 24 months. So from a longer time point of view, I would remain bullish on those kind of stocks.
Anand, there used to be these stocks that were considered the bluest of blue chips. And, they have actually either done nothing or they're actually sharply lower, even if you look at it in the last 5 years. The stocks I'm talking about is HUL. You look at Asian Paints, ITC. Any of these have come to levels that you like? ITC, for example, is down sub the 300 rupees now. Yes, there was a shock with regard to the duties, but that one's getting hammered. Valuation-wise, there is some support, or you'll stay away?
So, like you said, ITC is something that would have done reasonably well, except for the fact that they keep getting slapped with these duties every now and then, and sometimes these duties are fairly high. Without taking a moral stand on whether they should be or not, the reality is that therefore the earnings growth from the cigarette business cannot be very strong. One, because I think the penetration is already to a level where the newer generation perhaps is not so keen on taking on cigarettes, which is a great thing. And the growth, therefore, is in terms of earnings is also being shared by the government in a disproportionate manner. That pretty much leaves you with the FMCG side of the business. And that has still not started giving you the kind of margins that one should have. So the valuations are attractive. I don't think one should be looking to get out. The cash flows will remain strong. But to look at a very strong performance from here for ITC, well, may take a while. For Asian Paints, etc., and the likes, I've always maintained that when there is a new player coming in with a lot of capital, there will be a fight. And we saw that being played out. Now there seems to be some amount of volume increase that had begun to happen just before the war. And now we have to worry about the raw material prices all over again. So yes, there was a reason for some of these stocks to remain depressed. I think, as I mentioned earlier, they are not particularly, relative to the earlier times, they are not very expensive. But given the new context, I won't very go out and call them cheap.
What about IDBI Bank? Divestment not happening, but 110 rupees stock at 70 rupees. It could be taken up at a later date. The problem was in pricing. Enough in the price at 70 bucks?
So if you are looking for cheap banks, there are other cheap banks. If you are looking for the fact that this can be a divestment target, the government has shown inordinate incapability of doing anything remotely called disinvestment. The only thing they have managed to do is sell from one PSU company to the other. So it doesn't look like they're very serious in terms of divestment anyway. So really, if you were to look at it as a regular bank, yeah, it is cheap. So are others.
Got it. Okay. All right. Thanks, Anand, for joining in and giving us your view on all those stocks. By the way, I just want to pull up some intraday charts, actually. Gujarat Alkalis, I don't know what's going on there. The stock was flattish when we started off the show. This is the second day running that the stock suddenly has spiked up. Now it's into circuit. Not sure in terms of news flow, but we'll try to find out more. Big surge out there. Ola Electric as well, a beaten down name. That stock has spiked to the high point of the day, as is the case with Sagility, another stock that's fallen by the wayside. Well, all these stocks is suddenly saw a very, very sharp uptick in the last few minutes. So that's why I'm just pulling some of them up. On the flip side, Shriram Finance has taken a leg down. Adani Total Gas as well is lower. And Irida, a stock that did very well in the uptrend. All those three names, Shriram Finance, Adani Total Gas as well as Irida. But it's time to wind down the markets and get into the weekend, and hopefully we get some pleasant news. Personally, I hope it's good for you and hopefully on the markets front as well. So let's run you through the top winners of today. The top winners were from the fairest pack. You had Tata Steel and JSW Steel that did do well. Giving it company on the upside was the IT names. Tech Mahindra, Infosys, both of them did do well. And Reliance Industries, that's the big boy in there. that was doing the heavy lifting. It managed to conquer the 20 DMA. However, it couldn't get past 200 DMA. That's going to be a stock, though, that the markets will be turning to. The problem is the largest weight on the index, which is HDFC Bank, continues to remain under pressure. That's under the weather. The stock was down close to around 2%. More than selling today, it appeared there was unwinding of long positions. And Hindalco from the non-ferrous names was a big underperformer because by the time we wound up, you had Hindustan Copper actually that had recovered all its losses and moved into the green. Even Nalco cut its losses in today's trading session. So from the metals park, individual stocks were doing a thing of their own. Other stocks that did do well, Ola Electric, Happiest Minds, both of them up 7% apiece. Inox Wind was up close to 5%. And Vodafone Idea as well decided to participate. Stocks that were in the circuit, you had Bepsol Energy, Gujarat Alkalis, as well as Brainbees. Net for the week, we ended more or less flattish on the headline index. The problem was the Nifty Bank that actually underperformed this week, courtesy HDFC Bank. I'll tell you what, we'll wrap up on this edition of Closing Bell, but you stay with us. Editor's Roundtable comes up next.
The war in West Asia keeps the markets volatile. The Nifty and the Sensex see minor gains this week while banks underperform. The index falls 1%. Autos see buying after last week's big fall and is the top gainer in terms of an index this week. On this week's edition of Editors Roundtable, we'll decode the week on Dalal Street. We'll take stock of the global energy scenario. We'll put the spotlight on the FDI rush into the BFSI space. We'll take stock of India's weight loss drug market and the big fall, the free fall in the currency market. I am Reema. With me are Ekta, Nimesh and Nigel joining in. And also here with us in the newsroom is Ramesh Mantri, CIO, White Oak Capital AMC. Hi guys, it's a flattish week after last week's carnage, brutal 5% fall. This week, the moves were very large, but Friday to Friday, it's a flattish performance for the market.
Well, that's right. I mean, at one point of time, it looked like we were ending the week at close to around 24,000 odd. We ended closer around 23,000, but there was a fear that maybe we go down even from there.
As well.
Yeah, I mean, getting into last week, I think there was a lot of calls of 5%, 10% correction from there. At least as of now, it's not taken place. The problem is the rupee, I think.
Absolutely. I think the rupee is the big problem. It's crossed 93 for the first time. It hit a record low of 93.76. It's one of the worst performing currencies in Asia since the Iran war started. And not to mention, if you look at it from the start of 2025, it's down over 8% in terms of depreciation. So it's definitely one of the key assets that we need to track and where it could go from these levels.
And this rupee is actually having an impact on the FI flows as well, right? I mean, Feb was a bit of a month where we saw a bit of inflows and we all got excited and it all got short-lived. And now back to FI selling. So this month, in the month of March itself, until now, FIs have sold nearly $8.5 billion. Yes. So obviously, this war-related concerns have again resurfaced. So that's a bit of a nervousness. But again, rupee doesn't help the FIs for sure. So for them, it's a double whammy. The stocks are going down, and in dollar terms, they lose on the currency as well. So I guess that's been a big reason why the FIs have done net sellers and they've sold nearly $8.5 billion in the first 20 days.
So Ramesh, markets, we were just turning constructive on the market. So many experts, and then came the war. Nothing that you can control about. Then 3 weeks into the war, the comments say from Israeli Prime Minister Netanyahu seem to suggest or hinting that the war is coming to the close. And then on Friday, wham, you had that big free fall in the currency market, once again spoiling the picture for us. So take us through how you're assessing the market right now.
Yeah, so first on rupee, I think the clear issue is that India is significantly vulnerable to this conflict, right? We are a country that imports over 80% of our crude, and particularly on LNG, right? On natural gas, we are significantly exposed to the straits, right? And of course, then Qatar has got hit. The LNG facilities have got hit. So we are clearly looking at a disruption, and it's not just restaurants are shutting down, right? Because of gas cylinders not available. In a days to come, if this crisis continues, starts impacting manufacturing, because the number of even as basic processes as a welding, which is as basic manufacturing, requires natural gas. It works on natural gas, and there are no easy alternatives to that. So we are clearly looking in the short term, a lot of disruption if things don't. Of course, we are slightly better off that some cargoes are coming through. We are one of the luckier countries, but we are clearly vulnerable. So I think the world is negative for three reasons on this. First is exposure to energy. Secondly, a lot of Indian companies do business in Middle East, and a lot of remittances come from Middle East. There's uncertainty on both the business and the remittances. And third is again that lingering concern of AI and how it impacts IT exports.
So what's your base case for our markets?
No, I think the base case is it's almost, say it's every day you're living through this war, and you hope every day it gets over. You find some, but there's no way to predict wars, right? Everyone when they start a war, remember when Ukraine started, we thought it'll get over in a week or two. We believe like a month is max it's going to last. It's ongoing as we speak. There's no way to predict the war. The good part of this war is, I'm sorry, in a crisis, I'm talking about good part. The whole world is exposed. Everyone is on their knees. It's getting impacted. So the whole world is invested to solve this crisis. It's like COVID. The whole world was invested to solve COVID. It is not a problem that is localized. It hits us harder in the short term. But I think all of us are in the same boat in getting this issue resolved. So I think I'm hopeful. I'm just using the word hopeful. I'm not predicting that the world will find in the days and months to come a resolution to this crisis.
But Rakesh, do you think that this is a problem which, if it lingers on for the next 1 to 2 weeks, could eventually hit the economy, hit the GDP, hit banks in terms of gross NPLs? What is the worst case scenario that you're assuming at this point in time, if you can make one?
No, I think the Indian economy has been robust and the banking credit quality has been very robust. In fact, there was a recent study that said Indian banking credit quality today is better than pre-COVID. So we're one of the strongest cycles of credit quality. So I don't think this crisis has ability now at this, what we know, and even in the month to come, can start impacting significantly credit quality that you will start worrying about banks. That's not a concern. It's going to start impacting certain manufacturing businesses, people who are, the thing that worries me is fertilizer. Because remember, we're getting into a agriculture cycle in June, right, when the seasoning. So you need to get fertilizer on ground. Yeah. Now, India imports a lot of urea, right, ammonia and urea. So those challenges are there. But the worry is not on banking. That's not my worry at all.
All right. But since you mentioned that the entire globe is exposed, is that risk that equity as an asset class itself gets shunned? Because even assuming that, say, the next week we have some news and there is de-escalation and hopefully this war comes to an end, the repercussions are going to be seen for the next many, many months. You're going to have higher interest rates. You're going to have currency movements, getting tuned to higher gas as well as petrol prices. So equity as an asset class, could it get shunned, say, for the next 2 years or so?
It's hard to predict what happens in the short term, but if like the conflict gets over, it's going to take maybe a few months to normalize it. It's not going to happen in a week or so. Yeah. The real world is, because remember, if you shut down production, and some of the facilities have got impacted, they'll probably sometimes take years to get back to normal. But we will take a few months to normalize. So then I think the world will move on. I think one big message this crisis leaves to the whole of the world is energy security is back on the table as a key geopolitical concern. And India, which has one of the largest dependence on imported energy, we need to build a domestic energy security program. Sure. For a country to grow, we need to diversify. That's a long-term initiative that has to play out in India.
So, Ramesh, in that case, in that sense, you see a lot of opportunity in the renewable power sector, so to speak, as an investment as well, say Varis and say premiers or all the alternative to natural gas. Is that something that will be?
So there is a large energy basket, right, from crude, natural gas to power, right? So there's going to be broad-based opportunity across the board. Like for example, today our cars run on petrol. Logically, they can run on electric vehicles. Now, one of the simple challenges of electric vehicle adoption is charging infrastructure. Does every home, does every large complex, does every hotel, every mall, every office building have charging infrastructure? The answer is no. So one of the challenges to adoption of electric vehicles is just charging infrastructure. So you have to start solving these problems. Right. So renewables will benefit, but we probably have to go a lot more to even traditional energy like oil and gas exploration, thermal, nuclear, and coal. All of them have to come back on the table. Right. Okay. We need to significantly diversify energy.
So power as a theme, you feel like it can be a decadal theme where everything across the power vertical can
I would use a broader word. Power is a subsegment of energy.
Sure.
I think the big opportunity is the whole energy basket.
In the energy basket.
The whole energy opportunity. Significant investments have to happen in the next decade so that we can reduce our dependence on imported energy.
But just to drill it down a little bit more, generators, what will you be looking at? Transmitters, generators?
So see, first of all, there's going to be opportunity in every part of the value chain, generators. But one of the most interesting opportunities usually all of the time is the guys who make the equipment. Because they actually make the most money. And if you have a very aggressive demand cycle, we've seen already in power, because of even AI itself has accelerated power demand. So there is already significant shortage of certain kind of power equipment. And that story can actually last longer.
Okay, all right. Let me just do a quick recap then of what went on in the mining, metals, precious metals, as well as commodities basket. So a quick couple of points then. Crude oil prices from the start of this conflict, it's up by more than 50%. The good news is that at least we're ending the week not at around $120 per barrel, which was what we saw at some time during this week. And that's because of comments that came in from the United States. They're saying they're not looking at putting troops on ground. And even Israel says they're not going to be hitting the infrastructure. So that was actually a positive commentary that we got on Friday morning itself. A quick matrix should come up for you on the screen. Every 1 rupee decline in the marketing margins, that hits their earnings estimates of OMCs by anything between 20%. So that's why HSBC, just to cite a brokerage name, they went ahead and they downgraded all the 3 stocks. Moving to coal then. Coal is going to be rather interesting, because we have Indonesia that's saying that first they're going to be addressing domestic demand. Remember, Indonesia, they account for a substantial amount of coal that goes into the globe. So because of that, you're seeing that a stock like Coal India, we're talking about the markets being under pressure. Coal India is up by 9% in this month itself. So the hope is that power demand comes back. For this year, India, as the power demand is going to be more or less flattish. But in the next year, the hope is that it will go up by close to around 6% or thereabouts. And also on pricing, coal pricing has been subdued. International prices are shooting through the roof. So then the case is there for Coal India to go ahead and increase their e-auction prices. So that's why the street appears to be quite positive. The third point we're looking at is the industrial or base metals. We're seeing a lot of profit taking. Aluminium, whether you look at silver, whether you look at copper, all of them came down to multi-month lows actually after the big run that we have seen. A few reasons. The primary aluminium stockpiles went up. It was at the highest we've seen in quite a while, at around 1.3 million tons. There was some liquidation of long positions as well. The Fed could be a little bit more hawkish than what they were earlier, and the dollar index did strengthen. So because of that, base metals itself did correct. Silver, by the way, is down close to 35% from the peak that we saw in January, while gold is down close to around the $1,000 per ounce from the highs that we saw. Finally, steel stocks, well, they have been outperforming. They were underperforming earlier, but they seem to be outperforming. And Macquarie's put out a neat note. They're saying that pricing is up by more than 10% from December lows. They're saying that this will help the spreads move to around $300 per ton from around $250 per ton. And they're also saying China is cutting down on production, which is good news. And besides that, you have production coming in India because the safeguard duty is there. Europe has already announced some safeguard for their domestic producers, and Tata Steel will get, because UK as well is moving in the same direction. So put everything together, a couple of brokerages were quite bullish on that. So that's the wrap in terms of commodities. How do you approach this? What do you like? And a quick word on gold. $1,000 per ounce, it's corrected out of nowhere. It ran very, very hard, but how would you position yourself?
Yeah, so see, gold, if you look at 2,000 years plus of human civilization, that has been the default currency of the world. The paper currencies, the hard currencies have been, let's say, less than 100-year phenomena. And when trust is breaking down in the world, with all the geopolitical issues and higher inflation, a part of the world is moving back to the traditional currency that they know of, which is gold.
Yeah.
Right. So gold, of course, has been a beneficiary of all the chaos the world has seen the last few years, all the joy. But from now, if you have to believe that gold will continue to do exceedingly well, by the way, it has done exceedingly well, even the last 12 months. So if you want to believe gold will continue to do well, you have to be bearish on everything. Because you have to believe the world will keep getting worse. Who knows? That's right. But I'm an eternal optimist long term. So I would believe that, the world will get better, hopefully. And gold has to have a place in a portfolio as an insurance policy. But I think the best days
of gold are behind?
Have already played out. From now, if gold does well, the rest of all other asset classes are in trouble.
Okay, all right.
Ramesh spoke about, you're not too worried about banking sector per se, but the biggest drawdown has come in the banking stocks and overall in the financial names, apart from the autos. Again, this week we saw big headline news in terms of HDFC Bank, the chairman leaving, and all those things. But the graphic will come up. The private banks have massively underperformed the PSU banks in the last 5 years. The 5-year CAGR return for HDFC Bank is almost flat. Same is the case with Kotak Bank as well. Virtually zero returns in 5 years. Whereas the PSU banks in the last 5 years, virtually everybody has given double-digit returns. SBI is something like which has given 50% return as well. What's the trade now? You think that the trade is going to change now from PSU to private? Will private outperform from here on?
So, 5 years ago, a typical PSU bank used to trade at 0.5 or half or less than, and the well-run private banks used to typically trade at 3.
Yeah.
Their multiples have corrected by 40 to 50% depending on which private bank you look at.
Yeah.
And PSU banks, first the book has grown a lot because there's been a lot of NPL recovery, very, very strong cycle. And then the multiples have rated to 1-time price to book close to that number. So you have a trade where one place the multiples corrected by 50%, another place at least multiples have doubled, and there's been huge book growth. And one of the reasons is we have been in a very strong asset quality cycle, and PSU banks are typically beneficiaries of that cycle because they had a very weak last decade. Now from here onwards, the valuation gap has significantly narrowed, and the gains of past loan books are coming off.
Yeah.
And remember this whole geopolitical problems, right? Particularly government companies end up participating the pain, right? So I feel where the valuations are today, clearly the trade is in favor of private banks versus PSU banks.
So in terms of valuation, where you give the comfort? Like for private banks, below, say, 1.5 time price to book, or below 1 time book, or below 2 time book, that's where you'll get a comfort. So, how are you going to value the private banks and which banks?
So typically the well-run private banks, if you find them below 2, that has been very few moments in the last 25 years.
Okay.
Right? It's been typically been a bit COVID, 08, 09 crisis. So now we started getting those same multiples.
Yes.
So this is an extraordinary time to be invested in private banks.
So you'd buy into your HDFC Bank, ICICI Bank, Indices, all of them are close to
high quality, well-run private banks.
Okay. I know it's hard for you to talk about stocks, but your just quick comment on HDFC Bank.
No, I cannot comment on specific banks.
Okay, but if someone is a shareholder in a bank like that, where there are question marks now on governance, we don't know the picture. The chairman himself has backtracked and said that, well, there are no wrongdoings. We've got, RBI sources, everyone telling us. But the damage has been done on the stock, right? In such a scenario, what does a shareholder do? How should they think about the problem?
Yeah, so I'm not going to comment on the bank.
Yeah.
But see, you have to revisit your entire thesis at that point. Because you invested with a certain thesis, right? Now you should understand what is the issue with any company when it goes through such a crisis, and where are the valuations. And one key input when you evaluate situation, look at the very long-term track record of that company.
Sure.
Usually cultures and track records are very persistent. So if some institution has done exceedingly well and behaved well for a very long period, it is likely the problems are smaller, right? But if institution or a company have always had issues in the past, right? Then you're likely the problem is again much larger. So that's something you should think hard about.
Sure.
Well, Rakesh, just to diversify into another asset class, real estate, what's your thought in terms of how you would approach real estate at this point? We know the index has done badly. We've heard from, experts say that they've approached RERA, real estate companies are approaching RERA because of possible project delays at this point in time, because tile manufacturers are seeing delays. So in that sense, how would you approach real estate? Do you think that it's going to run into a deeper problem?
So let me add a little bit more. Last time when you came, you said you're very bullish on REITs. So now tell us, between REITs and listed entities, where's your preference?
No, I wouldn't. See, real estate stocks are very different animal from REITs, right? Because on one side you're investing in, assets which are long-term leases, right? Where assets, and here you're investing on development companies. Yeah. So very different animals. I won't even keep them in the same bucket. Real estate, I think we have clearly concerns. We've had a very strong cycle post-COVID, where sales did well, property prices have gone up, doubled in many areas. And now with all this economic uncertainty out there, inflation going up, rates may not go down, may go up, who knows. And finally, this job uncertainty in IT. When do people buy and take a 20-year loan? When they think that they have a great future, when they think they're going to get promotions, increments, But if people start doubting their future, right, when they're not sure of their jobs, and investor demand also goes away when people stop believing that prices are going to go away. So first demand that gets hit is investment demand. Secondly is people who are on the margin, who will revisit whether they want to buy a house now. So clearly, and then the third is a supply problem in real estate. So real estate sector is not looking very good.
All right, we will slip into a very short break. On the other side, we'll put the spotlight on the pharma sector because semaglutide goes off patent from Saturday. So what's the opportunity? We'll discuss that on the other side.
Welcome back. You're still tuned into Editor's Roundtable. Well, one of the big pieces of news is that the weight loss drugs are going to get cheaper, which is basically semaglutide, is going to get generic from tomorrow onwards. We're going to possibly see eventually 50-odd companies sell that particular drug in the Indian market. So what we are going to see is that prices could fall around 50 to 70%. Whether or not it's going to become accessible, some analysts peg that maybe the market could grow to 9,000 to 10,000 crores for semaglutide. Remember, currently the market stands at around 1,464 odd crores. So that could be a huge upside, but it depends on accessibility. It depends on whether people are okay with the possible side effects and whether there are newer drugs which could possibly be even safer and more effective, which could possibly come into the market. But Rakesh, you know, this is a topic which is very widely discussed. We have NATCO, which has come out with its pricing. We have Eris, which has come out with its pricing. And I'm sure we're going to hear a lot more in the next couple of days. One, do you know people who use the drug? So you can get an idea in terms of how successful it possibly is. And do you think that it can scale up to those levels?
No, first, I personally don't know anyone who uses a drug. That's true. But I think, see, when you consider the thing is, in India, affordability is always an issue, right? So with this price points, right, 12, talked about 1290, and I'm sure with more launches, prices will go south further. So one will become very affordable. Considering India is a diabetes capital of the world, remember, this is a miracle drug for them, right? So that's at the very first principle level. We have had a very acute, I think all of us know personally someone who struggles with diabetes. So clearly, that's clearly going to work for them. So it's actually a big health epidemic in India. So that's one clearly. Second is the other market is the market to look good.
Obesity.
Right? Obesity. Yeah. Basically, there's a basic human need to look good, right? Obesity, that's a large market. In a country, there's such a large, the world's most populous country, there's going to be a large market. So I think affordability is going to be a key driver of product usage. So it's a really great measure that prices drop a lot.
Buy a stock from that perspective. Do you think that it would be a stock opportunity?
Yeah, so one, there's a whole value chain, So one are companies. So you can think of the value chain as people who make the vials and the pens. That's a value chain where there are few, particularly on the pen side, we are invested. And there are a few companies on that side, very limited opportunity. So that's a very interesting opportunity. Devices. Then you have the APIs, which is the active pharma ingredient that gets manufactured. And finally, the biggest value in my view, apart from on the pen side that will get created, devices side will get created, is the people who have in India marketing and distribution. MRs on the ground distribution. Because once the product becomes a commodity, the people who have the brand and the distribution win. The big pharma companies who have the right execution on ground. So there's going to be clearly opportunity in pharma stocks in India.
Okay, well, interesting thoughts. Thank you, Ramesh, for joining in. Completely out of time in this edition of Editor's Roundtable. We thank you for watching. Don't go anywhere. On the other side, more news and updates will follow.
Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the Indian rupee plunges to a record low against the dollar, breaching the 93 mark, registers its biggest single-day fall since the 24th of February of 2022. The rupee weakens by over 2% since the start of the war, even as the RBI sold dollars worth $15 billion in the last 20 days. The currency has dropped from 90 to 93 in 107 days. The Sensex and the Nifty end a volatile week on the large street with minor gains. Financial stocks underperformed. 50% of the Nifty stocks closed the week in the red. Iran targets Kuwait's largest refinery and Israel's Haifa facility as attacks on energy assets continue. Saudi officials warn that oil prices could touch $180 by April if disruptions persist. Qatar Energy says 17% of LNG export capacity has been knocked out for 5 years. Hindustan Petroleum hikes the price of premium petrol by 2 rupees a litre, leaves the price of normal petrol unchanged. Indian Oil Corporation hikes the price of industrial fuel by nearly 22 rupees a litre. Israel pounced Iran with airstrikes as Iranians mark the Persian New Year. Iran's Revolutionary Guard says a spokesperson has been killed in the Israeli strikes. Iran warns the war will continue until the enemy is completely exhausted. President Trump appears to rule out deploying boots on the ground for now. Shares of Tata Power rally after the Gujarat government approves a long-term purchase agreement. With this, Tata Power can restart the coal-fired plant in Mundra, which has remained shut for the past 6 months. Eli Lilly is well prepared for competition from generic overweight loss drugs, says Executive Vice President Patrick Johnson. The patent for a key ingredient called semaglutide expires in India today. That's an exclusive. From changing the name of his company to investing $90 billion, Mark Zuckerberg was all in on the metaverse just 5 years ago. But now Facebook's parent Meta is killing its virtual reality business as it pivots to artificial intelligence. A special report coming up. Well, let's start with the day's market action. Ended in the green, but came off their intraday highs on the back of a weak rupee. The Sensex and the Nifty added 0.5% each, while the mid-caps outperformed today. But if you take a look at the picture for the week, the needle didn't move much. The Nifty 100 points higher at close, 0.5% higher in the Sensex. The Nifty Bank absolutely flat, and the mid-cap index almost 1% higher today. But for the week, the Nifty closing flat, but in the red. Similar story for the Sensex, the mid-cap index just about in positive territory. The bank stocks, of course, were bearing the brunt of a lot of the pain that we saw through the week. And the top story this evening is the rupee. It has plunged to a record low against the dollar, breaching the 93 mark. Now, the currency has dropped from 90 to 93 in just 107 days. The rupee has weakened by over 2% since the start of the war. Ritu joins us with more on the rupee's free fall. There doesn't seem to be any stopping the slide, Ritu, at this point in time. The Reserve Bank is the lone defender.
Thanks for that. The Indian rupee under sharp pressure, breaching that 93 to the dollar mark and setting new record lows near 93.5 almost. And what's driving this fall is not very new. As we have been telling you, at the core, it is a perfect storm of what's happening globally and the domestic factors, which have been in play for some time. The rising oil prices, that's pushing up the dollar demand by importers. Foreign fund outflows continue. That's adding to the pressure. And you have a stronger US dollar globally. All of that is intensifying the rupee fall. In fact, since the start of the Iran conflict, the rupee has now fallen by more than 2.5%. And that strain is unlikely to ease anytime in the near future because of what's happening with the oil prices. Also keep in mind, so far, foreign investors have pulled out more than $8 billion from the India markets just in the month of March. And all of that is playing up. Now, the speed of the fall is what is really striking. We've looked at how many days it really took for every 5 rupees per dollar fall. Now, this 90 to 93 rupee fall is not a one-to-one comparison with that. But even then, it is staggering that it took nearly 5 years for the rupee to move from 65 to 70. More recently on your screen, around 1 year for the move from 85 to 90. And just 107 days for that slide from 90 to 93, and that tells you the depreciation is accelerating sharply. Now, some of the traders we've been speaking to also worry that these lower lows tend to bring in the speculators in the market, and then that fall becomes self-reinforcing. Now, RBI, of course, has been actively intervening. It already sold more than $15 billion just in March to defend the currency, and its forward book, or the net short dollar position, is already close to $100 billion, and that shows you how actively it has been intervening. But keep in mind, it's not just India. Most Asian currencies have weakened since the Iran conflict began. Many, which you can see on your screen now, seeing even sharper falls, even sharper declines than the rupee.
Many thanks, Ritu, for joining us. 93.71, so nudging the 94 mark, that is the rupee for you. But to the news that is moving the markets worldwide. The attacks on energy infrastructure continue across the Gulf as the war in West Asia has now entered day 21. An Israeli oil refinery in the northern city of Haifa has been struck in a missile attack. Israel's energy minister played down the attack and said the power outage caused by the strike was resolved quickly. Drones also struck Kuwait's largest oil refinery for the second day. Kuwait's national company said several units had been shut down and there were no casualties. Qatar's national oil and gas company says Iranian attacks have knocked out 17% of the country's LNG export capacity for the next 5 years. 2 of Qatar's 14 LNG trains and one of its 2 gas-to-liquid facilities were damaged in the strikes. The damage is expected to impact revenue by $20 billion annually. Crude oil prices remain elevated despite softening marginally after the U.S. Treasury Secretary Bessent hinted at removing the sanctions on Iranian oil. However, the Strait of Hormuz remains effectively closed, with ships still anchored in the Persian Gulf. The region's biggest oil producer, Saudi Arabia, has warned that the prices could soar past $180 a barrel if the disruptions persist until late April. Meanwhile, the U.S. and its allies have intensified the battle to reopen the Strait of Hormuz. The U.S. Army has deployed low-flying attack jets over the sea lanes to hit Iranian naval vessels and helicopters to shoot down drones. However, officials say it will take weeks to clear out Iran's web of assets. Several European nations and Japan have issued a joint statement saying they would, and I quote, join appropriate efforts to open Hormuz Strait, end of quote. Israel has pledged to spare energy sites a day after Iran said it will show zero restraint if such infrastructure is targeted. Israel's Prime Minister Netanyahu also confirmed that President Trump's assertion that Israel acted alone in its attack on Iran's largest gas field and promised not to attack energy assets anymore.
Fact number 1, Israel acted alone against the Slawiya gas compound. Fact number 2, President Trump asked us to hold off on future attacks, and we're holding out. I want to close these opening remarks with one other fake news, and that is that Israel somehow dragged the U.S. into a conflict with Iran. Does anyone really think that someone can tell President Trump what to do? Come on.
Have you talked to Prime Minister Netanyahu about attacking the oil and gas fields?
Yeah, I did. I told him don't do that, and he won't do that. We didn't discuss. You know, we do. We're independent. We get along great. It's coordinated, but on occasion he'll do something, and if I don't like it, and so we're not doing that.
Well, that's President Trump. And back home, Hindustan Petroleum has hiked the price of premium petrol by 2 rupees a litre. The price of normal petrol has been left unchanged. Indian Oil Corporation has also hiked the price of industrial fuel by nearly 22 rupees a litre. The oil ministry says premium variety is about 3 to 4% of the total petrol demand.
नॉर्मल पेट्रोल में कोई प्राइस इंक्रीज नहीं हुआ है, सिर्फ एक प्रीमियम कैटेगरी जो है उसमें कुछ इंक्रीज है, and that is hardly 2, 3 or 4% of the entire petrol which is sold every day. तो वो ऐसा नहीं है कि पेट्रोल में आम जनता के लिए कोई प्राइस इंक्रीज किया गया है. पेट्रोल और डीजल का प्राइस has been deregulated. It has been decided, it is decided by oil marketing companies.
And it's not just petrol and diesel. Rising jet fuel prices are also forcing airlines to hike fares and introduce surcharges. Global jet fuel prices have surged 86% since the start of the month. Madiha is standing by with more. Madiha, take us through the extent of the rise in prices and how airlines are planning to deal with it.
Well, this is turning into a serious concern for the aviation sector. Right now, airlines are staring at a potential jet fuel shock that could significantly disrupt air travel. Let me break it down simply. Fuel is already the single biggest cost for airlines, but now it could become overwhelming. We are looking at a scenario where ATF could make up as much as 80% of an airline's operating cost, up from roughly 40% today. And why is this happening, or why will this happen? Because globally, jet fuel prices have shot up nearly 86%, as you mentioned, in just a month, which is between February and March, from about $94 per barrel in February to $175 now. And in India, the impact hasn't fully hit yet, as oil companies held back major price hikes in the month of March. So ATF prices have only seen a marginal increase so far. But, and this is the key point, sources are saying this could change from the 1st of April if oil companies start passing on global prices, the global price spike. Jet fuel costs in India could nearly double, and that's where the real pressure begins. For airlines, this means costs shooting up sharply, and for passengers, it likely means higher airfares. In fact, airlines are warning that if ticket prices rise too much, demand could take a hit, making some routes, especially the long-haul routes, unviable. There's also a bigger risk at play here. Any disruption in the Strait of Hormuz, which is a key global route for fuel supply, could even lead to jet fuel shortages. And in a worst-case scenario, that could mean flight cancellations, especially on international routes, right when we are heading into a busy travel season. So clearly, this is developing situation, one that could impact both airfares and flight availability in the coming weeks. When CNBC TV18 asked the government during a press briefing today on whether jet fuel prices will surge from the start of April, the Joint Secretary in the Oil Ministry, Sujata Sharma, said jet fuel prices are deregulated and a decision on price lies with the oil marketing companies.
All right, many thanks, Madiha, for joining us. Now, Israel's Prime Minister Netanyahu suggests the need for a ground offensive into Iran, claiming that Tehran has no capability of manufacturing ballistic missiles. Iran countering his claim, saying that they're still building missiles. All of this as the West Asia war completes a week. Here's a look at the top developments. Now, Israel and the U.S. hit central Tehran overnight. Multiple airstrikes damaged residential areas in the city. The attacks came on a day when Iranians were celebrating the Persian New Year. Bridges and civilian infra in southern Lebanon have also come under Israeli air assault. Tel Aviv had earlier said it would target bridges to prevent militant group Hezbollah from transferring fighters and weapons. According to officials, the conflict has killed over 900 people in Lebanon so far. UAE, Qatar and Kuwait have intercepted a barrage of Iranian missiles. Authorities in these nations have ordered that Eid prayers should be held only inside mosques as opposed to traditional large outdoor gatherings. Iran's Revolutionary Guard Corps has faced a setback with the death of its spokesperson, General Ali Mohammad Neni. This marks the fourth death of a high-ranking Iranian official in the last 3 days. Neni had earlier mocked Trump's assertion that Iranian Navy had been destroyed. He had dared Washington to deploy ships into the Persian Gulf. The Iran Revolutionary Guards claimed that it struck an American F-35 stealth fighter jet over central Iran. Pentagon has said the aircraft landed safely and the pilot is in stable condition. The Iranian foreign minister has reportedly told the UK government that if America uses British military bases, it would be seen as a participation in aggression. Israel's Prime Minister Netanyahu has reiterated Israel's stance of sending ground troops into Iran. Trump has said that the US was not putting troops anywhere as of yet.
No, I'm not putting troops anywhere. If I were, I certainly wouldn't tell you. But I'm not putting troops. Iran is a serious threat to the world, to the Middle East and to the world. And everybody agrees with me. I think virtually every country agrees with me on that. So I wanted to put out that fire.
And what came as an awkward moment for Japanese Prime Minister at the White House, President Trump compared the surprise attack on Iran to Pearl Harbor. Speaking in the Oval Office, President Trump made the remark while responding to a Japanese reporter's question asking why the U.S. did not inform its allies about carrying out the attacks against Iran.
Why didn't you tell U.S. allies in Europe and Asia, like Japan, about the war before attacking Iran? So we are very confused about we Japanese citizens.
Well, one thing, you don't want to signal too much. You know, when we go in, we went in very hard, and we didn't tell anybody about it because we wanted surprise. Who knows better about surprise than Japan? Okay? Why didn't you tell me about Pearl Harbor? Okay? right? He's asking me, do you believe in surprise? I think much more so than us. And we had to surprise him, and we did.
Well, that's President Trump. Time for us to head into a break, but up next, Zuckerberg was all in on the metaverse just 5 years ago, but now Facebook's parent Meta is killing its virtual reality business. That and more when we return. Shares of Tata Power rallying after the Gujarat government approved the long-term purchase agreement. With this, Tata Power will be able to restart the coal-fired plant in Mundra, which has remained shut for the past 6 months. So good news there, the stock closing 1% higher. Torrent Gas, the city gas distribution arm of the Torrent Group, has drafted papers with SEBI for a potential IPO via the confidential route as per a money control report. The issue will be a pure offer for sale with no fresh equity component. If the listing goes through, Torrent Gas would become the third listed entity from the group after Torrent Pharma and Torrent Power. Flipkart's Group Chief Financial Officer Sriram Venkatraman will step down ahead the company's planned IPO. The e-commerce company has said that Venkatraman will stay on for a short period to ensure continuity and a smooth transition. Flipkart CFO Ravi Iyer will oversee the company's broader finance operations until a successor is appointed. Well, on to a CNBC TV 18 exclusive. Eli Lilly, the pharma giant behind Mounjaro, has told CNBC TV 18 they're not surprised and are well prepared for generic drug makers entering the weight loss medicine market. Speaking with Ashmit, the company's management has highlighted a value-based pricing approach which reflects the GDP per capita across nations. Take a look.
No, there is nothing new that we didn't know a couple of years ago. I think we have a good understanding over time of patent expiries for ours and the competitive portfolio as well. So we are not surprised by any means. In terms of pricing, I think we and many other research-based pharmaceutical companies are taking a very value-based approach to pricing, and we also reflect the GDP per capita in different countries. So the price picture in one market is a reflection of their GDP, and that is the case in India as well.
And remember, the patent expires on Saturday, 24 hours to go. Chinese e-commerce giant Alibaba's workforce has reduced by around 34% over the course of 2025. The company said it offloaded some of its offline retail businesses while doubling down on artificial intelligence. This disclosure came in the company's earnings report, where the firm's profit plunged 67% and its revenue missed expectations for the last 3 months of the year. Amazon's founder Jeff Bezos is reportedly in talks to raise $100 billion for an AI-driven manufacturing fund. According to Wall Street Journal, this new fund will acquire manufacturing companies and use AI tech to speed up automation. The fund will also target sectors including semiconductors, defense, and aerospace. ChatGPT maker OpenAI has reportedly plans to launch a super app for the desktop. The company will combine its web browser, the ChatGPT app, and Codex coding app into a singular desktop super app. So that's on the anvil. And there's more tech. Meta's metaverse dream is now being scaled back after nearly $90 billion in losses and weak user adoption. Rachna joins us now with the details. Rachna, this was a massive bet and it's now being buried very silently.
That's right. Mark Zuckerberg once stood in front of the world and said the metaverse would be the next internet. 5 years, close to $90 billion and a few million empty virtual rooms later, Meta has quietly pulled the plug. The company announced this week that Horizon Worlds, its flagship virtual reality social platform, will shut down on June 15. It will disappear from the Quest headset entirely and survive only as a stripped-down mobile app. But the story begins in October 2021. Facebook, under intense regulatory pressure, rebranded itself as Meta. Zuckerberg's pitch was sweeping. The metaverse would be the next frontier of human connection. 1 billion users, hundreds of billions in commerce, and an entire digital economy built in virtual space. Horizon Worlds was the product meant to deliver that future. Users would strap on the Quest headset, enter as customized avatars. So think internet, but the fact that you're inside it, that was the idea. But the numbers tell a very different story. The division behind the vision, Reality Labs, has lost money every single year since 2020. In 2024 alone, the losses were close to $17.7 billion. And in 2025, that climbed over to $19 billion. The total bill now stands between $80 to $90 billion. To put that in context, that is larger than the GDP of several small economies, and it was spent chasing a product that never found users. Horizon Worlds never broke through internal targets, so the targets were cut and still missed. At its peak, it had fewer than 200,000 monthly users. Globally, compare that to Roblox, which has over 80 million daily users, or even any mid-sized mobile company beats those targets. So the problems were structural. Access required an expensive VR headset. The product launched with glitches, including avatars without legs, which quickly became a symbol of its limitations. The world felt empty, and as global VR headset shipments declined for 3 consecutive years, the hardware bet only made these things worse. A mobile version was launched in 2023 to expand access, but it did not change the trajectory. But then came the inflection point. In late 2022, ChatGPT arrived and the industry shifted overnight. AI became the center of gravity for any tech investment. And Meta moved with it. By 2024, the word metaverse had completely disappeared from its earnings calls. Layoffs followed. Over 1,000 employees linked to Horizon Worlds have already been cut. And now the final step, the VR version of Horizon Worlds, is being shut down. What remains is a much smaller mobile-only product, which is a shadow of the original version. And the contrast with what is working is pretty stark, because Meta's Ray-Ban smart glasses, which are built around real-world AI, have sold millions already. Its AI assistant is seeing massive usage across apps, traction that Metaverse never even came close to. So the Metaverse was supposed to be the future of the internet. Instead, it has become one of the most expensive experiments in tech history.
All right, Rachna, RIP Metaverse. Thanks very much for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We've got plenty more coming up for you right after this short break.
Hello and welcome to the special coverage on the rupee fall. I'm Ritu Singh. Now, the Indian rupee under sharp pressure, breaching 93 to the dollar, setting new record lows near 93.7. What's driving this fall is not very new. At its core, it's a perfect storm of global and domestic factors that have been in the play for some time now. Rising oil prices are pushing up dollar demand for imports. Even as foreign fund outflows continue, foreign investors have pulled out more than $8 billion from India so far just in the month of March, the largest monthly outflow since January last year. Add to that a stronger US dollar globally, and the pressure on the rupee has intensified. In fact, since the start of the Iran conflict, the rupee has now fallen by more than 2.5%, and the strain on the rupee is unlikely to ease in the near term as worries over high oil prices remain with the ongoing West Asia conflict. Now, the speed of the fall is what's really striking. We've looked at how many days it took for every 5 rupee per dollar fall. Nearly 5 years for the rupee to actually move from 65 to 70. More recently, almost 1 year for the move from 85 to 90, but just 107 days for the slide from 90 on the 3rd of December to 93 now. And that tells you the depreciation is accelerating sharply. Some traders we've been speaking to do worry that these lower lows tend to bring in speculators in the market, and then that fall becomes self-reinforcing. Now, the Reserve Bank of India has been actively intervening. Estimates suggest RBI has already sold more than $15 billion in March alone to defend the currency, and its forward book or net short dollar position is now close to $100 billion. And that shows you how actively it has been managing this pressure. But keep in mind, it's not just India. Most Asian currencies have weakened since the start of the Iran war, many seeing even sharper declines than the rupee. We are now joined by Abhishek Goenka, who's the founder and CEO of India Forex and Asset Management Global, Kanika Pasricha, who's the Chief Economic Advisor at Union Bank of India, and Anindya Banerjee, Research Head of Currency and Commodities at Kotak Securities, to decode the rupee fall. Kanika, gentlemen, thanks very much for your time here today. Anindya, I'll start with you. 93 is not a number we thought we'll get to so quickly. We know the usual suspects, oil prices, FII outflows, dollar strength. But what exactly happened in trade today? Was there any intervention at all by RBI?
Very good evening, and thank you for having me. See, yesterday the onshore markets were shut. So naturally in the NDF, we had seen a print of almost 93.40. Today, so when it opened and the oil prices once again rose from 105 back to almost 110. So a lot of speculative selling as well as oil buying, and plus the overall sentiment around the rupee is pretty bad. And that's the reason why which you are seeing is this kind of a sell-off. Because at these levels, only supplier in the market is the RBI. The only saving grace is that we are at the fag end of the financial year, almost the last week, and we tend to see a lot of exporter selling, the repatriation of their foreign currency earnings. But that might hit next week. But as of now, the rupee is now up to the RBI to decide where to draw the line. Maybe 94 could be a level they may come in heavily, try to defend. But ultimately, everything rests on the oil prices and Hormuz. Because the world trade is now, all the financial markets are being traded off Hormuz. Unless those flows normalize, oil prices are going to go up, and that will continue to exert a downward pressure on the rupee.
Well, yes, a lot of it depends on what's going on in West Asia and how long oil prices stay up. And, typically we do see RBI intervening more heavily towards the end of the financial year. But, Abhishek, on a day like today, who's actually selling rupees? If you could break down for us how much of it is, just oil importers hedging, how much is FII, equity-related dollar buying, how much is really speculative in this?
Hi, Ritu. Thanks for having me. Well, I may not know the divisions of each of it, but one thing I can tell you is that over the last few months, what's unfortunately happening for India is we're getting hammered from all sides. Earlier, it was a trade deal not happening. Before that, it was earnings slowdown, then FII outflow, all-time low. And now we have concerns on capital account, current account, both, and there is no respite. Normally, these kind of movements in a situation like India, which has a good fiscal prudence, which has good growth, normally doesn't happen. But this time around, since we are getting hit both sides, and also the oil, which has always been a loose end for India, is going one-sided up. There's a speculation and there's a huge nervousness in the market that the oil is likely to stay above 100. And that's the reason speculation and outflows are happening at these levels. If I have to learn from history, there's no reason why rupee should be at 94. And I'm optimistic that things are going to settle down. And I think it's completely dependent on oil now. If oil stays above 100, 93 is a fine level. But if oil comes back to 80, very soon we are going to see levels of 90, 91 within no day. In no time, it's going to come back. So I think right now, it's more about the recency information, whatever is coming out of the Gulf, which is playing, and there's no exporter selling happening in the market. But in the medium term, if I have to take a 3-4 months view, I think things are going to settle down and rupee is going to go back 90-91 levels.
Well, I don't know when we get back to those $80 a barrel crude levels, and hopefully that happens soon and it helps the rupee. But, just follow up, Anindya, at a 93 per dollar level, isn't there a mechanical wave of stop loss orders that will force even these, corporates and banks to start covering position, effectively worsening the move?
Absolutely. Because what happens is that after a point in our currency market, it becomes a self-fulfilling one. And it's kind of a cycle that takes over. Currently, the cycle is that the rupee is being treated like a proxy to oil. So every one tick up in the oil is like a fresh speculative pressure on the rupee. Now, the exporters, they always want a higher realization. So naturally, the exporter won't sell. Who will panic? The importer. So that creates a complete dollar demand with lack of supply. And the only supplier in the market becomes RBI. And they also have a constraint because they cannot sell hammer and tongs on the spot market, because if they do that, that will suck out the rupee liquidity, which will tighten money market rates further. So they have to do the fine balancing act between NDF, forwards, and spot.
Yeah. Kanika, let me actually bring you in on that. Firstly, if you could set up the macros for us. What happens with every 1% additional depreciation when it comes to the headline CPI through imported goods? Do the math for us. 93 rupees, what does that mean for India's macros?
So Ritu, thanks for having me, and I completely agree with the way Abhishek and Anindya talked about the rupee view. We'll come to that. But just your question, 1% move, the way RBI puts it is 10% move in rupee affects annual CPI inflation over a 12-month period by 35 basis points. Now, it's all dependent upon how much of shocks from inflation shock from the oil price hike the government is willing to take, how much is divided between government, OMCs, and households. At the current juncture, yesterday the chief economic advisor commented at $90, they will absorb most of the pressure. So inflation at $90 oil, if it sustains at these levels, will still be close to 4.5, and not spike very sharply. So it depends upon how much of the shock the government and OMCs are willing to take before passing on to the households. Thanks.
Yeah, but I think we've already seen some OMCs announce, fuel price hikes for premium petrol, not so much for regular petrol. But Kanika, quickly to the point that Anindya was making, beyond this spot market intervention, what are the actual tools RBI has left? The FCNRB deposit scheme, from 2013, could something like that work again? Can RBI raise the interest rate ceiling on NRI deposits to attract dollar inflows? What are the tools on the table?
So Ritu, first and foremost, let's understand, when did the FCNR deposit scheme come? In September 2013 when it was announced. That's the time, similar period, we had our FX reserves let import cover slip to around 6.5 months. At the current juncture, our total reserves, latest print is around $718 billion spot. As per current estimates, the short dollar forward position is $100 billion short. If we assume, so the reserve number is around $615 billion. If we assume that the monthly import number continues to average at $65-70 billion, Then the import cover today is close to 9. We've still not reached a crisis level. But at this juncture, while I still believe we are still slightly farther away to introduce crisis type measures, which is FCNR or NRI deposit ceilings, RBI, the way it's behaving, by making rupee the shock absorber in this tussle between rupee and rates today, we actually see RBI trying to preserve its FX reserves to the maximum quantum at the current juncture. Still, it can come up with measures like even the FX swaps. If you see, is another way it helps improve reserves or at least improve the dollar forward position over a long-term period. That's been one instrument they've already used. FCNR, NRI deposit ceiling hikes can be measures, maybe not now, maybe if the crisis prolongs and that import cover falls further. Thanks.
But Kanika, using forex swaps, that then directly starts to impact liquidity. You don't want to do that at the end of the year when anyway there are outflows. Is that a tool that RBI would look at even using right now?
These are buy-sell swaps. So you buy dollars today, it beefs up your reserves in the short term and gives rupee liquidity to the system. So apart from OMOs, that buy-sell FX swap is being used as a tool to support liquidity as well. So it'll be like, two birds killing from one stone in the very short term. But of course, and even the forward premium gets addressed because it's a buy-sell swap. So swaps may help. Of course, this is one of the tools.
Yeah. Take your point, Anindya. I just want to get back to the point of 93.71. What next? I mean, you said if crude goes to 80, we may get back to 90.91. That doesn't seem to be the case, at least at the moment. We don't know when it comes down below 100 and what happens. But is there air below this 93.71 level, or how quickly do you think we'll get to 94 from here?
See, the current script, which is the Hormuz script, we haven't seen this script since 1970s, and none of us were in the market then, because this time it's not an energy price rise, it's an energy shortage, because you have a 10 to 15% of the global oil flows offline almost, and you have a 20% of the gas flows offline, fertilizer, chemicals, the petrochemical feedstocks, etc., etc. So, of course, it's a global crisis. Like 2013 was India-specific crisis. This time is a global crisis, and this is far different from 2022. So the whole point is Hormuz has to open up. You cannot have a situation where you have 10% of the global oil supply out and 20% of the gas supply out, and the world continues to function as normal because you don't have a spare capacity outside West Asia. So I think the efforts, I presume, are being made. I'm quite optimistic that to open up the Hormuz, hopefully if it opens up, let's say by max mid of April, things will settle down. But if it goes beyond mid-April, then it will start to hit every supply chain globally. It's kind of COVID lockdown.
Okay, comparing it to the COVID lockdown, Abhishek, let me get your sense as well on the rupee level. What are the technical levels markets are watching for next? 95 to the dollar, is now that a realistic near-term risk for the market?
Well, Ritu, I don't think technicals work in this market when there is news flow every single day, every single night. If you have to ask me just technically, 93.30 was a level which was a last line on the sand. Ideally, that level should not have broken, or even if it stretches a little bit, I think we are almost at the last fag of the depreciation. Market can reverse any single time. On the chart, is completely overbought with huge divergences. So from a chart angle, there is no reason why rupee should be at 94. Having said that, you cannot put a technical chart on the emotions of people right now, and the emotions are pretty negative around the oil prices going up and supply chain shocks, etc. So I would say these are times like 13 and 20 and 2008. I hope it doesn't go from that line that much, because those times it went all the way 15-20%, and we never had $700 billion of reserves. I hope it doesn't escalate to that extent, but right now I think the only driver right now, as I said, will be oil. And if oil comes down, rupee is going to correct 2 rupees overnight. And if oil stays above 110, then it keeps depreciating.
Yes, Abhishek, I didn't mean to put you in a spot, but of course we can't measure what happens with emotions, and there's really no way of saying how long this goes on and what happens to oil prices. But we'll take our best guess at this point. Gentlemen, Kanika, do stay on. We have to take a very short commercial break, but we'll be back to continue this conversation after that. Welcome back to this Rupee special show. Abhishek Goenka of India Forex and Asset Management, Kanika Pasricha of Union Bank, and India Banerjee of Kotak Securities still with us. Kanika, let me get back to you on what RBI keeps repeating every time we ask it about the rupee level, that the idea is not to target any particular level, but only to smoothen the volatility. But the question really is, at 93, almost 94 to the dollar, how much longer can we afford to keep looking through this one-way slide? And how do you expect the MPC to react when it needs to set rates in a couple of weeks?
So, Ritu, 3 points. First and foremost, does the RBI want to catch a falling knife? The answer is no. As you yourself said that all the currencies are depreciating, the RBI is not willing to extinguish critical reserves at the current juncture in order to just safeguard the rupee level. Yes, they're trying to curtail the volatility, but depreciation has been consistent with the broad global trend. That's one. Second, when you're asking about MPC, see, frankly, we are in a world where when oil is at $100, even though underlying inflation or the starting point for inflation is low, given the kind of numbers we have, we still believe it's a case for prolonged pause on rates in times of uncertainty. The RBI can manage liquidity measures to ensure that call rate, the WACR, weighted average call rate, which is its monetary policy target, may be strictly aligned to repo rate and does not slip below the same. But overall, no change in policy at the current juncture. We have to wait through uncertainty. Last but not the least, just coming back to rupee, as I stated even earlier, just repeating, rupee remains shock absorber as per RBI's policy actions or RBI's intervention moves compared to rates at the current juncture. Thanks.
Okay, interesting there. A longish pause is what the market's currently working with. But Anindya, I think $15 billion is the last figure we have about how much RBI has spent defending the rupee this month. And you still have the rupee breaching 93. The net short forward position also keeps on growing. I mean, is that a risk? Because RBI, is it in this loop where the more it intervenes through forwards, the larger the future dollar demand it creates for itself, that may weaken the rupee, then, that'll again require more intervention. Where do you end this loop, theoretically speaking?
Right. See, the RBI has enough measures, it has a swap window, it has the forward and the spot. When we are going to map the future dollar demand because of these actions, we have to also take into account what could be the state of the dollar in the future. So that is uncertain. And plus the state of this oil, the energy crisis, because we have to understand this. Unlike the past, this and 2022, these were the two times when this whole energy price hike or energy price shock is artificial, which means it is that just that the Straits of Hormuz is holding the entire world hostage. The moment the flows improve, the whole energy complex is going to fall very, very sharply. It might even collapse. So the point is, how long does that continue? So assuming that it won't continue beyond a couple of months at worst. So when we look at a future dollar demand, it could be that the oil prices could be much lower in the future. And considering how the US economy is shaping up, that's in real trouble with the credit crisis, and one after another, the credit funds are blowing up. So it could be such that the Federal Reserve could actually get into action mode with the new governor and be cutting rates aggressively or infusing a lot of dollar liquidity, which could push the US dollar down against international currencies. So that could also be a situation in future when we are trying to map the dollar demand.
Well, Abhishek, let me then just ask you, because some analysts keep arguing that, RBI should let the rupee find its level, don't intervene as much, preserve its reserves, accept this weaker currency and let exports benefit. But, where do you stand on that argument? Is there a credible case to be made for a managed step down rather than a defense that's, obviously not working as well?
Say, Ritu, they have spent close to $100 billion. Now, just imagine if they would not have spent $100 billion. What would have been our rupee? Would have been much higher. So time and again, they have liquidated the long positions of speculators. They have been very, very careful, and they've been asking questions to banks and EDs about NDF positions. So they are very much watchful. So we should not say that they don't have the ammunition or they don't know how to manage the rupee. They're doing it in a very fine manner. But as one of our guests has been saying, that rupee has been a shock absorber in the impossible trinity that we play around. You cannot do anything on the flows. You have to manage the bond yields. You have to ensure that there is enough liquidity in the system, growth does not get suffer. And in that process, if exporters get some benefit in depreciation, and because the inflation is down, and if there is some higher imported inflation, at this point of time, we can manage. So they're letting the rupee depreciate. But mind it, whenever RBI feels that there is thin liquidity, they can jack the rupee down. They come with full force. So looking at history, I am very, very hopeful that thou shall pass. And this is not going to be a situation where we're going to see a huge spiral of depreciation in the rupee. Things would be definitely better, as Anindya was mentioning. That once we start seeing signals that the war is getting settled, which it should be, then we're going to see a drastic hit by the RBI to bring the rupee down. And automatically, if the oil starts correcting, like a few days back, we saw the oil corrected 15-20%. So if we see something like that, tomorrow you're going to see rupee 91.5. So I think let's be hopeful and let's not be so pessimistic about India. Things will definitely be better.
No, not pessimistic, Abhishek. We're just trying to understand the thinking and the, behind what RBI thinks it should make of this move and the kind of intervention it should make. But let me just follow up on that, Abhishek, on where you see the fair value for rupee in the current macro environment.
There's one way that we measure the fair value of the rupee is the real effective exchange rate. And if you actually see that numbers, we are at least 5-6% undervalued. So if you talk to me about the fair value is definitely 90 and below. 93.5 is not the fair value of the rupee by any chance. If you look at the relative currency depreciation with regards to Indian rupee, then also you see Indian rupee has depreciated much more. They are getting hammered from all the sides, like I said. And one thing which markets, we should learn from it, that market course corrects. Now today, if you think as an FII who's sitting in Singapore, now if he gets rupee at 94, which is at least 4-5% undervalued than the fair value, you also see that your Nifty 50, historical average is close to around 18 PE. We are close to that number. Mid and small have corrected and 5-10%, they're above their historical average. Now, why would I not invest in India? We are still buying the India story, right? So at some point of time with rupee depreciation and the valuation in India and the 10-year bond yields, maybe it starts going up a little bit more, these flows will start coming in. Whether it's at 94, whether it's 95, anybody guess. But at one point of time, that number is going to play out and we're going to see billions of dollars coming in. And if followed by lower oil prices, then we're going to get flows from all over. So that's the case that I'm putting in my head, that under these circumstances, we are going to get the flows and the rupee is going to correct.
Well, always bullish on the India story. Abhishek, Anindya, Kanika, all of you, thank you so much. That's all the time we had for coming here and candidly sharing your thoughts. It's been a pleasure speaking with all of you. On that note, we're going to bid our guests goodbye and to our viewers. But stay with us. More news and updates will continue after this show.
Hello and welcome. I am Ashmit Kumar. Now, the conflict in Iran has entered its 21st day with an uneasy understanding between US and Israel to not hit the oil assets of Iran. Israeli Prime Minister Benjamin Netanyahu has confirmed that Israel acted alone in launching strikes on Iranian South Pars gas fields. This strike had led to Iranian counter launching a flurry of strikes on gas facilities in the Gulf region, most notably hitting the Ras Laffan gas facility in Qatar and the Habshan gas facility in the UAE. Ras Laffan, mind you, is the world's largest LNG plant. Netanyahu in a press conference said that he will hold off on any future attacks on Iranian gas fields on Donald Trump's insistence. The Iranian Foreign Minister Abbas Araghchi has said that they will show zero restraint if Iran's energy facilities are hit again. After the attacks on oil assets in the Gulf, U.S. Treasury Secretary Scott Bessent has clarified that the U.S. may consider unsanctioning Iranian oil on water. It is estimated to be around 140 million barrels. The U.S. is hoping this would help calm the markets after the strikes that we saw in the Gulf region. This move would follow U.S. previously allowing the sale of Russian crude. Brent crude prices, meanwhile, have cooled off after yesterday's spike. Saudi officials, in a conversation with Wall Street Journal, have estimated prices at $180 a barrel if the conflict stretches to late April.
I'll say two things. Fact number one, Israel acted alone against the Slawia gas compound. Fact number two, President Trump asked us to hold off on future attacks, and we're holding out. I want to close these opening remarks with one other fake news, and that is that Israel somehow dragged the U.S. into a conflict with Iran. Does anyone really think that someone can tell President Trump what to do?
Well, joining us now to discuss this further is with us Professor Adam Dixon, the chair and director of Adam Smith's Panmure House. So we also have with us Paolo Napolitano, the associate director, MENA, at Dragonfly Intelligence, a Dow Jones company. We also have with us Mr. Judah Taub, the founder and managing partner at Hetz Ventures and former Israeli intelligence officer. Gentlemen, thank you so much for joining us. Professor Dixon, I'll come to you first. There seems to be an uneasy, a tentative agreement at best between Israel and the United States that there shall be no further strikes on Iranian gas facilities. Will this tentative agreement hold?
I think it will. I think what we're seeing is that what the U.S. and Israel is trying to do is to not destroy assets that prevent, after this war ends, the Iranian economy from being prosperous and supporting some kind of transitional government. And so I think that's why we'll see some restraint. Of course, in war, we can't predict what's going to happen, but in my view, I think we will see some restraint. What has happened is clear signal from both sides to say that we can destroy your energy assets, and no one wants to see that. And I think actually what we'll see more now is continued targeting of military assets rather than infrastructure or energy infrastructure assets.
This was perhaps the first time that we saw cracks in between Donald Trump and Benjamin Netanyahu, where Trump had to publicly say that, look, this was not done with informing us, that we have no role to play as far as the Israeli strikes are concerned. Is this the first signs of perhaps some pushback coming in from the United States, from the Donald Trump, for this entire Operation Fury to be held back, to be drawn back, some amount of de-escalation? Do you see this as a sign?
I actually, it depends on what you mean by de-escalation. I think we need to understand that Donald Trump, the United States, and I would add Israel, is committed to regime change. Let's be clear about that. I don't think Donald Trump is willing to allow his legacy to be one where an Iranian regime that is continually hostile to U.S. interests and Israeli interests to continue. I think Donald Trump is in this for the long run, and I think we need to take that into account. Everyone is saying that, using tacos, saying Donald Trump always chickens out, but I think in this instance, Donald Trump is considering his legacy and he's considering his commitment to the free world. And I think that is what will drive U.S. decision-making going forward. So, of course, there's going to be disagreements between the U.S. and Israel and other allies that we see will be involved in this conflict. But of course, I don't think we'll see necessarily a de-escalation such that this conflict will end in any short order, at least some kind of de-escalation that allows the Iranian regime to continue as is.
Sure. Mr. Napolitano, let me come to you again. Your reading of this situation. Yesterday, there was a great deal of chaos and uncertainty. There was chaos on the markets as well as to what to expect. Now there appears to be an uneasy calm. Again, the same question to you. Do you see this tension holding, or do you see any light at the end of the tunnel?
Thank you very much for the questions. Well, I mean, definitely there has been some sort of signals by both US and Israel, especially with this some sort of agreement or that they've reached yesterday about not targeting any more infrastructure, and this had an effect on the oil prices. So they have fallen by I think around 2%. But I agree with my colleague on the panel. With this is not really probably the sign of the beginning of a de-escalation. This is, in my opinion, more a signal to the intent of US and Israel that they are ready to put further pressure on the regime to come to their conditions.
Sure. Mr. Taub, let me come across to you again. The economic impact is something that is being talked about, the knock-on effect of some of these strikes, now a 21-day conflict as well. Just your assessment going forward, where do things go from here? The reason I ask you is that most recently, Saudi energy officials in an interview with the Wall Street Journal have said that as per their assessment, the base case that they're working with is that should this conflict extend any further towards perhaps late April, $180 per barrel is what the world is looking at.
Yes, I think the most important question goes back to, does this operation end successfully? Ultimately, the long-term implications will be way more important, both for oil prices and for regional stability, than anything short-term. And we've seen that in recent conflicts as well. The general feeling, I think, within Israel, and I think within a lot of the allies, even though they don't always speak up as bluntly, is that when your house is on fire, you don't monitor the water bill. Right now, both the US and Israel are heavily committed to real change, one that, frankly, the Iranian people are the ones that want it most. So I think what we're seeing is a really incredible effort to try and do three things at once. The first is winning the war. The second is to try and do so, as was said earlier, while minimizing the effect on the Iranian people and their ability to step up afterwards and build a prosperous country. And the third is to try and do so as swiftly as possible. And doing those three things together is one hell of a task.
Let me then follow that up with another question, that the situation where we find ourselves in, regime change is what the US and Israel are seeking. But are they succeeding? Tactically, what many analysts tell us is that tactically, there appears to be success in terms of their Iranian air defenses being dismantled, their air force being shot down, their navy being sunk. But strategically, there's not much success being had because of hardline elements within Iran finding support, Mujtaba Khomeini being backed by the IRGC. So strategically, is this playing out the way US and Israel had planned?
Yeah, so I think it's a very fair question. And I think there's two levels to that question. The first, and the one that I think we have to start by asking, is what would have been the cost if there wasn't a strike? And a lot of people in the region are pointing out to the fact that if this would have happened a few years ago, the cost could have been a lot lower. It's unfortunate that we're surrounded by neighbors, the Ayatollahs, that just don't see the world the same way we do. Their incentives are not necessarily aligned, not only with their own people, but definitely not with the rest of the regime's welfare. And so the first and most important question we have to ask ourselves is, what would have happened if we wouldn't have acted? If there would be an extra 500 ballistic missiles every single month that would be piling up on the other side. And so on that front, I think it's been extraordinarily successful. I think the likelihood that we are going to see a powerful Ayatollah regime in the near future is very, very low. The higher bar, which is the one I think you're asking about, is regime change. And I think both Netanyahu and Trump have been very clear that this will be ultimately down to the Iranian people. The 85% of those 90 million Iranians who are waiting, craving for a different type of regime to eventually step up.
Sure. Mr. Dixon, let me come to you and let me get you on the geopolitical aspect of it. There's been significant pushback from the Gulf states who've suffered these strikes. Most importantly, Qatar. The Ras Laffan facility, the largest LNG facility in the world, has implications for countries across Europe and Asia. They have been claiming force majeure conditions. They've been applying pressure on Donald Trump. The question I want to ask is it working?
I think that if you look at the Gulf states, they ultimately support this war. I think what we're seeing is, of course, they don't want their populations, their assets to be attacked. But at the same time, I think at the end of the day, what would they like for West Asia, for the Middle East? They would like one that doesn't have Iran as a threat to them. And what we are seeing, and what we have seen over the last 3 weeks, is that Iran is willing to attack those that aren't directly involved. We already heard just yesterday from the Saudis that they say, if our assets are continually attacked, we will get involved. So I think we're not going to see the Gulf states push back Trump or to slow down the conflict. Of course, they are concerned, but I think they are committed to seeing this. I mean, of course, I don't want to speak for them, but I think they're committed to seeing a different type of Iran, which will be significantly better for the region. We have to consider that Iran's actions exist outside and has done for many years of its borders. They've supported terrorist groups around the world. They've supported proxy armies that have caused conflict for the Gulf states that they do not want to see. And so I think they are committed to seeing this to its fruition. But ultimately, going back to what Mr. Talbot said, is that this ultimately comes down to the Iranian people. And I think what's also really important to emphasize here is so many in the world were almost silent when tens of thousands of Iranians were killed on the street. And that's what I find really frustrating, is that nobody is speaking up for them. The allies in Europe that seem to have been silent in January when we had this major conflict or major kind of escalation internally that led to the killing of tens of thousands of people. And everyone acts as if Iran is an innocent bystander in some kind of conflict. But actually, this goes back 47 years. And I think the Gulf states, just to finish my point, are committed to seeing a different regime in Iran as well.
Mr. Napolitano, again, the same question to you, that again, the Gulf states are the ones that are bearing the brunt of these exchanges for the last 21 days. Their facilities, we've seen civilian infrastructure being targeted, now gas facilities on target as well. Do you see a certain amount of pushback coming in from these Gulf states, pressure being applied on Donald Trump to at least scale back some of these attacks that we have seen?
I mean, there is definitely discussions between these Gulf countries and the U.S. administration. They're still, as you say, bearing the blunt of all these attacks, and definitely they don't want to see their image of safe havens for business to be attacked in this way. I also wanted to add that there is always a threshold to how much these countries can take. And, as you can see, UAE, Saudi Arabia, their rhetoric is becoming a little bit more, I would say, aggressive, especially when it comes to attacking their energy infrastructure. One thing it's definitely certain, in my opinion, is that at the end of this war, the relations between Gulf countries and Iran will be completely different. We have seen some sort of rapprochement, some sort of detente, over the past few years. This will be completely different in the future. Those countries will focus definitely on deterrence, and I'm not entirely sure that having US bases in the future then would be the choice that these countries want to make or want to have. There probably will be a big strategic rethinking for these countries after the war.
Well, interesting insights those, Mr. Napolitano. That has there a red line been crossed in terms of the threshold that these Gulf states have, and whether or not how closely aligned they will be with the US going forward? But on that note, let's take a short break. We'll slip into a short break. We'll come back and we'll continue this conversation on the other side. Welcome back. I'm Ashmit Kumar, and we're maintaining our focus on the West Asia conflict, trying to unpack some of the developments that we've seen over the last 48 hours. And to help us understand that further is with us Professor Adam Dixon, Chair and Director at Adam Smith's Panmure House. We also have with us Paolo Napolitano, Associate Director, MENA at Dragonfly Intelligence, a Dow Jones company. Also with us, Judah Taub, Founder and Managing Partner at Hetz Ventures. Gentlemen, thank you once again for being a part of this. Mr. Dixon, let me come back to you. In terms of pressures being applied on Donald Trump, he has to now face the MAGA voter base. He has to go back stateside. He has to face those questions in terms of why there was a reneging of his initial assurance that there will be no endless wars that the U.S. will enter towards. The midterms elections are around the corner. Just a sense in terms of the pressure being applied from back home. How much momentum is there for Donald Trump to go out and seek an honorable exit from this current conflict that he finds himself in?
I think the question has to be asked is how significant and how powerful is the MAGA movement? And within the MAGA movement, how many are actually as isolationist as one would think, or at least how one would have expected them to be a couple of years ago? I think the way to see it is, do Americans want endless war? Obviously not. But what Americans like, and I speak as an American, I've lived half my life in Europe, but at the same time, I'm still very American. Americans like victory. They want to see victory. And there's something in the American psyche that goes way back to wanting to see protection of the free world. And I think what Donald Trump, this is why I think he'll be committed to seeing some kind of not honorable exit and allowing the Ayatollahs to continue. He'll want to see a victory that is of the like of Ronald Reagan saying, you know, tear down this wall, Mr. Gorbachev, which put Reagan in the minds of Americans as this person who is trying to free the free world or create a more freer world. And I think Donald Trump will be behind that. And I think that will get a significant amount of Republicans, even those in the MAGA movement, and I dare to say some Democrats or those that are in the center that want to see and are still committed to this idea of freedom. And I think that's the calculus that Donald Trump is looking at. Is, of course, there are the concerns about oil prices and gas prices and the general kind of constraints that this will have on the economy. But I think being able to sell to the American people that I took care of this threat that had for 47 years has said death to America, and that's no longer, that's a powerful symbol. And I think that is what Trump and his administration are betting on. So, but of course, we don't know what's going to happen in the midterms, but I think this is the calculus that Trump is depending on.
But just a follow-up question, you think this message of freedom and regime change in Iran, you think the younger Republican voters, the younger MAGA base will be able to reconcile with that and vote in favor of Donald Trump come the November elections?
I actually do. I do think there's something in the American psyche that believes in freedom, that wants to see the liberation of people around the world. Now, don't count me as a neocon. I mean, there was, of course, the concerns that people had with what happened in Afghanistan or Iraq. That is still within the memory, not so much for the younger people. But for Trump, as he said before, we shouldn't be kind of going in these endless wars. What Trump wants to do is win wars. And I think he has said before, I'm not opposed to war, but I'm opposed to losing. He wants to win. And I think he wants to win to create a more prosperous and free world. They are still committed to that. And I think that is a powerful symbol to the American people. And again, this is, but also, and just a final point, I think part of the problem with this conflict is that around the world, Europe in particular, but also in the US, there are people that dislike Trump so much as a person that they're unwilling to sit back and look objectively about what this mission is. And I think that's what complicates analysis of what's going on, but also prevents people from seeing the underlying drivers behind this. And I think the underlying drivers are one where America is and should be committed to freedom, whether that's including in America, but globally. And I still think that is a powerful symbol which will drive voters potentially for the Republicans in November.
Well, that's an interesting perspective. Let's take that across to Mr. Napolitano. Mr. Napolitano, do you agree with Professor Dixon that far from concerned, there's reason for believing that there's maybe momentum behind Donald Trump? as he faces this conflict?
Well, I mean, I can't talk too much about the MAGA movement, of course, but I think I can understand what Donald Trump doesn't want, and I think he doesn't want definitely that this war continues as a kind of like war of attrition, where you have, U.S. Israeli military capability still involved, and Iranian retaliation capacity, dragging on for a long time, and probably also doesn't want that this conflict ends and ends unresolved, essentially. So with Iran, regime surviving and having still capabilities that can attack, Gulf countries and Israel. So probably the victory, let's say, is in between. I think, from what I understand, the U.S. administration is trying to inflict so much cost on Iran to force some sort of surrender. Now, if this will lead to regime change, I'm not entirely sure. I'm concerned that some elements of the IRGC definitely weakened because, of course, U.S. and Israeli strikes have been quite effective in that. But some IRGC elements within the regime will survive, and that will probably what we will have to deal with in the future. I hope that answer your question.
Sure. Mr. Thorpe, coming to you, speaking of the IRGC, Mr. Napolitano was referring to how resilient they've shown themselves over the last 20-odd days. What I want to ask is, what does victory look like? Because IRGC has shown no signs of ceding control, especially over the Strait of Hormuz, which, of course, is the big focus for the world economy.
Yeah, so we know what victory doesn't look like. It doesn't look like the IRGC being able to manufacture hundreds of ballistic missiles. It doesn't look like the IRGC being able to go back to building a nuclear weapon. And it doesn't look like the IRGC being able to funnel billions of dollars to a wide array of terrorist organizations throughout the region. Between accomplishing those and potentially an even better outcome, one primarily, as was said earlier, for the Iranian people, there is a gap that will come back to the Iranian people to make that decision. I think there's one other point that is worth stressing, and that is about peace. In our region, in the Middle East, we know that peace is not always easy to achieve. But one thing that we are learning again and again, it is that when we do reach peace, it typically holds. If we look back the same year when the Ayatollahs took over and started this death cult, that same year was the year that Israel and Egypt signed a peace agreement, one that many analysts back then thought was never going to hold. And if we look now, close to 50 years later, it has gone through some extraordinary tests, but it still holds. Not long after Egypt came Jordan. And now, when I fast forward only to a few years ago, when we saw the Abraham Accords come about, a lot of analysts were saying this is just some pieces of paper, some diplomatic speeches and the rest of it.
Mr. Thorpe, I'm running out of time, so I'm afraid I'll just have to interject in terms of where things are heading. Of course, one would keep your fingers crossed, but we're running out of time. I'll just come to you for one quick question. That is there at least an assessment within Israel that there was, given the IRGC, the way they've reacted with their drones, with control over Strait of Hormuz, that there perhaps may have been a miscalculation in terms of going about Operation Fury? This was supposed to be a short campaign, a few days in, but clearly that's not happened. Has there been a miscalculation? Is there that consensus?
I don't think that's the case. We are seeing, definitely in the state of Israel, which very, very rarely do you have a unanimous feeling about certain sort of political moves. Here we are seeing from wall to wall, everybody believes this is the right thing. And I think Israel understands the nature of the IRGC and the type of people that we are unfortunately up against.
Right, gentlemen, thank you so much for joining us. Again, no easy answers there, but as we see the situation unfold, we'll continue to get for our viewers the latest perspectives from leading experts in the field. I'd like to thank all of our panelists once again, but that, unfortunately, is all the time that we have. Keep watching. More news and updates will continue on the other side. Hello and welcome to this very special broadcast right here on CNBC TV 18. Few companies have an impact as wide and as revolutionary across the sector as Eli Lilly has had on the pharmaceutical sector. The blockbuster drugs and the innovation that we've seen coming in from the company have changed the face of what treatment of some of the conditions such as diabetes and obesity will look like going forward from here. Meanwhile, India continues to be a promising market for the company, but with the promise also comes challenges such as legacy issues, such as the regulation in place, the pricing and the competition from generics. So it's an interesting gamut of issues that we have to unpack over the next half an hour. And joining us now is Mr. Patrick Johnson of Eli Lilly. Mr. Johnson, thank you so much for joining us. Would you prefer Patrick? Is that better for you?
Patrick is perfectly fine, and thank you very much for inviting me to this interview.
Well, Patrick, thank you so much. Pleasure having you on CNBC TV 18. Let me begin by asking you about AI. That's, of course, the big theme, and that has been the big theme across the last 2 years. Ever since you took charge, you've gone big on AI. You've announced a partnership with NVIDIA. You want to work towards drug discovery using AI. Tell us how that partnership has progressed. It's been a few months since you actually took that forward.
Yeah, I think that's super exciting. As you stated, we announced the partnership with NVIDIA in the beginning of this year. And I think that's driven by just a belief that the art of the possible in drug discovery and drug development can entirely change with the support of AI. I think it's too early to define any progress that has been made since the announcement, but I think what's unique here is that we have our scientists co-located with the people from NVIDIA to really look into how can we accelerate drug discovery, how can we define different molecules much faster and the right properties to really have the biggest impact on humanity, both from an efficacy and safety perspective, and how can we accelerate the timeline in drug discovery and drug development, because that's still, despite all of the progress that has been made over the last decade, that's still a very lengthy process. So we are super excited about the partnership, and we are quite optimistic as well in terms of what we will be able to achieve in that space.
Well, the minute you mention Eli Lilly and NVIDIA in the same sentence, that makes for a very interesting dynamic. So tell us, for the benefit of people who are new to this dynamic, when we talk of reduction in timelines for drug discovery, what does that in material terms look like? How much of a compression of timelines are we talking about? Will the years now be compressed into weeks, months? What are we looking at?
Developing new medicines is still a very timely exercise. We have made tremendous progress over the last decade to speed up the time it takes to develop a medicine from phase 1 to phase 3. It used to take 11 years. I think we are now industry leading and we are around 6 years or so. But still, the most timely part left is actually the phase 3 trials and the time it takes to recruit patients to the different sites and the screening time here as well, because you are screening patients and they need to comply with certain inclusion criteria or be excluded based upon certain exclusion criteria. So still there is so much more that can be done here. I don't think we will ever be down to months unless it's something very acute, and we saw that during the pandemic. You saw how rapidly we could develop new medicines for the treatment of COVID, including vaccines. So I think that's probably something that has inspired us in terms of what is the art of the possible to speed up time for discovery and even development of new medicines.
Fair enough. Talking about this AI matrix, let's bring in the India dynamic as well. You've had a center of excellence that you've inaugurated in Hyderabad. You were here in India not very long back as well. Tell us about that and tell us about where India sits as a part of this AI innovation-led journey that Eli Lilly is keen to mount on.
We had one center in Bangalore that opened up long time before the Hyderabad center, and the Bangalore center has been fully and is fully engaged in terms of how we are progressing with our clinical development, a lot of the work that is required for drug discovery and drug development. So Bangalore has and will continue to play a significant role in that space. With the opening in Hyderabad last year, it serves as a manufacturing and quality tech lab for us. So I think that's an area where we're really looking into AI and tech through a different lens.
Tell us about the India footprint that you mentioned on your last visit is something that you're keen to grow. We've also seen recently the announcement of an investment of $1 billion over the next few years. Tell us about what this roadmap looks like when you talk of investing here in terms of widening your footprint?
You know what, I think if we look at the last couple of years, we have been one of the biggest foreign direct investors into India. And when I was here just 4 or 5 months ago, we made the announcement of a $1 billion investment in manufacturing through partnerships with contract manufacturers in India. So that's a huge one. And of course, we are still in the process of taking the next steps in those areas, and that's where we're focusing right now. What is the art of the possible for India? I think India is very well positioned. You have some excellent scientists here. You're really strong in several areas that covers drug discovery, drug development. So I think we have a lot of the conditions here in India, but there are also opportunities to further step up. We are competing in a global world today. So I think there are certain elements that we are strong advocates for that needs to be upgraded in India as well to make sure that we have the right level of predictability. And for innovations, we also need to ensure that we have the right level of protection after we launch new and innovative medicines. So those are some of the items that I strongly advocate for when I meet with Indian policymakers. And I think future investments, I see the opportunities in India. India is well positioned, but I also see opportunities for India to even further lean in on some of the pro-innovation policies that are required to compete successfully at a global level. If we would see those, I think there is a lot speaking in favor of India. And I think the most recent announcement in terms of how India is leaning in to ensure that you have even more sites prepared for clinical trials. That's a very positive sign. But what can we do beyond that? How can we ensure harmonization with global regulatory guidelines for clinical trials? How can we ensure that the regulatory procedure to approve new medicines in India are similar as we see outside of India? How can we ensure that the intellectual property protection for new and innovative medicines meets the global standards? Those are extremely key to attract incremental investments from the innovative-based pharmaceutical industry. And that's where I always try to spend my time with Indian policymakers. Let's make sure you're competitive in those areas, because that will send a strong signal. That will attract and enable an increase in foreign direct investments into India.
I was actually meaning to ask you this question a little later in our conversations, but since you alluded to that in terms of policy frameworks that are required, you talked about IP protection. That has been something where companies overseas have been slightly more careful, watchful of what India does, especially when it comes to IP protection, patent protection. What is the recommendation? You mentioned you've been in conversation with Indian policymakers. More recently, we've seen regimes such as the compulsory licensing regime. As somebody who holds a patent in India, is that a reason for cause for concern? Do you have these conversations with leaders here?
It is compulsory licensing, etc. That's always a concern for innovative companies. And I think regardless of the industry, that would raise a red flag for anyone in terms of investments. Where I think the biggest opportunity is right now for India is to implement what we see in most other markets. That's called the regulatory data protection. And it means in an essence that all of the data that the innovative industry is creating, that's data on efficacy, that's data on safety. Those are investments of hundreds of millions of dollars. I think it's reasonable to request that data is protected for a certain period of time after a new medicine has been introduced. And that's pretty much the standard in most markets in the world. And I think that's something that is currently missing in India. That could be a really nice signal to the external world that we value innovative medicines and we value not just the investment in manufacturing, but we would like to lean in, becoming a bigger part of the R&D efforts as well. So the regulatory data protection, I think that's a key area for the entire research-based industry for India to step up.
Let's talk about something that everyone has been talking about when it comes to Eli Lilly, that's GLP-1. The innovation that has come out of Eli Lilly and then the subsequent monetizing of that has been phenomenal in terms of the demand. Tell us about how these drugs are panning out for you. There's Zepbound, there's Mounjaro, phenomenal demand for them. They make up for what, almost more than 50% of your top line. How critical is this for this journey for you as far as the GLP-1 journey is concerned?
You know, yes, I think it's fair to say that the incretins, they have been a breakthrough in terms of how we are treating type 2 diabetes, how we are treating obesity. And when I look at the data today in terms of what's possible for a person with type 2 diabetes, the data that we have been able to generate with tirzepatide, when you look at the amount of people that get down to a blood sugar level or an HbA1c below 7 or even below 5.7, that was extremely rare in the past. You know, that's the reality for a huge group of patients treated with tirzepatide. I think there is more of an awareness today that obesity is not a matter of a lifestyle choice. Obesity is a chronic disease. And it's a huge burden for the entire world. We estimate that more than 1 billion people in the world are suffering from obesity. Of course, the demand has been significant because those people have been struggling. They have been on diet after diet to try whatever exists out there and maybe succeeding for a couple of months, but just recognizing that the body wants to get back to its original BMI. And here you see an opportunity to actually lose up to, in certain studies, 25-26% of your body weight. So that's game changing. Is it important? Yes, of course, it's extremely important for us today. But we also realize that now is the time to make sure that we are identifying the next era of medicines to meet other unmet medical needs. So we are reinvesting almost 25% of our revenues into research and development. And of course, a lot of those efforts are dedicated to find the next generation of incretins, so the next generation of medicines to even better treat type 2 diabetes, chronic weight management, but also areas such as Alzheimer's disease, areas such as breast cancer, ovarian cancer, immune-mediated diseases. We are not just about incretin. As a company, we cover some of the most devastating areas of diseases for humanity today, being the cancer, being the neuroscience, being the immune-mediated diseases, as well as cardiometabolic health, reflected by our efforts in type 2, type 1, and chronic weight management.
Right. Patrick, I'd ask you to pause that, hold that thought for just a moment. We're slipping into a very short break. We'll continue this conversation on the other side. Welcome back to this special broadcast right here on CNBC TV 18. We're in conversation with Patrick Johnson of Eli Lilly, and he's telling us about what the journey ahead in India may look like. So, Patrick, tell us, India, at least from what public data suggests, more than 100 million people suffer from conditions of diabetes and obesity, and this is on the rise. It's not falling, those numbers are rising. When you look at India, does that hold promise for you in terms of the size of the pie being large here as a potential market which could deliver higher numbers for you?
You know, I think what we see in India, of course, India population-wise is a big market. But I think we are not in India only to launch the incretins. And I made this very clear when we made the announcement in Hyderabad last year. We are here for long term. India is a very important part of our strategy for multiple of reasons. Do we see unmet medical needs in India that we are uniquely positioned to respond to? Yes, we do. And we see those in obesity. The rate of type 2 diabetes, I think you have 100 million people suffering from type 2 as well. And there is huge need in that space as well. I just met with the Alzheimer organizations this morning. Alzheimer is a huge burden in India, and where early diagnosis is very rare, and it's left as a burden pretty much on the family members and the younger generation of Indians to look after those. So I think there are many reasons for us to have a presence in India. Chronic weight management, type 2 diabetes being two of those, but there is at least a handful of other reasons for us to show a strong commitment to India.
Let's talk challenges here in the India market. Especially when it comes to competition from the generics. One of your key competitors, semaglutide, goes off patent as we speak, and the generic companies are gearing up to roll out the generic versions of that product. The apprehension is, in the minds of many analysts, is that as people gravitate towards these new forms of treatment for addressing diabetes and obesity, they're likely to move towards cheaper solutions. They mentioned that the Indian market is very price sensitive, and therefore patients may choose to move towards, are likely to move towards cheaper generic solutions. Is that a concern for you?
No, you know, there is nothing new that we didn't know a couple of years ago. I think we have a good understanding of the time of patent expiries for ours and the competitive portfolio as well. So we are not surprised by any means. Secondly, and I think it comes back to what I said earlier, obesity is a chronic disease. But in quite a few markets, it's mainly out of pocket. Very few patients are being reimbursed. And I think by all means there is consumer pricing sensitivity that plays a role here as well. And I think with generics, you probably open up those opportunities for more patients than we have seen in the past. But for us, if you refer specifically to Eli Lilly and Company and our medicine, tirzepatide, our medicine is different versus the competitive ones. We have what is called a dual agonist. It acts on both GIP and GLP-1, while the competitive products are only acting on GLP-1. And we know that acting on both GLP-1 and GIP makes a difference. It makes a difference from an efficacy perspective, and we have seen that in head-to-head trials. We have seen that in type 2 diabetes. With tirzepatide, you see a significantly higher reduction in HbA1c and a bigger weight loss in type 2 patients. And similarly, in the head-to-head in chronic weight management that was announced back in Q4 2024, you see close to a 50% more relative weight reduction with our medicine tirzepatide versus the competitive product. So I think we have a medicine that is highly differentiated, and there will be no generics to tirzepatide not in 2026 and not in quite a few years to come. So I think we are well positioned with our medicine, despite the fact that there will be competitive generic entries, but they compete with a different product, with different features, and with different patient outcomes.
Sure. But on the question, while we are on the subject of competition, one question on pricing as well. The price point operates as such where it may not be accessible for a large chunk. We discussed the figures, 100 million people suffering from type 2 diabetes and obesity. Not all 100 million will be able to afford such solutions. Just your take on pricing, is there a need for perhaps rationalization? Is that something that's on the cards that may be considered?
You know what, I think overall, I think first and foremost, obesity is not necessarily treated along the same lines as other chronic diseases. In terms of pricing, I think we and many other research-based pharmaceutical companies are taking a very value-based approach to pricing, and we also reflect the GDP per capita in different countries. So the price picture in one market is a reflection of their GDP, and that is the case in India as well. I think there is probably one part where we just need to look at the cost of health in a more holistic way. So I think the cost of obesity today to the Indian state, to Indian employers, that's huge. Because we know that obesity has an impact far beyond quality of life. It has an impact on absenteeism, on presenteeism in the workplace. It has a huge impact on productivity. It is also one of the main reasons for more than 200 comorbidities. So people with obesity is facing a higher risk of cardiovascular disorder, of type 2 diabetes, of cancer, of liver diseases. So I think you need to look at it in a much more holistic way, and hopefully we'll come to that point where the willingness to cover even treatment for obesity goes beyond where we are today. I think that's where the discussion needs to be held. And I think that's how we destigmatize obesity. And that's how we actually demonstrate with real actions that we recognize obesity as a chronic disease and not just do it as a confession by the lips.
But when you go back to the United States, when you have a discussion at the board level, is there a case to be made that perhaps rationalization of prices here in India, having wider adoption, having greater volumes, could also maybe get you the numbers that you're hoping for? Is that a conversation worth having?
I think we always strive to ensure that we provide access to as many patients as possible. So access is a very important part of our agenda. But we also realize that we have one role to play. There are also other stakeholders, and I'm coming back to what I just said in terms of a holistic view on how we're treating different diseases. That is today a huge cost being carried by the Indian state and by Indian employers and by Indian citizens due to the cost of obesity. There are today scientifically confirmed medicines that can actually change that outlook. But I think we need to look at this holistically. We have one role to play, but there are also other stakeholders here that should reflect on the new scientific breakthrough and the data that are consistently being repeated in terms of the value it means treating obesity as a chronic disease.
I just have two more questions for you. This one, I'm trying to zoom out of the conversation and have a slightly more broader view of societal view, a social media view, if you can call it that. The way this drug, it's captured the imagination of a lot of people on social media as well. Very often the critique that comes on social media is that this is a lifestyle drug. How would you respond to that criticism or that commentary that goes viral on social media?
I would say precisely as I said earlier, some people define obesity as being a lifestyle choice. It's not. It's a chronic disease. And to the same extent, the medicines we are debating today are not lifestyle medicines. They are medicines that have been studied in a huge amount of phase 3 trials. We have been investing hundreds of millions of dollars to create the scientific evidence to actually confirm that treating obesity makes sense. So those are the serious chronic diseases. Those are medicines that should be used consistent with a label only. We even issued a white paper at the time of launching tirzepatide for chronic weight management in the US. And we said that this is a medicine to treat a chronic disease named obesity or type 2 diabetes. Those are the approved indications. Sure. These are not medicines for the red carpet. And I think that's extremely important. And that's why we always emphasize you should have a dialogue with your healthcare provider. It's your healthcare provider that will consult you and guide you to make the right decisions. But we stand behind using our medicines for the indications that have been studied and approved by regulatory authorities across the globe.
Well, this has been an engaging conversation. Patrick, we'd like to thank you for taking our time on what is clearly a busy day, a busy week for you. And we hope to stay in touch to learn more about some of these innovations that we are seeing at Eli Lilly. Thank you once again for being a part of this conversation.
Excellent. Thank you very much. It's a pleasure to be here in India and in Delhi. Thank you.
Thank you so much.
Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the Indian rupee plunges to a record low against the dollar, breaching the 93 mark, registers its biggest single-day fall since the 24th of February of 2022. The rupee weakens by over 2% since the start of the war, even as the RBI sold dollars worth $15 billion in the last 20 days. The currency has dropped from 90 to 93 in 107 days. The Sensex and the Nifty end a volatile week on the large street with minor gains. Financial stocks underperformed. 50% of the Nifty stocks closed the week in the red. Iran targets Kuwait's largest refinery and Israel's Haifa facility as attacks on energy assets continue. Saudi officials warn that oil prices could touch $180 by April if disruptions persist. Qatar Energy says 17% of LNG export capacity has been knocked out for 5 years. Hindustan Petroleum hikes the price of premium petrol by 2 rupees a litre, leaves the price of normal petrol unchanged. Indian Oil Corporation hikes the price of industrial fuel by nearly 22 rupees a litre. Israel pounced Tehran with airstrikes as Iranians mark the Persian New Year. Iran's Revolutionary Guard says a spokesperson has been killed in the Israeli strikes. Iran warns the war will continue until the enemy is completely exhausted. President Trump appears to rule out deploying boots on the ground for now. Shares of Tata Power rally after the Gujarat government approves a long-term purchase agreement. With this, Tata Power can restart the coal-fired plant in Mundra, which has remained shut for the past 6 months. Eli Lilly is well prepared for competition from generic overweight loss drugs, says Executive Vice President Patrick Johnson. The patent for a key ingredient called semaglutide expires in India today. That's an exclusive. From changing the name of his company to investing $90 billion, Mark Zuckerberg was all in on the metaverse just 5 years ago. But now Facebook's parent Meta is killing its virtual reality business as it pivots to artificial intelligence. A special report coming up. Well, let's start with the day's market action. Ended in the green, but came off their intraday highs on the back of a weak rupee. The Sensex and the Nifty added 0.5% each, while the mid-caps outperformed today. But if you take a look at the picture for the week, the needle didn't move much. The Nifty 100 points higher at close, 0.5% higher in the Sensex. The Nifty Bank absolutely flat, and the mid-cap index almost 1% higher today. But for the week, the Nifty closing flat, but in the red. Similar story for the Sensex, the mid-cap index just about in positive territory. The bank stocks, of course, were bearing the brunt of a lot of the pain that we saw through the week. And the top story this evening is the rupee. It has plunged to a record low against the dollar, breaching the 93 mark. Now, the currency has dropped from 90 to 93 in just 107 days. The rupee has weakened by over 2% since the start of the war. Ritu joins us with more on the rupee's free fall. There doesn't seem to be any stopping the slide, Ritu, at this point in time. The Reserve Bank is the lone defender.
Thanks for that. The Indian rupee under sharp pressure, breaching that 93 to the dollar mark and setting new record lows near 93.5 almost. And what's driving this fall is not very new, as we have been telling you. At the core, it is a perfect storm of what's happening globally and the domestic factors, which have been in play for some time. The rising oil prices, that's pushing up the dollar demand by importers. Foreign fund outflows continue. That's adding to the pressure. And you have a stronger US dollar globally. All of that is intensifying the rupee fall. In fact, since the start of the Iran conflict, the rupee has now fallen by more than 2.5%. And that strain is unlikely to ease anytime in the near future because of what's happening with the oil prices. Also keep in mind, so far, foreign investors have pulled out more than $8 billion from the India markets just in the month of March. And all of that is playing up. Now, the speed of the fall is what is really striking. We've looked at how many days it really took for every 5 rupees per dollar fall. Now, this 90 to 93 rupee fall is not a one-to-one comparison with that. But even then, it is staggering that it took nearly 5 years for the rupee to move from 65 to 70. More recently on your screen, around 1 year for the move from 85 to 90, and just 107 days for that slide from 90 to 93, and that tells you the depreciation is accelerating sharply. Now, some of the traders we've been speaking to also worry that these lower lows tend to bring in the speculators in the market, and then that fall becomes self-reinforcing. Now, RBI, of course, has been actively intervening. It already sold more than $15 billion just in March to defend the currency, and its forward book, or the net short dollar position, is already close to $100 billion, and that shows you how actively it has been intervening. But keep in mind, it's not just India. Most Asian currencies have weakened since the Iran conflict began. Many, which you can see on your screen now, seeing even sharper falls, even sharper declines than the rupee.
Many thanks, Ritu, for joining us. 93.71, so nudging the 94 mark. That is the rupee for you. But to the news that is moving the markets worldwide. The attacks on energy infrastructure continue across the Gulf as the war in West Asia has now entered day 21. An Israeli oil refinery in the northern city of Haifa has been struck in a missile attack. Israel's energy minister played down the attack and said the power outage caused by the strike was resolved quickly. Drones also struck Kuwait's largest oil refinery for the second day. Kuwait's national company said several units had been shut down and there were no casualties. Qatar's national oil and gas company says Iranian attacks have knocked out 17% of the country's LNG export capacity for the next 5 years. 2 of Qatar's 14 LNG trains and 1 of its 2 gas-to-liquid facilities were damaged in the strikes. The damage is expected to impact revenue by $20 billion annually. Crude oil prices remain elevated despite softening marginally after the U.S. Treasury Secretary Bessent hinted at removing the sanctions on Iranian oil. However, the Strait of Hormuz remains effectively closed, with ships still anchored in the Persian Gulf. The region's biggest oil producer, Saudi Arabia, has warned that the prices could soar past $180 a barrel if the disruptions persist until late April. Meanwhile, the U.S. and its allies have intensified the battle to reopen the Strait of Hormuz. The U.S. Army has deployed low-flying attack jets over the sea lanes to hit Iranian naval vessels and helicopters to shoot down drones. However, officials say it will take weeks to clear out Iran's web of assets. Several European nations and Japan have issued a joint statement saying they would, and I quote, join appropriate efforts to open Hormuz Strait, end of quote. Israel has pledged to spare energy sites a day after Iran said it will show zero restraint if such infrastructure is targeted. Israel's Prime Minister Netanyahu also confirmed that President Trump's assertion that Israel acted alone in its attack on Iran's largest gas field and promised not to attack energy assets anymore.
Fact number 1, Israel acted alone against the Slawia gas compound. Fact number 2, President Trump asked us to hold off on future attacks, and we're holding out. I want to close these opening remarks with one other fake news, and that is that Israel somehow dragged the U.S. into a conflict with Iran. Does anyone really think that someone can tell President Trump what to do? Come on.
Have you talked to Prime Minister Netanyahu about attacking the oil and gas fields?
Yeah, I did. I told him don't do that, and he won't do that. We didn't discuss. You know, we do. We're independent. We get along great. It's coordinated, but on occasion he'll do something, and if I don't like it, and so we're not doing that.
Well, that's President Trump. And back home, Hindustan Petroleum has hiked the price of premium petrol by 2 rupees a litre. The price of normal petrol has been left unchanged. Indian Oil Corporation has also hiked the price of industrial fuel by nearly 22 rupees a litre. The oil ministry says premium variety is about 3 to 4% of the total petrol demand.
नॉर्मल पेट्रोल में कोई प्राइस इंक्रीज नहीं हुआ है, सिर्फ एक प्रीमियम कैटेगरी जो है उसमें कुछ इंक्रीज है, and that is hardly 2, 3 or 4% of the entire petrol which is sold every day. तो वो ऐसा नहीं है कि पेट्रोल में आम जनता के लिए कोई प्राइस इंक्रीज किया गया है. पेट्रोल और डीजल का प्राइस has been deregulated. It has been decided, it is decided by oil marketing companies.
And it's not just petrol and diesel. Rising jet fuel prices are also forcing airlines to hike fares and introduce surcharges. Global jet fuel prices have surged 86% since the start of the month. Madiha is standing by with more. Madiha, take us through the extent of the rise in prices and how airlines are planning to deal with it.
Well, this is turning into a serious concern for the aviation sector. Right now, airlines are staring at a potential jet fuel shock that could significantly disrupt air travel. Let me break it down simply. Fuel is already the single biggest cost for airlines, but now it could become overwhelming. We are looking at a scenario where ATF could make up as much as 80% of an airline's operating cost, up from roughly 40% today. And why is this happening, or why will this happen? Because globally, jet fuel prices have shot up nearly 86%, as you mentioned, in just a month, which is between February and March, from about $94 per barrel in February to $175 now. And in India, the impact hasn't fully hit yet, as oil companies held back major price hikes in the month of March. So ATF prices have only seen a marginal increase so far. But, and this is the key point, sources are saying this could change from the 1st of April if oil companies start passing on global prices, the global price spike. Jet fuel costs in India could nearly double, and that's where the real pressure begins. For airlines, this means costs shooting up sharply, and for passengers, it likely means higher airfares. In fact, airlines are warning that if ticket prices rise too much, demand could take a hit, making some routes, especially the long-haul routes, unviable. There's also a bigger risk at play here. Any disruption in the Strait of Hormuz, which is a key global route for fuel supply, could even lead to jet fuel shortages. And in a worst-case scenario, that could mean flight cancellations, especially on international routes, right when we are heading into a busy travel season. So clearly, this is developing situation, one that could impact both airfares and flight availability in the coming weeks. When CNBC TV18 asked the government during a press briefing today on whether jet fuel prices will surge from the start of April, the Joint Secretary in the Oil Ministry, Sujata Sharma, said jet fuel prices are deregulated and a decision on price lies with the oil marketing companies.
All right, many thanks, Madiha, for joining us. Now, Israel's Prime Minister Netanyahu suggests the need for a ground offensive into Iran, claiming that Tehran has no capability of manufacturing ballistic missiles. Iran countering his claim, saying that they're still building missiles. All of this as the West Asia war completes a week. Here's a look at the top developments. Now, Israel and the U.S. hit central Tehran overnight. Multiple airstrikes damaged residential areas in the city. The attacks came on a day when Iranians were celebrating the Persian New Year. Bridges and civilian infra in southern Lebanon have also come under Israeli air assault. Tel Aviv had earlier said it would target bridges to prevent militant group Hezbollah from transferring fighters and weapons. According to officials, the conflict has killed over 900 people in Lebanon so far. UAE, Qatar and Kuwait have intercepted a barrage of Iranian missiles. Authorities in these nations have ordered that Eid prayers should be held only inside mosques as opposed to traditional large outdoor gatherings. Iran's Revolutionary Guard Corps has faced a setback with the death of its spokesperson, General Ali Mohammad Neni. This marks the fourth death of a high-ranking Iranian official in the last 3 days. Neni had earlier mocked Trump's assertion that Iranian Navy had been destroyed. He had dared Washington to deploy ships into the Persian Gulf. The Iran Revolutionary Guards claimed that it struck an American F-35 stealth fighter jet over central Iran. Pentagon has said the aircraft landed safely and the pilot is in stable condition. The Iranian foreign minister has reportedly told the UK government that if America uses British military bases, it would be seen as a participation in aggression. Israel's Prime Minister Netanyahu has reiterated Israel's stance of sending ground troops into Iran. Trump has said that the US was not putting troops anywhere as of yet.
No, I'm not putting troops anywhere. If I were, I certainly wouldn't tell you. But I'm not putting troops. Iran is a serious threat to the world, to the Middle East and to the world. And everybody agrees with me. I think virtually every country agrees with me on that. So I wanted to put out that fire.
And what came as an awkward moment for Japanese Prime Minister at the White House, President Trump compared the surprise attack on Iran to Pearl Harbor. Speaking in the Oval Office, President Trump made the remark while responding to a Japanese reporter's question asking why the U.S. did not inform its allies about carrying out the attacks against Iran.
Why didn't you tell U.S. allies in Europe and Asia, like Japan, about the war before attacking Iran? So we are very confused about we Japanese citizens.
Well, one thing, you don't want to signal too much. You know, when we go in, we went in very hard, and we didn't tell anybody about it because we wanted surprise. Who knows better about surprise than Japan? Okay? Why didn't you tell me about Pearl Harbor? Okay? right? He's asking me, do you believe in surprise? I think much more so than us. And we had to surprise him, and we did.
Well, that's President Trump. Time for us to head into a break, but up next, Zuckerberg was all in on the metaverse just 5 years ago, but now Facebook's parent Meta is killing its virtual reality business. That and more when we return. Shares of Tata Power rallying after the Gujarat government approved the long-term purchase agreement. With this, Tata Power will be able to restart the coal-fired plant in Mundra, which has remained shut for the past 6 months. So good news there, the stock closing 1% higher. Torrent Gas, the city gas distribution arm of the Torrent Group, has drafted papers with SEBI for a potential IPO via the confidential route as per a money control report. The issue will be a pure offer for sale with no fresh equity component. If the listing goes through, Torrent Gas would become the third listed entity from the group after Torrent Pharma and Torrent Power. Flipkart's Group Chief Financial Officer Sriram Venkatraman will step down ahead the company's planned IPO. The e-commerce company has said that Venkatraman will stay on for a short period to ensure continuity and a smooth transition. Flipkart CFO Ravi Iyer will oversee the company's broader finance operations until a successor is appointed. Well, on to a CNBC TV 18 exclusive. Eli Lilly, the pharma giant behind Mounjaro, has told CNBC TV 18 they're not surprised and are well prepared for generic drug makers entering the weight loss medicine market. Speaking with Ashmit, the company's management has highlighted a value-based pricing approach which reflects the GDP per capita across nations. Take a look.
No, there is nothing new that we didn't know a couple of years ago. I think we have a good understanding of the time of patent expiries for ours and the competitive portfolio as well. So we are not surprised by any means. In terms of pricing, I think we and many other research-based pharmaceutical companies are taking a very value-based approach to pricing, and we also reflect the GDP per capita in different countries. So the price picture in one market is a reflection of their GDP, and that is the case in India as well.
And remember, the patent expires on Saturday, 24 hours to go. Chinese e-commerce giant Alibaba's workforce has reduced by around 34% over the course of 2025. The company said it offloaded some of its offline retail businesses while doubling down on artificial intelligence. This disclosure came in the company's earnings report, where the firm's profit plunged 67% and its revenue missed expectations for the last 3 months of the year. Amazon's founder Jeff Bezos is reportedly in talks to raise $100 billion for an AI-driven manufacturing fund. According to Wall Street Journal, this new fund will acquire manufacturing companies and use AI tech to speed up automation. The fund will also target sectors including semiconductors, defense, and aerospace. ChatGPT maker OpenAI has reportedly plans to launch a super app for the desktop. The company will combine its web browser, the ChatGPT app, and Codex coding app into a singular desktop super app. So that's on the anvil. And there's more tech. Meta's metaverse dream is now being scaled back after nearly $90 billion in losses and weak user adoption. Rachna joins us now with the details. Rachna, this was a massive bet and it's now being buried very silently.
That's right. Mark Zuckerberg once stood in front of the world and said the metaverse would be the next internet. 5 years, close to $90 billion and a few million empty virtual rooms later, Meta has quietly pulled the plug. The company announced this week that Horizon Worlds, its flagship virtual reality social platform, will shut down on June 15. It will disappear from the Quest headset entirely and survive only as a stripped-down mobile app. But the story begins in October 2021. Facebook, under intense regulatory pressure, rebranded itself as Meta. Zuckerberg's pitch was sweeping. The metaverse would be the next frontier of human connection. 1 billion users, hundreds of billions in commerce, and an entire digital economy built in virtual space. Horizon Worlds was the product meant to deliver that future. Users would strap on the Quest headset, enter as customized avatars. So think internet, but the fact that you're inside it, that was the idea. But the numbers tell a very different story. The division behind the vision, Reality Labs, has lost money every single year since 2020. In 2024 alone, the losses were close to $17.7 billion. And in 2025, that climbed over to $19 billion. The total bill now stands between $80 to $90 billion. To put that in context, that is larger than the GDP of several small economies, and it was spent chasing a product that never found users. Horizon Worlds never broke through internal targets, so the targets were cut and still missed. At its peak, it had fewer than 200,000 monthly users. Globally, compare that to Roblox, which has over 80 million daily users, or even any mid-sized mobile company beats those targets. So the problems were structural. Access required an expensive VR headset. The product launched with glitches, including avatars without legs, which quickly became a symbol of its limitations. The world felt empty, and as global VR headset shipments declined for 3 consecutive years, the hardware bet only made these things worse. A mobile version was launched in 2023 to expand access, but it did not change the trajectory. But then came the inflection point. In late 2022, ChatGPT arrived and the industry shifted overnight. AI became the center of gravity for any tech investment. And Meta moved with it. By 2024, the word metaverse had completely disappeared from its earnings calls. Layoffs followed. Over 1,000 employees linked to Horizon Worlds have already been cut. And now the final step, the VR version of Horizon Worlds is being shut down. What remains is a much smaller mobile-only product, which is a shadow of the original version. And the contrast with what is working is pretty stark, because Meta's Ray-Ban smart glasses, which are built around real-world AI, have sold millions already. Its AI assistant is seeing massive usage across apps, traction that Metaverse never even came close to. So the Metaverse was supposed to be the future of the internet. Instead, it has become one of the most expensive experiments in tech history.
All right, Rachna, RIP Metaverse. Thanks very much for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We've got plenty more coming up for you right after this short break.
Hello and welcome to Startup Street. I'm Ritu Singh and with me is Arundhati Ramanan. Here are the key headlines from the startup world.
Officer Sriram Venkateshwaram will step down ahead of the company's planned IPO. The e-commerce firm has said that Venkataraman will stay on for a short period to ensure continuity and a smooth transition. Flipkart CFO Ravi Iyer will oversee the company's broader finance operations until a successor is appointed.
Rimo Technologies, a robotic neuro-rehabilitation startup, has backed 10 crore rupees in a seed funding round that was led by IAN Angel Fund. The fresh capital is going to be used to accelerate product innovation, expand manufacturing capabilities, and scaling into international markets, including ASEAN and the Middle East.
Zomato has raised its platform fee to 14.90 rupees per order, up from 12.50 rupees, reflecting a 19.2% hike as the company continues to strengthen its monetization strategy. The move marks the latest step in a steady build-up of platform fees since their introduction in April 2023 at 2 rupees per order.
In a massive crackdown against illegal gambling and betting websites, the government has blocked 300 such websites and applications, PTI has reported. The action was also taken on Matka gambling networks and real money card and casino gaming apps.
From changing the name of his company to investing $90 billion, Mark Zuckerberg was all in on the metaverse just 5 years ago. But now Facebook's parent Meta is killing its virtual reality business as it pivots to AI. A special report coming up.
Well, AI-led enterprise transformation company Cartech has raised $11 million in its Series B primary funding round that was led by Playbook Partners. Now, this fresh capital infusion is going to be directed towards strategic acquisitions, strengthening the company's AI-led enterprise operating system platform, enhance global delivery scale, and strengthen their go-to-market efforts. For more on the funding and the way ahead, joining me now is Maran Nagarajan, the CEO of Cartech, who is here with us. And, we'll try and see if we can also connect with their investors. But Maran, first to you, 1,000+ crores of revenue, 45% kind of a compounded growth. What's driving that? And what is the next leg of growth in this, now that you've raised this money? And how different is the company going to look over the next 2 to 3 years?
Hey, thank you so much for inviting us. And it's a pleasure to be connecting. And the growth has been largely led by the tailwinds that we had in the digital transformation happening in the space of the SAP. And thanks to the expansion we had from North America and also the European markets. So that is the reason for the 45% growth over the last 6 years. And coming back to the fund that we have raised, we intend to build our platform, the enterprise operating system. So the history has always been about the ERP transformation journeys that Cartech led. And now we are also in the forefront of the AI transformation happening in the organizations, where the new genre getting created called as enterprise operating system, which we will be building a platform as well. And this capital raise would go towards that. And we are extremely optimistic about the future growth as well. And we believe and we intend to grow in the 30% growth zone, but we will be putting more energy towards our profitability going forward. Over to you.
All right. We also have Vikas Chaudhary, founding partner at Playbook Partners, who is joining us now. Vikas, you've signed the checkbook for CAR. What stood out in their model that made you do it? If you could begin by telling us about that and the kind of conviction bet you've made in this particular investment.
Yeah, thanks for having us on today. What we saw was a structural shift in the technology landscape globally, which is quite obvious to everybody here, that there is a huge migration led by the AI wave of enterprise customers migrating their entire data, applications, and infrastructure to the cloud so that it can become AI ready for the future. And that is what Cartech exactly does, where it takes a company on the enterprise side, $1 billion plus organizations globally, to migrate their entire stack to the cloud. And that digital transformation, over the next 5 years, has over $1 trillion opportunity in the world that we see Cartech being a major player in.
Maran, you also said some of the capital that you raised is going to go into acquisitions, data engineering space and analytics. Do you already have something on the table? What kind of targets are you looking to acquire? And overall, how critical will this M&A inorganic route be for your strategy to stay competitive in this, AI space?
Oh, yeah. We are looking at an acquisition in the space of the data. And yes, we have a couple of shortlists, but it's a little bit too early to talk about that. And most likely it would be in the North American geography and on the horizontals of data space. And it is very critical for us and the growth forward and the growing forward. And this would accelerate our growth as well. And this will also add a lot of capability to our delivery to our existing enterprise customers as well. So it is very critical to our future journey.
But Maran, while you're not disclosing names, how quickly will we hear from you, and what is the size of these acquisitions you're eyeing?
In terms of the revenue points, we are expecting to add maybe 25 to 30 million in terms of our revenue point. But as I said, anywhere from within now till the next 6 months, we are looking to consummate a transaction.
Okay, so within the next 6 months, because from an investor lens again, how do you evaluate this M&A risk that's going to come up in the next 6 months, Maran says, in services-led companies that are transitioning into AI platforms? And what gives you the comfort that integration is going to create value and not really add to the complexity?
We've been down this journey on both sides of the table for many decades now. In my previous roles running tech organizations globally and in India. And we have benefited from several M&As that we have acquired companies in the past. Even in my current portfolio as an investor, we've invested in Capillary Technologies earlier that went public as well. And they've had over 4 M&A acquisitions that have almost doubled the revenue of the company over the last couple of years. So yes, of course, there's always risk in M&A acquisitions, but where there's no pain, there's no gain. So there's always, in the technology landscape, you have to be dynamic. You have to acquire skills and platforms that are early in the evolution of the landscape and be able to use those to cross-sell to existing customers and therefore land new customers. And I think the whole wave of now Indian companies, having global presence, global acquisitions that bring in large enterprise Fortune 500 kind of customers is going to be a huge opportunity for India tech going forward.
Okay, no pain, no gain. So maybe a little bit of pain when you start the integration process. But Maran, just to come back to you, on these IPO ambitions that you have, firstly, which market are you looking to list in? And also, how long would that whole process be? What milestones will you have to hit before going public? And what is the timeline we should keep in mind?
Thank you. We are looking to list in Indian markets only because we are headquartered in India and it's the easiest for us. And listing again in NASDAQ is going to be very important. And also, it is not so friendly for the companies headquartered in India, number one. And second thing, we are looking at to do the listing, file the DRHP anywhere by June 2027. That's our expectation. And we intend to cross the milestone of, let's say, 100 crore plus EBITDA by this year. That is FY27. We intend to hit 100 crore plus EBITDA. So that should position us for a very good IPO in the next year, next financial year. Oh, sorry, FY28 financial year.
Okay, because finally, to close this, what we've been seeing is a surge in these AI transformation narratives. As an investor, when you look at these investments, how do you separate the real capability from, buzzwords?
Well, it's three-pronged. There is a platform that you actually look at, which has been in use for several years now. And AI is really a horizontal layer. It's effectively empowering, automating, and making platforms more efficient, which Kartek here has been doing for a while. So we've been able to look and validate that. The second is, they are actually in production with customers who are paying millions of dollars of contracts using this for large enterprise installations and transformations. To pass the test with these large organizations is the real metal. And then finally, looking at profitability, which means that the pricing is market centric, it's competitive, and it is still profitable as per their tech peers in the market. So it's a very real business. I think AI is just an enabler that's going to accelerate the pace of growth. And because the end customers are going to need to accelerate their transformation, Kartik is going to benefit from a huge tailwind over the next 5 years.
All right, we'll leave it at that. Maran and Vikas, both of you, thanks very much for joining us here on Startup Street. It was a pleasure speaking with you.
Thanks so much.
As India faces rising temperatures and increasing pressure on power infrastructure, cooling is fast becoming a critical need, not just a luxury. Yet, air conditioner penetration in the country remains under 10%, highlighting a massive gap in access. Stepping into the space is Optimist, a new age startup looking to build future-ready, energy-efficient cooling solutions designed specifically for Indian conditions. The company has just raised $12 million in funding led by Accel and Arkham Ventures. Founded by Ashish Goel and Pranav Chopra, Optimist is betting on deep tech, in-house manufacturing and a built-for-India approach to disrupt a legacy category. So can innovation truly make cooling more accessible and affordable at scale? Joining me now to discuss this further is Ashish Goel, the co-founder and CEO of Optimist. Ashish, thank you so much for joining us on the show today. You know, this isn't your first rodeo, right? You've built and scaled already a large consumer brand before this. What made you sort of turn to build in a space like air conditioning, and what gap did you see in India's cooling market?
All right. Thanks a lot, Arundhati. And you are right. It's been incredibly nervous times for me getting into building this. I'm not a mechanical engineer, so it's been very, very hard. But we are committed to the problem is that with an increasingly warming world, right? The world is getting hotter. All of us know it, right? It's no secret. And in a country like India, where large population, low income levels. There's got to be an answer which is different from the way the market operates today, and it's a hard engineering problem. And we have been at it for the last 2 years, and I think we are starting to see some very good results. We are very convinced that over the next 5 years, our goal is very straightforward. This sub 10% penetration of air conditioners, we want to push that number up to at least 30%. And that's the yardstick you should assess us by 5 years from now. If because the work we are doing, another at least 100 million households in the country sleep better at night. They are comfortable even in the worst of summers. I think our job would be done, and hopefully we can take a good chunk of that incremental market build.
Sure. And what sort of makes your air conditioners truly different, right? Especially when it comes to operating in India's extreme heat and power constraint. How sort of big is this opportunity, and what will it take to make cooling accessible to the next 100 million households?
Yeah, so here's the thing. Everybody wants good cooling, right? That's an easy one, right? What's really the problem then? The problem is affordability. And affordability, the largest part of the affordability problem is the energy cost. Right, energy costs are just going up all the time, and topically also today, energy cost is just shooting up. And in a country like India, which is energy deficient, energy cost is really the big problem. So our push is to build absolutely the most energy efficient air conditioners, but also ones which are heat resilient, that they will cool you down in the worst of summers. Right. The problem that's been there is that when the peak summer happens, 30-35% air conditioners conk off. Right, and that obviously doesn't make any sense. I mean, how do you work with a product which conks off when you need it most? So that's our focus, right? Irrespective of how hot it gets, our products will perform and sort of cool you down, and they will deliver you the lowest electricity bills that you can imagine in the market by a good wide margin.
And with the current scenario that's happening in the world with the war and a potential shortage in fuel supply, how do you see that sort of impacting demand in this segment?
Yeah, I think all of us only hope that this is temporary and this problem goes away. But of course, that's just makes life very, very hard for everybody in the world. Definitely for people in India. So, frankly, I'm no sort of oracle. I don't know what will happen, but I really hope that this goes away soon.
All right. And you've raised this $12 million led by Accel and Arkham Ventures, right? Where will this capital be deployed, and what are the key milestones you're looking at in the next 12 to 18 months to achieve with the funds that you've raised?
Yeah, so the lion's share of the capital will be deployed towards core classic product R&D and engineering effort. right? That's about, let's say, 30, 35, 40% of the total capital raise will be deployed towards real R&D, which is rare. I mean, when you're building a consumer brand, one would assume that you'll end up deploying a large part in brand building. But our belief is that, the deeper the product moats are, the product should sell itself. And then, of course, about a third towards manufacturing and working capital, and a third towards brand building and consumer work.
Sure, and you're going with a mix of D2C and exclusive brand stores, right? How do you plan to build distribution and trust, especially in a category that's still dominated by legacy players? So what is the plan going forward? What's the strategy here for you?
Yeah, so our belief is to do our work in a geographically concentrated manner, and really solve the customer's problem in a significant manner. The thing is, if you are solving the customer's problem, if there is an acute problem and you solve it in a very small way, then you're up against everybody in the competition is big companies, and they obviously will win, right? It's just hard. But if there is an acute customer pain and we are solving it meaningfully while keeping our concentration on a few channels, few geographies very tight, so that all our dollars are deployed against a narrower sliver. That's our approach.
All right, and you've invested heavily in in-house R&D through your Nalanda lab, right? How critical is deep tech innovation in what is traditionally seen as a consumer durables category?
Yeah. So the thing is, if you don't innovate on the product and you don't really solve hard problems, then frankly, it's just going to be more of the same. I mean, if you think about it, in the last 7-8 years, the category penetration of air conditioners has gone up maybe about 1.5%, right? With a low base. That doesn't make any sense. I mean, everybody wants air conditioners. It's getting hotter. Why isn't the trajectory shifting? I mean, contrast that with washing machines. Washing machines is about 35-40% penetration category, right? Whereas you can actually hire somebody to wash your clothes, or you can do it yourself also. Without an air conditioner, you will swelter in the heat, right? Or two-wheelers, which is a 45-50% penetration category. So clearly there is something, the big shift that is required on the product, and deep tech is the way to go. Without product,
deep tech,
we'll be sitting in the same place 10 years from now also.
All right, so you need deep tech to sort of take it to the next level. And if you've, what's the kind of demand picture that you're seeing, and where do you hope to see penetration first? What's your target audience here?
We launched the Inner Circle early testing program yesterday evening. And I've been sort of, just blown away. Frankly, I'm falling way behind my own ability to field the requests that we are getting on that Inner Circle program, right? And I think that just gives you a sense of how much people are looking for real innovation in a category like this. It would seem like, this is a category with giants, and there are giants, and there are very high quality companies and competitors. They are very good, but clearly there is a space for something disruptive.
All right, there is space for something new. All right, Ashish, thank you so much for joining us on the show, and we wish you all the best on this going forward.
Thanks a lot, Arundhati. Thank you very much.
Okay, let's take a short break on that note. But Ally Blenders and Distillers pivots from mass market to ultra luxury with its new venture, ABD Maestro. When we return, we'll get you a glimpse with the co-founder, Ranveer Singh, on how they're eyeing rare collectible spirits that are priced in lakhs of rupees. Stay tuned.
Welcome back. You're still with us on Startup Street. Known for its mass market brands, Allied Blenders and Distillers is now looking upmarket. Its new venture, ABD Maestro, co-founded with actor Ranveer Singh, marks a clear pivot into premium and ultra-luxury spirits, including rare collectible bottles priced in the lakhs. CNBC TV 18 Shilpa Rani Peta speaks to the company's MD, Bikram Basu, on the company's playbook. Take a look.
India's alcobev industry has been riding the premiumization wave for years now. But at the very top, a new niche is now taking shape. One that's less about consumption and more about rarity, collectability, and long-term value. Betting on this new yet fast-growing segment, alcobev maker ABD carved out a new subsidiary, ABD Maestro. Co-founded with actor Ranveer Singh, ABD Maestro is positioning itself as a premium to luxury startup, a segment sharply different from ABD's mass market play. The latest from the company's stable is a foray into the ultra-luxury space with The Collective, a 1991 Macallan rare cask aged 34 years in Scotland.
The idea of The Collective is to really put out something which is super luxury in the Indian market, something. It's a first time sort of a thing that someone's gotten an ultra luxury, rare private cask product into India. And, people are curious about it. There's Uber HNIs who love to collect stuff like that. And it's also some people actually experience it. And it's one to get in 60 bottles or decanters into the country. All of them are individual numbered. And all of them are individually signed by Ranveer, who's a co-founder.
Is there an evolving market in India currently for, private casks, or whether it's these collectibles? Are you seeing an evolving market here? And just help us understand how that trend's been.
So there is an evolving market. Obviously, a certain set of India has come to wealth or had old wealth. It's just that, there are multiple asset forms which come through. And we all know the asset forms, which would include obviously the financial assets, but also in terms of the space of art or other collectibles. I think people have found an option for collectors to invest in casks. So there would be two types of people. One is collectors and investors. The other would be the people who are real connoisseurs, or a mix of both. A collector can be a connoisseur to just come to a sort of casks which are customized, which are top of line, which are not everyday, and which only can give you that many bottles. I mean, we are not talking about, we're talking about 50, 60, 100, a max of 600 bottles.
How's the response been for Yellow and Rangila, which were your, latest two products? And if any numbers that you can share, and what is the kind of volumes or the cases that it has sold so far?
So the early response has been really good. It's been noticed in the market. People are picking it off shelves because, it's gone viral and it's got that curiosity value in both the packaging. I would think Yellow, because it works in the larger space, has in the past 50 days sold around 100,000 bottles.
Okay.
And Rangila would have sold around 60,000 bottles.
Okay.
In the markets we've launched.
How do you look at ABD Maestro now in terms of valuation? Where's the company valued at? And, do you see that eventually becoming a big enough segment, to become a significant reportable segment for ABD as well going down the line?
Really, in terms of valuation, we are early days.
Okay.
We'll come to that, but it's been set aside as a subsidiary, obviously, to build value in a different space. Too early to call it out. I think at an ARR level, we'll be close to 100 crores sort of a thing.
Okay.
Right now.
For now, Maestro remains a small but fast-scaling bet within ABD's broader business. And with strong early response to launches like Rangila and Yellow, the company plans to expand its roadmap to tap into emerging categories like tequila and explore indigenous spirits as well. The idea? To build a meaningful play as India's alcobev market gets more segmented at the top end. In Mumbai, Shilpa Rani Peta.
All right, we're going to take a cue from, what Shilpa was just telling us about, because it is Friday and we'll also have to now take stock of all the big deals from the startup world. This week, We've seen a total of 24 deals worth $355 million, according to venture intelligence data. Some of the big deals include, Weaver Services, which got $156 million from Gajra Capital, Lightspeed Ventures, and Premji Invest. You had green lender Ecofi, which also raised $42 million from BII, Eversource Capital, and FMO. While Visa processing enabler Atlas, they backed $36 million in a Series C round that was led by Elevation Capital, Peak 15 Partners, Susquehanna Asia VC as well.
That's not all. Food delivery company Swish got $30 million in a Series B round. The round saw participation from Accel India, Bain Capital Ventures, and others. E-commerce accelerator Assiduous Global added $25 million to its coffers from Pulsar Capital, startup X, Speed Ventures, Uncorrelated Ventures, and others. According to Venture Intelligence, this year has seen a total of 235 deals worth $2 billion. And with that, it is a wrap on this edition of Startup Street. From Ritu and me, goodbye and many thanks for watching. More news and updates on the other side.
He likes offshore big, goes to Kazakhstan. He's a big, big thinker.
You know what's interesting is, Jim, sadly, after the Qatar news yesterday, the day before, some desk notes today saying it's likely the U.S. gets every major LNG contract for the foreseeable future, which is a multi-year boon for Cheniere, a multi-year boon for Venture Global.
Venture Global had been, I think Venture Global is worth talking about. That had been one of the biggest bust IPOs. They just kept, they were just the gang that couldn't shoot straight. Now they're the gang that actually you want to get long. I mean, they have a couple plants coming online. By the way, Sempra, if you want to do the easy one, SRE is the way, because that's the one that has, they have like an asset-light mode, but I mean, it is a great utility, 2.76% yield, one of the best performers in the S&P, and is still great, and is true for natural gas. Jeff Martin understands the natural gas business better than anybody. So Sempra's good, Venture Global's really good, and Cheniere's really good.
Yeah.
And the rest of them,
I'm just looking at charts of Cheniere, LNG, versus the S&P over 5 years, Jim, over 10 years, over 2 years.
Came to me when Suki was the head of it. He came in, he said, you know what, we have this plan. we're going to import natural gas, but at the last minute we decided, you know what? Why don't we export natural gas? I said, well, are you just going to reverse it? He said, yeah. I said, were you wrong? And he said, yeah. He said, we have more natural gas than any other country, and we're going to start selling it. Now, almost the day when his train, they call them trains, was open, we were going to go down and see him and kind of launch it, bottle champagne, and he got fired, which that was not for us as important as not being able to be invited to go down. Yeah. But he pioneered it, and if you look at Cheniere, that is a chart of a company that is going to produce.
Good evening, ladies and gentlemen, and welcome to the India Business Leader Awards. It's great to see all of you here, and it's wonderful to have a packed house on a Saturday evening in Mumbai. Ladies and gentlemen, 21 years ago when we started the India Business Leader Awards, and yes, I have been here for all 21 editions of these awards, a post-liberalization India. Thank you. I feel a bit old now, but with that out of the way. As I said, a post-liberalization India was starting to explore new possibilities, bite into new opportunities, adopt technology, and really open itself up to the world. And while the size and scale of the ambition and the scale of the enterprise has changed, what has remained constant for those that we have honored year after year for the last 21 years is the desire to create institutions with enduring values. Roosevelt said the credit belongs to the man who's actually in the arena, whose face is marred by dust and sweat and blood, who strives valiantly, who errs, who comes short again and again, who knows the great enthusiasms, the great devotions, who spends himself in a worthy cause, who at best knows in the end the triumph of high achievement, and who at the worst, if he fails, at least fails while daring greatly. And that spirit of courage and commitment is what the India Business Leader Awards have celebrated for 21 years. And tonight, we add another chapter to this story. Welcome once again to the Standard Chartered Presents India Business Leader Awards. Thank you all for being here, and many, many congratulations to our winners. May you continue to excel, and may you continue to find success in all that you do. Ladies and gentlemen, have a wonderful evening. Thank you very much again.
We begin the awards with a category that reminds us what human potential truly looks like. The Special and Para Sports Leader of the Year recognizes excellence achieved through discipline and sustained performance at the highest level.
And the winner in this category for 2025 is Simran Sharma, Paralympic athlete. May I request Simran to please join us on stage for her outstanding international achievements and her inspiring contribution to Indian sport.
Relentless resilience and remarkable performances on the international stage, he has not only brought pride to India, but also redefined what perseverance truly looks like in sport. Moving on, entertainment has the power to move us, to make us think, to stay with us long after the credits roll. The Entertainment Leader of the Year recognizes someone who has created work that transcends the screen.
This year, the Entertainment Leader of the Year award goes to Rishabh Shetty, actor and director. Let's welcome him onto the stage with a huge round of applause.
With a story rooted in tradition and folklore, he created Kantara, a cinematic phenomenon that resonated far beyond its origins. While it shattered box office records, its true achievement lay in how deeply it connected with audiences across languages, regions, and generations, reminding us of the enduring power of authentic storytelling.
एक dialogue हो जाए. One before you go.
Dialogue तो कन्नड़ में होगा. Okay. ನಮ್ಮನ್ನು ನೋಡ್ಲಿಕ್ಕೆ ನೀವು ಬಂದಿದ್ದೀರಿ, ನಿಮ್ಮನ್ನು ನೋಡ್ಲಿಕ್ಕೆ ನಾವು ಬರಬಾರ್ದಾ? Thank you.
Shetty, thank you so much. Ladies and gentlemen, a big round of applause for our Entertainment Leader of the Year.
Moving on, our next award is about promise and potential. While India's energy transition is one of the most consequential stories of our decade, this award recognizes a company that is writing a significant chapter in it. The Most Promising Company of the Year award goes to Torrent Power.
And we invite Jigish Mehta, whole-time director of Torrent Power, to please come and join us on stage. Congratulations to you, Mr. Mehta.
Now, the Torrent Group has built a strong presence across the power value chain, from generation and transmission to distribution, while accelerating its push into renewable energy and supporting India's journey towards a cleaner, more resilient energy future.
Ladies and gentlemen, the Most Promising Company of the Year, many, many thanks for joining us here this evening.
We'll move on, ladies and gentlemen. The Breakout Brand of the Year is one of our most exciting categories. It celebrates a brand that has captured the market's imagination, disrupted established norms, and achieved phenomenal growth in a very short span of time.
And this year, the Breakout Brand of the Year award goes to Rare Rabbit. Please welcome the founder and CEO Manish Poddar to receive this honor. In just 10 years, Rare Rabbit has built an entire fashion ecosystem under the House of Rare, men's, women's, kids and footwear, with over 1,200 points of sale and 200 premium standalone stores across the country. A homegrown label that has achieved what very few Indian fashion brands have managed at this scale.
When I manifested 10 years ago to start a brand of fashion in India, I did not even emphasize that I will stand someday here. I would like to take this opportunity to tell Sir that manifestation has been so kind to me that my father on his dying bed spoke about you. And he said, "Kaam karo, bado ek din aayega ki Birla ji se award loge." And I cannot tell you what are the odds that I am standing in front of his family with him by my side and my father above and my wife, the CEO of my life, who is watching me. And you cannot even imagine why and how. It is unbelievable.
Well, up next, the Lifetime Achievement Award is perhaps our most significant recognition of the night. It honors a career of excellence, a lifetime of impact, and a legacy that is going to inspire generations to come. The Lifetime Achievement Award 2025 goes to Dr. Anand Deshpande, the founder, chairman, and managing director of Persistent Systems. Sir, thank you for joining us here on stage. A huge round of applause for him, ladies and gentlemen.
Well, here's the man who saw the future of technology when most of India was just waking up to it. He built Persistent Systems into a global technology powerhouse, enabling digital transformation for businesses worldwide. His vision, leadership, and commitment to innovation have made him one of India's most respected technology entrepreneurs. Once again, ladies and gentlemen, a huge round of applause.
Mr. Deshpande, congratulations once again, and thank you so much for joining us here. Let me take this moment, since this is a conversation about leadership, it's a conversation about excellence, it's a conversation about design in action, in motion. We've got with us the Global CEO of Ferrari, who's here with us at the CNBC TV 18 India Business Leader Award. So let me come across to you, sir. What is your leadership mantra?
What is a leadership mantra? It's very simple. Learn from everyone, everywhere, because so far I never met a person so ignorant I couldn't learn anything. In these 3 years, there is one thing that I learned a lot, that is a good representation of the purpose of our company. And you say, "Hoga kaise nahi." I think this is...
That does deserve a big round of applause. Hoga kaise nahi.
It's very nice, because we say in English, we say we audaciously redefine the limit of possible. But Hoga kaise nahi, I discovered yesterday, I think is much shorter, is better, more effective. So this is what I learned in this trip here.
Hoga kaise nahi. Thank you very, very much, ladies and gentlemen, the Global CEO of Ferrari.
Ladies and gentlemen, we come to one of the most prestigious recognitions for the evening. The Hall of Fame is reserved for those rare individuals whose contributions have fundamentally shaped the industries and touched millions and millions of lives.
The IBLA Hall of Fame posthumously honors Piyush Pandey.
Bhaiya, I love you.
Well, Prestige has become more than a brand. It became a promise that Indian manufacturing can compete with the very best in the world. The IBLA Hall of Fame posthumously honors Mr. T.T. Jagannathan tonight.
Moving on, we now take a moment to remember and honor a remarkable leader who left us too soon. Anupam Nupuri was Senior Partner Emeritus at McKinsey & Company, a position that barely captures the impact he had on countless organizations.
We honor his legacy tonight as he lives on in the work that he championed and the people that he inspired.
Ladies and gentlemen, in memoriam, Tinu Puri, who really set up McKinsey in India.
We now honor the memory of another remarkable leader, Sanjay Kapoor, Chairman Emeritus of Sona Comstar.
Under his stewardship, Sona Comstar became a powerhouse in automotive components, setting new standards in innovation and in quality. Sanjay's entrepreneurial vision and commitment to excellence have left a lasting legacy in India's manufacturing sector.
Well, ladies and gentlemen, it is our proud privilege to honor at the India Business Leader Awards for the second time the outstanding contribution to the cause of sport, not just in India but globally, Jay Shah. Thank you very, very much, sir, for joining us here this evening.
Ladies and gentlemen, a huge round of applause for Mr. Jay Shah.
Mr. Shah, please, the podium is all yours, sir.
Thank you, CNBC 18, for this honor and respect. And I would like to dedicate this award to all the athletes, especially women athletes who are working hard on the field. सबसे पहले सूर्या, गौती भाई और सारे टीम इंडिया के प्लेयर, मैं आप सबको बहुत बहुत बधाई देना चाहता हूँ। जब मैं बीसीसीआई में था, तब मैंने 2028 के ओलंपिक तक प्लानिंग की थी, लेकिन सूर्या मैं भी चला गया, मैं आईसीसी में आया, मेरी जगह बीसीसीआई में और लोग आए। आप सबको मिलके 2030 की भी तैयारी करनी है, 2032 की भी तैयारी करनी है, 2036 कहाँ आने वाला आपको मालूम है, उसकी भी तैयारी करनी है। फिर से पीयूष जी, आपका बहुत बहुत धन्यवाद। CNBC न्यूज़ 18, आपको भी बहुत बहुत धन्यवाद। जय हिंद, जय भारत, वंदे मातरम।
Thank you very much, Mr. Shah, for joining us here. Ladies and gentlemen, a big round of applause. He set the agenda all the way to the 2036 Olympics. Thank you very much, sir, for joining us here this evening. The Excellence in Sport Award recognizes the person and the team that creates those conditions. This year, the Excellence in Sports Award goes to Gautam Gambhir, the head coach of the Indian cricket team. Please join me in welcoming him on stage. Ladies and gentlemen, a big round of applause for Gautam Gambhir.
The Sports Leader of the Year award goes to Surya Kumar Yadav, captain of the Indian T20 cricket team. 360 degrees with the bat, ladies and gentlemen. Please welcome Surya Kumar Yadav with a huge round of applause. Unflappable with the armband, and 6 days ago, a World Cup winning captain in front of his home crowd. There is nobody quite like him in the world of cricket right now. Sky 360 degrees on the field, but let's get a full picture of it too. Over to you, Shireen.
What is the captaincy mantra? What is your leadership style as a captain? You know, you're a 360-degree player, but what is it that you believe is your true mantra for success and strength?
I feel irrespective of what happens on the ground or on that field, when you come out of the field, you're just another man, or you're just another woman when you're playing that game. So you can't carry, irrespective if you're doing well, not doing well, to your home, to your friends, to your family, just leave it on the ground. All those small things, I think that really matter to me. And that dressing room, I think it's very important to hear everyone out. The freedom of speech, that is very important, that dressing room. We listened to everyone, what they wanted, but yeah, at the end of the day, the goal was same.
Mr. Shah has laid out the agenda all the way to 2036 on what needs to be done by the team. What's next? What are you working towards?
I think after this, definitely 2028 LA Olympics is definitely on the cards because that cricket is entering in that event for the first time. It is going to be very special. Yes, we relax for a bit for some time, but then we start our journey to achieve something special in 2028.
Olympic gold?
Definitely Olympic gold is on the cards, yes.
And Olympic gold. Sky, thank you very, very much for joining us here this evening. Ladies and gentlemen, a big round of applause for the Indian skipper. Ladies and gentlemen, tonight is also special as we mark a moment of change at CNBC TV 18. After 26 years, we say goodbye to the CNBC Peacock. It has been much more than just a logo. It's been a daily reminder of what we stand for: accuracy, insight, and actionable information. Well, that is the new logo, and that is what you need to look for when you look for CNBC TV 18 on your television screens, and of course find us online as well. Our next category, the Young Turk Startup of the Year, celebrates audacious ambition backed by flawless execution. This award recognizes a company that has helped define one of the fastest growing sectors in India's digital economy, quick commerce.
And the Young Turk Startup of the Year award goes to Zepto. And we invite the co-founder and CEO, Adit Palicha, to please come on stage to accept the award. Now, in just a few years' time, Zepto has built a dense network of neighborhood fulfillment centers, reimagining how urban consumers access everyday essentials, turning near-instant delivery from an experiment into a very scalable business.
What has it taken to build Zepto, and what is the grand vision? What's the grand plan from here on?
Look, I think, although from the outside our business might look, very interesting, 10-minute delivery, consumer internet, the reality is that we're actually in a paisa by paisa business. It's all about, deep cost execution, driving operating leverage within the same inputs of our supply chain, getting more and more margin leverage. So it's a, basis point by basis point execution business. So it's just about, keeping your heads down, day-to-day running the business, and driving the needle, a little bit here and there. I think for us, we feel like if we can get to, enough scale and drive our cost structure to a low enough point over the next, couple of years, I think we have a real shot at building a, exciting, dynamic, generational company in India. And hopefully, what keeps us motivated as a team is that, why can't we build an internet and e-commerce company as good as the global best? There are, world-class companies out there that have created, amazing stories in capital markets that have driven growth in their respective countries for decades. Companies like Amazon or Mercado Libre or Coupang, across the world. So if we can do that, if we can be a great story of Indian excellence in internet, then, we'd be happy to be a small part of our growth story. So that's the thinking.
Well, Adit, at this age, the scale is truly remarkable. Many, many congratulations to the entire Zepto team.
A real young Turk there. Well, some leaders don't just build companies, they build Brand India. The Outstanding Contribution to Brand India Award recognizes someone whose work has elevated India's standing in the global business community. The Outstanding Contribution to Brand India Award goes to Vivek Chand Sehgal, the chairman of Madison Group.
Ladies and gentlemen, a big round of applause for Mr. Vivek Chand Sehgal, a company that was started in 1976, quite literally by him and his mother, and today is operating across 50 different countries or 40 different countries with a plethora of acquisitions that they've done. And taking forward what we just heard there from the Commerce Minister, Mr. Piyush Goyal, Mr. Sehgal is a true embodiment of what the Commerce Minister was talking about, of Indian companies looking to global markets. How did you get it all done, sir?
It's a long story, 50-year-old story. But I think the cornerstone of mother-son is BY. Buy yourself, beat yourself. You don't have to compete with anybody. Just keep listening to the customer and do the right thing, and you're there.
Many congratulations, Mr. Vivek Chand Sehgal, on your outstanding achievement and for putting India firmly on the global automotive map. Moving on, the Outstanding Company of the Year recognizes an organization that exemplifies excellence across every dimension. This year's winner carries a legacy of over 7 decades, but remains as relevant and dynamic as ever.
The Outstanding Company of the Year award goes to Mahindra & Mahindra. Please welcome Dr. Anish Shah, Group CEO and Managing Director of Mahindra & Mahindra, on stage to come and receive this honor. From tractors to SUVs, farm equipment to aerospace, they've demonstrated that diversification backed by excellence creates some enduring value.
Ladies and gentlemen, a big round of applause for Team Mahindra.
And now, our highest business leadership recognition for the evening, the Entrepreneur of the Decade, honors someone who has shaped an entire era of Indian enterprise.
Ladies and gentlemen, the Entrepreneur of the Decade is Kumar Mangalam Birla, Chairman, Aditya Birla Group, one of India's most respected and diversified conglomerates. Please join me in welcoming him with a huge round of applause.
Mr. Birla's leadership has been defined by strategic vision, ethical governance, and deep commitment to nation building.
The Entrepreneur of the Decade, ladies and gentlemen, Kumar Mangalam Birla. Mr. Birla, the numbers tell the story. The decade that you've steered the group through, why don't you share that with us?
So before that, Shirin, I'd like to just thank the people who have really, because of who I stand here today. Firstly, I don't know how many of you know, but Piyush is a CA, and he's a silver medalist. I too am a CA, but I just kind of made it. So admiration for him goes back a very long time, and it's great to receive this award from a dynamic minister and someone who's a dear friend. I want to thank CNBC. I was racking my mind. I think I got your Best Leader of the Year award about 10 years ago. CNBC clearly believes in long-term investing. Entrepreneur of the Decade, I must say, is a bit of a misnomer for us at the Aditya Birla Group. We believe in a more distributed model of leadership where leaders across the length and breadth of the company take fairly large entrepreneurial bets fairly regularly. And therefore, with a heart full of gratitude, very happy to take this on behalf of a very large group of very committed and very talented entrepreneurs. The last 10 years, I think that it's been they say that, a week is a long time in politics. And it would be fair to say now that a day is a long time in politics. But I always feel that a decade is a remarkably short time in business. Having said that, in the last 1 decade, we have grown rapidly. We have grown on the back of the Indian economic boom. We have also scaled up our businesses to global leadership positions.
Congratulations, ladies and gentlemen, the Entrepreneur of the Decade, Kumar Mangalam Birla. A big round of applause. On that note, may I request all the other winners to join Mr. Birla and Mr. Goyal on stage. We're going to get all the winners back, sir, for a quick photo opportunity. May I request all the winners to please come back up on stage for a quick photo opportunity.
May we have another round of applause?
A huge round of applause, ladies and gentlemen. One last time, all our winners on stage. Good evening, ladies and gentlemen, and welcome to the India Business Leader Awards. It's great to see all of you here, and it's wonderful to have a packed house on a Saturday evening in Mumbai. Ladies and gentlemen, 21 years ago when we started the India Business Leader Awards, and yes, I have been here for all 21 editions of these awards, a post-liberalization India. Thank you. I feel a bit old now, but with that out of the way. As I said, a post-liberalization India was starting to explore new possibilities, bite into new opportunities, adopt technology, and really open itself up to the world. And while the size and scale of the ambition and the scale of the enterprise has changed, what has remained constant for those that we have honored year after year for the last 21 years is the desire to create institutions with enduring values. Roosevelt said the credit belongs to the man who's actually in the arena, whose face is marred by dust and sweat and blood, who strives valiantly, who errs, who comes short again and again, who knows the great enthusiasms, the great devotions, who spends himself in a worthy cause, who at best knows in the end the triumph of high achievement, and who at the worst, if he fails, at least fails while daring greatly. And that spirit of courage and commitment is what the India Business Leader Awards have celebrated for 21 years. And tonight, we add another chapter to this story. Welcome once again to the Standard Chartered Presents India Business Leader Awards. Thank you all for being here, and many, many congratulations to our winners. May you continue to excel, and may you continue to find success in all that you do. Ladies and gentlemen, have a wonderful evening. Thank you very much again. We begin the awards with a category that reminds us what human potential truly looks like. The Special and Para Sports Leader of the Year recognizes excellence achieved through discipline and sustained performance at the highest level.
And the winner in this category for 2025 is Simran Sharma, Paralympic athlete. May I request Simran to please join us on stage for her outstanding international achievements and her inspiring contribution to Indian sport.
Relentless resilience and remarkable performances on the international stage, he has not only brought pride to India, but also redefined what perseverance truly looks like in sport. Moving on, entertainment has the power to move us, to make us think, to stay with us long after the credits roll. The Entertainment Leader of the Year recognizes someone who has created work that transcends the screen.
This year, the Entertainment Leader of the Year award goes to Rishabh Shetty, actor and director. Let's welcome him onto the stage with a huge round of applause.
With a story rooted in tradition and folklore, he created Kantara, a cinematic phenomenon that resonated far beyond its origins. While it shattered box office records, its true achievement lay in how deeply it connected with audiences across languages, regions, and generations, reminding us of the enduring power of authentic storytelling.
एक dialogue हो जाए. One before you go.
Dialogue तो कन्नड़ में होगा. Okay. ನಮ್ಮನ್ನು ನೋಡ್ಲಿಕ್ಕೆ ನೀವು ಬಂದಿದ್ದೀರಿ, ನಿಮ್ಮನ್ನು ನೋಡ್ಲಿಕ್ಕೆ ನಾವು ಬರಬಾರ್ದಾ? Thank you.
Shetty, thank you so much. Ladies and gentlemen, a big round of applause for our Entertainment Leader of the Year.
Moving on, our next award is about promise and potential. While India's energy transition is one of the most consequential stories of our decade, this award recognizes a company that is writing a significant chapter in it. The Most Promising Company of the Year award goes to Torrent Power.
And we invite Jigish Mehta, whole-time director of Torrent Power, to please come and join us on stage. Congratulations to you, Mr. Mehta.
Now, the Torrent Group has built a strong presence across the power value chain, from generation and transmission to distribution, while accelerating its push into renewable energy and supporting India's journey towards a cleaner, more resilient energy future.
Ladies and gentlemen, the Most Promising Company of the Year, many, many thanks for joining us here this evening.
We'll move on, ladies and gentlemen. The Breakout Brand of the Year is one of our most exciting categories. It celebrates a brand that has captured the market's imagination, disrupted established norms, and achieved phenomenal growth in a very short span of time.
And this year, the Breakout Brand of the Year award goes to Rare Rabbit. Please welcome the founder and CEO Manish Poddar to receive this honor. In just 10 years, Rare Rabbit has built an entire fashion ecosystem under the House of Rare, men's, women's, kids and footwear, with over 1,200 points of sale and 200 premium standalone stores across the country. A homegrown label that has achieved what very few Indian fashion brands have managed at this scale.
When I manifested 10 years ago to start a brand of fashion in India, I did not even emphasize that I will stand someday here. I would like to take this opportunity to tell Sir that manifestation has been so kind to me that my father on his dying bed spoke about you. And he said, "Kaam karo, bado ek din aayega ki Birla ji se award loge." And I cannot tell you what are the odds that I am standing in front of his family with him by my side and my father above and my wife, the CEO of my life, who is watching me. And you cannot even imagine why and how. It is unbelievable.
Well, up next, the Lifetime Achievement Award is perhaps our most significant recognition of the night. It honors a career of excellence, a lifetime of impact, and a legacy that is going to inspire generations to come. The Lifetime Achievement Award 2025 goes to Dr. Anand Deshpande, the founder, chairman, and managing director of Persistent Systems. Sir, thank you for joining us here on stage. A huge round of applause for him, ladies and gentlemen.
Well, here's the man who saw the future of technology when most of India was just waking up to it. He built Persistent Systems into a global technology powerhouse, enabling digital transformation for businesses worldwide. His vision, leadership, and commitment to innovation have made him one of India's most respected technology entrepreneurs. Once again, ladies and gentlemen, a huge round of applause.
Mr. Deshpande, congratulations once again, and thank you so much for joining us here. Let me take this moment, since this is a conversation about leadership, it's a conversation about excellence, it's a conversation about design in action, in motion. We've got with us the Global CEO of Ferrari, who's here with us at the CNBC TV 18 India Business Leader Award. So let me come across to you, sir. What is your leadership mantra?
What is a leadership mantra? It's very simple. Learn from everyone, everywhere, because so far I never met a person so ignorant I couldn't learn anything. In these 3 years, there is one thing that I learned a lot, that is a good representation of the purpose of our company. And you say, "Hoga kaise nahi." I think this is...
That does deserve a big round of applause. Hoga kaise nahi.
It's very nice, because we say in English, we say we audaciously redefine the limit of possible. But Hoga kaise nahi, I discovered yesterday, I think is much shorter, is better, more effective. So this is what I learned in this trip here.
Hoga kaise nahi. Thank you very, very much, ladies and gentlemen, the Global CEO of Ferrari.
Ladies and gentlemen, we come to one of the most prestigious. The Hall of Fame is reserved for those rare individuals whose contributions have fundamentally shaped the industries and touched millions and millions of lives.
The IBLA Hall of Fame posthumously honors PSU Bank.
Bhaiya, I love you.
Prestige has become more than a brand. It became a promise that Indian manufacturing can compete with the very best in the world. The IBLA Hall of Fame posthumously honors Mr. T.T. Jagannathan tonight.
Moving on, we now take a moment to remember and honor a remarkable leader who left us too soon. Anupam Nupuri was Senior Partner Emeritus at McKinsey & Company, a position that barely captures the impact he had on countless organizations.
We honor his legacy tonight as he lives on in the work that he championed and the people that he inspired.
Ladies and gentlemen, in memoriam, Tinu Puri, who really set up McKinsey in India.
We now honor the memory of another remarkable leader, Sanjay Kapoor, Chairman Emeritus of Sona Comstar.
Under his stewardship, Sona Comstar became a powerhouse in automotive components, setting new standards in innovation and in quality. Sanjay's entrepreneurial vision and commitment to excellence have left a lasting legacy in India's manufacturing sector.
Well, ladies and gentlemen, it is our proud privilege to honor at the India Business Leader Awards for the second time the outstanding contribution to the cause of sport, not just in India but globally, Jay Shah. Thank you very, very much, sir, for joining us here this evening.
Ladies and gentlemen, a huge round of applause for Mr. Jay Shah.
Mr. Shah, please, the podium is all yours, sir.
Thank you, CNBC 18, for this honor and respect. And I would like to dedicate this award to all the athletes, especially women athletes who are working hard on the field. सबसे पहले सूर्या, गौती भाई और सारे टीम इंडिया के प्लेयर, मैं आप सबको बहुत बहुत बधाई देना चाहता हूँ। जब मैं बीसीसीआई में था, तब मैंने 2028 के ओलंपिक तक प्लानिंग की थी, लेकिन सूर्या मैं भी चला गया, मैं आईसीसी में आया, मेरी जगह बीसीसीआई में और लोग आए। आप सबको मिलके 2030 की भी तैयारी करनी है, 2032 की भी तैयारी करनी है, 2036 कहाँ आने वाला आपको मालूम है, उसकी भी तैयारी करनी है। फिर से पीयूष जी आपका बहुत बहुत धन्यवाद, CNBC न्यूज़ 18 आपका भी बहुत बहुत धन्यवाद। जय हिंद, जय भारत, वंदे मातरम।
Thank you very much, Mr. Shah, for joining us here. Ladies and gentlemen, a big round of applause. He set the agenda all the way to the 2036 Olympics. Thank you very much, sir, for joining us here this evening. The Excellence in Sport Award recognizes the person and the team that creates those conditions. This year, the Excellence in Sports Award goes to Gautam Gambhir, the head coach of the Indian cricket team. Please join me in welcoming him on stage. Ladies and gentlemen, a big round of applause for Gautam Gambhir.
The Sports Leader of the Year award goes to Surya Kumar Yadav, captain of the Indian T20 cricket team. 360 degrees with the bat, ladies and gentlemen. Please welcome Surya Kumar Yadav with a huge round of applause. Unflappable with the armband, and 6 days ago, a World Cup winning captain in front of his home crowd. There is nobody quite like him in the world of cricket right now. Sky 360 degrees on the field, but let's get a full picture of it too. Over to you, Shireen.
What is the captaincy mantra? What is your leadership style as a captain? You know, you're a 360-degree player, but what is it that you believe is your true mantra for success and strength?
I feel irrespective of what happens on the ground or on that field, when you come out of the field, you're just another man, or you're just another woman when you're playing that game. So you can't carry, irrespective if you're doing well, not doing well, to your home, to your friends, to your family, just leave it on the ground. All those small things, I think that really matter to me. And that dressing room, I think it's very important to hear everyone out. The freedom of speech, that is very important. That dressing room, we listened to everyone, what they wanted, but yeah, at the end of the day, the goal was same.
Mr. Shah has laid out the agenda all the way to 2036 on what needs to be done by the team. What's next? What are you working towards?
I think after this, definitely 2028 LA Olympics is definitely on the cards, because that cricket is entering in that event for the first time. It is going to be very special. Yes, we relax for a bit for some time, but then we start our journey to achieve something special in 2028.
Olympic gold?
Definitely Olympic gold is on the cards, yes.
And Olympic gold. Sky, thank you very, very much for joining us here this evening. Ladies and gentlemen, a big round of applause for the Indian skipper. Ladies and gentlemen, tonight is also special as we mark a moment of change at CNBC TV 18. After 26 years, we say goodbye to the CNBC Peacock. It has been much more than just a logo. It's been a daily reminder of what we stand for: accuracy, insight, and actionable information. Well, that is the new logo, and that is what you need to look for when you look for CNBC TV 18 on your television screens, and of course find us online as well.
Our next category, the Young Turks Startup of the Year, celebrates audacious ambition backed by flawless execution. This award recognizes a company that has helped define one of the fastest growing sectors in India's digital economy, quick commerce.
And the Young Turks Startup of the Year award goes to Zepto. And we invite the co-founder and CEO, Adit Palicha, to please come on stage to accept the award. Now, in just a few years' time, Zepto has built a dense network of neighborhood fulfillment centers, reimagining how urban consumers access everyday essentials, turning near-instant delivery from an experiment into a very scalable business.
What has it taken to build Zepto, and what is the grand vision? What's the grand plan from here on?
Look, I think, although from the outside our business might look, very interesting.